Hello all, this is your tax guru CSMA Manidi. First of all, a big thank you to all the students who made the part 1 literally like a wildfire. Within one day, it reached almost 6,000 plus views. And then the response you given to that video is like tremendous. It's okay. So now, what I even said this in the part 1 also. Once again, I'm repeating the same words. Sir, in this series, I don't discuss just the concepts on a lighter note, sir. I went in depth. I explained each and every concept. Problems also we have discussed extensively. Almost 90% of the problems also has been covered. So make use of this series effectively and share with your friends also without fail. Then, sir, why I am doing this? I'm again mentioning, sir, there is no income tax act 2025 coming from June 2026 exams. So before it comes, you guys have to clear your group 3. Okay, so either June attempt or December attempt, I don't know which attempt you're writing, but definitely you should use these videos effectively and clear the exams. Now, what I want from you, sir, I have seen part 2, so many students like from different locations of the country, they have been messaging on the video. The same I'm expecting from this also. For this part 2 video also, don't forget to like this video. Okay, first pause it and like this video also. Don't forget to like this video and comment on this video from where you are watching. And then if any other topics you want me to cover also, or if you have any doubts also, you post that. You can go back and see the part 1 also. I've been responding to each and every comment of you. Okay, so don't forget to comment from where you are watching, and if you have any issues, queries also, don't forget to comment. I'll be there responding to them personally, right? Now, coming to the part 2, sir. In part 2, sir, out of all the parts which I'm going to release, part 2 is the crucial. Part 2 alone can decide your paper. This particular set of series, I mean, this 10 11 hours of content, if you could prepare properly, conceptually, if you are clear, this itself will decide your paper. Okay, from this itself, you can get 40 marks. See, sir, I'm going to cover return of income. Sir, return of income, I said, basics, deductions, return of income, these are fundamentals. Okay, certain fundamental topics are there. So, these chapters we are not learning just for weightage. These acts as a foundation for some other chapters. That's why we are learning. So, return of income, the weightage may be less, but don't skip that. Then, tax planning. Sir, tax planning chapter, people think like, okay, we'll leave part 1 and we'll come to part 2 and we'll start doing the tax planning questions and all. Sir, you don't trust me, fine, but go back and see the past examination questions. Go back and check June 25, December 25, June 24, December 24. Check these exam questions. You only will identify that basics is relevant, deductions is relevant, PGBP provisions are relevant. If you don't learn these, then tax planning for namesake only you are learning. So tax planning questions are like one of the easy questions. One of the easy questions, sir. I mean, easily out of this 14 marks, you can get 10 marks in any case also. Okay, one question you can get 7 out of 7. The other question, sir, in a nor if the paper is average, now both the questions you will get 7 out of 7 or at least 6 out of 7. If it is like little complicated also, one question you can answer and another question partly you can answer, then also you're gonna get 10 marks. So tax planning. So for tax planning chapter, you just can't do by opening the tax planning chapter and the relevant questions. You should have strong basics. Sometimes even like a capital gain point, IFOS points also will come. Okay, but those points we cannot cover anyhow. Okay, but at least PGBP deductions basics part, if you study properly, then only tax planning you can do effectively. Okay, so take this seriously, sir, and learn it. I'm sure that you're gonna learn PGBP even if you start now also. Then DTA. Sir, again, double taxation avoidance agreements. There are two questions being asked. One is theory question, one is problematic question. Again, if you don't know basics and the deductions part, then again DTA is also, it's like waste. Some simple tax calculation mistakes only. Here both the places you do only simple tax calculation mistakes only wrong. Then transfer pricing. From transfer pricing, the weightage is like 25 marks. 25 marks, sir. So again, sir, very important topic, sir. Like what? 3 7 marks questions are being asked and 2 MCQs are going to be asked. I have covered each and every concept, each and every corner from the transfer pricing, including the amendments also. So now what you have to do? And then like cup method, resale price method, everything I have explained detailedly. Logic also I have written there. You also, like when we are solving questions, pause it and then analyze on your own once again and try to write down the logics once again on your own. Definitely you're gonna get 40 from this place itself if you target properly. Then part 3, sir, within like 36 to 48 hours from the time we release part 2, I'm gonna release even part 3 also. Part 3 covers advanced tax ICDS, then business restructuring and NR tax. Okay, so I'm not leaving anything, sir. I'm gonna cover everything. Okay, if you want anything extra also, comment on this video. Definitely this time you have to succeed. That's what I want. And don't forget to like this video and comment from where you are watching this lecture.
Return of income chapter also will not have a 7 marks question. There is a chance of asking it for MCQ only. Okay, but it acts as a base for many other chapters because many times we'll be referring like due date for return of income. Okay, so that's why first we should learn this irrespective of the weightage. Return of income. Section 139 subsection 1. It's about filing of return of income. Who has to file return of income? Okay, that one. Mandatorily. Who has to file mandatorily? If it is a company, if it is a firm, including LLP, they should file return of income mandatorily, irrespective of what is their total income, whether they are having profit, whether they are having loss, that all irrelevant. If it is a company, if it is a firm or LLP, it has to file return of income mandatorily. First one. Then, what about others? Others, na? Individual, HUF, AOP, BOA, local authority, artificial judicial person. When those people has to file return of income, when their gross total income exceeds a basic exemption limit. What is basic exemption limit, sir? It depends on the regime you took. Default regime na 4 lakhs. Old regime means 2.5 lakhs. If you are senior citizen means 3 lakhs. Super senior citizen means 5 lakhs. So depending on the type of individual, his applicabilities, we should check whether gross total income, not net total incomes are here. What is the difference between gross and net? Gross na after subtracting chapter 6A deductions and 10AA exemption. Okay, so where net means after subtracting chapter 6A and 10AA. Gross means what? Just the aggregation of incomes under different heads, apply clubbing provisions and apply set off and carry forward of losses, you'll get gross total income. Such gross total income, if it exceeds basic exemption limit or not, we should check. Then this gross total income also, sir, this is much more important. Sir, these are exemptions under capital gains. 54, 54B, 54D, 54F, 54EC, 54H, 54G. All these are exemptions under capital gains. Let's say, sir, I have long-term capital gain of 75 lakhs. But I invested within 6 months in RECL bonds or NHA bonds, then I'm eligible for exemption under 54EC. Let's say 40 lakhs I have invested. So 54EC exemption I'll get of how much? 40 lakhs. So what is my net taxable capital gains? 35 lakhs. So what happens, sir? I'll take to the total income only 35 lakhs. But here what they are saying, like before giving this exemption, that means capital gains will be there in the statement actually 35 lakhs. But you should rework. I mean, you should add back the 40 lakhs. Okay, then you'll again get the gross total income. Such gross total income you should take. So simple thing. If capital gain is there, check whether that capital gain is after exemption or before exemption. If it is after exemption, you should make it again what? Before exemption. Nothing but that exemption amount you should add back. Such gross total income you should check whether it exceeds basic exemption limit or not. If it exceeds basic exemption limit, then return has to be filed. Otherwise, as of now, not required. Problem break and off చేశారేమమ్మా మీరు ఏసీ క్లాస్ స్టార్ట్ అవ్వడం అంటే వేసేయండి ఓకేనా ఒకవేళ మర్చిపోయి ఏసీ చెప్పినా సో క్లాస్ చెప్పడానికి నేను అంటే నేను ఎగ్జాస్ట్ అయ్యేదానికంటే మీరు ఏసీ లేకపోతే డబుల్ ఎగ్జాస్ట్ అవుతాం సో 2 రీజన్ ఒకటి ఆక్సిజన్ తగ్గిపోద్ది రూమ్లో సో నేను ఇంకా ఎక్కువ స్ట్రెయిన్ అయిపోతూ ఉంటాను సో కాబట్టి ఏసీ మ్యాక్సిమం ఆన్లోనే ఉంచండి ఆక్సిజన్ తగ్గిపోతుందంటే ఫ్రీగా వెంటిలేషన్ జరగదు కాబట్టి So then, sir, first 2 cases, most of the people will get covered. First one is what? Company, firm, LLP. No choice at all. Okay? Being a company itself, they have to file return of income. Then others, when their gross total income, before giving what? 54 series exemptions, exceeds basic exemption limit, then they have to file return of income. Second one also done. Now, sir, third one and the rest all the categories will go only if they are not covered under the first and second point. Okay. Now, third point. He is a ROR. ROR means resident and ordinary resident. But sir, resident and ordinary resident. he's a resident and ordinary resident, mostly individual only. Here we are referring to individual only. He's an ROR. He doesn't fit into the second case. But still he has to file return of income when? If he is a beneficial owner of any asset. What is called a beneficial owner? Beneficial owner, na, for the purchase of that asset, you only given money. But officially you are not there. You are not the owner. Nothing but binami. Okay? The property is under a binami name. But you are the true owner. Then you are called as what? Beneficial owner of any asset, including financial interest. If they are located outside India, so you are beneficial owner of what? Beneficial owner of a property which is located outside India, and you have a signing authority outside India. I mean, you have a bank account, you have a signing authority outside India. Then, irrespective of your total income, you should file return of income. Understand, sir? Sir, if your total income exceeds basic exemption limit, by second point itself, you are applicable for filing return of income. But let's say your total income you claim like less than basic exemption limit. But still, if you are beneficial owner of any property which is located outside India and you have some signing authority outside India, then also you should file return of income. First thing. Second one. Sir, you are not beneficial owner. Okay, but you are a beneficiary of an asset which is located outside India. Sir, what is beneficiary? Property not purchased by you, not acquired by you. Someone purchased the property. For that property, maybe they kept under the trust. Okay, let's say, sir, the property was purchased and the property was given to the trust. So trust will take care of the property. But for that property, who is the beneficiary? This individual is the beneficiary. I mean, whatever the income earned from that property, that has to be applied for the benefit of whom? This beneficiary. Then such beneficiary is also applicable. Is also have to file return of income. Understand, sir? If you are a beneficial owner of any property located outside India plus signing authority, or if you are a beneficiary of any asset located outside India and you are resident and ordinary resident, then you have to file return of income, even though your total income is within basic exemption limit. Right, is a beneficiary of any asset located outside India. Then, fourth case, sir. Sir, first three cases not applicable. Then these things. If you have entered into these special transactions, then also you are applicable to file return of income. Aggregate of deposits made rupees 1 crore greater than rupees 1 crore in current account of bank or cooperative bank. Okay, your total aggregate deposits in current account is more than how much? 1 crore. Okay, sir, you have 1 crore deposits, and if you are saying like your total income is less than basic exemption limit, now department does not want to trust you. So that's why they are asking what? First file return of income, then we'll check. Okay, whether applicable or not. Then this is current account now. What is the limit, sir? 1 crore. If it is savings bank account now, 50 lakhs is the limit. In savings account, if the deposits are more than 50 lakhs, in current account, the deposits are more than 1 crore. In both the cases, irrespective of your total income, you are required to file return of income. Then your foreign travel expenditure is greater than 2 lakhs. You are saying like you don't have income exceeding basic exemption limit also, but you are going to Maldives, going to Bangkok, all foreign travel you are doing, and your expenditure is that expenditure is also more than 2 lakhs. Then again you should file return of income. Then third one, your electricity expenditure in a year is more than 1 lakh. Sir, if your total income itself is within 2.5 lakhs or 4 lakhs now, how can you pay every year 1 lakh electricity bill? So again they are having a doubt. You should file what? Return of income. Then if you are into business and your turnover or sales exceeds 60 lakhs, if you are into profession, your turnover or sales exceeds 10 lakhs, okay, then the aggregate amount of TDS or TCS deducted for you in a previous year exceeds 25,000. In all these cases, you need to file return of income. Once again, I am repeating, sir. Current account now, how much deposit? More than 1 crore. Savings account? More than 50 lakhs. Then electricity expenditure more than 1 lakh. Foreign travel expenditure more than 2 lakhs. Then turnover. Business now more than 60 lakhs. Profession means more than 10 lakhs. And in the current year, I mean in that particular previous year, the total of TDS deducted or TCS collected is more than 25,000 for you. Then also you should file return of income, even though your total income is within basic exemption limit. Sir, is it clear till now? Who has to file return of incomes? Okay. Then other entities means like trust, political parties, research associations, universities, colleges and all. So these are covered by these specific sections like 139, 4A, 4B, 4C, 4D, 4F. Okay. You need not remember section numbers also. 139, if you remember, it is enough. Okay. Trust. Gross total income for a trust, sir. Trust na charitable trust kind of. Their gross total income before giving section 11 and 12 exemptions exceeds basic exemption limit. Okay. Their total income before giving section 11 and 12 exemptions exceeds basic exemption limit. Then also they have to file return of income. Political party. Their gross total income exceeds basic exemption limit before giving the exemption under section 13A. Okay. For political party, the exemption is under 13A. For trust, the exemption is under section 11 and 12. Before giving these exemptions for trust and political parties, their gross total income exceeds basic exemption limit. Then return has to be filed. Then research association, news agencies or institutions. Okay. Research associations, news agencies, mutual funds, many other things also covered, sir. But the total income before exemption under section 10, they'll have some exemptions, but before giving that exemption for research associations, news agencies and all, exceeds basic exemption limit, then they also have to file return of income. Then universities, colleges, associations, business trusts, investment funds, for these, sir, irrespective of their total income, they should file return of income mandatorily. So mandatory people are not only just companies and firms. Even universities, colleges, associations, business trusts, investment funds also has to file return of income mandatorily irrespective of their total income. Understand? Okay. Once again, I am repeating some of these things. Trust. before giving section 11 and 12 exemptions if it exceeds basic exemption limit. Political parties before giving 13A exemption exceeds basic exemption limit. Research associations, news agencies, institutions before giving section 10 exemption exceeds basic exemption limit. University, college, associations, business trusts or investment funds, they have to file mandatorily. So once again, sir, the total we'll discuss. First, for whom it is mandatory? Company firms, and towards the end also we discuss something extra. Investment funds, universities, colleges, associations, business trusts. Okay, done. Then, when exceeds the basic exemption limit, all the other persons, if their gross total income exceeds the basic exemption limit before giving 54 series exemptions. Trust political parties now before giving section 11 and 12 or section 13A exemptions. Research associations, news agencies now before giving section 10 exemption, if it exceeds basic exemption limit, then also they have to file return of income. Then, resident and ordinary resident, if he is a beneficial owner of any asset located outside India plus he is having signing authority outside India, then also he has to file. If he is a beneficiary of any asset located outside India, then also he has to file return of income. Then if he enter into specified financial transactions, then also he has to file return of income. What are those? Current account deposits more than 1 crore in a year. Savings bank account deposits aggregately more than 50 lakhs in a year. Done. Then electricity expenditure more than 1 lakh in a year. Foreign travel expenditure more than 2 lakhs. Turnover. Business na 60 lakhs. Profession means 10 lakhs. Then the aggregate of TDS deducted or TCS collected in a year is more than 25,000. These are the cases when a person is required to file return of income. Then due date for filing return of income. Shahrukh Khan, yes, you can watch CFNL student also, but don't rely completely on this. Because I'll be covering only to the extent needed for CMA students as of now. And then one more thing, okay, we'll not be uploading the whole series of income tax. These are like demo classes. We'll upload only one more class in the YouTube. Then, due date for filing return of income. Due date for filing return of income for companies and to assessees to whom tax audit is applicable. And then third one, sir, important. If to firm tax audit is applicable, then for the partner also same due date, like the firm only. Okay, so 3 persons are applicable here. First one, companies. Second one, assessees to whom tax audit under 44AB is applicable. Third one, partner of a firm. For him audit is not applicable, but for the firm audit is applicable. Sir, understand? For firm audit applicable, only from when firm books are finalized, partner will get his share of income or share of profit, then partner return can be filed. That's why to firm if tax audit is applicable, then even to the partner, for the partner individual capacity, no audit, but still the due date remains same, 31st October of assessment year. If transfer pricing provisions are applicable under section 92E, they have to provide a transfer pricing report also. Okay, TP report. Okay, they have to get an audit if transfer pricing provisions are applicable, and they need to provide TP report, transfer pricing report. Then in such case, their due date is 30th November of assessment year. In simple, transfer pricing provisions applicable or not. If applicable, 30th November of assessment year. Otherwise, audit applicable, normal audit applicable, tax audit, or they are companies, or is a partner of a firm to which audit is applicable, 31st October of assessment year. Rest all covered under other cases. For them, the due date is 31st July. So now for individual, what is the due date? Now we cannot tell. The information is not enough. Individual, whether for him tax audit applicable or not. If applicable, 31st October. Otherwise, 31st July. For company, what is the due date? We cannot say straight away. For company, transfer pricing applicable or not. If transfer pricing provisions are applicable, 30th November. Otherwise, 31st October. To firm audit applicable or not is the first question. To firm audit is applicable, then for firm also 31st October, the partner of that firm also 31st October. To firm audit is not applicable, then to the firm also 31st July, to the partner of the firm also 31st July. Okay, it depends on whether audit applicable to the partnership firm or not. What happens if return not filed by due date? There will be 234A interest for delay in filing the return. Then 234F fees for delay in filing the return. What is the fees, sir? If the total income is up to 5 lakhs, then the fees is 1,000. If the total income is above 5 lakhs, then the fees is 5,000. So 234F. What is the fees, sir? Total income up to 5 lakhs, na fees is 1,000. Above 5 lakhs, na the fees is 5,000. So 234 na again we'll discuss in advanced tax. 234F I will not discuss once again. So remember it clearly. For delay or for late filing in return, what is the late fee? 234F. 234F. Total income within 5 lakhs, na 1,000. Total income above 5 lakhs means 5,000. Understand? Sir, every day you should revise, sir. Otherwise, maximum you can retain yesterday's class. Okay, if I go back to 3 days back, 4 days back, then everything gone only. So how many times you listen to fast track, it will be of no use unless you revise. Okay, group, if you are alone, if you are doing single group now, then you are listening to the class for almost 2.5 hours. Then again, at least 1.5 hour if you allocate only, then you can revise. Okay, still, sir, even with that 1.5 hour revision also, you'll forget some points. Okay, if you don't even revise that 1.5 hour, then by the time we go to 20th day or 21st day, then all the first, second classes, these basics, if I ask, then you will not even remember, you cannot even recall. Okay, then this is only March. By the time we go to May, then you will be in a position like, did I took coaching also? If return of income is not filed, sorry, if return is not filed, then what they'll do? They'll compute income or they'll assess your income with the information available with them. That itself is called as what? Best judgment assessment. Sorry, if you write exam, then they can evaluate. Okay, if you file a return, then they can check whether you did correctly or not. You not even written, you not even filed return, then they do what? Whatever is the information available with them, with that, they'll calculate. Okay, that itself is called as what? Best judgment assessment. And for non-filing of return, there can be even penalty under 271F. Sir, how do I furnish return? Can I send in WhatsApp? Okay, WhatsApp, Telegram, or else like can I write a letter? So what is the mode of filing return? The mode of filing returns are paper format, sir, which is mostly discontinued now. There is no paper format except only one case is there where you can file paper form. In rest all the cases there is no such option. Then electronic return with digital signature. Sir, digital signature also we should attach for verification. Mostly in audit cases and company cases it is needed. Digital signature also has to be, DSC has to be attached. Normal individuals or firms for whom tax audit is not applicable, then you file return electronically but verify the return through ITRV. What? You'll file a return, then the manual ITRV will take printout. ITRV will take printout, then on that you will sign and send it to the CPC. Okay, manually you will send it to the CPC. And the last one, file written electronically, there itself will verify also. What? OTP will be sent to your Aadhaar linked mobile number, that OTP you can enter. Or else through net banking. Okay, in your bank portal there will be one EVC code will be generated that you can enter. Okay, like that you can verify your return. One is paper format, directly filling everything and submitting in the income tax office. Mostly outdated, nowhere we saw that. Then electronic return with digital signature. Mostly who will do, sir? Not mostly. It is applicable for companies and to persons to whom tax audit is applicable. Then third case, file return online only. In the website portal only you will file return. After filing, two ways. How do you verify that? One thing, you download the ITRV acknowledgement, sign it manually or physically and send it to the CPC center, Central Processing Centers. Okay, mostly in South India, we'll send it to Bangalore. Okay, then filing return electronically, normally only, you file return online only, and there itself you'll get it verified. By entering that OTP or EVC code, you'll get it verified. These are the format of filing returns. Okay, so for whom DSC is needed? For companies, political parties, firm, LLP, individual and HUF. Sir, companies and political parties, na, irrespective of audit, they have to attach digital signature. But whereas for firm, LLP, individual, HUF, only when tax audit is applicable, they should file e-return along with digital signature. Then paper mode is available only for an individual whose age is greater than 80 and he is filing ITR 1 or ITR 4. ITR 1 he doesn't even have business income. ITR 4 he has business income but opted presumptive scheme. Then such person can file any mode. Any mode even paper form is also available, but even those people also we never saw filing paper form. Okay, then the last ones are any other person. Okay, any other person he can file through any of these three modes except paper form. Then 26 years. Sir, if you did articleship then you will not have any doubt about 26 years statement. But if you don't have any practical experience means, then obviously 26 years means you may think like accounting standard also, intangible assets. Okay, it's not accounting standard 26, sir. It is 26 years is a statement which is generated in the income tax portal. It will reflect, or by looking at the 26 years statement, you can see what is the TDS deducted for you, how much is the TCS collected from you, how much is the advance tax you paid. All these things will be reflected in the 26 years. Okay, so it reflects yearly basis, the advance tax, self-assessment tax, and even the normal assessment tax paid, the total tax paid. TDS, TCS deducted, if any refund issued, and then even from GSTR 3B, the total of all the months turnover will also get reflected in GSTR 3B. I mean, sorry, in GSTR 3B, you'll be showing your sales, right? The total of all those months sales will be reflecting in 26 years and details of any specified financial transactions like electricity expenditure or else foreign travel expenditure. Those kind of specified financial transactions will also be reported in 26 AS statement. Okay. I still remember, sir, when I joined office. So just 2 days, 3 days happened. They asked me to do an individual computation only. He has house property income and all. But I completely forgot by the time how to calculate house property and all also. Somehow I Googled, I did everything. Excel also I don't know because third day, fourth day, for me Excel almost like 15 to 20 times they send me back. Okay, do it this way, do it that way, because they were more particular about the formats also. The same border, same kind of uniformity, same text, same style, nothing has to be changed. Okay, 4 or 5 are like calculation mistakes. The other 10, 11 are like presentation mistakes. Yet finally, I thought it was confirmed. Then they asked like, did you check 26 years? I don't even know what is 26 years by that time. Okay, so then again I came back. I don't even know. I don't even process it properly. What is 26 years? He's talking about accounting standard now. What it is? How it is connected to him? Okay, then I came in the office. Then someone I asked like, what he's saying. Something like 26 and all, what is that related 26? Then they explain this is the 26A statement, it will consist of all this. We need to check mandatorily if you have to file a return of income. Okay, there shouldn't be mismatches between 26As and the return we're going to file. Okay, so that's why what you should understand is, sir, articleship is mandatory. Okay, so some people already started saying like, so we are doing CMA, but there are not that much opportunities. Opportunities are there, you are not meeting the skill standards of industry. Why you are not meeting skill standards? Because you're simply focusing on clearing CMA foundation, CMA inter, then again CMA final. Sir, understand, after some point of time, certificates alone will not give you the jobs. They obviously need whether you can do that work or not. Certificates are enough only for government companies, but for private companies, certificates can take you only to a level, to an extent. Okay, certificate can allow you to sit in the interview, but skills only can let you crack the job. Okay, so skill set are very important. You should, sir, I didn't did articleship, sir, but I already came to final, so what to do? Then you should be like a storyteller like Rajamouli. Gather the experience from your friends, narrate make a powerful story with all the twists, plots also, because they'll cross question you. If you say something, then based on that only they'll ask 5-6 series of questions in interview. So you should be super like, just like as Adi Seshu will write his story, right? Gudachari and all with more plot twists. If this happens, what happens? That happens, what happens? So like that, you narrate, you prepare a story and make yourself comfortable that you are telling it as if you're real experience with everything, okay, possibilities. That's what you can do. Okay, but that is not at all advisable, sir. Okay, if you are not did na, at least after writing exams, go and join. 3 months, 4 months also, at least gather that experience. That also, sir, to narrate this story, at least that 3-4 months experience will help you. Okay, in 3-4 months, 12 months is minimum, sir, because you'll complete the whole cycle once, so you'll understand what is happening. Okay, 2 years, 3 years, 1.5 years is mostly enough. Like CA articles, 3 years now, you'll not do much. But in CA articles, what you'll do now, first year you'll be as a junior article. Okay, you'll learn how to do. But by the second year, you'll learn how to manage the team also. Mostly, what they'll do, sir, you'll become senior, there'll be another junior articles, so you'll be training them. So you'll be knowing how to train them, how to manage them also. It's not about just learning the skill, it's even about managing a team also. So articleship is very much important. So if any of your friend or junior asks you about, should I do? Okay, they'll see how they'll come now, they'll come with emotionally. Sir, I already wrote inter 6 attempts or 4 attempts, 5 attempts. I already wasted 2 years, 3 years. Now again articleship now 1 more year. Okay, my family is already having so many problems I need to clear. Yes, all these are there. But understand, you cleared CMA final but not securing a job. Okay, no pain can replace that. Okay, so by the time you clear CMA final, you should have that internal confidence that I can do anything. Okay, maybe not this job, I can go for some other job. I have the required skill. That confidence you should get. When you will get, first you have that articleship experience and all, then sir, this qualification is not just about you securing a job. The qualification should give you the confidence that I can live anyway. If not job, I can start practice. If not practice, I can go for teaching, or otherwise I can do some any other thing. That's what the confidence should, the qualification should give you. Okay, so not like otherwise, sir, if the same thing happens, if the malpractice is happening, okay, within 3-4 years now, we'll make it as like a normal regular 10th in MBA degree or normal graduation degree only. Okay, first don't encourage the malpractices also. Even if your friends doing also, so I don't say like you only have to go and tell the invigilator, but you don't involve. You write on your own. Okay. Yes, you'll make quote me examples, sir. That fellow cleared with copying only, but still he got MNC job. He settled so much. Sir, that is one example only. There might be other 90 people who couldn't. Okay, there are almost 600-700 people debarred in the last attempt. Okay, they are not even eligible to write the next 2 attempts. Almost there. CMA journey came to a halt. So nobody talks about this. People who are debarred, sir. So that's why don't go into that one. We ourselves reducing our standards. Sir, how it happens now? If you go, I have seen practically. See, in COVID time, like 21-22, that time home-based online exams has been happened. So that time so many people cleared CMA final also. Okay, now I know few people who have cleared that time, and because of reservations and all, they got even in good PSU jobs also. But we know, I mean, see, some of my friends referred them also. See, in PSU and all, okay, he's our known student only, or known person only. If you could do anything, help him. So at the time of interviews and all, they have at least given some consideration and all. But later on, they started scolding us. Okay, what you sent this kind of people, they doesn't know anything. We thought CAs and CMAs, sir. Why? Because now in most of the places, CMAs are equivalent to CA roles. If you cannot do the same kind of job now, obviously they'll see separately. Okay, they'll come into a notion that CMAs doesn't have standards only. So understand, articleship is must. Whoever is your junior and all. Sir, I have seen many institutions. Once you cleared CMA internal, they'll start calling you. It is irrelevant only. You can join final classes, no issues and all. Sir, it is not at all correct only. You have to do articleship at least 9 months, 10 months. Okay, must. Sir, otherwise you cannot do anything confidently. See, for going interview also, you'll be so much afraid because you don't know what you'll ask and all. Sir, subject now you prepared already, but you don't have the answers for the practical questions you'll ask. See, if you already did articleship, now you can say confidently, I did this, I didn't know that one. Confidently you can say. Otherwise you may think like, oh, this one also they'll do now. You'll tell some kind of answers and you'll easily get caught. Okay, interviewers now, they are not someone who cannot test you. So based on your expressions only, they can tell you whether you are a whether you are having genuine experience or not. Okay. What study mat will be provided in fast track classes? Sir, for DT, 3 sets of books will be given. There is a concept book, there is a workbook. Concept book is named as Pulse, workbook is named as Applicator, and we have a class notes also, which is handwritten. Okay, the one file which I am discussing now. All these 3 printed books in color format will be given to you. But as of now, Pulse and Applicator are only being sent. Handwritten will take another 1 week or 5 days time from our side only. Then for the transportation and logistics another 5 days. So it takes at least minimum 10 days to for you to get the handwritten notes. Then section 139 1C. Section 139 subsection 1C. Exemption from filing return of income. Exemption from filing return of income. Sir, certain people are not required to file return of income also. Who? Central government can specify such class of persons. It has specified individual, resident, age greater than 75 years. Okay. Almost not super senior citizen, but age greater than 75 years. They are having only pension income and or interest income, or both. 75 years now already they are retired. They are having only pension income and interest income, or only pension income or only interest income. Those people are exempted from filing returns. Okay, and they should be what? Resident also. Both incomes, sir, look at the other condition. Both this pension income and interest income are credited in the same bank account. Same bank account, that also a scheduled bank, not any bank. Okay, then such person files a declaration also that I am not going to file return of income. Then what happens? Bank only deducts the TDS, how much ever he has to pay as tax. That tax will be calculated by bank, and bank only will deduct TDS for him under section 194P. So government got whatever is the tax needed in the form of TDS, so that person is exempted from filing return of income. So when he is exempted, sir? Individual, resident, age greater than or equal to 75, having pension income or pension and interest income, any both are there or any one of them is there, and both should be credited into the same bank account in a specified bank. And such person files a declaration, then bank should deduct TDS under section 194P. If bank deducted TDS under 194P, then only this person exempted from filing return of income. Then section 139 subsection 3, it is about loss return. Loss return. Sir, what we said, a person has to file the return only when his total income exceeds basic exemption limit. If I am having loss, then obviously my total income will not exceed basic exemption limit. Sir, this point will not applicable to company and firm. Because companies, firm and LLPs, mandatorily they have to file return of income irrespective of income or loss. But individuals, HUFs, AOPs, they have to file return of income even though they are having losses. Why, sir? If they are, only when they file a loss return, they are eligible for carry forward of such losses. Sir, mostly the losses can be carried forwarded for 8 assessment years. House property loss, business loss, capital gain loss, capital loss, this can be. IFOS loss, no carry forward option at all, sir. IFOS loss, first IFOS loss itself is rare. Even though such loss is there, it can't be carried forwarded. Only we can do set off. Okay? Then PGBP also 4 type of losses. There are 4 types of losses, sir. One thing. Normal business loss, specified business loss, speculative business loss, and the next IFO is also this one. Income from owning and maintaining horses for race. Normal business loss can be carried forward for 8 years. Specified business loss can be carried forward for indefinite period. Speculative loss can be carried forward only for 4 assessment years. Even income from owning and maintaining horses for race also can be carried forward for 4 assessment years only. But to carry forward that, you need to file loss return. Okay. So by filing the loss return only, you can carry forward business loss, specified business loss, speculative business loss, capital loss, and loss from activity of owning and maintaining resources. Even without filing return also, you can carry forward house property loss and unabsorbed depreciation. House property loss and unabsorbed depreciation can be carried forwarded irrespective of whether the return filed or not. But whereas these 5, business loss, normal business loss, specified business loss, speculative business loss, capital loss, or loss from activity of owning and maintaining horse races, this can be carried forwarded only when the return is filed on or before the due date. Restriction is only for carry forward. Sir, you filed return belatedly. Okay, sir, by due date return has to be filed, but you filed return belatedly. No problem, sir. Since you filed return belatedly, you can do set off. But what you can do, you cannot do carry forward. You can do set off. Set off is different. Carry forward is different. Set off means what? In the current year, loss under one head, if it can be adjusted with other head incomes, it is called set off. So set off can be made. What can't be made? Carry forward can't be made. Okay, but condonation of delay. Condonation of delay, sir. Because of some genuine reason, you cannot file the return. Let's say, for example, on the due date, let's say 31st October, you are trying to file the return. But there was some technical issue, some server issue. You cannot file the return by midnight also. You able to file only on the 1st November, early morning 4 a.m. But already by the time due date lapsed, right? But yours is a genuine concern, genuine reason. Because what? Because of technical glitch or technical error or mistake issue only, you can't file the return by 11:59 p.m. But you can file by what? 4 a.m. Okay, by the time the issue solved, you can file by 4 a.m. But still, it was filed after due date. Can you carry forward or not? Yes, sir. That time what you can do, you can apply to PCIT, CIT or CCIT or PCCIT. They can condone the delay so that you can carry forward your losses. So to whom you should ask for condonation? If the loss is up to 1 crore, you should ask the condonation from PCIT. PCIT na Principal Commissioner of Income Tax, CIT na Commissioner of Income Tax. If the loss is between 1 to 3 crores, then the condonation has to be made by Chief Commissioner of Income Tax. If the loss is above 3 crores, then the condonation has to be made by Principal Chief Commissioner of Income Tax. P means principal, C means chief. Okay, Principal Commissioner of CIT means Commissioner of Income Tax. Principal Commissioner of Income Tax, Commissioner of Income Tax. Here, Chief Commissioner of Income Tax. Here, Principal Chief Commissioner of Income Tax. Then we discussed about section 139 subsection 3, which is about loss return. Return of income has to be filed by due date under section 139 subsection 1 to carry forward the following losses. Sir, these losses can be carried forwarded only when the return is filed. What are those? Business loss, specified business loss, speculative loss, capital loss, or loss from activity of owning and maintaining race horses or horses for race. Okay. Then which can be carried forwarded even though return is not filed? House property loss and unabsorbed depreciation can be carried forwarded even though return is not filed within the due date. However, sir, for belated return or for delay in filing return, only carry forward option will be taken away. Set off option will be there. Okay, let's say you filed after due date. Still, any loss is there now, you can set off with other heads in the same year. No problem. But the losses cannot be carried forward to the next years if return is not filed within due date unless house property loss and unabsorbed depreciation. Then, however, sir, if due to some genuine reason, genuine cause, you cannot file the return in time, then you can apply for condonation of delay. Okay, who are the authorities that can condone the delay? It depends on how much loss you have reported. If the loss is up to 1 crore, the condonation power is with Principal Commissioner of Income Tax or Commissioner of Income Tax. If the loss is between 1 crore to 3 crores, then Chief Commissioner of Income Tax. If it is above 3 crores, Principal Chief Commissioner of Income Tax. Then 139 subsection 4, section 139 subsection 4, it is about belated return. So what is called belated return? Yes. So when we wish belated happy birthday? Once the birthday is over, then next day or after 2 days, if you came to know that his birthday already completed, then you'll wish belated happy birthday. Same here also. Belated return. Birthday already went on 31st October here. Return filing date. Afterwards, if you are filing return, then that is called as belated return. Just like as birthday wish, sir. Sir, today is his birthday, but you don't know and you cannot wish. Then afterwards, 1 day, 2 days, you came to know and wish belated happy birthday, fine. 1 week, up to 1 month also fine. 6 months completed. Then you came and saying like, belated happy birthday. So then it will be like what? Senseless, right? Same way, belated return also has to be filed within a limit, within a time limit. You cannot file like after 1 year, 2 years, 3 years and can say simply belated return. So it has a time limit also. First, belated return means return filed after due date. Then it is called as belated return. And such belated return has time limit. What is the time limit? If return of income is filed after due date, then it is belated return. Belated return has to be filed by earlier of 3 months prior to end of relevant assessment year or before completion of assessment. Okay, sir, what is the applicable assessment year for your exams? First tell previous year applicable. For you the exams you write, what is the previous year applicable? Previous year 25, 26. Assessment year 26, 27. That means first you need to find out for previous year 25, 26. First tell me, sir, assuming audit is applicable. What is the return filing date, sir, for assessment year 26, 27? 31st October. Assessment year you should tell. 31st October 26 is the date of filing the return, due date of filing the return. Okay. Then what is the time limit for filing belated return, sir? It is 3 months prior to end of relevant assessment year. So this is the relevant assessment year. By when it ends? 31st March. Year also important. If you say just 31st March, no, it is not enough. 31st March 2027. For that 3 months prior means 31st December 2026. So 31st December 2026. So 3 months prior to end of relevant assessment year or before completion of assessment, whichever is earlier. Sir, before 31st December only, if assessment was taken and completed, then that itself will be the last day for filing the belated return. If assessment was not initiated, even though initiated, it is not yet completed, then you have time till 31st December of 2026 for filing belated return. 3 months before the completion of relevant assessment year. Sir, actually, with respect to this, in Finance Act 2026 also there is an amendment. 2026. But 2026 Finance Act is not applicable for us. For us, which act is applicable? Finance Act 2025 only. Okay, in the recent budget, there is an amendment with respect to this. But that is not applicable to June 26 exams as well as to December 2026 exams. So whatever the provision we are discussing is like final only. Okay, don't get confused if someone or some post you see later. Okay, so what is the point, sir? You have to file belated return by when? 3 months prior to completion of relevant assessment year. For us, relevant assessment year is 26-27. Then by when it has to be filed? 31st December 2026. Okay, this is the maximum date. If before itself assessment completed, let's say by 30th November only assessment completed, then 30th November 2026 itself is the last date for filing belated return. Understand? Okay. Sir, able to understand, right? Then we are moving on to revised return. So what is called revised return, sir? You already filed a return, and in such return there is an error, omission or mistake, and you wanted to rectify it. Okay, then you will go for what? Revising the return already filed. So which return you can revise? A normal return filed under 139 subsection 1 can be revised. A loss return filed under 139 subsection 3 can be revised. A belated return filed under 139 subsection 4 can be revised. A revised return filed under 139 subsection 5 also can be revised once again. Okay, so you filed revised return. Why? Because there is an error, omission or mistake. But afterwards also there is still error, omission. Then still again you can go for what? Revision. So revision can be done any number of times. There is no restriction on revision. Okay, so what returns you can revise, sir? Normal return under 139 subsection 1, loss return under 139 subsection 3, belated return under 139 subsection 4, and even a revised return under 139 subsection 5 also you can revise. If you revise, you can revise it for any number of times. Then, sir, once you did the revision, then the original return is gone only. Whatever the original return you filed, then it doesn't have any relevance. It substitutes completely. It substitutes completely. The revised return substitutes completely the original return. Sir, first you filed normal return, then you filed revised return. Then at the time of assessment again you got out and you wrote a letter to the assessing officer stating like, sir, I mistakenly filed revised return, sir. I thought in some other way, but original return is only correct, sir. Consider original return only. Like that you prepared a clear letter and given to assessing officer. Is that letter has any validity? No validity, sir. Okay, revised return will substitute the original return. So assume like the original return deleted and this file was replaced. This file was replaced, sir. In system will do na, sir. Okay, if you want to copy the same file again, you'll just do replace. So replace now what happens? The original file will goes. The new file will get updated. Same thing happens even with the revised return. Okay. Sir, then what is the recourse, sir? Sir, what is the recourse, na? If he has to do, if at all he has identified that still there is any error or omission, original return is only correct instead of revised return. Then again, revise the return and show whatever you have filed in the original return only. Okay, you have any number of times for revision and updation, sir. Okay, and then, sir, let's say you filed return and you have observed some error or omission. Instead of filing revised return, you provided a letter. You provided supporting documents, you made a covering letter, you formally met the commissioner or whoever the applicable officer. Okay, you explained the issue, you submitted the documents, everything. But still, it need not be counted as a revised return and that documents does not have any validity. Okay, so if there is any error or omission, you should not do all those things. What you should do? You should go for revised return only. Okay, if there is any omission or wrong statement in return of income 139(1), 3, 4, 5, then SEC can file revised return. Revised return has to be filed. Okay, time limit, sir, I'll discuss afterwards. Revised return of income can be revised any number of times. This revised return completely substitutes original return. Revised return has to be made as per 139 subsection 5. If a plain letter or a revised statement provided that does not amount to revision. Okay, revision can be made even after intimation under 143 subsection 1. Sir, at the time of filing return also we do tax computation. That is called self-assessment, because we ourselves assessing how much is our tax liability. Assessing nothing but finalizing our tax liability on our own. So that is called what? Self-assessment. First one, at the time of filing return of income. Then once you filed a return, every return by default will get processed by system. Okay, that is called as what? Provisional assessment under one or summary assessment under 143 subsection 1. 143 subsection 1. So what will do? System will check for certain irregularities, whether the deductions you claimed are more than the limit given, or whether any losses which you cannot carry forward has been carry forwarded. Such kind of technical issues, it will check and give you a 143 subsection 1 intimation. This is first level of assessment. Then afterwards they can go for a regular assessment. By giving notice under 143 subsection 2, they can go for even a regular assessment. If you are not cooperating in regular assessment, then they can go for best judgment assessment under section 144. Okay, even after doing all this, later after 2 years, 3 years, they found out like they did assessment, but still they couldn't find out certain incomes, or certain incomes has been concealed by you, or certain incomes are not reported by you, and which is prejudicial to the interest of revenue. Then they can go for income escaping assessment. Income escaping assessment. So how many assessments are there, sir? First self-assessment, then summary assessment by system, then regular assessment. If regular assessment is not possible, then they'll go for best judgment assessment. After doing all these also, still they came to know that there is still some income has not been reported or not been taxed properly, and which is against to the interest of revenue. I mean, there is a revenue loss to the government. Then they can invoke what? Income escaping assessment. This many assessments are there. Okay, now what they are saying, revision can be made even after 143 subsection 1 intimation. When you can do revision, sir? Revision can be made even after 143 subsection 1 intimation. I mean, the provisional assessment or the summary assessment is already made by the system, but still afterwards also you can go for what? Revision. No problem. Okay, so what is the time limit for doing revision? Sir, maximum the revision has to be done by 3 months before the completion of relevant assessment year. 3 months before the completion of relevant assessment year. Means what, sir? 31st December of assessment year, nothing but 31st December 2026, or date of completion of assessment, whichever is earlier. Sir, here date of completion of assessment before completion of assessment here assessment means they are referring to 143 subsection 3, the regular assessment or scrutiny assessment, not the 143 subsection 1 intimation and all. Sir, in 143 intimation, when it will come, first the system will do the summary assessment. If there are any differences, even though no differences also, they'll issue what? 143 subsection 1 intimation. So this is also a closure of assessment. But this assessment is not counted for finding out before completion of assessment. Here assessment means what? Under 143 subsection 3 or 144. That's what they are referring here. Not the summary assessment which will be carried out by default for every return. Understood, sir? Revised return. Okay. Then defective return. Sir, when we can call it as a defective return? Return has been filed, and in the return there are some defects. What are those some defects? Return not filed in a prescribed form. Return not filed in a prescribed form. Sir, what are prescribed forms? Sir, depending on his income, there are ITR 1, ITR 2, ITR 3, ITR 4, ITR 5, ITR 6, ITR 7, like that. So many ITRs are there. But if he has chosen a wrong ITR and filed, then it is called as what? Defective return. Or any annexure statement. Any annexure or statement has to be filled and it was not filled. Then proof of tax payment was not attached. But since it is e-filing, sir, now proof of tax payment you need not to attach. Okay. And then audit report is also not submitted. If any of these are made, then it is called as what? Defective return. Return of income not filed in a prescribed form. Any annexure statement was not filled. And then audit applicable. But the audit report was not submitted. Then in that case, it is called as what? Defective return. What AO will do if it is a defective return? He'll intimate the defect to SSE and gives opportunity to rectify within 15 days or extended times. So minimum he'll give 15 days. But if you request that 15 days is not enough, now he can give you extended time also. So SSE has to file what in mail? He has to rectify within the time. Then the return, if SSE fails to rectify within the time, original 15 days or extended time, then the return considered as invalid, void ab initio. I mean, it doesn't even count as you have filed a return. Your return itself will become void ab initio. I mean, from the beginning, it becomes void only. So nothing but in simple, it is assumed as like you didn't file any return at all. Okay. So what is called defective return, sir? First, okay, proof of tax payment not attached. But is it required now? Since e-filing now, it is not even required to be attached. Then what are other defects? Wrong form selected. Then any annexure statement which has to be filled was not filled and audit report was not submitted. Then it can be called as defective return. Okay, if it is a defective return, what AO has to do? He has to inform that defect to SSE. Okay, and he has to give 15 days or sometimes more than 15 days also time to get rectify that defect. Okay, if he rectifies that now, then no issues. Otherwise, if he SSE fails to correct the defect within 15 days or extended time, then the return will be considered as invalid, void ab initio. Then PAN number. Who has to apply for PAN? If you are accessible to tax, sir, when you are accessible to tax, when your total income exceeds, when total income exceeds basic exemption limit, then you will be accessible to tax. If you are accessible to tax, you have to file return of income. When you have the need to file return of income, first you should apply for what? PAN. By when you have to apply, sir? By 31st May of assessment year. Because by July you have to file return. Okay, by July if you have to file return, by May you have to first apply for PAN. Okay, then if it is any person carrying business or profession and the total turnover exceeds or likely to exceed 5 lakhs, then also you should apply for PAN. By when, sir? By the end of financial year, nothing but 31st March of previous year, because financial year and previous year are one and the same. So here before the end of financial year, nothing but before the end of previous year. Then, so first case is what? You are going to accessible for tax, nothing but your total income exceeds basic exemption limit and you have the requirement to file return of income. Apply for PAN. By when? 31st May of. Before itself you can apply, no problem. But maximum by 31st May of assessment year. You are carrying some business or profession and your turnover exceeds 5 lakhs or likely to exceed 5 lakhs. Then by the closure of financial year itself you have to apply for PAN. Then third case, sir, you are a resident person and enters into a financial transaction. It could be related to purchase of goods, sale of goods, or purchase of any other property where your aggregately the value of that financial transaction exceeds 2.5 lakhs or equal to 2.5 lakhs. Then such person has to apply for PAN. But if this person is a company, then company has to apply, company director also should apply. If this person, original person is a firm, then firm should apply and even partners also should apply. If it is any other person, that person should apply and even the principal officers also should apply. Okay, sir? By when they have to apply? On or before 31st May of following financial year. Understand, sir? So the transaction entered by company is more than or equal to 2.5 lakhs. Then company should apply, even director of company should apply. If it is firm should apply, partner should apply. If it is any other person, such person should apply and even the principal officers also should apply. By when? 31st May of assessment year. Then, where we should quote PAN number? It's okay, PAN number, sir. See, there are this page is completely about where the PAN has to be quoted or PAN number has to be shown. First one, PAN is mandatory in all returns. In every return you file, PAN number is must. Actually, we need not to file also in e-filing. By default, the PAN number will be there. Okay, then, in all challans for payment of tax. Here also actually we need not to fill, by default it will come. Then in all documents related to specified transactions. So we're going to discuss about what are called specified transactions. Then Sale or purchase of motor vehicle except two-wheeler. Except two-wheeler, if you are buying any motor vehicle, then also PAN has to be submitted. If you are opening a current account, opening a demat account, or applying for any credit debit card, then also PAN has to be given mandatory. So once again, all the returns, challan, tax payments, then specified transactions, then fourth one, current account, demat account, then sale purchase of motor vehicle other than two-wheeler, and last one, applying for credit and debit cards. Now we're going to discuss about what are specified transactions. When you are making cash payment to hotel or restaurant in excess of 50,000. When you are making cash payment for travel, that also foreign currency, in foreign currency. More than how much, sir? 50,000. When you are purchasing demand drafts from bank or pay orders from bank, you are giving cash and buying what? A demand draft from bank. I mean, nothing but 50,000 cash converted into DD, demand draft or pay orders, which is more than 50,000. Then time deposit. You are making a deposit with timely deposits with bank or NBFC, post office, Nidhi company, which is more than 50,000 or aggregately rupees 5 lakh in a financial year. Sir, in one time you didn't deposit 50,000, but in a year you are deposited 40,000 20 times. You are deposited 40,000, how many times, sir? 20 times. So 40,000 into 20 now, 8 lakhs. Okay, which is aggregately more than 5 lakhs. So again, he has to mention his PAN details. Then purchase of prepaid instruments. Sir, what are prepaid instruments? Prepaid instruments, not stamp papers. Okay, stamp papers, you know. Okay, stamp papers. Then normal stamps. Post office stamps are also prepaid instruments. Stamp papers also prepaid instruments. Certain vouchers. The normal vouchers and all we buy, also called as what? Prepaid instruments. If they are prepaid instruments, you are purchasing cash by using what? Cash DD check, and it is more than what? Rupees 50,000. Then also you should quote PAN. Then you are making payment for purchase of mutual funds in excess of 50,000. Making payment for purchase of bonds, debentures of a company or institution in excess of 50,000. Payment made for purchase of bonds from RBI, which is in excess of 50,000. You are making a cash deposit in bank, post office, cooperative society in a day exceeding 50,000. You are entering into a contract for purchase or sale of securities, which is more than 1 lakh per transaction. And you are purchasing any unlisted share, which is more than or equal to 1 lakh per transaction. You paid life insurance premium more than 50,000. And then purchase and sale of immobile property where the consideration more than 10 lakhs or stamp duty value more than 10 lakhs. Sale purchase of normal goods and services in excess of 2 lakhs per transaction. Okay, in all these cases, PAN is necessary. Advanced reporting, I'll tell once again, sir. All these cases, first what? PAN is necessary. So what are those, sir? Hotel, restaurants in excess of 50,000. Travel related foreign currency in excess of 50,000. For purchase of DDs and pay orders in cash in excess of 50,000. Time deposit with bank, NBFC, post office and Nidhi companies in excess of 50,000. Purchase of any prepaid instruments. Sir, prepaid instrument, you pay money first and you'll get an instrument. But this instrument, if you submit afterwards also, it will be counted as equivalent of money. Sir, what is the purpose of stamp? Postal stamp, sir. Why postal stamps were introduced? You know, can you guess at least why postal stamps used to be there? So simple thing, sir. That time there is no online system and all. And then the office will not be open for every time. So what you can do, if you want to write letters, first itself you can buy stamps. And then instead of every time you going and paying money to the money in the post office, you just attach a stamp there, which is equivalent of what? Payment of applicable charges. So instead of now you going to the post office, you can deposit it in any letter box. అర్థమవుతుందండి. ఇప్పుడు మామూలుగా అయితే మనం కొరియర్ చేయాలంటే ఏం చేస్తున్నాం? ప్రతిసారి DTDC ఆఫీస్కి వెళ్ళాలి. ప్రైవేట్ కొరియర్ అనుకున్నా, లేదా అట్లీస్ట్ ఆన్లైన్లో అన్న బుక్ చేసుకోవాలి. అప్పుడు ఆన్లైన్ లేదు, ప్రతిసారి అక్కడికి వెళ్ళలేవు. సో ఏం చేస్తాం? ఫస్ట్ ఇట్ సెల్ఫ్, అండ్ దట్ టైమ్ ద మేజర్ మోడ్ ఆఫ్ కమ్యూనికేషన్ ఇస్ వాట్? Letters only. So what they will do? First, let's say they plan in a month they're gonna write 30 letters. Every letter needed 1 rupee stamp. So first itself you go into the post office, deposit 30 rupees and take 31 rupee stamps. So it is equivalent of what? You already paid applicable fee. Now on the every letter if you attach stamp, it is nothing but equivalent of paying applicable charges. Okay, that's why prepaid instrument concept has been introduced. Then payment to mutual funds for units in excess of 50,000. Payment to bonds, debentures of a company or institution in excess of 50,000. Payment to RBI for bonds in excess of 50,000. Cash deposit in excess of 50,000. Then contract for purchase or sale of securities in excess of rupees 1 lakh per transaction. Sale purchase of unlisted share in excess of 1 lakh per transaction. Life insurance premium greater than 50,000. Purchase and sale of immobile property greater than 10 lakhs or stamp duty value greater than 10 lakhs. Sale purchase of good or service greater than 2 lakhs per share. Then if you're gonna enter into these kind of transactions, sir, you should report them in advance itself. Okay, advancedly you should report your PAN number if you are going to enter into these kind of transactions. Advanced reporting of PAN. What is this? If you're gonna make cash deposit in excess of rupees 20 lakhs or equal to 20 lakhs in a financial year, then prior to 7 days itself update to the bank with your PAN details. And cash withdrawals you're gonna make in excess of or equivalent to 20 lakh, or opening of current account or cash credit, sir. This is cash credit. It is nothing but cash credit. Opening of cash current account or cash credit account more than 20 lakhs in a financial year. Then in that case, not at the time of transaction you have to submit PAN. Priorly 7 days advance itself you have to update your PAN details. Then section 139AA. Quoting of Aadhaar number. Quote of Aadhaar number. So first, every person is required to quote his Aadhaar number also. Where in his application for PAN number, now itself if he is applying for PAN, then in the PAN application itself he has to mention his Aadhaar number. He already has PAN and Aadhaar. Then what? In filing, at the time of filing return of income, in return, he has to mention even his Aadhaar number also. Person who has allotted PAN before 1st July 2017, because this Aadhaar requirement has came only in 2017, but you got PAN number before 1st July 2017 only. Then what? You should again link your PAN with Aadhaar. If your PAN is issued before 1st July 2017, that time in PAN application, they didn't collected Aadhaar number. So after, so if your PAN is before 1st July 2017, now what you should do? You should link your PAN and Aadhaar by when 31st March 2022 is the last date. Okay. Otherwise, what? Your PAN becomes inoperative. To make it operative, what we should do again? You should pay a fees under 234H, which is 1000 now, which is 1000. So okay, let's say, sir, you got PAN before 2017, but then after you didn't used. Okay, let's say your father or mother's PAN you didn't used by then, but now you required, or there's a need to use that PAN number also. But since it was not linked with Aadhaar, it became what? Inoperative. Now first you should pay 1000 rupees fees under 234H. Your PAN becomes operative. Then link your PAN with Aadhaar. Aadhaar need not to be linked or mentioned in certain cases. When you are residing in Assam, Jammu and Kashmir and Meghalaya. Why? Sir, in these three states, the Aadhaar updation is not yet completed. Why? Partially done, not completely. Why? Because now there is so much of havoc regarding the citizenship in these three states. Okay, in Assam, the border states, border countries, people might be coming. Okay, the citizenship cannot be decided easily. Jammu and Kashmir also same issues. Meghalaya also same issues. That's why these three states, complete Aadhaar issue has not happened. That's why these three states were exempted from that particular rule. And if he is a non-resident, sir, he's a non-resident, sir, he's staying in outside India. How can we expect David Warner or a foreign cricketer, just because he's earning in India, will have Aadhaar card in India? So they'll not have. Just because we kept in Instagram reels and all, it was circulated, you apply for Aadhaar card and all. Okay, but still, they don't have what? Aadhaar card. How they can do? That's why non-residents cannot do Aadhaar updations. Then, if his age is greater than 80 years, sir, already his age is greater than 80 years, sir, they are not able to walk also. So those people now need not to be taken to the Aadhaar centers and then Aadhaar updation and from Aadhaar again. PAN linking, all this process is not required if his age is more than 80 years. And then he is not a citizen of India. If he is not even a citizen of India, then Aadhaar itself will not be issued. How can you link Aadhaar? That's why, sir, Aadhaar is not required in the following cases. You are residing in where? Assam, Jammu and Kashmir, Meghalaya. You are a non-resident, age greater than, or non-resident is separate point. Then third point, your age greater than or equal to 80 years at any point during the previous year. Or you are not a citizen of India. Then 139B, tax return preparer. Tax return preparer. Specified class of people can file their return of income through tax return preparers. So tax return preparers, these are not CS, first thing. CMAs can be tax return preparers, but not CS. A chartered accountant cannot be tax return preparer, but a cost accountant can be tax return preparer. Sir, this is something, why this tax return preparer concept? Sir, I mean, in general sense, what they are going to tell here is like, if you are enrolled as tax return preparer, you can go to someone and tell, I am authorized to file tax returns for you or on behalf of you, even under income tax, so that you can claim your status that you are a tax return preparer, and you can get some business for filing returns and all, or for making tax compliances and all. Other than that, there is no much difference. But understand, sir, no CA will claim as tax return preparer, because by the qualification itself, the society knows that they know tax and they only do mostly tax compliances. So specified class of people can file return through tax return preparers. Who can file tax return through tax return preparers, sir? Other than company. Why not company, sir? Because company already audit applicable. For company already audit applicable. So they cannot come again to the tax return preparer. And any person who has audit under 44AB, if not tax audit under any other act. So these people, company, sir, company also audit applicable mandatorily as per Companies Act. So nothing but simply what they are saying, if audit applicable under this Income Tax Act or any other act, those people cannot file returns through tax return preparers. Other non-audit assessees can file returns through tax return preparers. So who can be tax return preparer? That was not answered. They answered only who cannot be tax return preparer. Okay, other than people, rest all can be tax return preparers. An individual can act as tax return preparer who is authorized by CBDT, except a chartered accountant cannot be a tax return preparer. A legal practitioner, nothing but a lawyer cannot be a tax return preparer. An officer of a bank in which SSE has an account, okay, he cannot act as your tax return preparer. Your employee of, okay, for specified class persons or for company, their employee itself cannot act as tax return preparer. Or if it is a firm to which audit applicable, any employee of that firm cannot act as tax return preparer. So if you are a specified class of person, your employee cannot act as your tax return preparer. In general, your CA cannot act as your tax return preparer. Your legal practitioner cannot act as your tax return preparer. Or officer of a scheduled bank in which you have bank account, such officer also cannot act as your tax return preparer. Then verification of return for in different cases for different individuals who has to verify. Sir, individual, who has to verify return? Generally, sir, you need not to put or take much stress also. Easily you can understand and remember this. Individual, he has to sign the return, whether digitally or physically. He is not in India or mentally incapacitated. Who will do, sir? Competent person, nothing but if you have given power of attorney to someone, then such power of attorney. Otherwise, your legal heirs, okay, they are gonna verify your return. Nothing but competent person, power of attorney is there, then that power of attorney. If no power of attorney, then the persons who are your legal heirs can do that one. Individual. Then HUF, who has to verify? Karta. Karta, not in India or mentally incapacitated. Any other adult member of HUF. Sir, need not to be co-partner. Any other adult member of HUF. Sir, you know there is a difference between member and HUF. Let's say Navneet started a HUF. In Navneet HUF, Navneet is a co-partner and member of HUF. But when he marries, his wife will become only member. His wife can never become co-partner of his HUF. But his children will become, irrespective of girl child or boy child, they'll become co-partners. Okay? But wife, since she came from some other family, she cannot be co-partner in your family. Understand? Okay. But where she will be co-partner? Your wife will be co-partner in her father's family or father's HUF, but not in your HUF. Understand, sir? So here they didn't say like co-partner has to verify. They said like what? Any other adult member can verify. So husband created a HUF. Children are still minors. Okay, but husband not available or mentally incapacitated. Then wife can verify the return on, wife nothing but she is another member of HUF and she is an adult member of HUF. She can verify the return. Okay, then partnership firm, managing partner. If no managing partner available, any other adult partner. Firm generally what, sir? Managing partner, not sleeping partners. If no managing partner available, then any other adult partner. LLP, designated partner. If no designated partner available, any other partner. Company, managing director. If no managing director, any other director. Company already into liquidation, then liquidator. Company into insolvency process, then such insolvency professional who has been appointed by the court. Management taken over by central and state government, then whoever the officer appointed by central and state government. Sir, when central government will take the control of a company? When a serious fraud is happened, it's a listed company only, but there is a serious fraud happened in that company. Now, all the shareholders' money is at stake. Because of that fraud exposed to the public, the share prices are collapsing like anything. Now, if no action is taken by government, then the public money will be lost. Public money is at stake. So now what? Government has to keep some competent person who can run the business for some time so that shareholders' interest will get protected. Okay? Shareholders now, it's not a private limited company, sir. It is a public limited company. That's why. So in such case, they can appoint a principal officer. Principal officer, nothing but they'll appoint an IAS cadre kind of officer, sir. So those people will be acting as what? Signing authority. In any other case, okay, other than companies, sir, okay, then if it is a non-resident company, who has to sign, sir? Whoever the person having power of attorney. Political party, CEO of political party has to sign. Local authority, principal officer has to sign. And any other person, sir, whoever person competent to verify can sign the return. Can verify the return. Okay, political party, who has to sign, sir? CEO. Local authority, principal officer. Then company into liquidation, liquidator. Company into insolvency, insolvency professional. Then management taken over by central and state government. Principal officer appointed by central and state government. If it is a non-resident company, power of attorney. Then, sir, in returns, we're going to discuss about updated return. Updated return is highly important for June 26 and December 26 exams, sir. There is amendment here in updated return. Updated return, sir, can be filed by any person, whether he filed return under 139.1. What is 139.1? Normal return. 139.4, belated return. 139.5, revised return. If whether he has filed any of these returns or not, still he can go for what? Updated return. Okay. What is the time limit? First, this point itself has been changed, sir. Previously, the time limit to file updated return is only 24 months. Now, the updated return can be filed till 48 months from the end of relevant assessment year. Previous year, 25-26. What is the relevant assessment year, sir? Relevant assessment year is what? 26-27. So what is the last day of relevant assessment year? 31st March 2027. From there, how much time is there? 48 months. So by when it ends? 31st March 2029. 48 months means how many years, sir? 2 years, sir. 48 months means how many years? 4 years. Okay. Good morning, all. Okay. Okay, you are counting 24 hours, huh? In a year, basic, we'll have 12 months. Okay, I need not to tell all the month names also for you. There are It means what, sir? 48 months means 4 years. If you count 4 years, 31st March, 30, 31. Chanchal, Shenmug, Kavita, good morning. మెలకుగానే ఉన్నారా పక్క అందరూ 1 అవర్కి ఎన్ని మినిట్స్ అంటే 70 minutes. Okay, how many minutes will be there in an hour? 60. Okay, thank you. How many days in a year? Thank you. It has to be filed within 48 months from end of relevant assessment year. That means for previous year 25-26, you have the time to file updated return till 31st March 2031. Okay. While filing updated return, you should attach proof of payment of additional tax. Sir, they are giving 4 years time now. Okay. It's not enough if you pay the normal tax. Normally, when you file return, whatever the tax applicable, 234A interest applicable, 234B, 234C, that you have to do normally only. Other than that extra, you should pay additional tax also. So only when you pay additional tax, you can file updated return. Sir, I don't have any additional tax, sir. Actually, originally I reported 20 lakhs as income, but actually it is not 20 lakhs, 15 lakhs only. So for that reason, to reduce income from 20 to 15 lakhs, I want to file updated return. Then such option is not available. Updated return can be filed only when you gonna increase your tax liability. But decrease in tax liability, no concept of updated return. Okay, it is in favor of department, not in favor of SSC. The only favor you have is like, at least now you can file return. But for allowing you to file even afterwards, they want some penalty. But they are not calling it as penalty. They are calling it as what? Additional income tax. Okay, late fees kind of. But late fees is there anyhow. Other than this extra, in the form of additional income tax, they will gonna collect from you when you are filing additional income tax. Sorry, when you file updated return, they gonna collect additional income tax also. See, when filing updated return, normal tax, whichever is applicable on the updated income, has to be paid. Plus, you should pay even what? Additional tax also. It is not just enough. It's not enough if you just pay the normal tax applicable. Okay. Updated return not allowed in the following cases. When, if such return is a loss return. Sir, with loss return, will there be additional income tax? They are not even paying tax. If not paying normal tax, then there is no concept of additional tax. Okay, that's why in case of loss return, no updated return concept. In case of results into updated return results into reduction of tax liability, then also no updated return. Or it results into refund or increase in refund, then such case also. So only case when you can file updated return, you gonna pay some tax compared to what you paid already in the original return. Okay, so through updated return, only if there is a chance of paying tax, you can file updated return. If there is no chance of paying tax, then there is no concept of updated return for you. Understand, sir? Okay, then search requisition. Sir, search means you can understand. It's okay, when income tax authorities has evidence or proof that you have some incomes which were not reported, then they can initiate what? Search. What is requisition? Sir, requisition means they wanted to come for search to your place, but all before the income tax people comes itself, CBI already did right, or ED enforcement directorate has did the search operations, or GST authorities, some other authorities has already made search, and the books of accounts, documents, money, whatever is there, it is already seized. Now income tax people will come and do what? Because already the documents, books, property, everything has been already seized by CBI or any other department. Now instead of again doing search, they'll request the other departments to provide those books of accounts, documents, or the assets to the income tax authorities. So they'll request other authorities. That's why it is called as what? Requisition. Okay, sir? There is a technical problem to carry out such. Why? Already some other department or some other authority has carried out such and seized the books of accounts, documents, and the money, whatever you are having. Now, income tax cannot seize anything now, even if they initiate such. So instead of search, now they'll go for what? Requisition. They'll not request you. They'll request what? The other authorities they'll request, because they cannot search other authorities. They can only do request other authorities to provide your relevant books of accounts, documents, or money seized to the income tax department. So that is called what? Requisition. Such is different. Requisition is different. But in both the cases, income tax people will get the books of accounts and documents of an SSC into their possession. Okay. So when search initiated or requisition initiated, then you cannot go for updated return. Then survey conducted. Sir, what is search? What is survey? Sir, compared to search, survey is much more smoother provision. Okay, search na they believe confirm fraud. Survey na they just have doubt, maybe he is doing something. So they'll come inquire and all. In survey they cannot seize books of accounts and documents, but in search they can seize the books of accounts and documents. So survey is much more smoother provision, and they still have some trust towards you. Then they'll come for what? Survey. If they find they had concurrent evidence that you are concealing some income, you are not reporting incomes properly, then search will be initiated. Okay, search, requisition, survey. Any of these has been initiated, then you cannot go for updated return. Okay, na, sir. Then Revised return till when you can file? What is the time limit for filing revised return? Afterwards, if you want to revise, what you can do? No option. So then what you can go for what? Updated return. Yes, you didn't file normal return, but you have income which was not reported. You have income which was not reported. Okay, then what? Sir, that time you thought what happens, I'll see. But later on, you got that fear. Maybe if income tax people caught now, they'll call it as undisclosed source of income and they'll take 78% of tax plus penalties plus prosecution depending on incomes and all. So what you thought? To avoid all this, at least now I'll file return. But the belated return time limit also completed. So what option you have? Updated return. Yes. See, updated return is like you did some mistake, but that time you felt like what? We'll see what happens, what income tax people can do. But afterwards you realized, okay, maybe your friend or known person, something like this has already happened. Then the fear started inside. So okay, instead of having all that trouble, what you are thinking now? We'll file return, even some extra tax also, no issues, I'll pay. So originally if you have filed return, it is enough with normal tax only. But not only just normal tax now, you need to pay even additional tax also. Okay? Yes, that I have to explain right afterwards. I wrote here, there is additional tax. How do we compute additional tax and all? I'll explain. You're sleeping or what? I said, previous year 25, 26. See, you have time till 31st March 2031. In between, any time you can file updated return. Whenever you had that Gnanodayam, that time you can file updated return. So you can file within 1 year, you can file within 2 years, 3 years, 4 years. See, understand, sir, how fast the realization happens, that much less will be the additional tax. Okay, so the additional tax is not fixed even if you file in 2 years or even if you file in 4 years. Okay, the additional tax increases based on the time you take. If it is within 12 months, there is less additional tax. If you take 24 months, then the additional tax will much more increase. 36 months, it will increase much more. Okay, 48 months, it will increase much more. Okay, like that. For any assessment year, from the end of that year, 48 months. Not for assessment year 26, 27 or 27, 28. For any assessment year, from the end of the assessment year, you should count how many months? 48 months. That is the last day to file for updated return. You can file in between also, no issues. Okay? I explained that already. Huh? No. For every SSC, it is applicable. Individual will clearly say it is individual. If nothing is mentioned, don't assume as individual. It is applicable for any type of SSC. Okay? See, when nothing is mentioned, then we should understand it is what? It is for everyone. For individual only, we should specify that is only for individual. Okay? Sir, got it? You have any doubts? Mac? Zone outs, zone ins. Vaishnavi, okay na? Sikka yav saline lekkistanani cheppindi Mac. Jarta exams June lone. Summer, heavy heat. Drink coconut water, Glucon-D. So you all also. It's okay, by the time it goes to March, you can't even. Okay, so there are some people who will get even rashes also because of the heat. It's okay, hydrate properly, maintain things and all properly. Saline lena. వాడికి ఏమైంది సిక్కు వాడికి ఏమైంది ఓకే దెన్ మీ పేరు అన్నారు పావనియా బావ చరిష్మా పక్కన పేరు భవ్య ఓకే Sir, a search was initiated at Bhavya's premises and they have collected or seized the money, valuable articles, books of accounts and documents. They have seized from whose premises? Bhavya's premises. But later on they came to know that all these books of accounts, documents which were seized not belongs to Bhavya but they belongs to Charishma. Then she, Charishma, is also not eligible to file updated return. Nothing but Bhavya acted as a binami. Okay, they went and searched her premises. They found some books of accounts, documents, money, bullion, jewelry, and all. But later on, Bhavya explained everything. I don't have anything. All this belongs to Charishma only. She is my friend. She asked me to keep at my place. So just I kept that. Okay. So who is the original gangster here? Charishma. That's why she is also ineligible for filing updated return. Okay. So you did mistake. But before income tax authorities catch it, you have to file the updated return. Once they catch it now, then you don't have option to go for updated return. If that option is there, then everybody will say what? Sir, you found now, wait for 10 minutes, I'll file updated return and come. Okay, so nobody will get any penalties and all. So that's why what they said, you can file updated return before they initiate search, before they initiate survey, before they initiate requisition, or they searched or requisitioned with respect to some other person, but the money, bullion, jewelry, documents belongs to be to a different person. Then the different person also cannot go for updated return. Then here, no updated return can be filed, sir, when already an updated return is filed for such assessment year. So there is no revision of updated return. Once you file updated return, again, updation is not there. Only one updation is only there. Okay. Then, if already assessment, reassessment, recomputation, or revision proceedings are pending or completed, then also you cannot go for updated return. AO has information in respect to such person under Prevention of Money Laundering Act. I mean, they already came to know that he did something suspicious, and they had information under Prevention of Money Laundering Act, Black Money Act, or Prohibition of Binamis Act, or under the Smugglers Foreign Exchange Manipulation Act. Under any of these acts, already AO has information that this SSC has did some kind of malpractices. Then what they can do, sir, instead of going for, I mean, such persons are not eligible to file updated return. Then information for a relevant assessment year is received under an agreement under section 9090A. Sir, 9090A, it is about DTAA. Double taxation avoidance agreements, which will be entered with foreign countries. Now, from foreign country, India got some information. Okay, this person has certain incomes, okay, which was not have been reported and all. So based on that, if that information is already received, then also this person cannot file updated return. Prosecution proceedings are initiated. Then the last answer, this is Finance Act 2025 amendment. See here, show cause notice under section 148A issued after 36 months from, sir, this is not an easy amendment, sir. You will not understand it simply. So please listen to it little carefully, sir, because they said 148A, so I need to brief about what is 148A, what is about 148, then only you will understand the significance of the amendment. Okay. Finance Act 2025 has added a new situation where you cannot go for updated return. Okay, so this is also important. Show cause notice under 148A has been issued after 36 months from end of relevant year, and it is a fit case for notice under section 148. So first we'll understand. Sir, to initiate 147, what is 147? 147 is about income escaping assessment. 147 is about income escaping assessment. They did normal 143 assessment, but later on they found out that you have some income which was not assessed properly, either because of mistake of assessing officer or you didn't show properly, some reason, certain incomes were missed from assessment. Okay, and it impacts adversely the revenue because the revenue interest is at stake. It is a material amount also, so small amounts now they might ignore, but it is a considerable amount only. Then they'll initiate what? Section 147, income escaping assessment. But straight away they cannot invoke 147. To invoke 147, first they should give notice under 148, show cause notice. We wanted to invoke 147 towards you. What is your cause that we cannot invoke, or why not we can invoke 147? Like that they'll give a show cause notice. Okay, for 147 to start, what has to be done first? 148 notice has to be given. Later on, sir, even they thought department is wasting so much of time on giving 148 notices also. So they introduced one more thing called 148A. So before giving 148, they'll issue 148A. So 148A is a notice first will be given to the SSC. Then they'll check whether it is a fit case to give 148 notice or not. 147 is about what? Income escaping assessment. To start income escaping assessment, what has to be done? 148 notice has to be given. Okay, if 148 notice is given, then obviously they'll go into 147 assessment and all. So they thought so much of department or officer's time is getting wasted by involving into non-fit cases or irrelevant cases. Also they are invoking 148, 147 and wasting their time. It is not productive to the department. So they thought what? We'll introduce one more thing called 148A. So first they'll give you 148A notice. Then they'll ask you some basic information and all. Then they'll decide first whether it is a fit case for 148 or not. If they decide it as a fit case, then they'll give 148 notice and then they'll go for 147 income escaping assessment. Sir, I understand. It's like assessment procedure concept. I'm bringing little forward, so you may feel a little complicated or a little heavy for you to understand. I'll repeat once again, no problem. 147 is about what? Income escaping assessment. Sir, I already said in the beginning of the class, there are several assessments. First, there is a self-assessment. When we'll do self-assessment? At the time of filing return. Then there is something called summary assessment. What is summary assessment? Who will do? The system itself will do summary assessment. If there are any deviations, they'll give notice under 143 subsection 1. Okay. Then 143 subsection 3. 143 subsection 3, which we call it as what? Scrutiny assessment or regular assessment. How many done, sir, as of now? Self-assessment, summary assessment, scrutiny assessment under 143 subsection 3. If you are not cooperating to scrutiny or not filed return, then they can go for best judgment assessment under section 144, fourth one. If any of these assessments are done or not made, but after some 2 years, 3 years, income tax people came to know that he has some incomes which was escaped from assessment in the earlier stages, then they can invoke what? Section 147. But they can't straight away invoke 147. First they should issue what? 148 notice. But they feel even giving 148 notice is also a time wasting if it is not a fit case. That's why they have decided even to give 148A notice first. So first they'll give what? 148A notice. Then they'll analyze whether it is a fit case. Sir, how do they decide it is a fit case or not? Sir, there may be some underreporting. But what is the extent of that income also they'll think. If it is a very small amount, then they'll ignore. They'll drop 148 and they'll not carry out with that kind of assessment. If they feel like the income escaped is also material or significant amount, then they'll decide it as a fit case and issue 148 notice, and then they'll proceed into section 147 income escaping assessment. You understand this process? Sir, all this is to understand the amendment, the background. Sir, now assessment year 22-23. Assessment year 22-23. Sir, if you want, copy this example part in your concept books also. You will not find example there in the concept book. I think it is kept as like refer class notes, for example. That's why. Okay, you don't have class notes with you right now, so that's why copy this example. Okay, first listen, then you can copy. Assessment year 22-23. What is the end of relevant assessment year, sir? 31st March 2023. For that, notice under section 148A is issued under 1st May 2026. Okay, sir, first notice under 148A is issued, and then they'll check some preliminary investigation and all, and they'll do, preliminary investigation they'll do, and then they decide themselves whether it is a fit case for 148 or not. So when they decided it as a fit case for 148, 5th July 2026. So, okay, so this period, in this interim period, you cannot file updated return. Sir, here on 5th July, they decided it as a fit case. Fit case for 148. Then afterwards also you cannot file updated return. But here 5th July they decided like it is not a fit case for updated return. Then from 5th July again you can file updated return. Okay, look at this example, sir. You'll understand much more better. The due date for 139 subsection 4 or subsection 5 ends on when? 31st December of assessment year. From there we will taking what? End of relevant assessment year. From there you have time to complete or time to file updated return. How many months is there, sir? 48 months is there. Okay. Now, notice under section 148A is issued on 1st May 2026. Notice with, sir, with respect to which year, sir, this is? Assessment year 22-23. Okay, let me tell you, write down once again. Assessment year 22-23 related. The end of relevant assessment year is what? 31st March 2023. You have time limit to file updated return till when? 31st March 2027. Okay. Now, on 1st May 2026, they have issued what? 148A notice. Once they issued 148A notice, from 1st May you cannot file updated return. Okay, so from 1st May you cannot file updated return. Then 5th July, they have decided whether it is a fit case for 148 or not. Let's say if they decided as fit case, then from 1st May you cannot file updated return. But what happened? 1st May they given 148A notice. Okay, you cannot file updated return. But on 5th July they decided like it is not a fit case for 148. So only in this interim period you cannot file updated return. Later on again you can file updated return because it is not a fit case for section 148. Understand, sir? This is the amendment which says like in this interim period you cannot file updated return. If it is not a fit case, later on again you can file updated return. If it is a fit case, then from that date itself your option to file updated return will get lapsed. Understand, sir? See, showcase notice under section 148A issued after 36 months, and this should be what? After 36 months from end of relevant assessment year, and it is a fit case for notice under section 148, then you cannot issue, sir, then you cannot go with updated return. But if it is not a fit case, then the time it is decided as not a fit case, you can go for updated return. Sir, everybody understood this amendment, sir? Okay, sir, this can be linked with assessment procedures and can be asked as a question, sir. Very important, because mostly assessment procedures also they are not asking a 7 marks question. Returns also they are not asking a 7 marks question. Usually in that slot, I mean, sir, here if you remember, sir, let me show you the index. Sir, from this slot of chapters we'll get definitely 14 marks, sir. Maybe not question number 5. Sometimes in a extreme situation they may change even question numbers also, but definitely from this set of chapters only 14 marks, not more than 14 marks also. Okay, most how it is happening now means from appeals and revision they are asking a 7 marks question, and then advanced tax interest and ICDS they are asking a 7 marks question. But in advanced tax and interest also there is no amendment. Even in appeals and revision also there is no much important amendment. Where amendment is there, in updated return there is significant amendment is there. So it is, I mean, there are high chances for asking it. So in this slot they can ask 7 marks from any chapter. So either they can drop question from these two and can ask a question on updated return linking with assessment procedures also, because assessment procedures also there in the same slot, or else they may drop appeals and revision question and can again frame a question linking with updated return and assessment procedures. Understand, sir? So this set of chapters you get 14 marks since there is an amendment in return of income. So for this attempt even return of income also will become important. Assessment procedures also will become equally important, because see the current amendment, sir, It's not just only based on updated return. You should have knowledge of even assessment procedures also. So it is a mixed kind of question they're going to ask. So understand, sir, amendments, there are simple amendments only, sir, which are going to be easy. On amendments, at least 1 or 2 questions going to be tested. So that question, which is having significant impact, first question is updated return only. At least an MCQ we can expect. Worst case also. Sir, everybody understood this clearly, right? This concept. Okay. It's okay, sir. We'll take break. Then after break, we'll discuss how to compute tax, normal tax, how do we compute, then additional tax, how we should compute. And then with the help of ChatGPT, we don't have any questions actually on doing this additional tax and all, because additional tax also there is amendment. Why? Previously it used to be what? 24 months only. Now it is extended to 48 months. So there also there is an amendment. So but we don't have any. Then from that time again you can file updated return. Okay. So then we're going to start about computation of tax, normal tax and additional tax. Sir, first 2 scenarios. Assuming SSE already filed return, normal return, and going for updated return. Second case, he didn't file normal return, only directly filing updated return. Sir, SSE furnished a return of income. First, in updated return, whatever is the extra income you are shown, the original income plus updated income, take the total and on the total compute tax. So let's say originally SSE reported 10 lakhs. Plus he updated it to 14 lakhs. Now tax has to be computed on what? 14 lakhs. So okay, tax on updated return, 14 lakhs you calculate. Then TDS, TCS, advance tax, MAT, AMT, DTA credit, if any of these credits are there, adjust them. Then, since he already filed return initially, he has even self-assessment tax also. Sir, at the time of filing return, what you will do? You will pay self-assessment tax. So, since he already filed return, he might have paid some self-assessment tax also. Subtract that one. Okay, then, compute interest applicable under 234A, 234B, 234C. Okay, but at the time of filing return originally, also you might have paid some 234A, B, C interest. So, now add, sir, here what you are doing, sir, you are computing 234A interest based on updated return related tax. But at the time of original filing also you might have computed some 234A interest. So first you add on the cumulative amount and then subtract whatever you have paid already. Okay, so then you'll get what? Total normal tax. This is in case of what? When the return is filed. If return is not filed, then whatever the total income you are showing in updated return on that compute tax. Adjust if any TDS, TCS, advance tax, MAT, AMT, DTA rate is there. Now on that calculate 234 ABC interest and even 234 FFE. Why? Because previously return is not filed. So that's why 234 F fees is also applicable. Add that, then you'll get the total normal tax. Okay. So now what is additional tax? Computation of additional tax. Sir, the additional tax depends on within how much time you have paid. Okay. Normal tax is this one, sir. Along with normal tax, you should pay even additional tax also. How much, sir? If it is paid within 12 months. Time limit after 139.45, but within 12 months from end of relevant assessment year. Sir, understand clearly here. 139 subsection 4 or 5 time limit expires by when? 139.4 means what? Belated return. 139 subsection 5 means revised return. What is the time limit for them? 3 months before completion of assessment year. What does it mean? 31st December. Okay, let's say here assessment year 25-26 taken. That means the time limit is what? 31st December 2025. From here, not 12 months. From here, time limit after 139 subsection 4-5, but within 12 months from end of relevant assessment year. Sir, this is 31st December 2025 and when the assessment year ends on 31st March 2026, from there again 12 months. So overall the period is not 12 months here, it is how much? 15 months. Because in the current assessment year only last 3 months, after expiry of assessment year also another 12 months. If you filed updated return in this period, then the additional tax you have to pay is 25% on normal tax. In normal tax, you should include surcharge, cess and even interest also. On the total of that amount, you should pay 25% as additional tax. Sir, after 12 months, but before 24 months, the additional tax is 50% on normal tax. If it is between 24 to 36 months, 60% on updated, normal tax. If it is between 36 to 48 months, means it is 70% on normal tax. It is 70% on normal tax. Right, sir? So what is the additional tax to be paid? From the time limit related to 139 subsection for belated return or revised return. Nothing but 31st December of assessment year. From there till 12 months from completion of relevant assessment year. So total period will be 15 months, not just 12 months. For all this period, in this period, if you have filed updated return, pay normal tax plus additional tax at a rate of 25% on normal tax. If it is between 12 and 24 months, then 50% on normal tax is the additional tax. Then between 24 to 36 months, then 60% on normal tax is the additional tax. 36 to 48 months, then 70% of normal tax is the additional tax to be paid. So to understand this one, created an example. Let's say Ramesh is a resident individual, has the following details for assessment year 24-25. Original income he reported is how much? 7 lakhs. Additional income discovered later is 2,50,000. Original income reported is 7 lakhs. And additional income discovered later is how much? 2,50,000. Taxes already paid. TDS 30,000, advance tax 20,000. Due date of return is 31st July 2024. Original return filed is 31st December 2024 and updated return is filed on 31st August 2024. Assume old tax regime and cess at a rate of 4%. Sir, he filed 31st December 2024. But the assessment year ends when 31st March 2025. From there, when he filed, so how many months is there, sir? Between this time, 31st August 2027. How many months is there? Sir, 31st March 2025 to 31st March 2026, 12 months. 31st March 2027, 24 months. Okay, 16 చెప్తున్నారు మీరు. Already 24 దాటిపోతుంది. 25 to 27 itself, 24 months. So after 31st March 27, how many months are there? April, May, June, July, August, 5 months are there. 24 plus 5, total how many months, sir? 29 months. Can they file updated return? Yes. Updated return can be filed till how many months, sir? 48 months from the end of relevant assessment year. Here assessment year is what? 24-25. Assessment year 24-25 ends on when? Assessment year 24-25 ends on 31st March 2025. And the time is how much, sir? 29 months. Okay. They filed on 31st August 2027. We can even tell how much additional tax they should pay. Percentage. Additional tax percentage, tell, sir. 50%. Huh? Up to 12 months from end of relevant assessment year, 25%. Up to 24 months, 50%. 24 to 36 months, 60%. So additional tax is 60% of normal tax. Clear? Till this point, okay. So first they reported original income 7 lakhs. Sir, what we'll do now? First we'll find out how much they paid tax originally. How much they paid tax originally. Sir, forget about 234B and C whether they are applicable or not. I think mostly they are not applicable also. But even if there is 234BC also, okay, forget about 234BC. We are only considering 234A interest alone. Okay, for that, sir, let me make this clarification. 234A interest. If a return of income filed, then interest has to be calculated. Interest at 1% per month or part month from due date of filing return. Due date of filing return of income to actual date of filing return of income to actual date of filing return of income. Due date of filing return of income to actual date of filing return of income. You need to calculate 234A interest. Sir, first, original income is how much? 7 lakhs. Now calculate and tell me, on 7 lakhs under old regime, he is an individual, what is the tax liability? On 7 lakhs, what is the tax liability? Huh? 54,600. Okay, including cess, it is 54,600. 52,500 is what? Tax. And then cess at a rate of 4% is 2,100. So total liability here is how much? 54,600. Okay. Sir, when he filed return, due date of return is 31st July. But when he filed 31st December 2024. 31st December 2024. So how many months delay he has made? August, September, October, November, December. 5 months. Okay. So for 5 months, sir, before that, sir, out of this total tax liability 54,600, already some amount is paid. By way of what? TDS and advance tax. So from 54,600, subtract this TDS 30,000, advance tax 20,000. So 4,600 was the tax due. On this, we should calculate what? 234A interest. 4,600 into 1% into 5 months. How much? 230. Okay. So total amount he paid at the time of original return is tax liability 54,600 plus interest 234A. Total liability 54,830. Whereas since already 50,000 is there, additionally he paid how much? Sir? Total 4,830. I mean 4,600 self-assessment tax and 230 interest. This is at the time of filing normal return. We didn't came to updated return, sir. This is at the time of filing normal return he did. Now about what? Updated return. Sir, updated return, what they found? They discovered additional income later. How much? 2,50,000. Now what is the updated income? 9,50,000. So now at the time of filing updated return, we should compute tax on what? Updated income 9,50,000. So compute tax on 9,50,000 and tell. Tax plus cess. 1,06,600. 1,06,600. Now, out of 1,06,000, now again, sir, 234 interest. Out of 1,06,600, already there is TDS and advance tax, 30,000 and 20,000. And at the time of filing normal return, self-assessment tax also paid to the extent of how much? 4,600. So if you adjust all that, how much is there? 52,000 is there. 52,000 is there. Now, sir, on this 52,000, sir, usually at the time of filing return also, you should have reported this much as income. But you have shown only how much? 7 lakhs. So since only on 7 lakhs you calculated your 234A interest, which you computed originally, is wrong. So you should again recompute 234A interest also. 52,000 into 1% into 5 months. How much, sir, it is? 2,600. Okay, now finally if you see, total tax liability is how much, sir? 1,06,600. Interest is how much? 2,600. Total 1,09,200. But you already paid some amount. How much you paid already? TDS 30,000, advance tax 20,000, self-assessment tax 4,600, and even interest under 234A you paid 230. So total you already paid how much? 54,830. From this you subtract this 1,09,200. How much, sir, it is? 54,370 is the normal tax to be paid now. Normal tax to be paid now is how much, sir? 54,370. Additional tax, how much percentage? 60%. So 24 to 36 months, additional tax is how much? 60%. So 54,370 into 60%, that is how much? 32,622. So the total additional tax to be paid at the time of updated return is that the normal tax payable 54,370 plus additional tax 32,622. If you round it off, it will become to 86,990 you should pay at the time of filing updated return. Sir, understood, sir, everyone, this point? Okay. Then we'll go into our workbook also and solve the questions quickly, sir. So question number 1, sir. So it is a CA inter question. Explain with brief reasons whether the return of income can be revised under section 139 subsection 5 in the following cases. Belated return, can it be revised? Can a belated return be revised? Yes. Return already revised, can it be revised once again? Can a loss return be revised? Go and check. Okay, నన్ను అడిగే పని లేదు, మీరు వెళ్ళిపోయి మళ్ళీ ఓపెన్ చేసి చెక్ చేయండి, అది మీకు తెలియాల్సిందే, నేను ఎక్స్ప్లెయిన్ చేయడానికి ఏముంది అక్కడ? దర్ ఇస్ నథింగ్ టు ఎక్స్ప్లెయిన్ దర్. If you have doubt, now again open what? 139 subsection 5 and read all the points once again. So revised return. Which returns can be revised, sir? If there is any omission, wrong statement in return of income under 139 subsection 1 normal return, 139 subsection 3 loss return, 139 subsection 4 belated return, even 139 subsection 5 revised return. All these can be revised. So in all these 3 cases, what you can revise, but you cannot just simply say like yes, yes, yes. You need to give explanations also. Then question number 2. State whether the following SSCs have to file return of income. If so, what is the due date? Sir, a registered trade union and a public trust hospital, you are there. This registered trade union having income from let out property 1 lakh. Sir, this is having exemption under section 10. So what does it say? Under 139(4), those subpoints will be there. There it is said like, before giving exemption, you should check whether their total income exceeds basic exemption limit or not. See, a registered trade union is having income from house property, which is exempt. Okay, section 139 foresee mandates filing of return only when the total income exceeds maximum amount not chargeable to tax, nothing but basic exemption limit without giving provisions of section 10. In the case, even without giving effect of 1024, their total income is how much, sir? 1 lakh only, which does not exceed basic exemption limit. So, are they required to file return or not required to file return of income? In first case, there is no mandatory requirement to file the return. Second one, sir, a public trust hospital having an annual receipts of 505 lakhs and availing exemption of 3,40,000 under section 1023C with total income of 2,40,000. Sir, their total income now is how much? 2,40,000. If this exemption, sir, after exemption it is 2,10,000. If you add back exemption, how much it will be? 5,50,000, which exceeds the basic exemption limit. So what they have to do? They have to file return of income. Okay, it is how much, sir? See, 5,50,000, which exceeds 4 lakhs. Sir, why 4 lakhs has been taken? Default regime. Okay, if nothing is mentioned now, we should check only what? Default regime. It exceeded 4 lakhs basic exemption limit. So trust has to file its return of income by 31st October 2026. Sir, why October, sir? Where it is mentioned? Sir, their receipts are 505 lakhs. So tax audit is applicable. Since audit is applicable, it is 31st October 2026. Turnover exceeding 1 crore. Okay, read the question and understand and think in each case whether return has to be filed or not. Question number 3. Okay, first case, sir. X is a resident individual, age 80 years, has total income of how much? 2,85,000. He has claimed a deduction of 1,50,000 under ATC. Okay, sir, we want gross total income or net total income for return of income. Gross total income. So this total income they said it is what? Net total income. So this is after claiming deduction. So 2,85,000. So for 2,85,000 is the net total income. Then they have deduction 1,50,000 under ATC. Long-term capital gain 88,000 is not taxable by virtue of exemption under specified threshold under 112. But still, it was included in 2,85,000. Assume that he has opted for normal provisions of income tax. Whether he is required to file total income or not. Sir, what is this total income? 2,85,000. Sir, this 2,85,000 already includes long-term capital gain. So we need not to add. This long-term capital gain 80,000 they said, nah, that is already included. Why? Because all the incomes are part of total income. So already 80,000 included. But since it is net total income, they already claimed what? Deduction. So we want gross. So what do we should do? We should add back deduction 1,50,000. How much, sir? 4,35,000. Sir, 4,35,000. He is what? X is a resident individual, age 80 years. So he is what? He is a super senior citizen. Since he is claiming deduction under ATC, we can assume like under which regime he is? Old regime. Sir, in default regime now he cannot claim ATC, right? So that's why we need to consider him as what? Under old regime. Sir, under old regime for senior citizen, what is the basic exemption limit available? 5 lakhs. So his gross total income didn't exceed 5 lakhs. So is he required to file return of income? No, he is not required to file return of income. Then would your answer change if he has incurred 1,05,000 towards payment of electricity bills? Yes. Since it is a specified financial transaction, electricity bill in excess of 1 lakh in a financial year, he has to file return of income mandatorily irrespective of his total income. Then ABC is a partnership firm which has a loss of 10,000. Tell, is it required to file return of income? Firm, sir, no income. It is having loss. Company, firm, LLP, the first line itself is that in the chapter. Company, firm and LLP has to file return of income mandatorily irrespective of their total income. So here even though it is loss, they have to file what? Return mandatorily. Then an association eligible for exemption under 1023B has income from house property. Sir, yes, house property income is exempted for them. But if you don't claim exemption, what is the total income? Because we need to check without claiming exemption under section 10. So then what is the total income? 6,60,000, which exceeded basic exemption limit. Okay, then they have to file what? Return of income. Then Y aged 45 years, an employee draws a salary of 5,90,000 and his income from fixed deposit with bank is how much? 10,000. Sir, he draws salary 5,90,000. From their standard deduction available 75,000 under default regime. Old regime it is 50,000. Okay, depending whatever he has claimed, any of the regimes, and he has FD interest of 10,000. So overall it will be more than basic exemption limit only. So he has to file what again? Return of income. Sir, look at question number 4. Read quickly. So try to read questions on your own and at least check how far you can recollect the answers. I already know the answers. Even if I don't know, it's not a problem. Only if you don't know, it's a problem. So see, question number 4. What is question number 4? We need to exercise the option to shift out from default regime. Okay. Submit is return of income under optional regime. Optional regime is nothing but what's now? Old regime. Okay. Consisting of income under at salaries, house property, bank interest. On 21st December 2026, he has filed return. He realized that he has not claimed deduction under section 80 Dtaa in respect of his interest income on the savings bank account. He wants to revise his return of income. Can he do so? Okay. Can he do so, sir? Yes. He has time limit till what? 31st December 2026. He has the time to revise the return. So he filed 21st December. It is a what? Belated return. Even it is a belated return, it still can be revised till 31st December 2026. Okay. Examine would your answer be different if you have discovered this in 21st March 2027? Yes. The answer will be different. If he has discovered on 21st March 2027, by that time, the time limit to revise return under 139 subsection 5 has been expired. So you don't have the option to revise. Yeah, he can file updated return. He can file updated. No, he cannot even file updated return because here it is not creating additional tax. He is claiming what? 80 Dtaa deduction, which results into reduction of his income tax liability, not increase of additional tax liability. So he can't even file updated return also. Then question number 5. Explain the term return of loss under Income Tax Act 1961. Can any loss be carried forwarded even if the return of loss has not been filed? Sir, we have discussed detailedly, sir. Which losses can be carried forwarded? Cannot be carried forwarded, you tell. Which losses cannot be carried forwarded? Cannot be carried forwarded. Which losses cannot be carried forward? Business loss, speculative business loss, specified business loss, capital loss, then loss from owning and maintaining horses for race. These 5 can't be carried forward if return is not filed by the due date. Which can be carried forwarded? House property loss and unabsorbed depreciation can be carried forwarded even though return is filed belatedly. However, sir, the restriction is only for carry forward, not for set off. Then question number 6. List the persons who should apply for PAN. Every person who is accessible to tax on or before 31st May, who is accessible to tax. That's what we wrote in the book. Then every person carrying business or profession and total over turnover exceeds 5 lakhs or likely to exceed 5 lakhs. Then they have to apply by when? Before the end of that financial year. Or a resident person who enters into a financial transaction of aggregate rupees 2,50,000 or more, and such persons related director, partner, principal officer of such person on or before 31st May of the immediate following financial year. Then how many questions? Okay, 12 questions here. Okay. Seventh question. X is an individual, got his books of accounts for the year ending 31st March 2026, audited under section 44AB. His total income is 5,20,000. He desires to know if he can furnish his return of income for the assessment year through tax return preparer. Tax return preparer. Sir, who cannot file returns through tax return preparer? Specified class of persons. Who are called specified class of persons? Any company or any person who has requirement to get their books audited under section 44AB or any other act, whether his books of accounts audited or not. Audited. Since his books of accounts are audited, he cannot file his return of income through tax return preparer. So that is the conclusion, sir. Here he cannot furnish his return of income through tax return preparer. Then question number 8. Akash has undertaken certain transactions which are listed below. You are required to identify the transactions in respect of which quoting of PAN is mandatory in related documents. Payment of life insurance premium 45,000, sir. Sir, when it is mandatory, excess of 50,000. So here PAN not required. Payment of rupees 1 lakh to a 5-star hotel for stay for 5 days with family, out of which rupees 60,000 was paid in cash. Sir, payment in a hotel more than 50,000 in cash. So what? Applicable. PAN has to be quoted. Then payment of 80,000 through ECS for through bank account for acquiring the debentures. Yes, sir. Any Indian company debentures, if you are buying for more than 50,000, then also 50,000 or 1 lakh. 50,000 only. Okay, it is applicable. Let me show you. Bonds, debentures of a company or institution. How much, sir? 50,000. Then payment of 95,000 by account pay check to Thomas Cook for travel to Dubai for 3 days to visit relatives. Sir, how much, sir? 50,000, but the payment is through cash. What he has did? 95,000 he paid, but it is through what? Account pay check. So not required, sir, not mandatory. See, fifth one. No, since the amount was paid by account pay check, quoting of PAN is not mandatory even though payment exceeds 50,000. If it is through cash, then payment has, then PAN has to be quoted mandatory. Then applied to SBI for issue of credit card. Debit card and credit cards are mandatory to quote your PAN number. Okay, so this question, little important, sir. Conceptually, I think this point we didn't wrote in the notes. So here we'll see. What will be the consequences when Raghav paid 75,000 in cash to a travel agent for foreign travel, excess of 50,000? But that means he has to quote what? PAN number. But business purpose, by intentionally quoting the wrong PAN. Would your answer be different if such cash payment was payment for travel to Nepal? See, if a person is required to quote his PAN in any document, quotes a number which is false and which is either knows or believes to be false, then how much is the penalty, sir? Then AO may direct such person shall pay penalty of 10,000 under section 272B subsection 2. In the given case, sir, since Raghav was misquoted, a penalty under 272B is leviable. Okay, however, sir, before levying penalty, opportunity of being heard has to be given. Okay. The answer would remain same even if it is to Nepal, because there is no exception for Nepal, sir. They said simply foreign travel. Then updated return. X would like to furnish his updated return for assessment year 25-26. In case he has furnished updated return of income, he would liable to pay 2,50,000 towards tax and 35,000 towards interest after adjusting tax and interest paid at the time of filing earlier return. You are required to examine whether X can furnish updated return in the following dates. If yes, compute the amount of additional income tax to be paid also along with updated return. Sir, they already given us normal tax to be paid. See, X would like to furnish updated return. In case he furnish updated return, he has to pay how much? 2,50,000. And interest how much? 35,000. So they already said normal tax. We need not to compute what is this normal tax. Okay. They are asking whether he can file updated return or not under those 3 different situations. If he can file, how much is the additional tax he has to pay? Sir, first, what is the end date of from assessment year 25-26? First we need what, sir? Not 31st straight away, sir. The due date of filing revised return we need first. So that is what? 31st March 2025. Okay. And from there we count till 31st March 2026 because that is the end date of assessment year. So here 3 months, and from here we should count how many months? 12 months. So from 31st March 2027. This is the first case. Then what? Sir, 12 months happened here. Then the next one is what? 24 months. 24 months not till when? 31st March 28 time limit is there. Then 36 months means till what time is there? 31st March 2029. Then 48 months now he has time till when? 31st March 2030. Yes, time limit. Now, what are the instances they gave, sir? 31st March 27, 28 February 28, 31st May 2028. Sir, in all these cases actually you can file updated return because 48 months expires only by 31st March 30. But we need to understand in which each case how many months it is. Sir, they filed on 31st March 2027. That means what? Within 12 months. Less than or equal to 12 months. So what is the additional tax, sir? 25%. Then by 28th February 28. Sir, that means by 31st March 28. So how many months less than or equal to 24 months? How many months, sir? How many? 50%. Then here by 31st May 2028. Sir, after 36 months. So, sorry, after 24 months. So, it is what? Less than or equal to 36 months. It is how much? 60%. Sir, before amendment, in this case, there is no updated return option. Third case. But now with amendment, even in third case also we can file updated return, and we should pay how much as additional tax, sir? 60%. We'll calculate that also. 2,50,000 plus interest, how much? 2,85,000. So on 2,85,000, calculate 25%. How much? 71,250 in first case. Second case, sir, 50%. 1,42,500. Third case, 60%. 1,71,000. $71,250, correct only, na? 1,42,500, and third one, 1,71,000. Then question number 11. Miss Heatle, an individual engaged in business of beauty parlor, has got her books of accounts for 31st March 2026 audited. Her total income is 15,35,000. She wants to furnish as return through tax return preparer. Not possible. Why? Audit applicable. So she is a specified person. She cannot, specified class of person. She cannot file her return through tax return preparer. Then state with reasons whether you agree or disagree with the following statements. Okay. Return of income of LLP could be verified by any partner. First, designated partner. If designated partner is not available or mentally incapacitated, then any other partner. Okay. See, the disagree. Should be by designated partner. Okay. Any other partner can verify when there are any unavoidable reason for designated partner or when there is no designated partner. Then time limit for filing return under 139(1) in case of A having total turnover of 160 lakhs for the year ended 31st March 2026. Whether or not declaring presumptive income under 44 AD is 31st October 2026. Disagree, sir. See, A offers his business income if as per presumptive taxation, it is 11.6 lakhs. Why? 100 lakhs into 8% we do. Balance 60 lakhs into 6% we'll do. 100 into 8% na 8 lakhs, 60 into 6% na 3.6 lakhs. Total how much? 11.6 lakhs. So if we opt for presumptive taxation, then the due date will be only 31st July because audit is not applicable. If we didn't opt for presumptive taxation, then audit applicable. In that case, it is what? 31st October. But what they said, irrespective of they opted for presumptive scheme or not, their due date will be 31st October. It is wrong. If they opt for presumptive scheme, due date is what? 31st July only because audit not applicable. If they didn't opt for presumptive scheme, then the due date is 31st October. Okay, sir. So with this, we have completed return of income, sir. So next, last 3 attempts if you see. Consecutively, they're asking like 3A, 3B, both are related to tax planning. I mean, I feel this is a pattern and this is going to be continued also mostly. Okay. Just to avoid, in case if they change the pattern also, we are discussing other model questions also. Okay. So 3A, they're asking optional versus a default from the perspective of individual. Whereas 3B, they are asking again optional versus default from the perspective of company. Okay, this is the standard format, sir, which happened in December 25, June 25, and even in December 24 also. Okay, this happened. Before attempts, this is not the place. Sir, before attempts also, I mean in June 24, December 23 also, out of these two, one question used to be the same way, either like individual or company, one used to be in this way only. The other question they used to do that test that by make or by decisions and other random questions and all. Okay, so now we could expect like in June 26, December 26, this only mostly will happen. Okay, but to eliminate the other chances also, we'll do the other model of questions also, but focus should be more on these questions. Okay, now tax planning. Even though the chapter name is, we are simply referring it as tax planning, sir, the whole chapter name will be tax planning, tax avoidance, tax evasion, and then tax management also. So we need to understand these 4 terminologies: tax planning, tax avoidance, evasion, and even management. Sir, management is something related to compliance. Tax management is something related to compliance. You effectively, I mean, you filing the returns on time comes under tax management. You paying advance tax within the advance tax installments comes under tax management. You paying the self-assessment tax, or you deducting applicable TDS and paying the TDS to the government within the time. So all those procedural compliance related to avoid litigations, to avoid disputes. Okay, the compliance wise, you'll make them everything properly, correctly, then it comes under tax management. So management is nothing but there is a team for you which look after the tax compliances, and they effectively check after each and every requirement, and they do that on time. When they are doing that on time, or when they are doing, there is a systematically they are doing if any tax related, then that comes under tax management. Okay, so a return has to be filed. That if it is filed by due date, then comes under tax management. If advance tax are there, 4 installments are there, if you paid all the 4 installments, comes under tax management. Minimum 90% has to be paid as advance tax to avoid 234B interest. If that is paid, then that comes under, I mean, if that is not, if that is to avoid that, if it is paid within time, tax management. If 234A, B, C interest come and that is computed and paid again, that also comes under tax management. All the compliance related aspects will come under tax management. Okay, when TDS is deducted to the deductee, a form 16 has to be given or form 16A has to be given. If it is given, then that also comes under what? Tax management. On a transaction, TDS has to be deducted. If TDS is deducted, again that comes under what? Tax management. Okay, so tax management is a system you have within your company or a team you have within your company which look after the tax related following the rules, complying the rules without to avoid any penalties or extra litigations from the department. Okay, compliance wise this is. Now tax planning. Sir, tax planning means you within the legal boundary, I mean, you're not doing anything illegal. You're within the tax boundary only, within the legal boundary only, first one. Then you're not just looking at the script. Script na what written in the text or what message is being conveyed by the text. Only if it is taken, then you are just taking the meaning of script. So sometimes message will have an intention also. Okay, a law or a section is introduced, then that section will be introduced with an intention. Okay, if that intention is kept aside and only script interpretation is there. Okay, so but tax planning, script also will be considered and even the intention behind that section also will be considered. Okay, in which way the section is formulated by the government, same way you will also interpret it. Okay, same intention you will also take it. Then that comes under what? Tax planning. Then tax avoidance. Sir, tax avoidance, na, this also within the legal boundary only. This also within the legal boundary only. But script only considered, not the intention. Script only considered. So script only considered, na, the text, whatever the message is communicating, if multiple views are there, they take whichever is best to them. The moral or the intention behind the section will not be considered. Only script interpretation will be considered. Sir, tax planning is moral also and legal also. Whereas tax avoidance are immoral or nothing but unethical. Unethical, but still it is what? Legal. Still it comes under what? Legal only. Tax avoidance is legal boundary, script only will be considered, not the intention behind the script or a provision. Tax planning is what? Moral and even legal also. Whereas tax avoidance are immoral, but still it is under the legal limits only. See, we said the Reliance example. Okay, when we are discussing MAT, what I said, till 98, 99, Reliance never paid tax. It has used the loopholes and exploited them. That comes under what? Tax avoidance. For the last time, what it did, it has revalued the assets. By doing the revaluation, it claimed more depreciation because of that their book profits came down. And again, they can avoid MAT applicability. So that's a loophole. So okay, they have exploited the loophole, sir. There is no tax planning there. It involves what? Tax avoidance. Sir, tax planning generally long-term in nature. Because that is even encouraged by department also. Like what? You taking a life insurance premium, ATC. You transferring a property to your minor son. So when a property is transferred to minor son, initially the income gets clubbed. But after a period of time, the income on that property will be assessed in whose hands? That child capacity only once he became major. So with considering after 15 years or after 18 years, you did a planning now itself. Okay, when we diversify the properties in child name and even the parent name, once the child become major, that will be accessible separately in his capacity only. So again, he can enjoy the slab rate benefit. That is what? Tax planning. That is called tax planning. Whereas tax avoidance, now with an intention to avoid the tax liabilities, which maybe short term, they are short term in nature only, sir, because within coming 2 years or 3 years, department will find out. Once they find out, they'll do a counter provision. Okay, deemed dividend. So I already explained you once at one particular point of time about deemed dividend. What private limited companies will do, instead of giving the dividend directly, if they give dividend directly, what? Company has to pay tax on the profit, and again, shareholder also has to pay tax on the dividend. To avoid that, what can company do? Ultimately, shareholder want money. So company, instead of giving it as a dividend, it will give it as a loan to the shareholder. But that loan is never going to be repaid by the shareholder. So now ultimately money flown from company to the shareholder, but the name is only different. Okay. So what 2 subsection 22 clause says, such kind of loans also has to be treated as deemed dividends only. Okay. So initially when they started, that is a tax avoidance. But to control that, government already inserted a provision under 2 subsection 22 clause. So tax avoidance you cannot do for so long. Maximum you can do 2 years, 3 years, 4 years. But then department, once it came to know that there is some tax avoidance going on there, then they'll do a counter provision there. Then it's a end for a tax avoidance. Okay. Then evasion, sir. Evasion is completely illegal with a malified or fraud intention. You may misappropriate the documents, misappropriate the accounts, and then you try to reduce your tax liabilities. Then that comes under what? Tax evasion. Under reporting of sales. Sales you made 1 crore, but you are showing only 50 lakhs as sales in the records. Then it comes under what? Tax evasion. So tax evasion is illegal, morally incorrect also, ethically incorrect also, and even legally also incorrect. For tax planning, it is encouraged by government. Okay, tax avoidance, sir, it is discouraged by government. Whereas tax evasion, sir, completely against to the provisions of the principles of tax law. So you will be prosecuted, you will be ending up with penalties also. But for tax avoidance, you will not get any penalties because you are still within the legal boundaries only. Okay, so let me show you the points here, sir. Tax planning. It is a way to reduce the tax liability by taking full advantages through various exemptions, deductions, rebates, and relief. Tax avoidance, it is an exercise by which SSC legally takes the advantages of loopholes in the act. Whereas tax evasion is illegal way to reduce the liability by deliberately suppressing income or sales or by increasing expenses, etc., which results in reduction of income of the SSC. Okay, sir, here what is the important word, sir? Here also reduce tax liability, but through what? Various exemptions, deductions, and rebates. here also legally takes advantage of what? Loopholes. Tax avoidance means. Here it is illegal way to reduce tax. How? By suppressing income or sales or by increasing expenses. Whereas tax management is a procedure to comply with provisions. Is a procedure to comply with provisions. Then tax planning is a practice to follow the provisions of law, which is moral framework, within the moral framework. Tax avoidance is a practice by bending the law without breaking it. So once you break it, it comes under tax evasion. You don't break the tax law. Within that only you'll interpret it in your convenient way. So it's called bending. Okay, whichever the way when you will only consider the text. Whichever way it is beneficial, that way you take. So you are just bending the tax law, you are not breaking it. Evasion, completely you are breaking it. Okay, evasion is illegal both in script and even in moral. Okay, whereas tax management, sir, it is implementation or execution part of taxation department of an organization. Okay, why tax planning, sir? Again, reduce liability only by applying the script and even moral. Whereas tax avoidance reduce the tax liability by applying only script, not by applying moral. Whereas here, sir, reduce tax liability by applying unfair means both script and moral also not applied. Management is nothing but complying with the provisions of law. Okay. Tax planning is futuristic and positive in nature. This is made to avail the benefits in future, tax planning. Whereas this is avoidance is also futuristic only, but it is short term in nature. Why? Once the loophole will be corrected they'll be correcting the loopholes in the future amendments, and there is no scope of avoidance. Then tax evasion, it is concerned with past and applied after the liability of tax has been arisen. It is done with a negative approach to avail the benefits by killing the moral of law. Okay, management is a continuous approach. Okay, then benefit. Generally, with the tax planning, the benefit will be long run. Management, short run. Whereas with the tax evasion, logically there is no benefit at all. Because once such person is caught, all the benefits will be taken away, and even additionally there will be penalties and prosecution also. With effective tax management, what happens, sir? You will file returns on time. So you can avoid late fees, interest, penalties and all. So penalty, interest and prosecutions can be avoided. Okay, treatment of law. Tax planning uses benefits of law. Tax avoidance uses loopholes of law, whereas tax evasion, it completely overrides the law, and then management is nothing but it implements the law. Okay, tax planning is a tax saving device, sir. It is tax hedging, it is tax concealing, and it is tax administration. Okay, planning is desirable. What? They encourage that one. Whereas tax avoidance is avoidable. They'll not encourage it, avoidable. Whereas this is completely objectionable, and management is essential. It is moral, immoral, illegal. Tax management is a duty. What are the objectives of tax planning? What you will get with the tax planning? Your tax liability will be reduced. How tax liability, sir? By availing various exemptions, deductions. Overall, our tax burden will come down. Minimization of litigation also, because you are not going something beyond the law. Even in script also you are following, moral also you are following, so you are not doing something. Okay, and that is desirable by the department also, encourageable by the department or government also. So the litigations will be minimized. Productive investment. Sir, to get tax savings and all, you do productive investments. Let's say life insurance premium, equity shares, mutual funds, post office savings deposits, NPS contributions. Okay, all these are like what? Certain meaningful productive investments. So to get the tax planning, you do certain productive investments which will help you in long term. Then healthy growth of economy, because you don't have any unaccounted money or unaccounted cash. All the money you have is within the legal system only. Okay, see, legitimate tax planning promotes both individual prosperity and economic growth by encouraging the flow of white money. Unlike illegal savings that generate black money, proper tax planning supports transparent and sustainable development. Sir, when you do tax planning, whatever the money you have is what? White only. So that you will not keep in your house ideally as cash, because that is white only. So you'll deposit in bank. Once the money is deposited in the bank can use it for lending to someone else, and all the economy will grow. So like that it is gonna help, sir, when it is what? Tax planning. Then essentials of tax planning. To do tax planning, what has to be done? Up-to-date knowledge, sir. What are the amendments came? All those you need to know, because every year to encourage a tax planning, certain new exemptions or deductions will be introduced. Okay, one such one is like NPS Vatsalya account, recently introduced. What? Till now, sir, NPS contributions will be made for himself. But now what? Even if any NPS contributions made on behalf of children, that also can be claimed as deduction under 80 CCD 1B to an extent of how much? 50,000. Okay, you should be updated about those points and you'll get how much? 50,000 deduction also. Up-to-date knowledge, true disclosure, no colorable device. Sir, what is called colorable device now? So there is a case law, Commissioner of Income Tax versus Keshavji Murarji. Commissioner of Income Tax versus Keshavji Murarji. It is a Supreme Court case law, sir. Okay, what happens means, sir, when individual transfers any asset or money without adequate consideration to his spouse Okay, if any asset transferred to spouse without inadequate consideration, then the income arising from this asset has to be clubbed in the hands of individual only. Even the legal owner is whom? Spouse. But the income arising from such asset has to be clubbed in whose hands, sir? Individual hands only. Okay. Same way, when individual transfers any asset to his minor child until he becomes major, whatever the income arising from such asset, that income will be clubbed in the hands of transferor only. Okay. Or the parent whose income is higher. Those provisions are there. Right. Now, what is this case, Lana? There are two brothers, sir, B1, B2. Two brothers. Okay, here B1 wife and here B2 wife. Sir, what happens usually when individual transfers a property to his spouse, clubbing applicable. So what they are doing, instead of transferring directly to their spouse, this brother transfers property to brother's spouse. And even he also transfers property to brother's spouse. So instead of directly transferring to their spouse, they are transferring it to their brother's spouse. Then actually, if you look at the script of the law, clubbing provisions are not applicable because clubbing applies only when you transfer it to the spouse. Okay. Now, the matters are actually, commissioner said like, no, this comes under the purview of clubbing only. He said like it has to be applied. Okay. Then the matter went to Supreme Court. Supreme Court said like this transaction is a colorable device. Okay, colorable device to prevent or to avoid taxation. So even though this arrangement is made, still clubbing provisions can be applied. So on this property, whatever this she gets, whatever the income brother one wife gets, that income has to be clubbed in the hands of respect to husbands, not the transferors. Okay, so her income will be clubbed in the hands of husband. And same way, this second brother's income also has to be clubbed in her husband. So only this happens with respect to brothers only. In case of sisters also, it will not happen because mostly brothers will have identical properties. If father has, let's say, 5 acres of land, what will do? One side 2.5 will give to one brother, the other side 2.5 give to other brother. So these are mostly commercially interchangeable. So no problems will come. Okay, when there are two commercial complexes, one will be given to one brother, the other one will be to second brother. So mostly in brother cases, there will be identical properties. So they can transfer, instead of directly to their spouse, they can transfer to their brother's spouse and can avoid tax liabilities. But in this case law, sir, Commissioner of Income Tax versus Keshavji Murarji, they said like this is a cross transfer, which is a colorable device to prevent tax or to avoid taxation. So here they applied clubbing provisions, okay, because they considered the intent of the law, moral of the law, rather than the script of the law by the Supreme Court. Okay, so essentials of tax planning. What? There shouldn't be no colorable device. If there is a colorable device now, then there may be litigation. In litigation, we don't know what happens. Okay, aligning with future goal. If you have a future goal, so in such way only tax planning has to be gone. Tax planning, short range of tax planning. Short range of tax planning now, you investing in LIC, equity, okay, those 80 deductions, 80C series deductions if you are claiming, that comes under short-term tax planning. Long-range tax planning, transferring a property to minor. Okay, now there won't be any tax benefit, but after 10 years, 15 years, that property-related income will be separately assessed in minor capacity only, or creating a HUF. Okay, an individual creating an HUF, and certain properties are given to the HUF. Now, HUF will have a separate slab benefit. This individual will also have a separate slab benefit. Those will come under long range of tax planning. Then, permissive tax planning. Okay, permissive tax planning is nothing but planning which is allowed and encouraged. So, to claim exemptions and all. Purposive tax planning. Sir, purposive tax planning, sir, again, we cannot say how much, even though they said like, sometimes it even slip into tax avoidance also. Then areas of tax planning, where the tax planning can be done. Form of organization or ownership itself. Because firm better, sole proprietorship better, company wise better. There itself you can do tax planning. Which organizational structure gives you better benefit, tax benefit there. Locational aspects. Sir, why location? In SEZ unit now you have certain benefits. Normal unit now you may not have certain benefits. Or in special category states, you will get some other tax benefits. So location wise you can do tax planning. Nature of business. Sir, normal business, one kind of taxes. Speculative business, specified businesses. Specified business now what happens? 100% of their capital expenditures is allowed as deduction. So depending on the type of business also there can be tax planning. Tax planning in case of corporate restructuring. Whether to go for amalgamation or in better things, sir, we have questions also in business restructuring. Whether to go for slump sale or whether to go for demerger, which is better? Slump sale better, demerger better. So such kind of restructuring related we can do tax planning. In respect of financial management, whether to take equity better or whether to take it as a loan better, or that loan also from a bank, 2-3 different types of loans will be there. Which loan is better? That comes under what? Financial management. In respect of employee remunerations, whether to give it as a allowance or to give it as a perquisite, which is better? Sir, employee certain benefits will be given like car, servant, then accommodation, travel related. Whether if they are given as like allowance better or given as perquisite better, their tax planning can be done. In respect of specific managerial decisions and tax planning in respect of non-residents. So all these areas we can do tax planning, sir. And then the next table, sir, I need not to explain separately. This is something like benefits with company, firm, sole proprietorship. Every kind of organization have its own benefits and own disadvantages. Sir, what is the benefit with companies? Limited liability, sir. what limited liability, you are only to an extent you are responsible. In company, what the risk taking will be high, because money is one person's, decision is taken by some other persons. Sir, if it is your money and I have to take decision, I'll be much more aggressive, because it's not my money, obviously. Okay, I will do much more aggressively. So risk also will be more, premium also will be more. Okay, then when it comes to firms, sir, risk at least scattered. Why? Because there are multiple partners are involved. So your own risk will be comparatively less, because the total risk is shared by the partners. When it comes to sole proprietorship, complete risk is on sole proprietor. But where decision making will be quick. In sole proprietorship, the decision making will be quick, because he is the only person to react. Once he decides, it acts quickly. Partnership firm, comparatively better. But in company, sir, general meetings has to happen, board meetings has to happen, and there they have to take a decision. So comparatively, decision making is longer in which process, sir? Company. And in company status, company has to pay tax and shareholder also has to pay tax on dividend. In case of firm, company pays tax on profits. To shareholder, that profit is exempted if the firm is registered in India. Sole proprietorship, there's nothing such kind of concept. Okay, I mean, only sole proprietor hands only it is tax. Again, he'll not be giving to someone else. Next. Remunerations. Sole proprietorship from his business, he cannot claim his own remuneration. But partnership firm can claim remunerations of their partners, but there is a limit. 40 subsection B, how much interest they can claim, how much remuneration they can claim. But for company, there is no such restriction with respect to the remuneration that can be taken by directors and all. Okay, there is no restrictive clause there. So we have discussed tax rates, then remuneration I already said, distribution said. Then for companies only certain expenses are allowed. If you remember, sir, in PGPP, capital expenditure on promotion of family planning or expenditure on promotion of family planning, that is allowed only to companies. Whereas to other firm, other things, it is not allowed. So certain expenses are allowed only with respect to companies. Sir, where it is easy to bring additional capital, company or firm or sole proprietorship? Where it is easy to bring additional capital, sir? Sole proprietorship is comparatively tough, because only you should bring the money. How much you will bring? So if you have a limited money, then you cannot bring more. But whereas a company, many people are involved, so it is easy to pull the money once again. Firm comparatively better than that of sole proprietorship. Out of all this, which becomes which is so tough to bring additional capital? Sole proprietorship. Loan also. Where it is easy to bring loan, sir? Company only again, because since the company has succession, sir, individual may die, but company will not die. Company will have perpetual succession. Okay, Dhirubhai Ambani, long back he started Reliance, but still from Dhirubhai it came to Mukesh Ambani. From Mukesh Ambani now it is transferring to their child also. So the people, the thing is like what, companies will have perpetual succession. So banks will trust more companies to give loans, because it is not dependent on one particular individual. Firm comparatively better than that of sole proprietorship. Out of all this, which is more risky, sir? Loan for sole proprietorships only. Banks will not be interested in giving loans. Limited liability, we said. Liability of business also said. Size of business. Comparatively, sir, sole proprietorship, we cannot, mostly they are not scalable. They can operate only in a smaller scale. Whereas partnership firm, it can be increased, sir, maximum up to 20 partners. Whereas for companies, sir, there is no limit at all. But it's a public company, it can grow to whatever the size it needs. Okay, that's what, sir, theory related. Now we are coming to straight away to questions. Theory wise, they are not asking a question, so you need not to do with the theory. The only clarity you should have is like, what is tax planning, what is the tax avoidance, what is the tax evasion, and what is tax management. Those 4 areas, if you have clarity, then it would be simple. So tax planning, page number 6.1, come to question number 1. In respect of the following independent transactions undertaken during the previous year, state whether they are tax planning, tax management, or tax evasion. Each point, we have to decide whether it comes under tax planning, tax management, tax evasion. Okay? So starting with the last bench, we'll ask each one point, they'll decide whether they can decide or not. Okay, now Bhavya, tell. First point, whether it is tax planning or tax management or tax avoidance. Filing ITR before the due date in order to carry forward business loss. Tax planning or tax management. It is a compliance related activity, sir. It comes under what? Tax management. It is what? Tax management. Second point, sir, setting up a warehouse to avail tax benefit under section 35 AD. It comes under what? Tax planning, because you are not, whatever is the provision is there, that benefit you're gonna take, that exemption you're gonna take. It comes under what? Tax planning. Then Pravalika, suitable point for you. Payment of medical insurance premium of 45,000 for a parent aged. Tax planning only, right? Still within the legal purview only. You are not bending the law, you are not breaking the law. So it comes under what? Tax planning. Vaishnavi, fourth point. Tax management, because it's a compliance related aspect. Okay, collecting PAN details from the deductees, it comes under a compliance or procedural aspect. So it comes under what? Tax management. Next one. Recording in the books of account salary payment to J, who is not actually employed by SSC. What? Tax evasion, sir. Why? You are breaking the tax law. You are into some, okay, you are suppressing your expenses. Oh, sorry, not suppressing, sir. You are increasing your expenses. Okay, even though it's not an expense actually, you are claiming it as an expense. Recording books of account salary payment to J, who is not actually employed by SSC. So, okay, you are claiming a fake expense. Okay, then it comes under what? Tax evasion. Paying advance tax installments in accordance with section 211 comes under what, sir? Tax management, because again it is a compliance point, so it comes under tax management. Okay, last one. Gifting a property to major son in order to divert rental income so that it is taxed at a lower slab rate. Okay, there is no modified intention, nothing is there, so it is no colorable device also. So it comes under what? Tax planning only. Done. Okay. Mac. Question number 2, first point. Okay, sir. Sir, why not? Understand. Setting up of a licensing office in India. Sir, this is little. You need to understand transfer pricing and DTA chapter, sir, to write this point properly. So what they are doing, they are just starting a licensing office instead of starting a full-fledged establishment. Sir, when you have a full-fledged establishment, you will have a PE. Once if you have a PE, the income earning from such from connected through such PE will be considered as accrued in India and taxable in India. If you just have a licensing office, okay, it will not be counted as PE. So that income we cannot say like income accrued only from India. So it is better to what have a licensing office only than that to have having a full-fledged establishment. So it comes under what? Tax planning. Sir, if you see organizational structure, areas of tax planning we decided like location, organization structure, how organization has to be. If you keep a full-fledged establishment, then it will be called as a permanent establishment. Then once you have a PE, the income will be considered as what? Accrued from India only and taxable only. Whereas if it is a licensing office, you still be under the foreign company only. Okay, it won't be directly considered as what? Accrued in India. So licensing office or full-fledged establishment, that decision making will come under what? Tax planning only. Maheshwari. Tax evasion. What he is doing, sir? He installed solar power system in his residential premises, but claiming as an expense under the business books. So it is what? Breaking the tax law only. Okay, which is not permitted by tax law, but still he is taking, then it is breaking the tax law only. It comes under what? Tax evasion. It is illegal, immoral also. Then investment in bonds approved by section 54 EC. Tax planning, sir. 54 EC is what? Investment in NHA bonds, RECL bonds. Okay, if you have any long-term capital gains arising on transfer of a immovable property, such gains you can invest in NHA bonds, RECL bonds within 6 months from date of transfer. Then you will get exemption of amount invested or 50 lakhs, whichever is lower. So here how much you can claim, sir? 50 lakhs. 54 EC will come under what? Tax planning. The second one is what? Tax evasion. Okay, question number 3, sir, straight away. Okay, they're giving the points here itself. First one. Since the answers are there only, sir, we'll read out them simply. Okay. By the time you read the question itself, you know answer. Taking health insurance, tax planning, because you can claim ATD deduction. Form 15G through his income exceeds the basic exemption limit to avoid TDS. Submits Form 15G, sir. Usually Form 15G will be submitted when your income is within the tax slabs only, and you don't want to get TDS deduction and all. Then genuinely, if your income is within the slabs, you'll give Form 15G. But here, what happening? Even though it exceeds basic exemption limit, to avoid TDS, he is giving Form 15G. So he's trying to do what? He's trying to break the tax law or tax provisions only. So it comes under what? Tax evasion. Then third point, sir. Maintains proper records of TDS deducted from employees' salaries on the deposit and deposits them on. He deducts TDS and deposits in time to time. Tax management. Invest 1,50,000 in PPF to reduce tax liability under ATC. Planning. Create fictitious entries of rent paid. Evasion, sir. Fictitious entries, again, some fraud intention is only there. Forgets to file his return by the due date, but files before the end of assessment year. Management only. Okay, it's a issue with management only. Sells agriculture land in rural area and claims it as exempted income. Planning only, sir. Actually, agriculture land, if it is sold, that comes under exempted category only. So correct only, doing tax planning. Claims depreciation on his personal car in the block of assets. Evasion. Calculates advance tax liability and pays installments before due dates. Planning. Management. Hence 4,000 as interest from the savings bank and claims deduction under 80 DTA. Correct only, it comes under what? Tax planning. Okay, now again. First point, sir. Okay, life insurance premium he has taken. It comes under what? Tax planning. Books open. Evasion. Why? Personal cost. Personal expense is booking as a business expense because residence, AC installed in residence, but is claiming it as what? Business expense. So it comes under what, sir? Tax evasion. Tax evasion. First one, planning. Third one, sir. Mandeep. Y Limited maintains registers of tax deductions affected by it. So it comes under a procedural aspect, tax management. Next one, sir. Okay, see. Issues a credit note for 36,000 for brokerage payable, who is the son of G, managing director. The purpose is to reduce Z Limited income and increase A's income from 18,000 to 54,000. It comes under what? Tax evasion. Then DT. Evasion only, sir. Why he is treating as salary? Because if we treat it as salary, he can claim standard deduction. Okay, but income from partnership firm, salary from firm is to be taxable under, is to be taxed as PGBP income only, sir. If you will refer to the charging section of PGBP, any interest, remuneration, salary comes from partnership firm to partner, it is taxable under which side? PGBP head only. But he considering it as what? Salary, which is breaking the tax law only, comes under what? Tax evasion. Okay, again, Bhavya, starting with you. Using a motor car for personal purpose, tax, personal purpose, but charges as business expenditure. What it is? Tax evasion. Then Charishma X. So always pays advance tax on time. Tax management. Then Vaishnavi. Why sold his residential house and purchased another residential house to claim exemption under section 54. 54 exemptions are available on residential houses only. So it is what? Tax planning only. And then Pravilka. X had fixed deposit interest amounting to 15,000, but that does not disclose this amount in income tax return. Suppression of income with the modified intention only. It comes under what? Tax evasion. Okay. Then Y had saving deposit interest 5,000. He disclosed this amount unclaimed deduction under 80 TTA, which comes under what? Tax planning. Okay, sir. Only in one attempt this kind of question has been asked, sir. Then they thought these are easy and everybody getting marks. Then from there on, okay, in December 23 they asked this question. From then it's becoming easy. Everybody could get at least 6 out of 7 marks they are getting. Then institute felt jealous, and from then they are not asking this kind of questions. Question 23, December 25 exam. So look at the question. Sridhar, a resident individual, age 42, furnishes the following particulars of his income. A simple question only, sir. Business income how much? 17 lakhs. Long-term capital gain 1,20,000 from sale of listed equity shares. Okay. Paid life insurance premium 1,50,000 on 3rd January 2025. The policy was taken by self in April 2022. The sum insured is being 12 lakhs. Paid 2 lakhs to Prime Minister National Relief Fund in September on the occasion of Operation Sindoor. Assess the tax liability of Sridhar under both default regime and old regime. Okay, so solution. Old regime, default regime. So first, we'll take with what? We'll start with what? Headwise incomes we need to take. He has 2 incomes only. One is business income, second one is capital gain income. First what we should take? Business income. $17 lakhs. Under default regime, how much, sir? So that also 17 lakhs only. Business income already computed 1770. PGBP head this is. Then under the capital gain head, he has how much, sir? Long-term capital gain. Which section it is related to? 112A. So long-term capital gain under 112A. Capital gains, long-term capital gains arising on transfer of listed equity shares, units of EOF, units of business trust, covered under 112A. So how much is that one, sir? 1,20,000, and here also 1,20,000. Okay, same till here. What is the gross total income, sir? 18,20,000. Here also 18,20,000. Then here, chapter 68 deductions. Chapter 68 deductions. What are the chapter 68 deductions, sir? We'll have 80C will have. How much is the life insurance premium paid? 1,50,000. Whereas the policy was taken in 2020-22. Sir, after 1st April 2012, now we need to take what? 10% of the sum insured or actual premium paid. So 12 lakhs into 10% or 1.5 lakhs, whichever is lower. So how much will be the 80C deduction? That also under only regime only, sir. 1,20,000. Default regime 80C deduction is not available. Then the next one is what? 80G. Prime Minister National Relief Fund will come under 80G category 1. Category 1. So 80G category 1s are 100% eligible for deduction. How much is the actual contribution made? 2 lakhs. Whereas under the default regime 80G is also not available. So what are available? 80CCD subsection 2, 80CCH subsection 2, 80JJAA. Okay, those are eligible for deduction in respect to individual. So these two are not available. So what is the net total income? Here it remains 18,20,000 only. Whereas here, how much? 15 lakhs. So now we'll calculate tax. Old regime 15 lakhs. Sir, what are their age, sir? Senior citizen, 42 only, normal individuals only. 15 lakhs means first 10 lakhs, 1,12,500. On rest 5 lakhs, 30%. 5 lakhs into 30 na 1,50,000. 1,50,000 plus 1,12,500. 2,62,500. This is the tax rate. So first 10 lakhs, how much, sir? I said in the beginning also to remember at 10 lakhs, what is the tax? For 10 lakhs, how much? Old regime. 1,12,500. Above 10 lakhs, how much is there? 5 lakhs. 5 lakhs into 30% na 1,50,000. 1,50,000 and 1,12,500. 2,62,500. Then on 18, okay, first we'll complete this. Surcharge will not come, sir. Okay, we'll get what? Rebate will come. Okay, old regime total income within 5 lakhs only, rebate will come. So more than 5 lakhs, no rebate also. Tax is there, then surcharge is not there. So directly assessed at a rate of 4%. How much? 10,500. So total how much? 2,73,000. Then here, sir, we need to apply what? New slab rates. 0 to 4 nil, 4 to 8, 5%. I mean 20,000. 8 to 12, 10%, 40. Then 12 to 16, 15%, 60,000 will come. Okay, so up to 16 lakhs, sir, it will be 1,20,000. The rest, how above 16 lakhs, how much is there? 2,20,000. So 2,20,000 into 20% you do, 44,000. So 44 plus 1,20,000 total is how much? 1,64,000 plus assessed at a rate of 4%. 6,560. What is the total? 1,70,560. Okay, By any chance the answer in given here is correct? No. We also have to do capital gain special rate, right? So we only did wrong. Wait. Sir, first we need to calculate what? Special rate, separately we should first tax on special income. How much is the special income, sir? 1,20,000. But 1,20,000 under 112, is it any tax will be there, sir? No. Up to 1,25,000 it is 0. Plus tax on normal income. How much is there, sir? Normal income. Here it is like 13,80,000 because out of 15 lakhs, 1,20,000 is capital gain only. And here out of 18,20,000, how much is there? 17 lakhs. So here what will be the tax, sir? Here 1,40,000 will come. Here how much will be there, sir? 2 lakh? 3,80,000 into here, this one. Okay, wait. Here, how do we do, sir? First 10 lakhs, how much? 1,12,500. Then 3,80,000 into 30%. Do total, how much? 2 lakh? 2,26,500. On this, sir, 17 lakhs we need to calculate. First 16 lakhs, how much? 1,20,000 will come. Because 4 to 8 it is 20,000. 8 to 12 it is 40,000. Sir, 4 to 8, 4 lakhs into 5%, 20,000. 8 to 12, 4 lakhs into 10%, 40, 60. Then 12 to 16, 4 lakhs into 15%, 60. So total up to 16 lakhs it is 1,20,000. Extra 1 lakh into 20%, 20,000. So total how much? 1,40,000. Plus cess at a rate of how much, sir? 4%. How much? 5,000? 5,600 here. Okay, this is 5,600. On 1,40,000, 5,600. On this? 90. So what is the total? 2 lakh. So which is better? Default regime is only better. Okay, because there we have lesser tax liability. Okay, this is correct only, sir. So okay, this question there is no mistake, so it is correct only. Question number 23. Okay, so then question number 24 is also a simple question, sir. Last time in the whole paper, 3A and 3B are the most easiest questions. If you don't do silly mistakes, or in this sense, there's no other. So what are the chances of you doing mistake? EDC you may take wrongly. Straight away you may claim 1,50,000. Here there is no chance. And then like us in overlooking, we may calculate tax on the total amounts, forgetting that on long-term capital gain we need to claim separately. Rest all, there are no much twists and turns also. It's a plain question, sir. Easy to get 7 out of 7. And now you take question number 24 and try solving, sir. Don't rely on the answer given in the material. Do it on your own. Sir, here 1 point, sir. 115 BAB. Let me. Sir, here 115 BAB, what we said, it should be a domestic company, manufacturing company, set up on or after 1st April 2019 to 31st March 2024. Once it becomes eligible, from that year itself it has to claim 115 BAB. It cannot come and opt in the middle. Understand, sir? Here it should be started in this period, right? From the first year onwards after commencing, it should go for what? 115 BAB only. So it cannot come like after 10 years, they being under the normal business, they cannot again come into the 115 BAB. Why? Because here we clearly said like what? It should be a new business. It should be a new business. So an existing business cannot be converted as 115 BAB. So in the year of commencement itself, from the first year onwards, they should opt for what? 115 BAB. Okay. So now, sir, by reading this question, tell whether this company has option to take 115 BAB. Question number 24. First, look at the question and tell first whether that company has an option to avail 115 BAB. Why, sir? Read this question. RTP Limited Kolkata is a domestic company incorporated in May 2021. It has been assessed to tax as normal provisions with 30%. It has been and in the past. In the past, it was already being assessed at what? Normal provisions. The board now want to suggest whether to continue with the same or 115 BAB. Sir, now they cannot come to 115 BAB. First itself, they have opted 115 BAB. I mean, in the first year itself, they have to take choice. Now they don't have a choice. Once already they were under the normal scheme again, now they can't come under the 115 BAB because it's not a new business. They are changing an existing business into 115 BAB. So you cannot come like that. At the time of new business only, first year itself, you have to decide whether it is eligible under 115 BAB or not. Since already 2-3 years completed under the normal provisions, now they cannot opt under 115 BAB. So even though they asked to compute under 2 options, one option straight away became invalid because they cannot opt for 115 BAB. Now we need to compute only under what? Normal provisions only. So the answer given here is completely wrong, sir. Question number 24. Okay, sorry, wrong. And the correct answer is like what? Refer to. Suggested answer is the correct one. Okay, first one, sir. What they given as the profit for us? 1500 lakhs. This is before reduction of the following. Sir, we need to calculate now under 115 BAB a normal regime. Normal regime only, BAB is not possible. So in normal regime, sir, from 1500 lakhs, first we should claim what? Additional depreciation 125 lakhs. Then brought forward business loss also can be adjusted. So if you adjust both, what is the gross total income, sir? 675 lakhs. From there, 80 JJA deduction, 50 lakhs also available. ATM, 25 lakhs is also eligible. So total how much? 600 lakhs is the total income, net total income. Sir, 600 lakhs means net total income. What is the tax rate? Sir, did they given anywhere the tax rate also? Yes, they already said like what? With a tax rate of 30%. So they are going with a tax rate of what? 30%. How much? 180 lakhs. 180 lakhs. Then on this surcharge, sir, 1 crore to 10 crores. Sir, in between 1 crore to 10 crores it is there. What is the total income? 600 lakhs. I mean, how many crores? 6 crores. It been 1 to 10 crores. What is the surcharge rate? 7%. So surcharge at a rate of 7%. 180 lakhs into 7%. 12.6 lakhs. So total 192.6 lakhs. On this again, cess at a rate of 4%. 192.6 into 4%. 7.7 it will come. Okay. 7.712 lakhs. So total it is 200.12 lakhs. 200.34. How it came 4? They said like 192.6. Then if you add 7.712, how it came? 200 point. Or we did anywhere mistake. 192.6 correct only. Then 7.712 correct only. సెస్తో కలిపి మనం సెస్ సపరేట్గా చేయొచ్చు కదా. అసలు అట్లా ఎట్లా చేస్తాడు? 7.704 అట్లా కుదరదు కదా. Sir, we do normally only, sir. Why you are referring to suggested answer? How we have to do surcharge generally? 7% only. Na? So tax rate 30% means how much? 180 lakhs. On that surcharge at a rate of how much? 7% only. How much? 12.6 lakhs. Then 180 plus 12.6, how much? 192.6. Then again, amount different. 7.704 lakhs. Then how much it is? 200.304 lakhs. 200.304 lakhs. That's wrong. Sir, okay. Sir, now in this question, if you have already attempted December 25 exam, solving this 200.304 lakhs, you should do correctly only. Okay, but what point you might miss? That they are not eligible for 115 BAB, that point may miss. That's a general thing, sir. We cannot avoid mostly. Even if I wrote exam also, I could also easily took what? 2 columns, 115 BAB and then normal regime. But even here, if this part you got correct, sir, you might have got 3 marks for this answer. Only this part if you did correct also. Okay, because 2 options are there. This for 3 and that for 3. And for the final decision making, 1 mark, 7 marks. So you did 1 part correct now, then for that 1 part you'll get 3 marks at least. And the other 3 marks, it is so tough, sir, here in this question, because identifying that particular point and understanding that 115 BAB is not applicable. It's not easily stretched. Maybe like 0.5 or not even 0.5% people also can able to find out that point. So అలాంటి వచ్చినప్పుడు మనం ఏం చేయలేం. ఓకేనా? నువ్వు జనరల్గా ఇప్పుడు మీరు దాన్ని కూడా ఫోకస్ చేయాలన్నట్టు చూస్తూ ఉంటారు. సో సర్టైన్ ఏరియాస్ ఇఫ్ ఇట్ ఇస్ టూ స్పెసిఫిక్, టూ కార్నర్లోకి వెళ్ళి టెస్ట్ చేసినప్పుడు దెర్ ఆర్ ఛాన్సెస్ ఆఫ్ డూయింగ్ మిస్టేక్స్. బట్ అట్లీస్ట్ మనం చేయగలిగినంత, మీరు చేయగలిగినంత ఏంటంటే వేర్ ద క్వశ్చన్ ఈస్ ప్లెయిన్, యూ షుడ్ నాట్ డూ మిస్టేక్స్. లైక్ ప్రీవియస్ క్వశ్చన్ యూ షుడ్ హావ్ గాట్ ఫుల్ మార్క్స్, అండ్ దిస్ క్వశ్చన్ ఆల్సో అండర్ ద normal regime there is no chance of doing mistake. That part you should have done. Okay, now taking 115 BAB again you might have did correctly, but we shouldn't even do what 115 BAB option itself, because from the beginning itself they should have, in the first year of commencement itself they have to decide whether they should be under 115 BAB or the normal regime. Okay, since it is already continuing under the normal regime, now it cannot shift to 115 BAB. Sir, again I will say another thing also. Once it is already from the first year under 115 BAB, now also again it cannot shift to sir the same question. If they said like from the beginning they are under 115 BAB, now they are asking us to check under 115 BAB or default regime, then also what we'll tell, default regime is no more applicable. So what they have to do, only 115 BAB only. It's okay, sir. It's okay, we'll see. Sir, I think even in question number 22 also there might be a mistake. So but you know all the concepts related to question number 22. There are no twists, sir, which were not explained. Everything you know only. It's okay, it's just about whether you could apply properly or not. So solve question number 22. Question number 22. Private Limited, Kanpur is a new manufacturing company incorporated when 16th January 2022. Commenced from when 1st April 2022. Net profit is 30,90,000. After debiting creating the following items. What is the net profit, sir? 30,90,000. Then depreciation they have given. Contribution to employer contribution as well as employee contribution was given. Dividend given. Dividend received given. And then amount spent for earning dividend given. Normal depreciation given. Additional depreciation given. Dividend declared and distributed given. And then the company has a gross turnover of above 200 crores. You are required to suggest the company whether it should opt for provisions of 115 BAB or not by clearly showing your relevant computations. Okay, sir, actually, now see, this is also almost like same framed question, right? Almost like, but only for that extra word in suggested answer, they interpreted it like what? Since in the beginning, sir, if actually December 2025 only, na, what we have to understand the question, how we have to read, since they already commenced in 1st April 2022, and now we are in 25-26, we cannot decide actually. Whatever they have already followed in 22-23, 23-24, 24-25 only has to be consistently followed. In 25-26, actually, we don't have a decision to take now. Okay, if they are already under what regime? Normal regime, na, they should follow normal regime only. If they are already under the default regime, na, they should follow what? Sorry, if they are already under the 115 BAB, they should follow BAB only. Default regime, na, they should follow default regime only. If you have taken the suggested answer view of December 2025. Sir, in December 2025, what they interpreted, see. Same question only. See, look at this point. The question specifically states that in the earlier years, the company is paying tax as per normal provision. Suggested answer, sir, this is. For which question? December 2025 exam question. Which means that the company had not exercised the option earlier for 115 BAB in the previous year relevant to the assessment year. Therefore, SSC cannot opt for the provisions of 115 BAB in the assessment year 25-26. So what is the extra such a difference between those two questions? In question number 24, it was said like it has been already assessed to tax as per normal provisions with a tax rate of 30%. So this extra one sentence they interpreted and saying like what? Since in the past they are already under the old regime, already under the default regime, now they cannot opt for 115 BAB. That's the view taken. Okay. But since in question number 22, there is no such extra line. Is there such extra line, sir? There is no such extra line stating like what? Who commenced activity, they said. Net profit, they said. But in the past, what option they took? Nowhere mentioned. In the past for the 3 years. So that's why. But actually, logically, it is also wrong. How the question should be framed, if at all it is a proper question framing, they should say it like, okay, sir, if they say it in the current year, if it started, then 115 BAB is not even available. Why? 115 BAB option is available only till what? 1st April 2019 to 31st March 2024 only. Okay. So now the last year to decide optional regime or so in question making itself, there are certain problems are here. See, 1st April 2019 to 31st March 2024, they should have started. I mean, last financial year which they might have started will be what? 23-24 is the last year to start. Yes or no, sir? After 31st March 2024, even though they start business, they are not eligible for 115 BAB. So that means previous year 23-24, assessment year is what? 24-25. So what is the last year for us to decide 115 BAB or normal regime? In assessment year 24-25 only, we should actually decide whether they are under default regime or under the 115 BAB. Post assessment year 24-25, you don't have the choice to decide. Whatever is decided in the first year, that only has to be consistently followed. But in June 2025, they asked a question and they did in a way, right? So in question asking itself, there are mistakes, sir. So actually, to be solved now, in question number 23 or question number 24, the right way is like, they shouldn't interpret the point in such a way. If they are interpreting now in June 2025, they shouldn't have asked the question in such a way. Understand? అంటే ఇప్పుడు వాళ్ళు అడిగిన క్వశ్చన్లో అయితే జూన్ 2025 క్వశ్చన్ అన్న రాంగ్గా ఫ్రేమ్ చేసి అడిగి ఉండాలి. లేదు అది కరెక్టే అని అనుకుంటే అప్పుడు ఏది రాంగ్ అవుతుంది? December 2025ని పూర్గా ఫ్రేమ్ చేశారు. బికాస్ యూ విల్ బీ ఆన్ ద బేసిస్ ఆఫ్ వాట్? June 2025 సజెస్టెడ్ ఆన్సర్. సో ఆన్ దట్ బేసిస్ విల్ బీ డూయింగ్ ద ఆన్సర్. ఓకే, అది కూడా మళ్ళీ చూడండి, ఇయర్ కూడా మారల, అసెస్మెంట్ ఇయర్ కూడా సేమ్ అసెస్మెంట్ ఇయర్ ఓన్లీ June 2025, December 2025. సో ఇన్స్టిట్యూట్ what has to be changed? Institute examination board standards has to be changed first. Why? Because they are not framing the questions properly, or else even though they are framing the questions proper, I mean, there is no consistency there. Okay, ఒకసారి ఒక వ్యూ తీసుకొని ఇంకొకసారి ఇంకో వ్యూకి వెళ్ళిపోతున్నారు. సో వాళ్ళ సజెస్టెడ్ ఆన్సర్ కూడా ఇంకా ఇష్టం వచ్చినట్టు వెళ్ళిపోతుంది. సో ప్రాబ్లం అక్కడ వచ్చింది. లేకపోతే మోస్ట్ ఆఫ్ ద పీపుల్స్ ఆర్ హియర్. ఓకే, వీ డోంట్ నో ఆర్ వీ డోంట్ సీ ద సజెస్టెడ్ ఆన్సర్, I mean certified copies of all of you, but I could say 99% of the students might have did what? Even 115 BAB option also they might have did, and doing that is not a wrong on our part. Okay, అది 99% అలానే చేస్తారు. 99 కాదు, ఇంకా 99 పాయింట్ కూడా వెళ్ళి దాన్ని చేసి ఉండొచ్చు, దాన్ని మిస్ అయ్యి ఉండొచ్చు. ఎందుకంటే మనం ఏ క్వశ్చన్ చూసుంటాం ముందు June 25 అలాగే అడిగాడు కదా, 2 years బ్యాక్ స్టార్ట్ అయింది, ఇప్పుడు డిసైడ్ చేయమన్నాడు. 2 years బ్యాక్ స్టార్ట్ అయిందని ఇప్పుడు డిసైడ్ చేయమన్నాడు. కాబట్టి ఈవెన్ ఇన్ December 25 ఆల్సో వాట్ వి థింక్ 2 years బిఫోర్ స్టార్టెడ్, బట్ స్టిల్ వీ హావ్ ద ఛాన్స్ టు డిసైడ్ నౌ మీన్స్ దెన్ you'll go with the same option. So June 2025 question framing itself, there is a mistake. What? If it is started already in 2022, we don't have the option to decide now. It has to be decided already in which year? 24, 25 only. Whatever decided there, that becomes final. You don't have the option to shift also. Okay, but still ఓకే, సో ఇప్పుడు దాన్ని ఏమని చెప్తున్నాడంటే ఒక్క సెంటెన్స్ని పట్టుకొని అని చెప్పి సైడ్ ఆన్సర్లు ఇచ్చాడు కాబట్టి ఇంకా అంతమించి మనకి ఇంకొక ఆప్షన్ లేదు, దాన్ని తీసుకొని చూద్దాం. ఓకేనా? సో సార్ నెక్స్ట్ వాట్ వుడ్ బి సార్ నెక్స్ట్ ఇయర్ నెక్స్ట్ అటెంప్ట్ ఇఫ్ ద సేమ్ క్వశ్చన్ సేమ్ మోడల్ క్వశ్చన్ కమ్స్ నా దెన్ సేమ్ థింగ్. So now we have two questions for us to base. 22 is there, 24 is there. What is the only difference there? If in the question they have clearly specified, like in the past they already exercised an option, then in the current year we don't have the option to decide once again. So whatever the option they are following, that only has to be followed. New option we cannot exercise straight away. You say like the other option is not available, only this option is available. If they didn't talk about the past options, then we'll go with which view? June 2025 question view and decide under both the options. Sir, are you able to understand, sir? Everybody? Sir, okay, again, don't overthink, sir. Sir, if these things and all happen, my tax knowledge itself is little bit. If again these things happen, how do I clear? Don't think of much in tax paper, in DT paper. Always, whichever the paper there is, sir, first the tax itself is a subject which involves so much of interpretations. Okay, so that's why there is always this kind of risk which we cannot avoid. Okay, that's why you instead of, so we'll take two options, sir. One is what? Default tracing, and the next one is what? 115 BAB. So what is the profit, net profit as per P&L, sir? 30,90,000. Here also how much? 30,90,000. This is after debiting and crediting the following items. Sir, depreciation as per Companies Act, what we should do? How much? 4 lakh. Here also we should add back 4,50,000. Then employer contribution as well as employees contribution to 11 lakh each for the month of March was deposited in 31st May. Employers fine, but employees is disallowed, sir. Why? Because it was not contributed within the due dates of PF Act. Employees contribution, how much, sir? Employees contribution 11 lakh each. So for both 11 lakhs has to be disallowed. We need to add 11 lakhs. Then dividend is taxable under which head, sir? IFOS. So what dividend we need to add or subtract? Add. Dividend is an income, expense or dividend received. It will be there on what? Credit side. It's an income included already. So we need to do what? Subtract. Sir, the relevant dividend related expense, what we should do? Add back. Dividend related expense how much? 3,60,000. We should do what? Add back. Whereas what we should subtract, sir? Dividend we should subtract how much? 17 lakhs, right? 17 lakhs. Then what we need to subtract? Normal depreciation we need to subtract, because Companies Act depreciation we are reversed. We should subtract now what? Normal depreciation. How much, sir? 4,90,000. Okay, so subtract items I'm putting in brackets. 4,90,000. Here also 4,90,000. Then, sir, additional depreciation do we need to subtract in both the regimes? Additional depreciation is allowed only in which regime? Default regime only it is allowed. How much? Okay, in 115 BAB it is not allowed. Okay, dividend declared is an adjustment from profit, sir. So nothing to be done with respect to dividend declared. So what is the income under that? PGBP. Here it is how much? 26 lakh 60,000. Whereas 115 BAB 28 lakh 10,000. This is under what? Income under the head? PGBP. Do they have income under any other head? IFOS is there. So IFOS, what is the dividend income they had? 17 lakhs, sir. But relevant expense can be claimed as deduction. Okay, sir, in first chapter only I kept this point we discussed there. First chapter only. No. At ATM, when we are discussing intercorporate dividend deduction, there I given this point also. What? Dividend. For earning dividend, if any interest expense is included, such interest expense is allowed as, alone is allowed as deduction. How much is the interest paid, sir, here? 3,60,000. But how much is allowed as deduction? 20% of dividend or actual, whichever is lower, is allowed as deduction. 20% of dividend or actual, whichever is lower. So 20% of 17 lakhs means how much? 3,40,000 is only allowed as deduction, not 3.6 lakhs. Okay, so here 3,40,000. Here also how much? 3,40,000. So total, gross total income is how much, sir? Okay, sorry. This is expense, right? After claiming expense, what is the net dividend, sir? 13,60,000. So here also we'll take 13,60,000. Here also we'll take how much? 13,60,000. Now do gross total income. 40,20,000. And here also we'll have what? 41,70,000. Okay. Then we'll have deductions. Which deduction is available, sir, here? ATM. ATM deduction is how much, sir? Dividend received or dividend paid, whichever is lower. Okay, dividend received now we should take net dividend, sir. Net dividend. How much is the net dividend we have? 13,60,000. Or the dividend paid 20 lakhs. Whichever is lower eligible for deduction. Sir, ATM is available even under 115 BAB or not available? Available, sir. ATM is available under both old regime as well as default regime as well as under the optional regime also. So how much it is? 13,60,000 is the deduction available. Subtract these two. 26,60,000. Here also How much? 28 lakh 10,000. 26 lakh 60,000 and here it is 28 lakh 10,000. Now we need to calculate what's our tax. The company never had a turnover above 200 crores. Since the company never had above 200 crores, what tax rate, sir? 25% is only applicable. Tax rate at 25%. 6 lakh 65,000. Sir, whereas under 115 BAB, sir, actually we should calculate separately. Normal income, business income at 15%, other incomes at 22%. But other income is totally claimed as deduction. Whatever the other income, 13 lakh 60,000 is there, that was set off with the ATM deduction. So we don't have any other incomes. What we have is only what? Business income only, which is chargeable to tax at what rate? 15%. So here it is 25%, here it is what? 15%. How much? 28 lakh 10,000 into 15%, now how much? 4 lakh 21,000. Then surcharge. Sir, surcharge under default regime not applicable because the total income is only 26 lakhs, didn't exceeded 1 crore. But under 115 BAB, there is a 10% flat surcharge. So 10% is na 42,150. Then if you do subtotal 6 lakh 65,000, here 4 lakh 63,650 plus cess at a rate of how much, sir? 4%. How much? 26,600. Here 4 lakh 63,650 into 4%. How much? 18,546. If you take total, how much? 6 lakh 91,600. Here 4 lakh 190. 6 lakh 91,600 and 4 lakh 82,196. It is rounded up to 4 lakh 82,200. Here it is 6 lakh 91,600. Which is better, sir? 115 BAB is only better. Okay, answer wise same only. Correct only, sir, everywhere. Answer here. In the answer given, it is correct only, right? Okay. Then fine, no issue, sir. It's okay. So we have the mistake we are having is only in which question, sir? Question number 24, there is a mistake. Question number 20, age 34 years. Bablu, an Indian resident, age 34 years. Started his retail trade business from 1st April 2025. He gives the following information from financial year 25-26. Net profit as per P&L account is 51,70,000. Net profit includes gross rent received from let out properties 1,20,000. Interest debited to P&L includes interest on loan taken for purchase of house property 2,20,000. Additional information, deposit in PP of 2 lakhs. Medical insurance premium for self and spouse 30,000. Compute total income. His age is how much? 34 years. Okay, sir. I'll do it. We have to do it under what? Both. Default regime and even under old regime also. First, what is the net profit, sir? PGBP head we are starting first. Net profit is how much? 51,70,000 under both the regimes. House property income is credited here, sir. So what we should do? Minus. So we should subtract house property income. How much? 1,20,000. Here also 1,20,000. And house property expense also debited interest. So what we should do, sir? Since income need not to be considered, relevant expense also not to be considered, we should add back what? House property related interest. How much is the interest, sir? 2,20,000 we should add back here. So house property income we have subtracted because not related to PGBP. Relevant expense we have added back because not related to PGBP. So 2 points done. Then we'll get what? Income under the head PGBP. How much, sir? Here 52,70,000. Here also 52,70,000. So PGBP income we got. Now we have to do again under what? Income from house property. So income from house property. Let out property it is. So first NAV will take. Income from house property. First we'll take what? NAV. So sir, the given is like what? Gross rent received from let out property. Okay, gross rent received. Actually, we should compare fair rent or municipal rent, whichever is higher restricted to standard rent, will get expected rent. Then expected rent or actual rent, whichever is higher is called GAV. GAV minus municipal taxes will get NAV. Since we don't have all that information, straight away the rent received we are taking as what? NAV. So NAV is how much? 1,20,000. Minus let out minus standard deduction under what, sir? Standard deduction under section 24A, 30%. How much? 36,000 here and here also 36,000. Then minus 24B deductions, sir, which is nothing but interest. Sir, let out property for interest, no limit at all. How much is the let out property related interest, sir, here? 2,20,000. 2,20,000 if you claim. What is the loss from house property? Not income, loss from house property, how much? Not 4 lakhs. From 1,20,000 you should subtract these two. 1 lakh? 1,36,000. Here also 1,36,000. Okay, this is a loss. But you should remember one thing, sir. Under default regime, loss from house property is eligible for set off intra-head only, not for inter-head. So this is eligible only for intra-head. Since there is no intra-head only, but whereas this is eligible even for inter-head also. So intrahead, what else income we are having, sir? PGBP. That means under old regime, this loss we can adjust with PGBP income also. But under default regime, this loss we cannot adjust with PGBP income, sir. Why? Because only intrahead set off is possible, intra set off is not possible. So, okay, so now gross total income. Okay, here it remains what, sir? Same PGBP income only, 52,70,000. Whereas here how much, sir? 52,70,000 minus 1,36,000. 51,34,000. 51,34,000 is the gross total income minus Chapter 6A deductions. Sir, Chapter 6A deductions, what we have? PPF, how much is there, sir? 2 lakhs. ETC, how much it is restricted to? 1,50,000 only. Then we have ETD, medical insurance premium. How much they paid? 30 for himself and spouse. But his age is only 34. So how much is allowed? 25,000 is only allowed. So total deduction, sir. Sir, both these are available only on old regime only. In new regime, these are not available. So subtract this 1,50,000 and 25,000. What is the net total income? Net total income is how much, sir? Same, it remains 52,70,000 only because nothing to be subtracted. Whereas here, 49 lakh 59,000. Now we should calculate what? Tax. Under new regime, old regime. Yes, morning only, Divya. It came in live. Within some time, it gets updated in the live session. Within some time, it gets updated in the live folder only. Today only morning I have taken. How much, sir, here? 52,70,000, sir. First 24 lakhs, how much? First 24 lakhs, 3 lakhs. Above, how much is there? 28,70,000 into 30%. Plus 3 lakhs. Total how much? 11 lakh 60,000. 61,000. Then here, first 10 lakhs, 1,12,500. Then balance 39,59,000 into 30%. 39,59,000 into 30% plus 1,12,500. What is the total? 13 lakh. Okay, here surcharge applies. Where? Default regime. What is the surcharge rate, sir? 10%. So it is how much? 1,16,100. Here it is not available because total income is only this. Then we need to do total again. Here 13,200 only. Here it comes to what? 12,77,100. Then we should do again what? Cess at a rate of 4%. 51. Here 52,080 008. So if you add the totals, it will be 13 lakh. Here I am doing 13 lakh 52,000 208 rounded off to 210. Here 1 rounded off to 180. Okay, which is better, sir? Here default is only better here. Sir, Palam Limited, Delhi is a manufacturing company engaged in the manufacturing activity. Revenue given, expenses given, normal depreciation, additional depreciation, ETIA, ETJJA, turnover never exceeded 400 crores. We need to check under what? Normal default provisions and even under what? 115 BAA also we need to check. Okay. Sir, under 115 BAA, what is the tax rate? 22% plus surcharge at a rate of 10% plus cess. So first the default, whatever it is, sir, here it is gross revenue. What is the gross revenue they have? 80 lakhs, 80 lakhs in both the places. Then manufacturing expenses are allowed only, sir, under both the regimes. Okay, subtract expense. How much is there? 30 lakhs, 30 lakhs. Then under default regimes, sir, normal depreciation allowed, and even in 115 BA also normal depreciation allowed. So we can subtract what? Normal depreciation. Sir, here the given is revenue, not profit. Understand? So if I said in PGBP, there are two model questions, receipts and payments model, and the other one is P&L model. This is similar to that of receipts and payments model. They given you the receipts, they given you the payment. Out of the PGBP receipt, you should claim expenses which are allowed. So which is allowed? Manufacturing expense is allowed. Where 37 it is allowed, it is a general, it is not a capital expenditure, not covered under 3236, not a violation of law, so it is allowed. And there is no specific disallowance also. So 30 lakhs can be claimed as deduction, no problem at all. Then normal depreciation allowed under which section, sir? Section 32. So subtract normal depreciation. How much? How much is the normal depreciation, sir? 7 lakhs, 7 lakhs. Then it comes about what? Additional depreciation. Sir, additional depreciation allowed under both the regimes, sir. Additional depreciation only under default. Optional, it is not available. So additional depreciation in default regime, how much, sir? It is 2 lakhs. Whereas here it is not available. So we'll get what? The PGBP income. How much is the PGBP income, sir? Here 41 lakhs. Here it is how much? 40 3 lakhs is the PGBP income. Then they have what deduction, sir? So this itself, sir, they don't have any other income. So this PGBP income itself will become what? Gross total income also. From there, we'll subtract Chapter 6A deductions. Sir, Chapter 6A, ETIA is available only in default regime, whereas JJAA available in both the regimes. Okay, ETIA and then 80JJAA. So how much is 80IA? 5 lakhs here. Whereas JJAA is how much? 4 lakhs. Sir, okay, so what is the net total income? Net total income is how much, sir? 32 lakhs. Whereas here it is how much, sir? 39 lakhs. Okay, we got net total incomes also. Now, tax rate. Here, under the default regime, how much is the tax rate? 25%. Here, 22%. Still, 32 lakhs into 25%. 8 lakhs. 39 lakhs into 22%. 8 lakh. 58,000. Then here no surcharges are under the default regime, no surcharge because total income didn't exceed 1 crore. But under the 115 BAA, always there will be 10%. So 85,800. So what is the totals here? 8 lakhs. Here 9 lakh. 800 plus cessation rate of 4%. How much? 8 lakhs into 4% now 32,000. So total it comes to 8 lakh 32,000 here. Here 9 lakh 43,800 into 4%. 37,752. If you do total 9 lakh 80. Rounded off to 500. So which is better, sir? Default regime is only better instead of 115 BAA. 8 lakh 32,000, 9 lakh 81,550. So default regime is only better. Then question number 19, sir. Individual related. So December 24, June 25, December 25, they followed a standard format. 3A is from individual old versus default regime. Your company also old versus any of the optional regime. I mean default versus any of the optional regime. So it's all done. Sir, see, profit as per P&L account, how much is given, sir? 10 lakh 60, 10 lakh 60. Then depreciation as per books is how much? 56,000. So the depreciation as per books has been added back, and normal depreciation 77,000. Sorry, normal depreciation 66,000 has been subtracted. Additional depreciation is allowed only under the old regime. So in old regime only it is subtracted. So total business income came how much, sir? 10 lakh 50, 10 lakh 39,000. Okay, first 3 points done. Loss from speculation business, sir, irrespective of the regime, it cannot be set off because speculative loss can be set off only with speculative gain. So ignore this. Then straight away we will go to what? Chapter 6A deductions. So chapter 6A deductions, how much, sir? ETC 1 lakh 50. Okay, and medical insurance premium, how much is allowed, sir? 25,000. So under old regime, 1 lakh 75,000 deduction will come, whereas new regime that will not come. So total 10 lakh 50 net total income here 8 lakh 64,000. Then tax. So tax computation correct only. Yeah? 115 BSC, sir. Correct only, right? 0 to 4 nil. 4 to 8 lakhs. 4 lakhs into 5% is 20,000. Then 8 to 12 lakhs. 10%. So 2 lakh 50,000 into 10% not 25,000. So total how much here? 45. Here 85,300. Then rebate, sir. This point you may miss, sir, because what? Under the new regime, rebate is available up to how much? 12 lakhs. Up to 12 lakhs. Here the total income is only how much? 12 lakh, 10 lakh 50,000. So rebate 45,000 has to be given. So tax payable is nil. Whereas here 88,710. So which regime is better? Default regime is only better. Okay. Are you able to get rebate point also? Rebate point strike out in the available. Okay. Sir, question number 18. This is June 23 exam question, sir. Sir, what is their salary income, sir? Income from salary is how much? 8 lakh 20,000. Okay. Sir, they straight away took, sir, after standard deduction. Sir, under default regime, standard deduction available is 75,000. Whereas under old regime, it is only 50,000. So 8 lakh 20 minus 50 is 7 lakh 70,000. Here minus 75, na? 7 lakh 45. That is income under that salary. Then self-occupied property, there is loss. Under default regime, loss from house property is only eligible for intra-head set off, not inter-head. Whereas under old regime, this can be set off to an extent of 2 lakhs. So max 2 lakhs eligible, here nothing. Then income from house property, how much is there, sir? Interest from fixed deposit 1 lakh 10,000. Savings bank interest 20,000. So total IFOS interest is how much, sir? 1 lakh 30. So total, what is the gross total income, sir? 8 lakh 75,000 only, na? 7 lakh 45 plus 1 lakh 30. 8 lakh 75. Here it is how much? 7 lakh 70 minus 2 lakh set off, sir. It came to 5 lakh 70 plus 1 lakh 30. If you do not, it is 7 lakhs correct only gross total incomes. Then chapter 6A deduction, sir. RPF contribution is eligible for what? Then we started doing questions in tax planning chapter. So the questions part, the models we have completed is like first 4 or 5 questions are related to deciding whether it is tax management, tax avoidance, or tax evasion, or tax management. Those questions we have discussed. And then we went and discussed the recent examination questions. The last 3 attempts related recent examination questions. Not 3, 4 attempts also. What? Individual, optional versus default regime. Company also, default versus optional regime. So those questions being asked as a trend in the past 3 or 4 attempts. So those questions we have discussed. Then there are some other questions also, some other model questions also, which may not be frequent, but still we need to cover those questions as well. Sir, question number 1, 2, 3, 4 we already covered yesterday. Question number 5, if you Question number 5, sir. Lucent Limited purchased a machinery on 1st April 2025 for 10 crores by availing loan facility from the bank. Lucent Limited purchased machinery on 1st April 2025 for rupees 10 crores by availing loan facility from the bank. The machine was put to use in effective production on 1st February. The interest on loan is 12%. Advice, Lucent Limited on the treatment of interest payment made on this loan and depreciation allowable for the previous year 25-26. You may assume this is the only machine in its block. Sir, all the relevant needed concept we already discussed, sir. You just need to bring it at the right time. That's what. Okay, look at the question and tell for what value the asset has to be capitalized. For what value the asset has to be capitalized here. For what value the asset has to be capitalized. What is 1 crore? Total asset to be capitalized. Total asset value. Calculate depreciation until. Sir, what is the relevant provision there? No. You said like what is the asset cost? Okay. How we got that 11 crores? What we are doing to get 11 crores? Sir, interest, borrowing cost or okay, that borrowing cost relevant interest we need to add to the asset cost. Okay, till what day such interest has to be added to asset cost? Till the date of loan actually. Date of loan to date of put to use. Okay, so here we don't know date of loan and also we'll be starting from date of purchase to date of put to use, and that part of interest will capitalize only. Okay, so how much, sir? 10 crores has been taken as loan. 10 crores into 12% into how many months, sir? 10 by 12. So how much? 1 crore. So 1 crore plus 10 crores, total asset value to be taken is how much? 11 crores. On 11 crores, now we need to charge depreciation. Sir, it is a machinery. What is the rate of depreciation, sir? 15%. It is put to use for new machines, sir. Put to use for more than 180 days, sir. Within 180 days, sir. Within 180 days. So the depreciation is restricted to 7.5%. Okay. So 11 into 7.5, if you do, it is how much, sir? 0.825 crores is the depreciation allowable. 0.825. Sir, everybody. Sir, it's a simple point only, sir. There's nothing, no twists, turns and all are there. A simple point. Question number 6, if you remember, sir, we already solved when we are doing deductions chapter. Okay, chapter 6A deduction, sir. Then regarding 80IA, we brought this concept and discussed, sir. What is this concept about? When 80IA deduction, what does 80IA say? Like 100% of the profits can be claimed as deduction. But such deduction has to be claimed as if 80IA is the only business SSC has. As if 80IA is the only business SC has. How do you claim that loss? How do you claim that profit as deduction? Such a way only it has to be claimed. So while explaining deductions only, we have solved this question. Question number 6. Now question number 7. Mr. A owned 2 residential houses for his own residential purpose. Details of which are as follows. Gross annual value of house 1, house 2, municipal taxes, and then interest on loan taken for construction of house. Then on 1st April 2025, A gifted 25 lakhs to her wife. Out of such money, she acquired a property for her own residential purpose. The new house has a gross municipal value of rupees 2,50,000. She paid a corporation tax of rupees 2,000. Compute income from house property of Mr. and Mrs. A. Assume that Mrs. A does not own any other property. Assume that he has opted for the old tax regime. Sir, little basic level knowledge, maybe inter level knowledge, something. Should you read the question and then think of what are the possibilities? Sir, house 1, house 2, there is no big thing, sir. Easily you'll calculate. The point is only about he gifted 25 lakhs to his wife. And with that, his wife also purchased another house property. Now, linking that point, what are the possibilities? You tell just your views. It need not to be correct also, but tell at least how far you can guess. I didn't get. We need to do clubbing. Okay, concept. Why we need to club? For inadequate consideration, where any asset is transferred or money is given to spouse, then income arising from such asset has to be clubbed in the hands of transferor. Okay, where any asset is transferred to spouse for inadequate consideration, then the income arising from such asset has to be clubbed in the hands of transferor. Now, third house related, whatever is the income, that also has to be clubbed in whose capacity? Mr. A. Okay, now clubbing has to be done headwise or as a line item after gross total income we can add? In first chapter only I said, sir, clubbing has to be done headwise. Clubbing has to be done headwise. I mean, headwise means what? If you have house property income to be clubbed, then at house property head only it has to be clubbed. If you have business income to be clubbed, then at PGBP head only it has to be clubbed. Now, one more point I'll introduce, sir. For this, you need to have clarity. If you remember, house 1 and house 2, sir, did they given? Okay. House 1 and house 2, sir, if you see what they said, they are for what? Own residential purpose. Now, wife house also what? Residential purpose. If you remember anything or any points about house property, when a person has more than 2 house properties as self-occupied, then the third property has to be treated as what? Deemed to be let out. Yes or no? You remember that point, sir? When a person has more than 2 house properties self-occupied, then the third property has to be treated as deemed to be let out. Now the question comes into picture, the actual puzzle. Did he own 3 properties? He owned only how many properties? 2. The third property is owned by wife. Thus the clubbing provision says like house has to be clubbed, income from house has to be clubbed. Income from house only has to be clubbed. Okay, he doesn't own 3 properties. He own only how many? 2 properties only. He own only 2 properties only. The third property related income is also assessed in his capacity only, but still he is not the owner of the third property. So that deemed let out concept is not applicable. Deemed let out concept is not applicable. Okay, so now see, sir. First here, how many points you should have remembered? Clubbing point should come into your mind. Once clubbing comes, it has to be clubbed headwise. At house property head only it has to be clubbed. Then third point, since there are like more than 2 house properties, deemed let out concept may come. Then again, that solution also should come, because what? Deemed let out concept will come only when SSE owns more than 2 house properties and all of them are self-occupied. Here he owns only how many properties? 2 properties only. The third property he has been assessed. On the income he is being assessed, but he will not be the owner of such property. So deemed let out concept is not applicable. So first, sir, for his 2 properties, sir, for self-occupied properties, what will take as GAV, sir? No, for self-occupied properties, not only GAV, straight away NAV also will take it as what? Nil. So house 1 also NAV nil, house 2 also NAV nil. Okay, did they said any regime, sir? Okay, he said like what? Old tax regime only. Then NAV. From NAV, what we can take, sir? Nothing. NAV 0 na standard deduction also will not be there. But interest we can take it as deduction, sir. How much interest? 20,000, 25,000. Okay. Then wife related. Again, sir, for wife related also NAV is what? Nil only, because that is also self-occupied property. And then, is there any interest on that one, sir? On the wife related property? No interest is there. See. Out of such money, she acquired a house. The new house was municipal value 2,50,000. She paid corporation tax 2,000. Compute income from house property. But wife also, sir, no interest is there. So NAV is what? Nil. Okay, no standard deduction, no interest also. So that 0 house property income, if you include in SSEs, Mr. A also, what is the total, sir? 3 houses. House 1, 20,000 loss. Because NAV nil, interest you can claim as deduction. Self-occupied property also, up to how much interest we can claim as deduction, sir? 2 lakhs. So house 1, 20,000. House 2 loss how much? 25,000. House 3 related, sir, nil. So total loss of his is like how much, sir? 45,000 is the total loss. Got it? Simple point only, sir, but related to basic level points. Then come to question number 8. Sir, he is asking to compute under both old regime as well as new regime house property income. Good morning, Divya. Sir, Amara has how many house properties? 2. One is used for own residence and the other one is what? Let out. What is the let out property rent? 50,000. Okay. So for self-occupied properties, sir, NAV is nil. It's okay. So here, old regime, 115 BAC. He has a self-occupied property, let out property. Here also, he has a self-occupied property, let out property. Okay. Sir, since he didn't give any municipal taxes in the question, straight away we can go with what? NAV. NAV of self-occupied property is what? Nil. In both the regimes, NAV of self-occupied property is what? Nil. Then come to let out property, sir. What is the monthly rent? 50,000. He bought these houses with housing loan from SBI. He paid interest loan amounting to 2,50,000 on each and principal repayment of 2 lakhs. He is doing business by name of Mercury Traders, in which his income amounts to 11,80,000. Determine his income as per 115 BAC and also as per regular provisions. NAV nil. Let out property, sir. What is the monthly rental income? 50,000 into 12 now how much? 6 lakhs. So let out property NAV is 6 lakhs in both the regimes. Minus 30% standard deduction, nothing. 6 lakhs into 30% now how much? 1,80,000. That is even available under the default regime also 1,80,000. Then minus interest deduction, which is under 24B. Self-occupied nil. Self-occupied also there is interest deduction available, sir. But maximum how much, sir, for self-occupied? Only 2 lakhs. For let out no limit, so we can claim how much? 2,50,000. Again here also self-occupied. For self-occupied, no interest deduction is available, sir. For self-occupied, under new regime, no interest deduction is available. Where we written? In first chapter, we have written clearly for self-occupied, interest deduction is not available. For let out, again, no limit, sir. Interest is available as deduction. Then, if you do totals, here self-occupied lost 2 lakhs, and let out, how much is that, sir? 1,70,000. Here, sorry, this is income, right? Here again, 1,70,000 income. Now, altogether, house property loss or income is how much, sir? Here 30,000 loss, here 1,70,000 income. Then what else he has? He has PGBP income. How much is the business income he has, sir? 11,80,000. So 11,80,000, here also 11,80,000. House property loss under old regime, sir, inter-head adjustment is possible. With other heads also you can set off. Since it is from self-occupied, that last part, maximum up to what amount you can adjust with other heads? 2 lakhs. Within 2 lakhs only, no problem. So we'll get what? Gross total income. How much? 11,50,000 here. 11,80,000 plus 1,70,000. 13,50,000. Then minus chapter 6A deductions. Any chapter 6A deduction available? What is available? Housing loan principal repaid is eligible for 80C deduction. So 80C is available here 1,50,000. Whereas here nothing is available. So what is the tax here, sir? 10 lakhs is the net total income. Whereas here it is how much? 13,50,000. Then we need to calculate tax. Tax here is how much? 1,12,500. Here on 13,50,000, sir. On 12 lakhs it is like 60,000. 1,50,000 into 50% and add 60. 82,500 plus us at a rate of 4%. How much? 1,12,500 into 4%. Here 82,500 into 4%. So total here 85,800. Here 1,17,000. So obviously which regime is better, sir? New default 115 BAC is only better. Sir, here there is mistake in tax liability. Huh? Under the old regime, sir, what is the tax liability of them? 1,17,000, correct only. Then what is this? Okay, here only it is wrong. Huh? So just to strike off this 1 lakh. In book, this number is there, right? 1,14,400. Just strike off that. It's okay. Then, sir, so we have question number 9, question number 10. Then we have question number 4, question number 15, question number 16, question number 17. All these are like FM kind of questions. Okay, whether to source the funds through loan or capital, share capital, which is better, or whether to buy an asset or to take a lease of the asset. Okay, so how we need to take a decision making considering tax adjustments. There are 5 questions, sir. So those 5 questions will solve quickly. Question number 9. A business entity requires 50 lakhs for expansion of its business. How much it needed, sir? 50 lakhs is needed. It has how many options? 3 options. Sir, again, sir, these 5 are like model questions only. If they want to ask a question on this, then it's based on your SFM knowledge or FM knowledge only. You have to solve the question. The only thing is like we can at least understand tax impact. How do we can include in those transactions? Rest all, it's not the tax part to be teached here. It's about your basic FM part only. If at all this part or this kind of question is asked. Option 1, what they can do, sir? They can raise equity 40 lakhs and debentures 10 lakhs. Second option, they can raise equity 30 lakhs, debentures 10 lakhs and interest 18%. Option 3, equity 30, debentures 20, nothing loan. Now they are expecting, what is the expected rate of returns are before tax? 15%. Tax rate is 31.2%. On the basis of aforesaid information, you are required to choose correct option. What will be the PAT in option 1? PAT in option 2, PAT in option 3, and which option is better? Okay, sir, first did they given the profit here? They didn't given the profit, but they given what? Expected rate of return. So expected rate of return on what? It has to be calculated on capital employed. How much is the capital employed? 50 lakhs. Capital employed is 50 lakhs, sir. Equity is differing, but capital employed in all the cases is 50 lakhs. What is called capital employed? Equity plus reserves plus long-term borrowings. All together it is called what? Capital employed. So here capital employed is what? 50 lakhs. On 50 lakhs, if you calculate expected rate of return, how much? 50 lakhs into 15%. So in all the three cases, the return is 7,50,000. Okay, from there, in every option, we'll subtract the interest. We want what, sir? PAT. Okay, PAT. So first we got what? 7 lakhs, 7.5 lakhs, 7.5 lakhs, and here also 7.5 lakhs. This is what? The profit before tax, EBIT, earnings before interest and tax. Now from there, sir, because on the total capital employed, 7.5 lakhs, 7.5 lakhs, 7.5 lakhs beyond. But for loan, we need to pay what? Interest. And for debentures also, we need to pay interest. So first subtract loan related interest. The total capital employed on this EBIT is how much? 7,50,000, 7,50,000. Then interest on debentures and interest on loan. Sir, in first case, what is the interest on debentures? 10 lakhs into 12%, now 1,20,000. Sir, they did nothing but here. They might have added one more column also here. It would be much more easy for us. What? Capital employed. 50, 50, 50. That also they might have kept. And on that return is how much? Return of rate of return on capital employed. This is before charging interest. So how much? So 50 lakhs into 15. 7.5, 7.5, 7.5. Now interest. In first case 1,20,000. Second case 1,20,000 on debentures. Whereas third case 2,40,000. Because the debentures are for 20 lakhs. So interest. Then loan related also we need to subtract. Loan related how much? 10 lakhs into 18%, 1,80,000. Only in option 2 you subtract. Now you will get what? EBT you will get. Earnings before tax you will get. Okay. What is EBT? EBT is or PBT is how much? 6,30,000, 4,50,000, 5,10,000 is what? EBT, earnings before tax. Now what is the tax rate given, sir? 31.2%. Now subtract the tax. 1,96,560, 1,40,400 and 1,59,120. I mean on the PBT you apply 31.5% as tax. 31.2% as tax. Now after reducing tax, what is the PAT? 4,33,440, 3,09,600, 3,50,880. Now they are asking, sir, we calculated first three. PAT in option 1 we calculated, PAT in option 2 we calculated, PAT in option 3 we have calculated. They are asking fourth one. Which option is better? Sir, whatever is the PAT available now, that belongs to whom? Equity shareholders. Now, how much return it is getting to equity shareholders, we need to check. Okay, so what? PAT divided by equity share capital into 100 if you do, you will get the return on equity share capital. So return on equity share capital, sir, in each option how much it came? 10.84, 10.32, 11.70. So which option gives more return to equity shareholders? Last third option. So third option is better. So question number 10, sir. Apex Limited is a widely held company. What does it mean by widely held company? Public company. It plans to expand its operations in evaluating the following three financing alternatives. Share capital 60, 30 lakhs, 15 in three alternatives. In alternative 1, only share capital. In alternative 2, there is share capital 30, debentures 20, loan 10. And then alternative 3, 15 lakhs share capital, 25 lakhs debentures and loan 20 lakhs. And they have EBIT also given 18 lakhs. Tax rate 30% also given, and then even dividend payout rate is also given 20%. So now please suggest which option is better. Sir, what is the EBIT in all the three options? 18 lakhs. Now again we need what? First EBT we need, and then PAT also we need. Okay. Tax rate they given us, sir? Yes, they given 30%. Sir, first in first case there won't be any interest, alternative 1. But in alternative, sir, 20 lakhs into 12%, not 2,40,000. 10 lakhs into 15% means 1,50,000. So those two subtracted. Then here alternative 3, 25 lakhs into 12% means 3 lakhs. And then 20 lakhs into 15% means 3 lakhs. So total 6 lakhs. After that, what is the EBT, earnings before tax? 18 lakhs, 14 lakh, 10,000, 12 lakhs. Then tax rate given at a rate of what? 30%. Okay, don't add our extra knowledge and put, sir, cess not included now, we'll add cess and take 31.2%. Don't do all that thing, whatever they given. Okay, in FM also, interlevel, in final also, in some chapters, these points will come. Considering tax rate also. There you include all that, cess, surcharge, all those and all. No, right? So same here, sir. We'll take only what? Tax. Tax how much, sir? Tax has to be levied on PBT. 30% here, 5,40,000, 4,23,000, 3,60,000. So total PAT is how much, sir? 12,60,000. From that, how much dividend has to be given to shareholders? 20%. Sir, actually dividend payout means from profit, how much percentage to be paid is called as dividend payout. But in answer, what they did, they didn't take it as dividend payout rate. They took it as like something like return on equity or return on share capital, like that only. They taken 20%, and the 20% they calculated on share capital. See, what is the share capital, sir? 60 lakhs into 20% if they do, then it comes what? 12 lakhs. So I wrote that also. Dividend payout to be applied on PAT. But here it is applied on share capital, so it is like a return on capital. This is the note added by us because of their wrong treatment actually. Dividend payout now, how it has to be given actually? On the profit available, how much is given as dividend? How much percentage is given as dividend? How much percentage is retained? So that percentage given from profit or PAT is called as dividend payout actually. Not on share capital we'll calculate. Okay. But they did like what? On share capital, they calculated 20% and given as dividend. And then, sir, So the question they evaluated is like, how na? So actually the question has to be solved in such a way only, then only we'll get the answer also. But here, they giving dividend payout word is only wrong. They might have said what? The expected return of equity shareholders is 20% if they give. After giving the equity shareholders 20% also, where there is surplus amount, that option will be better. So, okay, sir, in alternative one, for equity shareholders 20% now, out of 60 lakhs, 20% means how much has to be given? 12 lakhs. So, give the 12 lakhs. After that, how much is the surplus available with the company? 60,000. Then, in alternative 2, sir, how much is the share capital? 30 lakhs. 30 lakhs into 20% now, how much has to be given to equity shareholders? 6 lakhs. So, subtract that 6 lakhs. How much is the surplus? 3 lakh 87,000. In alternative 3, what is the equity share capital, sir? 15. 15 lakhs into 20% now, 3 lakhs. Then, if you subtract, how much is there? 5 lakh 40,000. So, which option has more surplus? Option 3, sir. So, obviously, which option is better? Option 3. But this is only considering this particular criteria. But option 3, sir, still majority may not choose, even with this calculation also. Why? In option 3, the risk is high. Sir, equity shareholder, na, if at all the 20% return not came also, it's okay, we try to have. But still, even if that there is no 20% return also, company doesn't have any financial struggle. Whatever the return they comes, that only they'll give it to shareholders. So, the company can survive. But in alternative 3, sir, if their profits are not 18 lakhs or if they are below 18 lakhs, their interest cost is high. Because if 20 lakhs bank loan is there and 12% debentures is there. So their interest cost is high. So with heavy interest cost and heavy finance cost, when the EBIT dips, then the company get hit harder, sir. So the company survival itself will come into a question. So alternative 3, in terms of surplus available with the company, assuming the EBIT is 18 lakhs, it is better. But companies, can they fixedly say like my EBIT will be definitely 18 lakhs? No, right? It may change depending different situations. If the EBIT 18 lakhs, this is the best alternative. But we cannot predict. If you take best case, worst case, best case, and optimum case, like the 3 cases if you do, then in worst case your EBIT might be somewhere like 10 lakhs. In your optimal case what? In your best case what? So like that if you do, then option alternative 3 itself may not be the better. Okay, so alternative 3 is better, but risk is also high in what? Alternative 3, because huge finance cost involved. So understand, sir? But do we need to write all that? We need not to write all that in the exam, but you need to know. Okay, just because of the surplus is more in alternative 3, always we cannot suggest to the client this is only the best option. Okay, there are other factors also like what? Risk to be in what? If EBIT dips, what happens? Then come to question number 15. Question number 15. Both methods are not correct, Divya. Again, as I said in some other class, the question framing itself, they didn't framed properly. Here, dividend payout rate, they shouldn't give. Okay, na? Because no equity shareholder will expect dividend payout on the profit available. He'll expect the return on his share capital only. So here, they giving dividend payout is only the mistake. They should have kept what? Expected return on share capital by equity shareholders is how much? 20%. That only I wrote. Dividend payout to be applied actually on what? PAT. But here it is applied on share capital. So it is like a return on equity share capital. So it's an expected return on equity share capital. Assume it like that way. Dividend yield ratio. Yes, on share capital, how much? Okay, that word they can use. Dividend yield. On share capital, how much dividend they're going to get? Then that comes under dividend yield. So come to question number 15. Question number 15. We have 15 to be solved, 16, 17, okay, 3, like considering present value factor, annuity factors, all those kind of questions. You only know better these questions than me. Core Success Limited wants to acquire an asset costing 1 lakh. It has 2 options are available. First one is buying the asset by taking a loan repayable in 5 installments, 20,000 each, with 14% APH per annum. The second one is leasing the asset, for which lease rental charges 30,000 up to 5 years. The lessor charges 1% as processing fee in the first year. Assume the rate of return is 10%. Present value factors are this. Suggest which alternative is better for the company. And the rate of depreciation is 15%, while tax rate is 33.2%. Sir, we have 2 options: buy an asset, lease an asset. So what we have to do for all the 5 years, we need to find out how much is the net cash outflow. Okay, in whichever the option gives the total present value of cash outflow is less, that option will take it as what? Best. Okay, sir, if you buy an asset, what happens? If you buy an asset, sir, what is happening? Asset cost 1 lakh. Okay, it is repayable in 5 installments. So year 1, year 2, year 3, 4, 5. Every year you need to pay how much? 20,000, 20,000, 20,000, 20,000 you need to pay. Okay, this is what? Cash outflow. Every year. But then you can claim, since you are a owner of the asset, you can claim depreciation. But depreciation is a cash benefit, huh? Non-cash benefit. So it does not impact our cash outflow. So but every year how much depreciation they can claim, sir? 15%. Okay. Sir, 15% now on what value we need to claim, sir? Interest we can take afterwards. It's not like first we should take only interest, right? We can take depreciation, then also we can go with interest also. Okay. Sir, depreciation, we're going to get how much? On return down value method, we have to solve. So first year, 15,000. Second year on 1 lakh into 15%, 15,000. Second year on 85,000. So like that it will come. But why we are considering still depreciation? Sir, because of depreciation, we'll have a tax saving. Okay, so the tax saving element will consider, not just the depreciation, because of depreciation our profit will come down. Once our profit come down, our tax outflow will get reduced. So that reduction of outflow we need to consider. Okay, so this is a positive cash outflow. The tax saving is a negative cash outflow because it reduces our cash outflow. Na? So on depreciation we need to find out what tax impact. Then interest is there, sir. Every year how much interest has to be paid, sir? First year on 1 lakh we need to calculate. Second year on 80,000 only we need to calculate. Third year we need to calculate only on 60. Fourth year only on 40. Fifth year only on 2,800. But again, sir, interest is a cash outflow. But the problem is what? Total interest is not a outflow, sir. Why? Because again, interest is also an expense. Once you claim an expense, your profit will come down. Again, in interest element also there is some part of tax saving. So reduce the tax element. The balance only we need to consider. So what I'm going to say is like, first installment 20, 20, 20, 20, correct. Interest 1 lakh into 14%, 14. 80,000 into 14%, 11,200. The same way 8,400, 5,600, 2,800. Then depreciation. But the tax benefit, sir, what is the tax benefit we have? D, B plus C. Because on together we'll have what? Tax benefit. Okay, because on interest also will have tax benefit, depreciation also will have tax benefit. So both together 29,000 into 33.22%. So this is the tax benefit. So now clearly, sir, what is the cash outflow? This installment money 20,000 is an outflow. Interest 14,000 is also an outflow. Depreciation non-cash item. But this tax benefit is what I said, negative cash outflow. I mean, because it saves our money. So it's something like offsets the cash outflow. How much? 9,634. So what we have to do? 34 minus 9,634 if you do. What is our net cash outflow, sir? 20,000 installment, interest 14, 34 minus this tax saving 9,634. If you do, what is the net outflow? 24,366. Okay. Then you discount it with present value annuity factor at a rate of what, sir? 10% discount rate. So it is how much? 0.909. So if you do it, how much it will come? 22,151. Likewise, if you do the discount, the total present value of cash outflows for 5 years will be how much, sir? 83,985. The total present value of cash outflows after removing the tax savings also. Okay, then. Sir, again, since they didn't spoke anything about salvage value, we'll think even though asset is purchased, the salvage value is nil. But usually they'll give what? Salvage value also. When salvage value is given what? Here there will be a negative cash outflow. Okay. There will be a negative cash outflow. Let's say the scrap value they said like 30,000. On 30,000 also we'll find out the present value of amount and that also will get reduced. So the total present value of cash outflow will get reduced much more further. Then the next option is what? Lease. Sir, what is the lease charges? Every year they need to pay how much, sir? 30,000. And in the inception of lease, they need to pay how much? 1% as processing fee. So that has to be paid in year 0. Because at the inception of lease only processing fee has to be paid. So year 0 also will be there. At the beginning of the year, you need to pay processing fee. Okay. So how much, sir? Year 0, 1,000. But processing fee is also an expense or not? So there is a tax benefit on it. Net outflow is how much? 668. So total present value 668. Sir, since it is a leased asset, in second option, will you get depreciation? You will not get depreciation. You will not have any interest. So only lease payment. On that, if you subtract tax saving, you will get the net cash outflow. So what is the lease payment, sir? 30, 30, 30, 30, 30. From there, tax benefit is how much? 33 point. How much is the tax rate, sir? 33.22 if you subtract 9,9666. So what is the net outflow? 6668 in first year processing charge. Then every year 20,034. So if you discount it with present value factor, the total outflow is how much? 76,611. So which option is better? Leasing is only better because they didn't give salvage value. But most of the ideal cases there will be only even what? Salvage value. Okay, then considering salvage value, alternative 1 also may be better. But here with the information available, alternative 2 is only better. Then question number 16, sir. So total 3 options are there, sir. First, buy the asset with your own money. Second one, partly use your money and partly use loan money. Third one, go for lease. Okay, the question is almost like same only. In each and every option, we need to find out the present value. Sorry, in first case, everything you used what? Own money only. So you don't have interest cost also. So what benefit you will get only? Since 1 lakh asset you have, you will get only depreciation. Sir, depreciation, they said like what additional depreciation is also available. So total first year how much is the depreciation they can get? 35,000. Sir, first year 35,000. Now what is the written down value? 65,000. 65,000 into 15% how much? 9,750. Then on the written down value again 15% like that. They did. Understood, sir? How they calculated? Here 1 lakh into 35. Why 35? Normal 15, additional 20. Here 65,000 into what? 15%. Then 65 minus 9,715, how much will be there, sir? 55,250 into 15%. Like that if you do, you'll get the depreciation amount. So on written down value method, we are calculating. Okay. Then because of depreciation, we'll get tax benefit. Because depreciation reduces our profits, our tax also will get reduced. So the tax saving, we need to find out. How much, sir? 35,000 into 34 point. Where they given the tax rate, sir? Here they given clearly tax rate is how much? 34.944. So if you find out the tax shield, 12,230, 3,407, all this if you subtract. Okay, this is the tax saving they got. Okay, so this tax saving multiplied with present value, sir. See, what is the total present value of savings they got because of tax? Sir, this is not present value, this is the present value of savings. What is the present value of total savings? 19,091. But today they have a cash outflow of how much? 1 lakh. Today they have to purchase an asset now. So today they have a cash outflow of 1 lakh, but because of tax they have a savings over a period of 5 years how much? 19,000. So if you subtract, what is the total effective cash outflow? 80,909. 80,909 in case of own fund. Sir, this could be done even in another way. Year 0 only, you might have kept here asset value 1 lakh, no present value factor, total 1 lakh is what? Outflow. Whereas these are like what? Negative outflows because tax savings. So if you subtract all this, you'll get straight away how much? 80,909 is the total cash outflow under the first option. What is the first option? Instead of taking loan or instead of taking it as lease, everything is, the total money is funded by own funds only. Charishma, first option you got. First option arthamaindamma? Okay. Then second option. Cost of acquisition if financed via loan. Sir, if financed via loan, what they are doing, sir? 25,000 they are doing own funds. Balance 75,000, what they are doing, sir? Loan fund only. Okay. So see, first year they paid how much? Principal 25,000, total outflow 25,000, present value of outflow how much? 25,000. So then, what is the next outflow, sir? Every year they need to pay interest also. Because 75,000 is a loan fund. So how much is the interest, sir? 75,000 into 6,750, 6,750, 6,750, 6,750, 6,750, and here you will pay even 75,000 loan also. In 5th year end you will pay loan. So where it is given? Can be availed at 9% interest payable annually with principal repayable at the end of 5th year. Okay. So if you do, then again, for interest and loan repayment, what is the total outflow, sir? 6,750, 750, 750, 81,750. But here there is a tax benefit on interest. On asset related, purchase related, you will not get any tax payment. But with related to what you will get tax benefit, sir? In relation to interest, you will get tax benefit. So this is net of tax benefits, sir, straight away. Okay, they didn't add one more point here. Actually, what? 6,750, what is the tax benefit? 6,750 into 34.944%. How much? 2362. They subtracted this 2362 and then finally they got what? Okay, 34 point, how much percentage, sir? 944. We did 2 4s, 1 4 only. 6,750 into 34.944%. 23? Then you'll get 4392 or 4391. Okay, so then you got, sir, this step they did straight away, sir. Actually, we should add one more column also, what? Tax shield. Okay, you might have add one more column also, tax shield, which is how much? 6,750 into the tax rate. If you do, you'll get what? Tax shield also. Then this is the net column. Vaishnavi, able to understand? Sir, you got the point here, sir. After tax shield, this is the 25,000 you paid instantly is an outflow. Every year interest you have to pay, but on interest you will get tax benefit. So net of tax savings is the outflow. Net of tax savings is how much? 4391, 4391, 4391. Here also 4391 plus this 75,000. Total outflow is how much? Sir, why 79, sir? 75,000 loan repayment. On loan repayment you will not get any tax saving, but on interest related you will get tax saving. How much after tax saving? Interest related 4931 plus loan repayment. Total it is how much? 79,391. So have we got this 79,391? 75,000 plus 4,391. Okay, so now present value. So what is the total present value of outflows they are having, sir? 49,302. Sir, this is the total present value of outflows. Okay, plus. Sorry, this is not the total, sir. Total we need to do here. Total comes to how much, sir? 25 plus all this if you do. The total present value of outflows is how much? 88,217. But sir, is he the owner of the asset or not in this case? Owner only, right? Since he is the owner of the asset, he can claim even what? Depreciation. But depreciation to be considered in the table? No, right. But in the first case, already we computed the depreciation. How much tax shield will come with respect to depreciation? How much will come, sir, with respect to depreciation total? 19,091. So from this 88,000, subtract the depreciation related 19,000. So effective cash outflow is how much? 69,126. Got the point, sir? Then third option. If taken on lease, sir, if taken on lease, there won't be interest, there won't be what? depreciation also. Okay, so lease in the year 0, sir, he need to pay a processing fee 1000, and every year he need to pay 34,000. So year 0, 1000. On 1000 there is a tax shield, sir. After removing tax shield, how much is the net cash outflow? 651. So present value is also 651. Then every year lease rental is how much? 34. Tax shield on it is how much? 34.944%. After removing tax shield, what is the net cash outflow? 22,119. So every year if you discount it, total value of present value of cash outflow is how much? 84,481. Can we subtract depreciation here? Depreciation tax shield? Why? Because he is not the owner in this case. He will not get depreciation. So 84,481 is the first option outflow. Second option outflow is how much? 69,126. Third option outflow is how much? 80,909. So which option is better, sir? Second option is better. So okay, sir, it is always to be remembered, sir, in case of business assets, even though you have money, it's always not advisable to buy with your own funds. You need to use what? You need to mix own funds and loan fund also. Okay, because let's say you are buying some plant and machinery or car. Usually the bank will charge less rate of interest on those kind of assets, 8%, 9% only. Okay, but on your own funds, your expected return will be more than that. So why to block your own funds where you can get an interest loan at a rate of 8% or 9%? So that is something to be decided in case of even tax planning also. Then the last one in this model, sir, question number 17. Total cash outflows after getting the tax benefit, if you see, which option is better? Okay, see here. They purchase a second-hand machine in first option for how much, sir? 10 lakhs. What are the manufacturing costs? So this is a outflow, sir. First year they'll have 10 lakhs outflow. There won't be any tax benefit on this 10 lakhs. Every year depreciation will come. And then manufacturing cost how much? 15, 18, 21, 24. On this there will be tax benefit. And on 10 lakhs there will be depreciation. On depreciation we need to consider again what? Tax benefit. And machine sold, salvage value is also there, 1,50,000. So we need to consider. So 0 in year 0, 10 lakhs outflow, 10 lakhs. In year 1, 15 lakhs is the manufacturing cost. Depreciation 1,50,000. On all both together, what is the tax saving, sir? 15 lakhs plus 1,50,000 together, 16,50,000. On them, what is the tax saving? Tax rate is how much? 32.445%. If you reduce tax saving, what is the net cash outflow? 9,64,658. Okay, so every year you do and discount it with the present value, you'll get the total cash outflow in first option is how much? 54,81,657. Salvage value. Okay, salvage value is there 1,50,000, sir. That is a negative value to be subtracted. After adjusting all that, you'll get how much? 54,81,657. Sir, these questions, without practice, if you straight away go to exam, then you'll not get. And these questions need not to be watching questions also. These are not watching questions also. Watching now, what you'll do, you'll just put tick marks. Okay, this step correct only, this step correct only. Okay, you are not testing the quality of book or testing the quality of my class. You are learning. So instead of putting tick marks, take a rough paper and solve. Not now at least. Okay, so when you are practicing, don't do watching, sir. Once if you do watching, you are just testing the quality. You are not knowing the how to prepare that. So you wanted to know. It's okay. So you wanted to do audit by now itself, but wait for some time, sir. First learn how to do accounts. See, first if we know how to do accounting, finance, then audit starts. Here this is something first we need to learn how to do. Then you can do watching, verification and all. Wasting అర్థమైందమ్మా టిక్లు పెట్టుకోవడం కాకుండా క్వశ్చన్ చదివి రఫ్ పేజ్లో ప్రతిసారి ఆన్సర్ ఏం చేయండి సాల్వ్ చేయండి ఇన్ ఎనీథింగ్ ఇది ఎస్ఎఫ్ఎం ఆర్ ట్యాక్స్ దెన్ యూ విల్ అండర్స్టాండ్ హౌ మెనీ ప్రొవిజన్స్ యూ ఆర్ ఏబుల్ టు రీకాల్ ఆర్ నాట్ టిక్ పెడితే ఏమన్నా అన్ని కనపడుతూనే ఉంటాయి అక్కడ ఓకే ఆల్ ద ఆన్సర్స్ దేర్ ఓన్లీ ఇట్స్ ఓకే దెన్ యూ థింక్ లైక్ ఇది నాకు తెలిసే అనుకుంటావు తెలిసి నీకు అంతే గుర్తురాట్లా తెలియడం వేరు యూ రిమెంబరింగ్ ఇట్ ఈస్ డిఫరెంట్ నోయింగ్ ఈస్ డిఫరెంట్ రిమెంబరింగ్ ఈస్ డిఫరెంట్ ఎక్కడో చూసినట్టు ఉందిలే అనిపిస్తుంది మీకు అంతే అప్పుడు స్మాల్ చూసుకుంటూ వెళ్తే నాకు నిద్ర వస్తుందమ్మా Then ABC Limited, sir, instead of buying that, they wanted to produce that material externally. So then year 0, no outflow. Year 1, year 2, year 3, year 4, year 5 outflow, sir. No depreciation also because they don't own any asset. So on all these things, they'll get tax saving. So net of tax saving if you do and find out the present value, see, 20 lakh, these are the purchase cost, tax saving, these are the cash outflows, discounted with present value. What is the total cost, sir? 55,15,637. So if you buy a machine and produce on your own, it is 54,81,000. If you give it to someone else, it is 55,15,637. Okay, now, sir. So before break, sir, let me, sir, salaries 2 questions anyhow I am not explaining. Pray that they should not ask salaries question only because even if I explain, if they ask salary question, you cannot do because day before exam, anyhow you cannot revise salary provisions and go to exam. Even if you are writing single group also, you will not have time to revise salaries provisions and all. Okay, and if they target to test the salaries provision, there is so many things even in the salaries chapter. So 99% they will not ask a question from salaries chapter, 99%. Okay, so here in this chapter, even 2 salaries questions are also there. Okay, if you look at question number 11 is related to what, sir? Salary. Question number 12. Question number 12 is related to salary. Question number 13 is related to salaries. Question number 14 is also related to salaries. Okay, so now we'll solve question number 11, sir. Question number 11 will leave. So first let me explain you this section. That is from capital gains, that particular section. Sir, what is this 54G? See, this is an exemption, sir. Under 54 series, we have exemptions. 54, 54F, 54B, 54D, 54F, 54EC. Okay, same way 54G we have, 54GA we have, 54H also we have. Okay, now see. 54G. What happened here? Any SSE transferred plant and machinery, land, building. Any SSE, what he has did, sir? Transferred plant and machinery, land and building. Plant and machinery, land and building. Okay, why he has transferred? Because he is shifting his undertaking from an urban area to rural area. And government wants to encourage such kind of shiftings also. Because, sir, 30 years back when they started factory, it was in outskirts only. But now the city has grown and the factory has become in the center of the city. Okay, now the problem is what? In the center of the city, if a factory is located, it creates a lot of pollution. So obviously they'll encourage the factories to shift from cities to rural areas. So SSE is transferring plant and machinery, land, building. He's selling all of them. Why? Because he wants to shift from an urban area to rural area. Then what this 54G says, like, in such cases, we'll give capital gain exemption. How much? Or what to be done? Sir, that money, whatever he gets from transfer of plant and machinery, land and building, has to be invested again in purchase of new plant and machinery, land, building, and for shifting expenses. That money which he got from transfer of the plant and machinery, land and building, to be used for what? Shifting expenses, and to buy new land and construction, and for new plant and machinery purchase, it has to be used. Okay? If it is done in such a way, then there is an exemption available, sir. Capital gain or amount invested, whichever is lower. The capital gain they got or amount invested, whichever is lower, will be given as exemption. The time limit for investment. Within what time they need to do investment, sir? Okay, they need to do investment, sir, whether they are purchasing or whether they are constructing. When they are acquiring, then it has to be acquired within 2 years from date of transfer. When they are constructing, it has to be done within 3 years from date of transfer. Okay, sir, till 2 years, 3 years, if they didn't construct, they have time till how many years, sir? 3 years or 2 years in case of construct. But till that time, can they keep the money with them only? Because return filing will come within 6 months. By the time of return filing, you may not either purchase an asset nor even started construction also. Then how do you claim exemption? Okay, if you say simply like, I will purchase an asset, then income tax people will believe. No, right, sir. So what they are asking, if by the time of return filing, you didn't make the purchase or you didn't utilize the money, then deposit that money in a separate account called CGAS account, capital gain account scheme. Okay. In that account, if you have deposited, then they believe like you are going to use that money only for purchase or construction. And they'll even further assume that that amount has been already spent, and then they'll give you the exemption. Okay. So CGAS account is there. And lock-in period, sir. The asset invested has to be there with the SSE only for another 3 years from the date of purchase or date of construction. Okay. Violation of lock-in period, whatever the capital gain exempted previously has to be reduced from the cost of acquisition of the new asset. Okay. So now related to this, there is a question, sir. See. Smile Limited shifts its industry from urban area in Jaipur to a remote village in Rajasthan. From where to where it shifted, sir? Jaipur to remote village in Rajasthan, it has shifted. In the process of shifting, the company sells the following asset and purchases new assets at its new place. Okay. So they have a cost of acquisition for building, plant and machinery. The sale proceeds are what? 30 lakhs, 25 lakhs, 9 lakh 50. Transfer expenses 30,000, 25,000, 9,500. Cost of new assets 12 lakhs, 8 lakhs, 4 lakhs. So this is what the investment they have been made. Then land is acquired in the year 12-13 for how much? 1 lakh. So the cost of acquisition of land is how much, sir? 1 lakh. Compute capital gain. First we need to calculate capital gain. Land what value, sir? 1 lakh. Sold for 30 lakhs. What is the capital gain? 29 lakhs. Sir, currently there is no indexation benefit available. Don't think of indexation. There is no indexation. Indexation available only to resident individuals and HUF. That also when they sell their residential house property. Okay. That also has an option. Not straight away as like an indexation benefit, sir. So currently there is no indexation option available. Okay, for any SSE, no indexation benefit available. Only in a residual case for resident individual and HUF, there will be a indexation option. Okay, there also first we should compute capital gain without indexation only. While calculating tax, you calculate tax applying 12.5%, one option. Second option is what? You recompute capital gains by providing indexation benefit and apply 20%. Okay, such option is there. So 99% of the cases, as of now, there is no indexation. So first, transfer related expenses. What is the transfer related expenses, sir? Sale proceeds 30, 25, 9 lakh 50. Then what is the format of capital gain, sir? First we will take gross sale consideration. From there, transfer related expenses, you will get net sale consideration. From there, cost of acquisition, cost of improvement. There is no indexed cost of acquisition and indexed cost of improvement. You have to subtract cost of acquisition and cost of improvement. Then you will get long term or short term capital gains. From there, you can claim the exemptions under 54 series. Then you will get the income chargeable under the head capital gains. So here first they took what? Sale consideration. They subtracted transfer related expenses. Where they said transfer related expenses, see 30, 25, 9,500. Subtracted. What is the net sale consideration? 29 lakh 70, 24 lakh 75 and 9 lakh 41,500. Then cost of acquisition 1 lakh for land And for building and plant and machinery, sir, building is a depreciable asset. Plant is also a what? Depreciable asset. We should subtract what? PGPP will end. Okay, block ceases to exist or not. So when the block ceases to exist, when the sale value exceeds the total written down value. So the written down value is how much? 8 lakh 50, 4 lakh 50. It exceeds. So we have how much, sir? 28 lakh 70, 16 lakh 25, 4 lakh 91,500. But the point to be remembered, sir, this 16 lakh 25,000 is short-term capital gain only. This 4 lakh 91,500 is also short-term capital gain only. Why? The gains arising from transfer of depreciable assets always has to be treated as what? Short-term capital gain. The asset may be long-term only. This building long-term capital asset, plant long-term capital asset, but the resulting depreciation always has to be treated as what? Short-term capital gain only. Okay? Even though they are short-term, still 54G exemption is available. So what is the exemption available, sir? Amount invested or capital gain, whichever is lower. Sir, 1 second. Why they did like this? Or I wrote wrongly in the notes, sir. Just let me check once. If cost of new assets plus expenses incurred for the specified purpose is greater than or equal to capital gains, then entire capital gains is exempted. If cost of... It's okay, it is correct only, sir. What we wrote is correct only. Capital gain or amount invested, whichever is lower, is only exempted. So in answer only we need to correct. Sir, what is the capital gain here? 28 lakh 70. What is the amount they have invested? 12 lakhs. The amount they invested is what, sir? 12 lakhs only, right? So what is the exemption available here? 12 lakhs. Okay. So here amount invested or net sale consideration. Sorry, this total amount invested or capital gain, whichever is lower. So then here 12 lakhs. Here what is the capital gain, sir? In second case 16 lakh 25,000, whereas the amount invested is only how much? 8 lakhs. In third case, sir, what it is? Plant and machinery is how much? 4 lakhs. Amount invested, whereas the capital gain is how much? 4 lakh 91,500. So here also how much is available? 4 lakhs. Then we'll get the total. How much from 28 lakh 70 to subtract 16 lakh 70,000 here, 8 lakh 25,000 here, and here it is 91,500. Okay, so 54G is not like amount invested, long-term capital into amount invested by net sale consideration. It is simply like what? Amount invested or capital gain, whichever is lower. It's okay, everybody? So question number 12, 13, 14, all the three are related to salaries related only, sir. If you wanted to try anything, try 13. Okay, because it covers everything cumulatively. It's a way of tax planning also. The employer gives two options. Either it can be taken as an allowance or it can be taken as a perquisite, whichever gives the best option. So it covers most of the points. Okay, so instead of solving 12 and 14, if you solve 13, you get more clarity regarding salaries chapter related provisions, sir. It's like a brush up of again the total inter-level salaries provisions and all. Okay, I don't want to risk doing that. DTA and transfer pricing. DTA is about double taxation avoidance agreements. So here, both these two chapters, many students think they are like, these are like easy questions only, everybody target here, but still they do mistakes and they lose marks here. Okay, because if you are not good at logic, then these two chapters you cannot do. It's okay, it's not just about these two chapters, at least DTA has some tax provisions. When it comes to transfer pricing, tax is very less, only logic is more. Okay, the taxability or the tax concepts to be teached is 20-25% only. The rest 75% is about logic only in transfer pricing. Okay, so where the logic only people will do most of the mistakes, sir. That's why. Otherwise, these two chapters alone can help you in clearing the tax exam. But still, students are struggling now. You can understand the problem. Logic. Okay. DTA, there'll be, if two questions are asked, one will be a theory question and the other one will be a problematic question. So now see, first, what is called double taxation? When the same income getting taxed more than once, when the same income getting taxed more than once, it is called what? Double taxation. Sir, why it gets taxed more than once? Sir, let's say Divya has received 15 lakhs rent from house property located in USA. So now where the property is located, sir? USA. I mean, it means where the income accrued? Outside India. Sir, outside India, now why it was in rupees, it should be in dollars now. Okay, for our convenience, I kept it in rupees, don't worry about it. Okay, so property located in USA, received money also, accrued also where? USA. Sir, when the income accrued outside India, it is taxable in USA. And then Divya is a resident also. Since Divya is a resident, her global income is taxable in India. For ROR, all the incomes are taxable in India for resident and ordinary resident. Whether income received in India, income accrued or deemed to be accrued in India, or income accrued and received outside India is also taxable if such person is a resident. So here Divya is a resident. So the 15 lakhs rent, since accrued outside India, in USA also it is taxable because of source rule. In India also it is taxable because of resident rule. Now 15 lakhs, property located in India, source in USA, property located in USA, source in USA, so taxable in USA. And Divya, resident of India, global income is taxable, hence this 15 lakhs is taxable even in India. Same income getting taxed in two countries, which is called as what? Double taxation. Okay, sir. So what if there is double taxation, what we have to do? Sir, if it was not addressed, if there is no solution for this double taxation, then people even lose the motivation to earn income also. Because 15 lakhs they got, and let's say some 30% paid in USA and another 30% paid in India, she is left with only 40%. So she thinks like, what, for 40% I have to do all this, sir. Why I want that 40% also? Simply she even quit earning incomes also if this double taxation is not addressed. So that's why government has a need to address this double taxation issue. Otherwise the basic motivation to earn income also will get killed. Okay, you know, sir, the Soviet Union, Russia, a long time back, I mean, they introduced one policy, sir, like what? See, basically, India, US, these are like capitalistic economies. I mean, you can start your business, you can grow, okay, in the way you want. That is like capitalistic economies and all. But Russia, what they did now, long time back, whatever you do, whatever the business you do, the whole money will go to government only. The total money will go to government only. And government will evenly distribute to all the people according to their needs. Then what? Sir, if you wanted to do something big also, you don't have any motivation because ultimately you will get the same share from the government. So that's why people started being lazy, they are not working because anyhow government is going to give them. So the earning people or who could do more they didn't thought of it and they didn't started doing those things. Whereas the lazy people anyhow they are like them only. So there's so much of pressure created on government, the economy collapse. So overall there's a pressure situation. Okay, otherwise Russia used to be a country which can compete directly in economy also with US. But then why the economy collapsed now? Because of their approach. I mean, they believe in communalism. So, okay, so communism means what? Everybody is equal. Everybody has the equal right, equal share, because all these belongs to everybody. So such kind of philosophy came. So because of that, what? The one who have the capacity or capability to earn more also did that. So, okay, so government is not getting much revenues. Okay, but government has to look after each and everyone. So automatically pressure created and all. Okay. So now again, Russia also moved to capitalistic economy only, sir. DTA, double taxation. So now China is there where it's not again capitalistic approach. A moderate approach. It's not completely capitalistic or not completely communistic approach. So okay, in China you cannot own land. The total land belongs to government only. You can just take the land on lease. Okay, you cannot own any immobile property. So you can just own. Sorry, if there is no land now, then your source of investments will come down drastically. In India, majority people's investment will be on land only. What are your assets now? First they'll talk about land only. If land itself is not an asset, then the sources of investment will come down. So then what people do with all this money? They'll spend more. Okay, once they spend more, obviously economy will grow. Okay, otherwise now the whole money is getting blocked where in the name of immobile properties and all. Okay, so now coming back to the point, sir. DTA, double taxation avoidance agreements. Double taxation means what? When the same income getting taxed more than once. Why it get taxed more than once? In one country because of source rule, in another country because of resident rule. So it is getting taxed more than once. To avoid these kind of things, double taxation was needed. Double taxation avoidance agreements is needed. Okay, so and again there is another way of interpreting double taxation. One is economic double taxation. The other one is jurisdictional double taxation. What is jurisdictional double taxation? Which I said now is called jurisdictional double taxation. Two or more country levy taxes on same entity on same income for identical periods. So here for the same 15 lakhs, US also levying tax, India also levying tax. So okay, US is a separate jurisdiction, India is a separate jurisdiction. So two jurisdictions levying tax on same income for an identical period, then that is called as what? Jurisdictional double taxation. Economic double taxation. Economic double taxation means when the same income taxed in two or more countries, but in the hands of different taxpayers. Two or more incomes taxed in the same two or same income taxed in two or more countries, but in the hands of different taxpayers. Sir, I invested in Google. In Nasdaq, I purchased Google shares and I invested in Google. Now Google is what? Which company? US company. Google is a US based company. So whatever the profits earned by Google, where it will pay tax? US it will pay tax. Then out of the profits it's giving me dividend. It is declaring me dividend. And where? I'm in India. So my dividend again is taxed in India. Sir, the same profit after payment of taxes by company only again given as dividend to me, and again such a dividend is being taxed to me in India. So that is called as what? Economic double taxation. Same income taxed in two or more hands. Partnership firm has a profit already taxed, and again that was distributed to partner as share of profit. Again they're getting taxed. But actually, sir, for partnership firms there is an exemption under 10 subsection 2A. We already discussed in PGBP. When partnership firm gives any share of profit to partner, such a share of profit is exempted, provided the firm should be registered where? In India. Okay. So same income taxed in two or more countries, but in the hands of different taxpayers. See, R Incorporation Japan declared dividend. R Incorporation Japan declared a dividend. So okay, so the profits are taxed in Japan, and already the profits are taxed in Japan, and again the same is given as dividend to shareholder. Then that dividend is again taxable in India. Then sir, basic format of house property. You already know this. What is the basic format of house property, sir? First we'll start with what? GAV. Okay, so not needed before GAV also. Usually now we'll take fair rent or municipal rent, whichever is higher, restricted to standard rent. Compare again with actual rent, whichever is higher is called as GAV. Okay, straight away in our questions will not go till fair rent, municipal rent and all. Straight away we can go with GAV, gross annual value. From GAV, what has to be subtracted? Municipal taxes has to be subtracted. Whether they are paid in India or outside India, both can be subtracted. Municipal taxes paid in India or even outside India also can be subtracted. Then we'll get what? NAV. So okay, from NAV what we need to subtract? Standard deduction. How much is the standard deduction? 30% of NAV is the standard deduction. Then from there, 24B interest. How much? Assuming old regime. Old regime. For self-occupied property, maximum 2 lakhs. Let out property, no limit. Okay, in the default regime. Self-occupied property, nothing is available as deduction for interest. Whereas let out property, no limit. And ultimately, under the old regime, house property loss can be eligible for set off maximum of 2 lakhs. I mean that with other rights, 2 lakhs. Whereas under new regime, default regime, house property loss only intra-head adjustment is possible. Intra-head set off is not possible. Okay, double taxation relief. We have two sections are here, section 90 and section 90A. Both are like same only. And then section 91. Okay, so section 90 is what? When Indian government enters into a treaty with some other foreign government, then it is covered by section 90. Instead of government, some association or some institution from India entered with DTA with some other foreign institution, and such treaty has been again notified or adopted by government, then that is covered under 90A. When two governments directly enter, 90. Instead of government, two institutions enters, and later on that is notified or adopted by government, then that comes under section 90A. Okay, there is a DTA between India and that foreign country. Okay, when there is no DTA, sir, it is covered by section 91. So two options: with DTA, without DTA. With DTA, those are covered under section 90, 90A. No DTA, it is covered under section 91. Okay, so 90 and 90A, sir, there is a DTA between India and that foreign country, which is called as bilateral relief. Bilateral relief, because both the countries agreed, so it is called what? Bilateral relief. When, sir, here there is no DTA at all. Okay, if any relief has to be provided, then that has to be provided only by India. Because with the other country there is no treaty. So this is only one side. That's why I call unilateral relief. This is from both the sides. That's why it is called as bilateral relief. With DTA, we call it as what? Bilateral relief. Without DTA, unilateral relief. Okay, in bilateral relief, sir, there are so many other methods. Exemption method. Under exemption method, there are two methods, sir. Again, full exemption method, exemption with the tax progression. Tax credit method, sir. Under tax credit, again we have direct credit method. Under direct credit, again we have full credit method, ordinary credit method. And indirect method, sir, underlying credit method. And the last one is special credit, which is called as tax sparing. So effectively, there are 1, 2, 3, 4, 5, 6 methods. In which case, bilateral relief. What are those? Full exemption method, exemption with the tax progression, full credit method, ordinary credit method, then underlying credit method, and then tax sparing. So these are the 6 methods. Sir, then under unilateral relief, there is only one method. Even though here there are 6 methods, mostly the question is coming from unilateral relief only. So we'll discuss first 2 methods, and then we'll discuss the questions. Sir, here theory discussion is very less. It's all about question solving only. Full exemption method. Income earned in the state of source is fully exempt in the state of residence. If you remember previous example, sir, house property rent, how much is there? 15 lakhs. Taxed in USA, taxed even in India. So since already that 15 lakhs taxed in USA, in India that 15 lakhs completely exempted. Then that is called as what? Full exemption method. The income which got taxed outside India is fully exempted in India. Then that is called as what? Full exemption method. Then exemption with the tax progression. What happens here? Income from the state of source is considered by state of residence only for the tax rate purpose. Only for the tax rate purpose only such income is considered. So see how it has to be solved. First we will include foreign source income also. Calculate tax including cess on total income including foreign source income. Okay, you include that foreign source income. Yes, that is double tax, but still include that and calculate tax. Then find out average tax rate. What is called average tax rate, sir? If you remember in first chapter we have discussed tax payable divided by total income into 100. Tax payable divided by total income into 100 is called as what? Average tax rate. Find out such average tax rate. Then relief equals to, what is the relief given? Such a foreign source income into average tax rate will be given as relief. The balance will be the total tax payable. Sir, what to do the steps, sir? Exemption with the tax progression. What are the steps? You include the foreign source income also and calculate tax normally. Okay, forget about double taxation and all and calculate income normally including the double tax income also. Okay. Then after finding out the tax, calculate average tax rate. How do we calculate average tax rate? Tax payable divided by total income. Total income na gross and net. Net total income into 100. You got average tax rate. Now third one, we need to find out what? Relief. How do we find out relief? Such average tax rate into foreign source income. Into foreign source income, you'll get the relief. If you subtract the relief, you'll get the final tax payable. Okay, so let me go back to the workbook. So yesterday I asked you to solve an advanced tax question. Tried everyone? Okay. Mehak, try it. So remind me towards the end of the class, we'll again go back to that question and we'll see once again. Okay, about the advanced tax question. You understood clearly? Have any doubts? It's okay, we'll see that. Okay, question number 1, sir. Prabhas is a resident, has earned the following incomes for the year ended 25-26. Income from house property in India but received in, sir, first you should know here basic residential status rules. You need to at least find out whether income accrued in India, income received in India, income accrued and received both outside India. Sir, if income received in India to resident also taxable for all the three category, resident, ROR, NR, for all of them. Sir, again, one more thing. This chapter is clearly asked, this chapter will be asked only from individual perspective. Never they tested from any other perspective, sir. This chapter they're going to test it only from individual perspective. Okay, so you should be clear only about individual kind of regimes only for this chapter. Okay, so again, for resident, ROR, RNOR, NR, for all the three, income received in India taxable, income accrued or deemed to be accrued in India taxable, whereas income accrued or arisen outside India, ROR only taxable, for RNOR and NR it is not taxable. Sir, you know these points, 3 points, right? Basic inter-level points. Okay. Now tell me, sir, for every point, where it is accrued? Income from house property in India but received in UK. Is it Indian income or foreign income? If it is accrued in India and received in India, accrued in India or received in India, we call it as what? Indian income only. Both accrual and received outside India, then only we call it as what? Foreign income. So this is Indian income or foreign income? Indian income. Then second one, royalty on patent outside India. So where it is received? Where it is accrued? Outside India. So it is what? Foreign source. Then past untaxed income brought to India, taxable or not taxable? Again, sir, if you remember inter-level residential status, this point will be there. Income earned in the previous year is only taxable in the assessment year. That's the basic rule, right? Income earned in the previous year is only taxable in the assessment year. So we are in assessment year. This was past, not related to previous year. So it cannot be taxed in the current assessment year. Why? Because the basic rule, only previous year income is accessible to tax in the assessment year, not preceding previous year's incomes and all. So then what to do? Okay, file an updated return for that year and pay tax. If updated return also not there, okay, compute as if this income is included in that respective year only, calculate the tax and pay applicable tax and leave at least, since you don't have the option to file a return. Okay. Tax paid in respect of income 1, 2, 3, 90,000, 75,000, 20,000. Sir, with respect to this, even though they pay tax, that is completely irrelevant for us because that is not an income for this year. So that is completely irrelevant. So first they are what they are asking, compute tax liability and relief. First compute tax liability, sir. First method is what? DTA under tax exemption method. Sir, tax exemption method means what? We need to completely ignore that income, right? That income is. Sir, what are the methods we have? Full exemption method, exemption with tax progression method. What is the first one? They said like under tax exemption method. So tax exemption method na full exemption. If it is full exemption, this 5 lakhs again taxable in India, not taxable. This 5 lakhs is not taxable. So what else we have? What else income we are having? 7 lakhs. On 7 lakhs, what is the tax? On 7 lakhs, what is the tax? Which regime you are calculating? Rebate vastada? Which regime it is? Old regime. Sir, what is the tax, sir? First 5 lakhs, how much, sir? 12,500. Then balance 2 lakhs into 20%, 40. Total tax is how much? 52,500 plus cess at a rate of 4%. 54,600. No relief, nothing. So the tax itself will remain how much? 54,600 only. There is no relief available also because here what? Full exemption method. Understood? Come to question number 3. Sir, what we did in question number 1, first basic things. By reading this question, what steps you did to identify or to solve this question? First thing is like you should identify which is Indian income, which is foreign income. And you should even identify what that past untaxed incomes are not taxable in the current assessment year, because only the incomes earned in the previous year are assessable to tax in the assessment year. So past foreign untaxed income completely ignored. There are other two. Here, which method we have to do? Full exemption. Full exemption method means what? The total income which is the income which is already taxed outside India is completely exempted here. That means 7 lakhs exempted or 5 lakhs exempted. 5 lakhs exempted. Sir, if you cannot identify which is Indian income, which is foreign source income, then you will take wrongly the exemption. So the foreign source income which is already taxed outside India is fully exempted. So how much? This 5 lakhs is exempted. So now which is taxable? 9 lakhs is taxable. Sorry, 7 lakhs is taxable. On 7 lakhs under old regime, what is the taxability, sir? 54,600. Don't again misjudge about rebate, sir. In old regime, rebate is applicable only when total income is within 5 lakhs. Under new regime, 12 lakhs. If the same question asked in new regime, rebate itself will come, the tax payable will be 0. Okay. So read question number 3 and try to understand, sir. Which method it is? Okay, in question name it is given, but how do you identify by reading the question which method it is? Such income is included for rate purpose under Indian income tax law. Okay, read the provision here also. What is mentioned here? Income from the state of source is considered by state of residence only for the tax rate purpose. So if it is included only for tax rate purpose, then that is called as which method? Exemption with progression. So what are the steps, sir? First step, what we have to do? Compute the total income and tax. Forget about foreign source and all. Include all the incomes and tax. So first find out and tell what is the tax. Sir, if nothing is mentioned, which regime we need to take? Default regime only we have to take, right? So now calculate and tell what is the tax liability of it. Total income is how much, sir? Total income how much? Total income equals to 26 lakhs. Now on 26 lakhs, calculate and tell the tax. How much? On 24 lakhs, it is how much, sir? 3 lakhs. Okay, on the extra 2 lakhs into 30%, 60. So total 3 lakhs 60 plus cess at a rate of 4%. How much? 3,74,400. So we want what now? Average tax rate. How do we calculate average tax rate? Tax payable divided by total income. How much? Percentage it should come, right? Into 100 you should do. 3,74,400 divided by 26 lakhs into 100. 14.4%. Then what we have to do? Find out the foreign source income. What is the foreign source income, sir? 10 lakhs. Okay. Now the relief under which sections are this relief? 90 or 90A. Okay, relief. How much? 10 lakhs into 14.4%. How much? 1,44,000. Okay, now final tax is how much? 3,74,400 minus 1,44,000. 2,30,400 is the final tax liability. Got it, everybody? Question number 3 done. Okay, now again question number 4, sir, quickly. Question number 4. Okay, calculated, sir. Sir, what is the total income? Sir, income from India 13 lakh 40, income from countries at 12 lakh. So this investment is not even a income. Okay, then India has Dtaa with countries that according to the said agreement, income is taxable in the country in which it is and not in the country. However, such income could be included for the purpose of computation of tax rate. So again, which method? Exemption with the tax progression. Foreign income compute Indian tax payable. So now, sir, first tell me what is the total income? Sir, did they mention about old regime or new regime? So by default, if nothing is mentioned, we'll go to what? Default regime. What is the default regime? New regime. So what is the total income, sir? 25 lakh 40,000. Then what is the tax liability? On 24 lakhs, it is how much? 3 lakhs. On the balance, 1,40,000 into 30%. 41. So okay, so total you do, and again add tax. Cess. 3,55,680 is the tax. 3,55,680 is the tax. Now we need what? Average tax rate. How do we calculate average tax rate? Tax divided by total income into 100. How much? 3,55,680 divided by 25,40,000. It comes to 14%. Now we need to calculate what? Relief under section 90 or 90A. What to do? 12 lakhs into 14%. How much? 1 lakh? 1,68,000. If you subtract 1,68,000, how much is that? 1 lakh? 1,87,680 is the final tax payable. Okay. But sadly, sir, these questions are not asking in exam. Then, sir, we are going on to now full credit method. Okay, so we are now into direct. So these two are done, right? So we are into the direct credit method. Under direct credit method, we have two methods: full credit method, ordinary credit method. Okay, what is full credit? Full credit is easy, sir. Tax paid in state of source is allowed as credited against tax payable in the state of residence. State of residence means what? In which country SSE is resident is called as state of residence. Okay, in that country, what they will do, whatever the tax you paid in foreign country, such tax, you can take it as like something like TDS credit, TCS credit or advance tax, adjust such credit, balance only you pay. So simply no average tax rates and all. Whatever the tax you paid in foreign country, take it as credit. Something like TDS credit, TCS credit, and adjust that credit when you are paying the final tax payable in the source country. The source country. Calculate tax including foreign source income normally only. Then what is the relief? Tax paid in the foreign country. If you give it as relief, then you'll get the final tax payable. Final tax payable. So this is so easy. Now we are moving on to ordinary credit method. Ordinary credit method. So in ordinary credit method, what happens? Tax paid in the state of source is allowed as credit or in the state of residence. Whatever you paid as tax in foreign country, given as credit. But what? Restricted to that part of income tax which is attributable to foreign source income taxable in the state of residence. I mean, simple, you'll calculate two. Tax paid in foreign country and in that foreign source income into Indian average tax rate. You do both. I mean, if that income, the same income, how much tax in foreign country, on the same income, how much tax in India. You find out that, compare both, whichever is lower will be given as relief. Sir, let's say 5 lakhs is foreign source income. On that 5 lakhs in US, 20,000 has been, 1 lakh has been paid as tax. So how much is the foreign tax? 1 lakh. The same 5 lakhs, if it is taxed in India, how much tax? Okay, you need to find out average tax rate. Let's say, sir, average tax rate is 22%. On 5 lakhs, you apply 22% and compare with that 1 lakh, whichever is lower is given as relief. Ordinary credit method. See. Step 1, compute tax including foreign source income. Then again, compute average tax rate. Then what? Relief is what? Tax paid in foreign country or foreign source income into average tax rate, whichever is lower. Subtract that one, you'll get the final tax payable. Easy or not? Okay, so now we'll go back to the workbook. Sir, here, in first question, second option we can do now, sir. So do second option now. In first question, second option we can do now. In first question, we can do second option now. See, earned outside India also eligible for deduction if repatriated within 6 months from end of previous year in convertible foreign exchange. Okay, so the information is like too vague. So it's not like 80 QQB, sir, 80 RRB. Actual amount or 3 lakhs, whichever is lower. Deduction not available for sale of product within the use, resident individual and true and first inventor. Sir, there's no adequate information there, sir. That's why not claimed. Otherwise, 80 RRB can be claimed. Because what? It's a royalty on patent. Even though it is received outside India, also still eligible for deduction, sir. But it has to be received within 6 months. It has to be repatriated into India within 6 months. Now tell sir here. In tax credit method. Sir, what we have to do? First we need to calculate total income, how much we should take? 12 lakhs. On 12 lakhs, what is the tax, sir? Old regime or new regime? Old regime. On old regime, tell 12 lakhs, what is the tax? Vaishnavi. అక్కడ ఆన్సర్లు స్టిక్లు పెట్టాను కదా నేను రమ్మని క్లాస్కి క్యాలిక్యులేట్ చేయను ఓకేనా. సో on 12 lakhs, what is the tax? Sir, ordinary credit method, sir. This is like, sorry, full tax credit method. Full tax credit method, how do we solve? First find out the total income, including foreign source income. Because foreign source income also taxable in India. Why? Because he is a resident, global incomes are taxable. So if he is a resident, what incomes has to be included? All of them has to be included. So 7 lakhs also include, 5 lakhs also include. Total how much? 12 lakhs. Okay, so total income is 12 lakhs. On that, what is the tax? 1 lakh, including cess, sir? 1 lakh? 1,79,000. 1,79,400. Okay, is the tax. Now we want what? Relief. So relief what? What is the tax paid in foreign country? 75,000 or that 5 lakhs into, what is the Indian average tax rate, sir? 1,79,400 into, sorry, 1,79,400 divided by 12 lakhs into 100. How much, sir? 14.95%. So which is lower? 75,000. 5 lakhs into 14.95%, how much? 74? So 74,750 is lower. We need to subtract 74,750. On subtracting, what we'll get? 1,04,650 is the final tax payable. Under which method, sir? Full credit method. 1 lakh. Huh? Okay. Sorry. Yes. Full credit method this is. So in full credit method, what we have to do? Straight away we'll subtract 75,000. Ordinary credit method, we'll do both. Here it is what method, sir? Full credit method. ये method is manke DTA under tax credit method. He didn't set it as like ordinary credit. So we'll take it as like what? Full credit only. So full credit now subtract the total 75,000. Then you'll get how much? 1,04,400 as the tax payable. This is full credit method. Okay. Now solve question number 2. Question number 2. So Rohit, here we need not to do that one and all. Because full credit method means we need not to find out average tax rate and all. Straight away whatever the tax paid in foreign country that can be claimed as relief. Question number 2. What is the total income, sir? 16 lakh 94,000. What is the total tax plus cess? Old regime or default regime? Nothing is mentioned, so we should take what? Default regime. So how much is the tax? Including cess, sir? Everybody got the same? 1,44,352. What's the number? 1,44,352. Now we need to find out what? Relief. So for relief, sir, first find out average tax rate. 1,44,352 divided by 16,94,000 into. Okay, so in question you say like where it was clearly mentioned. However, foreign tax can be set off against Indian tax liability. Sir, if foreign tax is instead of being set off, if they said like foreign tax. Yes, sir, here question is not clear actually. Question is not clear about whether to take. Your doubt is correct only. The question is not clear about what? Whether to take. Yes, in the heading I given as ordinary credit method. But if you read only the question, in the question nowhere it is clear like whether to do it under full credit method or ordinary credit method. So it's like a question framing mistake only, sir. But in institute it's a study material question only as mentioned. So they solved it in ordinary credit method. That's what we are doing. But actually there is a fair chance you thinking of which method has to be solved. Okay, so write down clearly ordinary credit. Okay, in exam they are being little specific only, sir. This kind of mistakes they are not doing in exams. The question is mostly being clear only, so don't worry about that one. Okay. ये book लो. Ordinary credit है. तुम all compare చేసుకొని చూడండి అర్థం అవుతుంది. See, what is the average tax rate? 8.52. What is the foreign tax rate? Which is lower? 5%. So 5% into 4,50,000, which equals to how much? 5% into 4,50,000. How much? 22,000. That is what? Relief. If you subtract 22,500, how much is the final tax payable? 1,21,852. Understood, sir? What we are doing? Total income plus tax calculation. Then relief. Average tax rate find out first. How do we find out average tax rate? Tax payable divided by total income. How much we got? 8.52%. 8.52% is the foreign tax rate. Whereas Indian tax rate 8.52. Whereas foreign tax rate is how much? 5%, which is lower. Foreign tax rate. Multiplied with the foreign source income, you will get the relief. So 1 done, 2 done, 3 done, 4 also done. Then the rest all are with no DTA, sir. So that's why we'll go back to again theory. See, in handwritten I solved it as like ordinary credit method only, sir. 4,50,000 income from profession 1,44,000. Outside India 4,50,000 total 16,94,000. Tax plus as 1,44,352. Average tax rate equals to 8.52%. So which is lower? 5%. So 4,50,000 into 5% it comes to 22,500. So overall the tax payable is like how much? 1,21,850. Then sir, we have another two methods also, underlying credit method and tax sparing. Sir, but for these two methods we don't have any questions. They are there like theoretically only. But practically, sir, to go much more theory background, sir, how India will choose a DTA means there are certain model conventions available. Conventions are standard approaches available. One is UN model, second one is OECD, third one is US model. There are three different type of conventions, established formats of double taxation avoidance agreements. So when you are entering a treaty with a country, you need not to build everything from scratch. Every point you need not to rewrite again. So these three models are like templates. Already there is a template available with you. UN model template is there, US model template is there, and you have a OECD model template is also there. Three kind of model conventions, the model practices, approaches are there. Now, the next one is about tax sparing. The next one is about tax sparing. Sir, tax sparing, sir, you understand it in the example. Okay, clearly, sir. Listen to this example. Sir, in USA, 10 lakhs income is there. In USA. The source of this income is what? USA. Usually, tax rate in USA is how much? 20%. That means on this, how much to be paid? Amount. 2 lakhs has to be paid. But since it is in an SEZ area, US also assume there is SEZ area. Since it is in a SEZ area, such income is exempted. So they should have paid actually 2 lakhs. But the 2 lakhs is what? Exempted. Now in India, such a tax, 10 lakhs is taxable because of resident rule. Understand? Now technically speaking, here there is no double taxation. Because the 10 lakhs not taxed in USA, only taxed in India. Technically speaking, there is no double taxation. But deemed tax paid. If at all there is no exemption in US, how much tax might be paid? That is called the deemed tax paid. If there is no exemption in US, how much is the tax that might have been paid? 2 lakhs. That deemed tax paid will also be given as credit or relief. That is only called as tax sparing. Not just the actual tax paid. If there is no such exemption, no such remission or benefit, how much is the tax actually payable? Okay, that notional tax paid you have to compute. Such notional tax also will be given as credit. That is only called as tax sparing. We will not see much in India treaties, sir. This is very rare. We will not see this tax paying clause in our DTA which are entered by India. But maybe some other countries may follow this model also. So we are generally talking about tax treaties, not just particularly about India and US or India and one particular country. Okay, so tax paying also may be adopted as one particular means in any of the countries. Okay, we don't know which particular country is following or which between which two countries there is tax paying also in their DTA agreements and all. Okay, we are just understanding globally how the tax relief will be provided. So one among them is what? Tax sparing. In tax sparing is what? Not just the actual tax payable, even the notional tax payable will also be given as credit. That is only called as tax sparing. So assuming India has a tax rate how much? 30%. So 10 lakhs into 30% means how much? 3 lakhs plus cess, total how much? 3 lakh 12,000. Now tax sparing. Tax sparing is what? The notional tax paid in US. How much will be the notional tax payable in US? 2 lakhs. Because yes, it is exempted. If there is no exemption, how much should have been paid in US? 2 lakhs. So subtract the 2 lakhs. How much is the tax payable in India? 1 lakh 12,000. 1 lakh 12,000. So state of residence allows credit for deemed tax paid which is exempted otherwise in the state of source. Okay, so actually exempted in state of source. Okay, but such a deemed tax paid, if there is no exemption, you might have paid some tax, right? Such deemed or notional tax will also be given as credit in the state of residence. Such model is called as what? Tax sparing. Tax sparing. Then the last one, sir, underlying tax credit. Underlying tax credit. It is also very rare, sir. This is much more rarer than tax sparing. Sir, tax sparing has at least a logic. The logic is what? The exemption is given associating with some conditions with an intention to give you a benefit. Now such benefit cannot be revoked. Sir, if there is no, since if you think like there is no double taxation and this 2 lakhs is not given as credit means, then the exemption benefit you lost. In USA they give an exemption, but that exemption benefit you are losing, right? Because again, sir, let's say if there is no exemption, then you might have got 2 lakhs, right? Effectively how much you have paid? 3 lakh 12,000 only. See, forget about tax paying. Generally if you solve also, in US you will pay how much? 2 lakhs tax. And in India you need to pay how much? 3 lakh 12,000. The 2 lakhs anyhow will be adjusted, right? Full exemption method or ordinary rate method, any of those methods also you'll get 2 lakhs. Now, US they give an exemption, maybe he's an exporter or maybe he's doing some essential business. That's why to encourage him such exemption has been given. Now that encouragement is going off, right? Okay, so because of in US whatever the exemption they given, that becoming pointless. Because in India again you are paying how much? 3 lakh 12,000 tax. So that's why that deemed tax paid also has to be given as what? Credit. So that their true intention behind giving an exemption remains like that only. So to sustain or to keep it alive, the true intention behind giving an exemption, they are giving what? Even credit for the notional tax paid or the deemed tax paid also. That is called as what? Tax sparing. Then the next one is what? Underlying tax credit. Underlying tax credit is linked to economic double taxation. All the methods which we have discussed are related to jurisdictional double taxation. What is jurisdictional double taxation? Same income taxed in India and even in foreign country. India because of residence rule, foreign country because of source rule. Then to avoid that, then that is called as jurisdictional double taxation. What is economic double taxation? Same income but taxed in different persons. They may be in the same country or different countries. Then that is called as economic double taxation. To address economic double taxation only, there is something called underlying tax credit. Underlying tax credit. It tries to mitigate economic double taxation. Where same income is taxed more than once in the hands of different persons. Where same income is taxed in the hands of more than once where same income is taxed more than once in the hands of different person or same person. Then this relief will be, credit will be given. So see, company USA on profits tax paid in USA and it again distributed as dividend to shareholder in India. On this, sir, see, previously, instead of, sir, when I am doing CA intro or CA final time also, dividend is not taxable in shareholder hands. Dividend is completely exempted in the hands of shareholder. Then dividend, then there is only one tax, sir. There is no double taxation at that time. So now what happening? Company also has to pay tax. Shareholder also has to pay the tax on the dividend. Previously, dividend is exempted completely in the hands of shareholders. Then this tax loss, then this part of revenue is a loss to the government. No, sir. What did it? Company first pay tax on its profit. Then again, if it want to declare it as dividend, it has to pay dividend distribution tax. It has to pay dividend distribution tax and then the net amount shareholder will get. In simple, whatever the tax has to be paid by shareholder, that also is being collected from company only in the name of dividend distribution tax. Dividend distribution tax. Understand, sir? So 2 times the taxability is within which hands? Company hands only. But now dividend distribution tax is not there. Instead of dividend distribution tax, directly it is being taxed in the hands of shareholder only. Now understand, sir? In foreign countries still there may be dividend distribution tax. You invested in a foreign company. In that foreign country, still there may be dividend distribution tax. Company already paid tax on profits. And again, on distribution of dividends, such company has to pay dividend distribution tax. After the dividend distribution tax, you got dividend income. Again, that has to be taxed in the hands of shareholder under that IFRS. Now instead of 2, it became 3 times taxing. Company on profit, it has to tax. On declaration of dividend distribution tax is there. And again, the shareholder has to pay again tax on dividend received under that IFRS. Now, how many taxes, sir? 3 taxes are there. To address this, what are the taxes paid? Okay, relief will be given, sir. Such relief is only called as what? Underlying tax credit. Okay, we don't have any questions to write something like stepwise and all because that is not much frequently there. Okay, it won't be there. Maybe in 1 or 2 countries in the treaties it might be there, and we don't have any questions from this method. Okay, so tax paying and underlying tax credit, we don't have questions. What we have is only just a theoretical concept. We have questions related to what? Full exemption method, exemption with progression method, ordinary credit method, and full credit method. What are the other two methods? Underlying credit method, which addresses economic double taxation. Next, tax pairing. It gives even credit for the notional or deemed tax paid in the source country. Okay, so this can be even asked as a theoretical question also, sir. Okay, what are the different type of credits or exemptions given under DTAA? So each method you have to put and write about 2 or 3 lines about each and every method. It could be asked as a theory question also. Unilateral relief. If there is no, sir, when unilateral relief applicable, when there is no DTA between India and such country, then unilateral relief will come into picture. Understand, sir? When there is no DTA between India and such country, there are certain conditions to be satisfied, sir, to apply unilateral relief. SSC should be a resident of India. Only for residents, unilateral relief will be given because India is the resident country, it is giving. Then, income derived from foreign country and such income not accrued or deemed to be accrued in India. So, this relief is available only with respect to incomes which were accrued outside India. Okay, which were accrued outside India. If they were either accrued in India or deemed to be accrued in India, then this relief is not applicable with respect to such incomes. Okay, then tax should have been already paid or deducted on that in foreign country and there is no DTA with the foreign country. So 4 simple conditions, sir. SSC resident. Second one, such income not accrued in India or not deemed to be accrued in India. It shouldn't be accrued or deemed to be accrued in India. Then third point, tax should have been paid outside India. Fourth one, there is no DTA between India and such a country. So total how many points are there, sir? 4. If these 4 conditions are satisfied, then there will be unilateral relief. Unilateral relief. So once again, I am saying the 4 conditions are SSC should be home, resident. That income shouldn't be accrued in India or not deemed to be accrued in India. Third one, sir. Income, already such income, foreign income taxed outside India. Fourth one, there is no DTA between India and such foreign country. Then we'll get what? Unilateral relief. First steps. Calculate tax on total income including foreign source income. Then calculate average tax rate. Then find out rate at which tax paid in foreign country. Sometimes they give straight away the rate. Otherwise, you have to find out the foreign tax rate. What? Tax in foreign country divided by income taxable in foreign country as per foreign law into 100. Okay. Tax in foreign country divided by income taxable in foreign country into 100. If you do, you'll get foreign tax rate. Okay. Now relief. Relief, how do you do? Take that double tax income. What is called double tax income? The common amount. The common income which is both taxed in India as well as foreign country also. The common income which is taxed outside India and even in India is called as double taxed income. Understand, sir? Sir, let's say for example, house property income, foreign country taxable 10 lakhs. But in India, 30% standard deduction is available. So on 10 lakhs, if you claim 30% standard deduction, how much is taxable? 7 lakhs. So the double taxed income is not 10 lakhs. Only 7 lakhs only. Why? Because out of the 10 lakhs rent, in India, the amount taxed is only 7 lakhs. Even though foreign country, there is no standard deduction, so 10 lakhs tax. But in India, only 7 lakhs tax. Now, that common income only, we call it as what? Double taxed income. Sir, unilateral relief, sorry, ordinary credit method also, it looks like similar only. But what we took there, instead of double taxed income, we took here foreign source income. But here they are saying what? Double taxed income. What does it mean by double taxed income? The common amount, which is even taxed in foreign country as well as in Indian country. India is also called as what? Double taxed income into average tax rate or foreign tax rate, whichever is lower. Okay, you should, for relief, first you calculate average tax rate, foreign tax rate, whichever is lower. Take that and apply it on what? Double taxed income. That you will get it as relief. The final tax payable. What are the steps, sir? Tax payable, till tax payable, no change. Calculate the total income, assuming, considering all the foreign source incomes also. Then calculate tax payable and cess. Then find out average tax rate. How do we find out average tax rate? Tax payable divided by tax payable including cess or excluding cess? Including cess. Tax payable divided by total income into 100. Then foreign tax rate. Foreign tax rate sometimes given in the question only, sir, directly. Otherwise, we need to calculate also. We need to be clear. Foreign tax rate means what? The tax payable in foreign country. Okay. Tax payable in foreign country. Tax payable in foreign country. Tax payable in. Okay. Tax payable in foreign country divided by income taxable in foreign country into 100. Tax in foreign country divided by income taxable in foreign country into 100 if you do foreign tax. Same as like average tax rate only, we also calculated foreign tax rate. Now the important thing here is what? To find out double taxed income. Majority get confused in finding out this double taxed income only. So in any question you solve, first to focus whether you could easily identify the double taxed income or not. Okay, any question. Okay, not just now, sir. After when you are practicing, when you are revising also, keep a focus on like roughly calculate what is the double taxed income, whether you are doing that correctly or not. If double taxed income you could calculate correctly, majority of mistakes you can eliminate or avoid from this chapter. Double taxed income into average tax rate or foreign tax rate, whichever is lower, multiply that, you'll get an amount, claim it as relief, then you'll get final tax payable. So come to question number 5. Mr. Saha, a resident Indian, has derived the following incomes for the previous year relevant to assessment year 26. 27. Mr. Saha, a resident Indian, has derived the following incomes for the previous year relevant to assessment year 26, 27. What are those? First one, income from profession. Income from profession, 3,74,000. Sir, which head it is? Then royalty on books from foreign country. Why? 3 lakhs is eligible for deduction under 80 QQB. And the tax paid in foreign country on that is how much? 5 lakhs. Compute Indian tax liability if he has opted old regime. So, okay, first what you have to do, sir? Calculate total income and calculate the tax payable first. And even step 3, average tax rate also calculate. Then we'll proceed. Find out total income, tax payable, average tax rate. What is the total income, sir? 8,74,000 is gross total income. But they'll get 80 QQB deduction. How much is the 80 QQB deduction they'll get? 3 lakhs. So, 8,74,000 minus 3 lakhs. Sir, why they will get deduction? Because they are under old regime. So, from there, claim 80 QQB, 3 lakhs. If you subtract 3 lakhs, how much will be the amount, sir? 5,74,000. On that, what is the tax plus cess? First 5 lakhs, 12,500, 74,000 into 20%, add, and then cess at a rate of 4%. Total how much? 20? 3? 392. Tax plus cess. What is the average tax rate? 4 point. Foreign tax rate given straight away. Which is lower? 4.94. What is the double tax income here? Double tax income 5 lakhs or 2 lakhs? Sir, in outside India, 5 lakhs taxed. But in India, we got a deduction of 3 lakhs. So the common amount which got taxed in both the countries is 2 lakhs only. So that is called what? Double taxed income. So double taxed income 2 lakhs into 4.94%. How much? 9,880. Subtract. How much you will get? 18? 510. 18,000. 510. What difference we got? Maybe some rounding off. Okay, it's not 4.1. So rounding off, do carefully, sir. 4.95% only, na? 9? 9,900. Subtract, then you'll get how much? 18,492 rounded off to 18,490. 92 rounded off to 490. This is what? Question number 5. Then, okay. Now try question number 6, sir. Question number 6. Try question number 6. Arvind, a textile merchant and resident Indian, is doing business in India and abroad. During the previous year, he has disclosed the following information. Income from business in India, 27 lakhs. Income from business in country A, 15 lakhs. Income tax levied in country A, 5 lakhs. And then loss from business in country B, which also India does not have agreement for avoidance of double taxation, 4 lakhs. Contribution to PP of 1,50,000. LIC premium 20. Compute the tax liability. So they mentioned as old regime. So then obviously what? Default regime. Okay. So first we'll go with PGBP income. So in PGBP income, first we have Indian income, Indian business income, how much, sir? 27 lakhs. Then we have what? Country X, sir, country A, how much is there? Then country B is also there. How much is there? 4 lakhs loss. Sir, business loss from one business can be set off with another business, intra-head set off possible. So what? How much is the total PGBP income? 38 lakhs. Then is he having any other income, sir? No, right? No deductions. Then what is the gross total or net total? Sorry, net total income is how much? 38 lakhs. On 38 lakhs under default regime, first 24 lakhs, 3 lakhs, balance 14 lakhs into 30%, 4 lakh 20, 4 lakh 20 plus 3 lakhs, 7 lakh 20 plus S. 7,48,800. Yes. Then we need to find out what relief. For relief, first we need what? Average tax rate. What is the average tax rate? 7,48,800 divided by 38 lakhs. What is the average tax rate? 19%. Then what is the foreign tax rate? Foreign tax rate given as, sir? %33.33%. So okay, whichever is lower, na 19.7. Okay, now we have to take what? Double taxed income. Sir, what is the double taxed income? Double taxed income is how much? So now someone may ask like, sir, this 4 lakhs loss, why can't we consider it as adjusted from 15 lakhs? It could be, but if your double taxed income is more only, it is better for you. If your double taxed income is less, you'll get less relief. So you wanted to take more double taxed income or less double taxed income. More double taxed income, more relief. Okay, so if you think it as adjusted from country A, then your double taxed income will be only 11 lakhs, you'll get less relief. If you think this 4 lakhs is adjusted from 27 lakhs, then you have more double taxed income, you'll get more relief. So as a tax consultant, you will be thinking that something favorable to client or favorable to department. Client only, right? So then what you will take? You try to have the double tax income more. So what you will assume? What assumption you will make? This country B income is assumed as adjusted with Indian income. How much is Indian income, sir? 27 lakhs adjusted. So total double tax income is how much? 15 lakhs. So 15 lakhs into 19.70 percentage, if you do, how much? 2,95,500 subtract how much? 4,53,300 is the final tax payable. Okay, now quickly question number 7 also. So we'll be solving mostly each and every question from this chapter, sir. So you be little quick. We have almost 20-25 questions, I think. We have like almost 19 questions, problematic only. Then 20, 21, 22. The last 3-4 questions are like theory. Okay, so be little quick, sir. Sir, here assessment here it's not 25, 26, it is 26, 27. Sir, what is this total income, sir? Sir, here professional fee is 2,40,000, here it is 1,60,000, on which TDS of 50,000 and 30,000 was already deducted. Okay, receives the following payments after TDS. After TDS. So these are what? Net amounts. We want what? Gross amounts. So 2,40,000 plus 50, it will become how much? 2,90,000. 1,60,000 plus 30, 1,90,000. So 2,90,000 plus 1,90,000, total it will come how much, sir? 4,80,000. Business income. And then there is a business expense, sir. The relevant business expenses can be claimed as deduction under the PGBP. So claim 2,40,000. So net PGBP income from foreign sources how much? 2,40,000. Then they have income from other sources in India. How much? 10 lakhs. So total income is how much? 12,40,000. Then they have paid to LIC. Sir, old regime or default regime? Default regime only. Why? Because nowhere they said like opted out from default regime or like opted old regime. So it is under what? Default regime only. Can the 70,000 LIC be claimed? So 70,000 not available. So then what? Net total income also 12,40,000. So on this 12,40,000, what is the tax? 66. Sir, marginal relief on rebate will come, sir, here. If you remember, marginal relief on rebate will come because 12,40,000 is nearer to that of marginal relief. So what? Step 1, you should compute tax on given total income. On 12,40,000, how much? 66,000. Then step 2, tax on 12 lakhs, nil. Why? Because 12,60,000 is the tax and 60,000 eligible as rebate. Then step 3, difference between total income and 12 lakhs, which is how much? 12 lakh and 12 lakh 40,000. Then step 4, marginal relief, which is how much? 1 minus 2 minus 3, which is 26,000. So 66 minus 26,000, how much it is? 40,000. So the tax on above is 40,000 and the cess on it 1,600. So the total tax payable is how much? 41,600. So this step gone here. Majority. If you could do it correctly, then fine. Then what is the average tax rate, sir? 41,600 divided by, what is the total income, sir? 12,40,000. So 41,600 divided by 12,40,000, how much? 3.3555 percentage. What is the foreign tax rate, sir? So what is the total foreign income? 4,80,000. What is the TDS deducted in foreign country? 80. 80 by 4,80,000. Sir, the total foreign source income is how much, sir? 4,80,000. Or that is only, okay. Sir, that income double taxed, huh? First, we are finding out what? Foreign tax rate. For finding out foreign tax rate, we'll take the total foreign income. Total foreign income is how much? 4,80,000. How much is the tax paid in foreign country? 80,000. So 80 by 4,80,000 if you do, how much, sir? Directly given a rate? No, right? So, okay, 80. How it came, sir? Rate of tax in country X is like 80 by 4.8 lakhs, which equals to how much? 16.67 percentage. Now, what is the double tax income? Income 4,80,000, foreign income. But does the total 4,80,000 taxed in India? Out of 4,80,000, 2,40,000 we allowed as expense. So the amount taxed in India is only 2,40,000. So double tax income is how much? Only 2,40,000. So 2,40,000 into which tax rate is lower? Indian average tax rate or foreign tax rate? Indian average tax rate. So 2,40,000 into 3.355 percentage. If you subtract, how much, sir? 8,052. So then the final tax payable is how much? 33,550. Done. Sir, how many of you able to recall this rebate point? Rebate marginal relief point. How many of you able to do? 1, 2. So one students in live, how many of you able to recall the rebate marginal relief point? 1. So 4 or 5 people, sir. So the point is again like what? The basics. The basics, if you are clear, then you'll easily get that. So okay. Try question number 8 also. Sir, every question it's you trying only. Me just explaining you afterwards. Because there is nothing to explain. All those are basics only. Kavita, age 63 years, is a resident individual and a classical dance performer. During the year, she earned income from India as well as from country X. India does not have a DTA with country X. Her income and investments are as follows. Rental income from residential house property located in Canada. How much, sir? 28,000 Canadian dollars. Municipal taxes paid in Canada, 250. Sir, first 28,000 is what? GAV. From there, subtract municipal taxes, 250. What is the NAV? 27,750 into 70. 19. 42,500. Okay. Sir, is there any other house property income in India? No, right? So we have to subtract here what? 30% standard deduction. How much? 19,42,500 minus 30% standard deduction. 5,82,750. Okay. Then professional income is there. Professional income, interest. There is no house property interest also given. So how much is the total house property income, sir? 13,59,750. Okay. This is house property income. Then business income, sir. Professional income India is 16 lakhs and professional income from concerts in country wise is how much? 11,200. So 11,200 into 90. Sorry, not 90, sir, 70. So PGBP income, sir. What is the PGBP income? 16 lakhs plus what is the 11,200 into 70? 7 lakh? 84,000. So 16 plus 17 lakh 84,000. It is total 23 lakh 84,000. So and then she has IFOS at income also. What is IFOS at income, sir? FD 3 lakh 25,000. Savings bank 18,269. Total how much, sir? 3.25 plus 18,269. How much? 3,42,269. 43,269. Then you'll get gross total income. How much is the gross total income? 27 lakh. So where we okay. House property 13,59,000. Then PGBP 23. Then IFOS total. If you add, what is the gross total income, sir? 40,87,019. Correct only, na? Clear. Then on 40 lakhs we need to calculate. We need to give chapter 60 deductions. Why? Has not opted for 115 BSc. So since not opted for 115 BSc, chapter 60 deductions are available. What are those? PPF and then PPF ATC 1,50,000. Then medical insurance premium for self and spouse. Sir, senior citizen, sir. Self and spouse together how much? 50,000. Okay. Then 80 TTA savings bank interest, sir. Senior citizen, sir. Okay. 80 TTA and TTB will come. Senior citizen, sir. Instead of TTA, TTB will come. On FD interest and savings bank interest together, you'll get 50,000 as 80 TTB interest. So total how much? 80D 50, TTB 50, ADC 1,50,000. Total deductions are 2,50,000. Total deductions are 2,50,000. Since he is senior citizen, not 80 TTA, TTB will come. Under 80 TTB, on savings bank interest and on FD interest also deduction will come to an extent of 50,000. Then what is the total income, sir? 38,37,019. Rounded off to 38,37,020. So on that, what is the tax liability under old regime? First 10 lakhs, 1,10,000. 1,10,000, sir, not 1,12,500 because he is a senior citizen. First 10 lakhs, 1,10,000. Senior citizen now. Then on balance, 28,37,020 into 30%. Tax on above is like 9,61,106. Correct only, sir. Everybody got the same answer. First 10 lakh, 1,10,000. Balance 28,37,020 into 30%. For that add 1,10,000, you will get 9,61,106. Clear? Okay. Then cess 4%, 38,444. So together how much? 9,99,550. Okay. So we got tax payable. Now we need to find out what? Average tax rate. What is average tax rate? Indian tax payable divided by total income. 26.05%. So don't round it off to at least round it off to second decimal. After point, round it off to second decimal. Don't round it off to like the number, whole number round off to after decimal 2 digits. So then how much it will come? 26.05%. Then foreign tax rate straight away they given, sir. 20%. So Indian tax rate 26.05, foreign tax rate 20%. So which is lower? 20% lower. So now what we need to find out? Double taxed income. Sir, here in our statement, house property income, how much is taxed in India? 13,59,750. And then from concerts in India, 7,84,000. So these two are the double taxed incomes. Okay. Commonly taxed incomes in both India and foreign country. 13,59,750 plus 7,84,000. Together how much? 21,43,050 into 20%. Now you'll get 4,28,750. Give it as relief. You'll get the final tax payable as how much? 5,70,800. So, okay, done question number 8. So now come to question number 9, sir. Status is what? Resident and ordinary resident individual. Age 58 years. Regime, old regime. Financial details. Arnav earns income from both India and a foreign country during the previous year 25-26. He provides the basic following details. Business income from India, how much, sir? 4 lakhs. From foreign country, 9 lakhs. Premium paid for medical insurance for his non-resident father aged 83. How much? 28,000. Income paid in country Y is 22% on 9 lakhs, 1,98,000. You are required to compute tax liability. Arnav if India does not have DTA with country Y. So first total income. What is the business income? 4 lakhs plus 9 lakhs, total 13 lakhs. Has any other income? No other income, sir. Minus. He opted for what regime? Old regime. So minus chapter 60 deductions. So what are the chapter 60 deductions available? 80D. How much available? 25 or 30? Why? Because he's a non-resident senior citizen. So only 25,000 available. How much? 12,75,000. On 12,75,000 in old regime, what is the tax liability? 1,95,000 tax plus cess. Tax plus cess, total how much? 2,02,800. Now we need to find out what relief. So, okay, average tax rate, sir. Relief, average tax rate. 2,02,800 divided by 12,75,000. 15.90% is the average tax rate. Foreign tax rate is how much? 22%. Which is lower? 15.90 only. So now here, what is the double tax income, sir? 9 lakhs is the double tax income. So 9 lakhs into 15.90. How much is the relief available? 1 lakh 43, 153. So total tax payable after rounding off is 59,650. 59,700. Okay. Okay. 1 lakh 43,000. How much will get? It is 15.90 only. Any third decimal, if you take, how much it is coming? Maybe that might be the issue I'm thinking. 15.905. Okay, so 905 now you have to round it up to what? 91. 15.905 now you have to take what? 15.91. Okay, or else like take 15.905 only. So 15.905 into 9 lakhs, how much? 1? 190. Okay. 15.91 you try? 91 only you tried. 15.905 percentage. 143? Okay, okay. So that rounding off adjustment only, sir, there. Okay. So because of that rounding off only, that number has been differed there. So nothing to be corrected, conceptually correct only because of that rounding difference it came. So okay, in DTA, sir, different model tax conventions. What are the different tax model conventions we are having? OECD model, UN model, US model. We are having 3 models. OECD model full form means Organization for Economic Cooperation and Development. UN model means United Nations. US model means United States. OECD emerged in 1978. UN model to from, sir, first the initial one is OECD, original one is like UN model only. Okay, group was formed in 1968. The finalized model is released in, sir, I think I said like wrongly, sir, initially. OECD model is the first one. And OECD model is followed by across the globe. Whereas UN model has been adopted for the purpose of this developing countries, which is followed by India, not OECD model. India is following UN model. So please correct me, sir. Okay, so note it clearly. OECD model, you can see, essentially a model treaty between developed nations. So India is not a developed nation. So OECD model is followed where when 2 developed countries are entering into treaty, then OECD model. When more favorable towards what? Developing nations, which model? UN model. So UN model is for the developing nations like India. So India follow which model? UN model. Then US model emerged in 1976. Okay, it is specific to US. Okay, OECD model emerged in 1978. For UN model, sir, thought of bringing such model in 1968, but later on it was finalized only in 1980. Whereas US model in 1976. Okay, after amendments, the latest one is OECD is 2017 it came. UN model, the latest version came in 2020-21. US model it revised several number of times, sir. We don't know the recent one. Then OECD model, essentially a model treaty between 2 developed nations. UN, essentially between 2 developing nations or 1 developing and 1 developed nation. And US model is specific to US. Then what OECD model advocates? OECD model talks about residence principle, whereas UN model gives more weightage to source principle. Sir, for us source principle is only better. Why? Because India, we lack investment. So we are asking the foreign companies and the foreigners to come and invest here. That's why FDI, foreign direct investments. So if resident rule followed now, all these foreign companies will pay tax only in their resident country only. Coca-Cola company, sir, they earn so much revenue from here, but it's a foreign country, right? Obviously. So where it has to pay tax? Foreign only it has to pay tax. So okay, Instagram, the Meta will generate, Google will generate so much income from India only. If resident rule followed now, they all will be paying tax in foreign country only. So there are many foreign companies which are operating. Samsung, okay, the majority car manufacturers like Honda, Kia, okay, then there are so many others. All these mobile manufacturing companies are from foreign companies only. So they earn income from India, but pay taxes in their own country. Then it's against to our, it's not a loss to developing nations. That's why instead of resident rule, which rule is followed? Source rule. So majorly the principles are designed based on source rule. So all those, even though they are not resident in India, since source in India, they have to pay tax in India. Okay. So these are certain general points, sir. When a firm distributes share of profit to partner, such a share of profit is exempted only when such firm is registered in India. Agriculture income exempted only if the agricultural land is situated in India. Then section 90. See, agreement with foreign countries or specified territories. It allows Indian government to enter into agreements with foreign countries or specified territories. So certain areas are not countries, they are called as territories only. It's like they are, might be under the king's rule. Okay, majority, few Arab countries or Middle East countries are still under the territories only. There will be a king for them. Okay, the sheikh, okay, he'll be a king. His kingdom like that only, they'll be ruling that one. So they are called as territories instead of calling them as countries. So when Indian government enters into agreements with other foreign countries or specified territories to provide relief or to prevent double taxation, such treaties will be entered. But what are the major aims? First one, to avoid double taxation by provide relief without creating opportunities for tax evasion or avoidance. They should give tax credits and reliefs, but it shouldn't be a way to do tax evasion and tax escapement. So they should clearly think of it that whether those tax credits or tax reliefs given can be exploited to do tax evasion and tax avoidance. That also has to be considered and plan accordingly. Next one, exchange of information. The foreign country will share information with us, and Indian government also will share information with the foreign country. So when there is an exchange of information, they can prevent avoidance of double taxation. Then recovery of tax under this act. Sir, Vijay Mallya, he has certain tax dues or loan dues to be paid in India, and he's currently staying where? In US or in UK, and he's giving interviews, and he's only playing the victim card again. If you have seen his interview, sir, he's only playing what? Victim card, as if he is like innocent only. He didn't did anything wrong, any guilty from his side, and he paid so much of taxes like that. He's playing a victim card. Once you listen to his total podcast now, you'll also feel sympathized for Vijay Mallya, how much he did, why again he's only having so many troubles, why government targeting him and all, you'll feel. Okay, so all that is narrative building. Okay, narrative building. So through these videos and all, you can generate a narrative towards. So okay, now by looking at that whole podcast, who doesn't know what happened 15 years back, 20 years back actually, so they may simply say like what? Vijay Mallya paid so much interest, why banks are still focusing on? Sir, what he said like, he's saying like he paid 3 times or 4 times than that of the loan money he has taken. Obviously you need to pay when you taken 30 years back loan, and if you are paying interest only now, then that is basic max. Obviously you need to pay 5 times, 6 times, 20 times of the loan also you need to pay. Why? Because that same, sir, what he is missing there is like he's not considering time value of money. But non-commerce background students or non-finance background students will think what? Oh, he paid 5 times of the loan now, so much he paid now. But what is missing there? Time value of money, sir. 30 years back land rate here is 1 lakh only. Now here it is like 4 crores. How many times it went? 400 times it went. But loan he is saying like 30 years back he took and paid 4 times. But land rate has jumped to 400 times. So who has to bear the total loss? Indian banks are only losing, right? So that's why we cannot just, okay. So these days podcasts are just for the sake of narrative building. Okay, so anybody can go to podcast and say like, okay, by listening to their version, we'll feel like, okay, that is only correct, that is only good. Okay, they are having the morals only. Okay, so recovery of income tax under the act. So if a person has did some tax evasion and settled in foreign country, to recover taxes from him also, provisions will be framed. These DTAs will try to insert points regarding them also. 3 aims. First one, provide relief without giving a scope for avoidance and evasion. Second one, exchange of information is the second aim. Third one is what? They should even create points like, or should consist points like recovery of income tax under this act or corresponding foreign country or specified territory. Then 90A. What is 90A, sir? Section 90A is about adoption by central government of agreements between specified associations for double taxation relief. Sir, 90, directly 2 governments will enter. 90A, directly 2 governments will not enter. Let's say from India, ONGC entered with some foreign Arab country or some Russian related oil company. ONGC. So now ONGC is not a government, but it's an entity or a specified association from here, India. And then in Russia, there is another oil company or some oil supplier with that in ONGC, and that Russian company has entered into agreement. That agreement will be any specified association may enter into agreement with a specified association in the specified territory or specified territory outside India with the same aim. The same aim, sir. What are the aims? Avoid double taxation, providing relief or exchange of information or recovery of income tax. With the same aims, even these agreements also will be found. But here what happens? Central government later, by notification in the official gazette, makes such provisions for adopting and implementing such agreements. So directly government will not enter. These associations will enter. Then that will be again adopted by government. Then they are covered under section 90A. We discussed about different models of tax conventions. How many models are there, sir? OECD model, UN model, US model. Out of all this, OECD model is emerged first, sir. It is actually between whom? 2 developed countries. Between 2 developed countries, when they enter into treaties, then they go for what? OECD model. It's mostly says like that incomes, the tax rate will stay with resident country only. But those rule or that principle is not suitable for developing nations, because many people will come and invest in developing countries. So they earn more from India and will be paying taxes in some other countries, which is not suitable for developing countries. That's why developing countries didn't thought that OECD is not suitable for them. So for them, UN, United Nations, a group was formed in 1968 and finalized model is released in 1980. So, okay. So OECD latest is in 2017 and the UN model recent model. Every 3 years, 4 years, they'll be changing according to the situations and also 2021. Okay. So OECD is essentially a treaty between developed nations, whereas UN model is more favorable to developing nations. Okay. OECD model advocates which principles are residence principle. That means what? The tax rate stays with the resident country. Whereas in OECD model, whereas in UN model, more weightage is to source principle. More rights are given to the source country rather than that of resident country. Then US model. US model emerged in 1976, revised several times, and it is specific to US. Then, sir, we discussed about 90 and 91. When Indian government and foreign government or foreign country or territory government entered into an agreement straight away, then 90. When it comes under 90A, instead of government, some other association from India and a foreign association has entered into agreement, and such agreement has been notified by government in official gazette and adopted, then it comes under 90A. Both these will have common aims. What are the common aims? First one, avoiding double taxation by providing relief. They wanted to avoid double taxation, but without giving room to tax avoidance or tax elimination. Okay, evasion or tax avoidance. Then it aims at exchange of information for prevention and avoidance of double taxation. The third one, in the case of default, how do they recover the income tax under this act or under the corresponding foreign country tax or territory related tax? Then, sir, the next question, theory one, is like permanent establishment. What is called permanent establishment? Permanent establishment means it is a fixed establishment. Permanent establishment, PE means it's a fixed establishment. which means a fixed place of business through which business of an enterprise is wholly or partly carried out. Sir, if you see, this SIMs and all will be sold. The cell phone companies will sell SIM cards. That is also an outlet, but is it a fixed establishment? So what they do, sir, they'll put an umbrella, okay, put one bench, then put SIM cards and they'll be selling. Is it a fixed establishment, sir? No. So to call it as a fixed establishment, it should have some degree of permanence. Okay, permanence, right? It need not to be a own property. Rental property also fine, but the agreements and all should mention, say like there is some degree of permanence. I mean, it's not for days. Okay, it should be for a year, 2 years, like that. Lease agreements are there, then it has a degree of permanence. And permanent staff should be there. I mean, you are not hiring people temporarily for 10 days, 15 days. Okay, you hired with an intention to keep them for some 3 months, 3 years, 4 years, like that. Then it comes under the definition of permanent establishment. It means a fixed establishment, which means a fixed place of business through which business of an enterprise is wholly or partly carried out. So it is a place of management, the head office or corporate office, or it could be a branch office, or it could be an office, factory, workshop, or a mine, oil, gas quarry, or any other place of extraction of natural resource. So, okay, permanent establishment means what, sir? It is a place of management, factory, workshop, office, or a branch, and even a mine, oil, or gas quarry, or any other place of extraction of natural resources. It also includes when you are having a building site or project site. You're constructing a project or you're constructing a building, that project site or building site also can be treated as permanent establishment, provided such site project activity lasts for more than 6 months. Okay, then it is called as what? PE. Then it even includes consultancy services provided by an enterprise. So most of the multinational companies here have their branches, okay, which take consultancy services, nothing but the foreign business related accounts, bookkeeping, transactions recording, all those kind of services will be dealt by the unit which is located here. This is a consultancy service. What they'll do now, they'll do business process outsourcing. Okay, there in foreign company, let's say an insurance company is having these claims and all. All these claims will be entered in the systems from India only. Okay, because India has that cheap labor thing for them. That's why they'll do all those activities where no decision making is involved or where no judgments are involved, directly like you entering into data into systems and all. So they'll do from where? India. So when they're doing such kind of consultancy services by employees or other personnel engaged by the enterprises, if they continue for a period or periods more than 183 days in a fiscal year, then it is called as what again? Permanent establishment. So you have a unit here. What you will do there? You will hire people and all your accounting transactions and all, instead of there entering, from here you do bookkeeping and all. Okay, so when you do all this, if it is continuous for more than or equal to 183 days, so these are called as BPOs, business process outsourcing units. So they do call centers kind of. Okay, business will be done by foreign country only, but any issues come, these people will address the issues and all call center guys. So they also will come under BPO only. So those kind of consultancy services provided by employees here, if the activity is continuous for a period or period greater than 180 days, then it is called as what? It's a fiscal, it is called as a permanent establishment. So a building site or project site also can be called as permanent establishment if it continues for more than 6 months. Even a consultancy office in India also can be called as what? PE, provided they have hired employees or other personnel through them. They're carrying those business outsourced activities for a period more than 183 days, then also it is called as PE. But exclusions to PE, the following are not called as permanent establishments. Sir, you are maintaining a facility or you are using a facility solely for storage or display of goods. You have a office or you have something here where you just store goods and you display them. You will not sell them. You just store them and you will display them. Then it is not a permanent establishment. Second one, you have a warehouse. You maintain stock there. You maintain merchandise there belonging to the enterprise. Again, for what purpose? Storage and display only. Third one, you have a fixed place of business. You have a fixed warehouse solely for the purpose of what? Purchasing goods and collecting information only. You will not sell. You have a place here. From there, what you will do? You will purchase goods only. You will not sell. Then maintenance of fixed place of business for the purpose of advertising, for supply of information, or for scientific research, which had preparatory or auxiliary character. It does not have the direct business nature. Okay, so you wanted to start a business in India, but directly you are not starting a branch or head office here. You just started a branch here and you are doing research. Okay, how well the product will be received in India. Okay, what are the challenges to be faced in India? To do a research on all that, you are just kept an office and doing all that research and all. And the initial promotion you are doing to test, okay, whether such product has demand or not. There also, you are not doing what, sir? You are not doing sale or you are not doing delivery. So it's not called as what? Permanent establishment. So when you are using a place only to storage or display of goods, not a PE, you are using a place just to purchase the goods or to collect any information. So these are called as licensing offices. Okay, through licensing offices, what you will do, you will collect information and all. They are also not what? Permanent establishment. You maintain a fixed place of business for the purpose of advertising, for supply of information, for scientific research, which has preparatory or auxiliary character. Okay, so these are not PEs. Then, in OECD model and UN model, sir, there is a difference, 1 point difference for PE. So in OECD model, PE excludes usage of facilities solely for storage, display, and even delivery of goods and services belonging to other enterprise. Whereas in UN model, PE excludes usage of facilities solely for storage and display only belonging to other enterprise. So OECD, even if you deliver the goods also, still it is not a PE. But we are following OECD, UN model. UN model. For most of the Indian treaties, PE means if it delivers any goods, then it comes under the definition of P. So it should not deliver. Maximum it can do what? It can store the goods or it can display the goods. From that place, if it starts even delivering the goods, then it comes under P. But whereas for OECD model, even though from such place the goods are delivered, it still does not comes under the P. Okay, no, sir. So come to question number 10, sir. So this is an important question, sir. It puzzles you. I mean, while doing, you'll get 2-3 different kind of thoughts or adjustments. Okay, so try it quickly. Unilateral relief only, sir. Try it quickly. What is the double taxed income? Lakhs, sir. Here they're given in crores, right? 14 crores. What is the double taxed income as per you? 14.8 crores. Charishma. So SSC is a popular Kollywood star, Mr. Sohan Lal. He has business interest in few other nationals as well. Income earned in India by Mr. Sohan Lal during the year is like. Mandeep, how much you got? Double tax income for Rohit is also 14.8 crores. Charishma. Not 13.6, huh? We stick to 13.6 only. DT 16.1 double tax. Okay, you're counting for both these two countries, this one. Both the countries together, this is for. Extra 10.7. So together it is 14.8, 14.8, 13.6, 16.1. Together 12.6 crores. Same. 13.2 crores. Now tell each of your answers also. Don't. Okay, already there are 4 or 5 different answers. Now even if you give 6th answer, it doesn't happen anything. Sai also 14.8. How much? If you say this now, you have to tell number. 10.7 for whom? X. Why? I'm asking double tax income. Here 2 countries are there, right? So from both the countries you'll have double tax income. Now, not only from one country you'll have double tax income, right? Why ka double tax income leda? Why ane country leda ikkada? So total tell 10.7 plus 14.5. 14.8 only for 14.8. You convinced her? You got that answer only. Okay. Tell where you are, like you are somewhere in, not even close to these answers, huh? Still. Vaishnavi. 16.1. Just 16 crores. 14.9. 13.5. 19.9. See, there is so upper and lower ranges. You are only pending now. Not even in this range also. No? Here the lower range given is like 12.6. Upper range given is like 19.9 crores. In this range only, you are beyond this range. Okay. 14.8. Okay. So he owns a cricket franchise, sir. From there he got 12.4 crores PGBP income only. He acts in movies, that also professional income only, PGBP. And he has a house property income also, which is 4.3 taxable under house property. He has income, okay, he deposited in 1.5 lakhs in PPF, life insurance 1 lakh, and other are like X, Y. Loss from house property is like how much? 1.3 crores. Business income from country X 7.2. This is also PGBP. This is also PGBP. Share of income from partnership firm not evidenced by an instrument in writing. So first this share of income from partnership firm within India, outside India. If the firm is in India, then exemption is available. From outside India, so it is what? Taxable. So this is also taxable under which PGBP head only. Then agricultural income also. Agricultural income from India exempted. It is from where? Outside India. So it is also what? Taxable. It is also taxable. In country X, share of income is not exempted. Loss from house property is not eligible for set off. In country Y, agricultural income is chargeable to income tax. Has paid income tax of 2.16 and 80 lakhs. Okay. So now quickly, sir. For him, house property head. From Indian India, he has house property income of how much, sir? 4.3 crores. And from country X also he is having, how much is this, sir, from country X? 1.3 crores is there. So 1.3 crores if you adjust. So total income from house property is how much? 3 crores. Sir, why we are not taking standard deduction and all? Because here it is said like already computed. Otherwise, we might have taken standard deduction also. Okay. Then we are moving on to PGBP income. Sir, from India, we'll take, sir. How many are there from India? Like, he has a franchise related cricket franchise. How much is from cricket franchise, sir? 12.4. And then from profession, 9.415. Then he has, from country X, he is having business related, how much? 7. And share from. Share from firm is also taxable under which head, sir? PGBP head. In charging section, we already explained 4.8. Country Y. From country Y, what is there, sir? Business income 2.9. Sir, agricultural income will come under which head? IFOS head. So I'm not taking here. So total of all this is how much? 12.4, 9.415, 7.2, 4.8, and 2.9. 36.715 crores. Then IFOS also will go. Sir, he has IFOS incomes like what? Agricultural income alone. That's what alone, right? No other thing is right. Sir, he opted for 115 BAC. So these deductions are not available. So IFOS agri income, how much, sir? 1.2. So what is the total gross total or net total income? 40,915 crores. Okay. So now double taxed. So first we'll find out taxes, sir. On 40.915 crores, what is the tax? Tax including cess, only tax. Only tax. How much? 40.915 crores on that tax. First 24 lakhs, 3 lakhs. So subtract this, sir. 40 crore lakhs, 91 lakh, 50,000. Minus 24 lakhs you do and apply 30% plus add 3 lakhs. 12 crore, 23 lakh, 25,000. Okay. Plus surcharge. Not 23, huh? This is including surcharge, 12 crore 23. Okay, plus surcharge, sir. He is an individual, sir. About 2 crores. Total income is above 2 crores. So what is the surcharge rate? 25% is the surcharge rate. How much? 80? Okay, then what is the total? 15 crore 29 lakh 6,250. Plus cess at a rate of 4%. 61 lakh 16,000. So total how much? 90. 500. So now tell me what is the average tax rate? 15 crore 90 lakh 22,500 divided by 40 crore 9. Okay. 38.86%. So till here everybody clear only, right? So there's nothing great we did here. Okay, now we want double taxed income. Sir, double taxed income most of you did together. But actually double taxed income has to be did separately. Why? Because the average tax rate of India is different. The other countries are different. Okay, first we'll find out, sir. Foreign tax rate of country X. Tax rate of country X. Sir, for country X, how much is the tax they paid? 2.16. What are the incomes from country X? 0.2 plus 4.8, 12 only, sir. Sir, this 1.3, why they are not setting off now? They said clearly in country X, loss from house property is not eligible for set off. Since this 1.3 cannot be set off in their country, it will be how much? 12 crores. So 2.16 by 12 into 100. What is the country X tax rate, sir? 18%. Then what is country Y tax rate, sir? Country Y, what is the income, sir? 2.9 plus 1.2, 4.1 crores. What is the tax paid, sir? 0.8. So 0.8 by 4.1 into 100%. How much? 19.512%. Okay. So now if you see here, average tax rate we cannot take because average tax rate or country X rate, which is lower? Country X. Average rate or country Y rate, which is lower? Country Y only. So to calculate relief now, we want first country X related double taxed income. Country X. Sir, these three are the country X related incomes. But this 1.3 crores in foreign country it is not eligible for set off. But in India we are claiming it as set off. In India, this 1.3 crore loss is eligible for set off. We already set it off also. In house property head, that 1.3 crores, we used it for set off. That means we are getting 1.3 crores relevant benefit here. Loss adjustment benefit. So the double tax income is not 12 crores. It is only 10.7 crores only, not 12 crores. Why? Because this 1.3 crore benefit we are getting here, it is 1.3 crore loss. Even though in foreign country it is not eligible for set off. In India, it is eligible for set off. So the common tax income is not 12 crores. It is only 10.7 crores only because for the loss 1.3 in India, we are getting the loss adjustment benefit. So if you claim that benefit, the effective amount taxed in India is only 10.7 crores. So relief is for country X is how much? 10.7 crores into 18%. How much, sir? 1 crore? Tell fully. Okay, you do it fully. 1 crore 92 lakh 60,000. Then country Y simple only, sir, because no other adjustment. Total is how much? 4.1 crores. So 4.1 crores into 19.512 percentage. If you do how much? 79 lakh 99,920. So total, if you adjust these two, what is the final answer? No. I'm not asking total relief. I'm asking after adjusting both the relief, what is the final tax? 15 crore 90 lakh 22,500 minus these two. 17 lakh 52,580. Correct only, sir. The reliefs we got are like 1 crore 92 lakh 60,000. Here how much? Okay, rounding off difference, sir. Okay, they got 80 lakhs. We got 79 lakh 99,920. Because of that 80 rupees rounding off adjustment, we got 79 lakh and all. If you do, how much it is coming, sir? 19.512 into 4.1 crore. 79 only coming or 80 coming? It's okay. No issues with that. So okay. So where you can do mistakes? Sir, here the mistake you can do is like here for calculating foreign tax rate also you may get confused, and here also you may take 10.7 crores. One thing. And if here you would have taken 12 crores, again here also you might have taken 12 crores. So 12 plus 4.1 are 16.1. So some people might have got that answer also 16.1. Yes. So if you got 16.1, now what you are doing? You are not adjusting this house property loss. Okay, so you are getting 16.1. Then there are other answers also, sir, but that we don't know what they did. Okay, they might have claimed this partnership share of income 4.8 crores exempted. So then if you claim 16.1 minus 4.8, if you do, no answer is there. 11. So there is no 11 answer related. So people got 13.6 and 13.5. I'm just wondering how they got that. Agriculture income. So 16.1 minus 1.2. 16.1 minus 1.2. 14.9. Okay, some got 14.9 also. That means what? They claimed agriculture income as exempted. Okay, do even 14.8 minus 1.2. They got 13.6 crores. So, okay, so the mistakes, if you could see, sir, within the classroom only, what are the mistakes? Some people took agriculture income as exempted. So those people got answer as 13.6. Here, sir, together the total tax income is how much? 14.8. But they got 13.6. Now what is the mistake they did? Agriculture income has been claimed as exemption. Some people got how much, sir? They got 16.1. How 16.1, sir? They didn't adjusted house property loss. They didn't adjusted house property loss. Then this answer only I didn't understand how she got 19.9. What you did? Okay. It's understood, sir. Same book, same faculty, same teaching, but you got. So different answers. The simple only, sir, but still we do basic points mistakes only. Here doing mistake regarding agriculture income is a basic mistake. At least loss adjustment na, okay, there's a chance of doing it like taking 10.8 or else like we need to take it as like 12 crores. The chance still it is there. But agriculture income or share of profit from partnership firm, if those two if you are doing now, those are like basic points related, sir. And one more thing, just because there is more weightage in DTAA, you cannot solve DTAA questions unless you have knowledge of other basic chapters. Understand? Okay, so and don't think like within the book only the questions will come. Every time they'll ask one or two new points. These chapters, transfer pricing, DTAA, if you are targeting, you should do conceptually everything correct. Okay, if you just because you practice these questions which are available in the material or any other source of materials available, they are not testing in that. They are framing a new question or new point from that because everybody knows that every CMA student targets which areas are these two chapters only, because two chapters giving 42 marks now, everybody will focus on these two chapters only. So they cannot ask the same repetitive questions. They are asking one or two new twists or new points only they are testing. Okay. So now people will come and select, sir, if we do CA final material questions, then it will come from there. So from there also they will not ask as it is. Okay, so learn conceptually, try to understand every time whether you are logically correct or not. 11, sir, quickly. It's a simple question only, sir. Question number 11. So BIST aged 58 is a resident of India, has business activities in India and in country. Income from speculation business 9,67,000, rent 6 lakhs, property tax 72,000, loss from business in country 1,24,000, 6,74,000 interest from bonds and bank deposits, other information are there. Is following normal tax rates, opted out from default regime, compute tax liability. In country after set off losses, it is allowed as what? 15%. So now first we'll go with house property income. So what is the income given for house property here? Gross rent received is like 6 lakhs. That itself I'll take it as GAV, sir, because there is no fair rent or municipal rent or standard rent available. From there, you subtract property taxes. How much is the property taxes? 72,000. Then you'll get NAV. How much? 5,28,000 as the NAV. From there, you need to claim 30% standard deduction. How much? 1 lakh 400. Subtract. Then you'll get the total in 3 lakh is what? Income from. Then we'll go to PGPP. So in PGPP, yes, they have a speculation income. How much? And then from PGPP, sir, they have a loss also. So the question is, can this loss be adjusted with speculation income? Sir, understand, speculation loss cannot be adjusted with normal business income, but normal loss can be adjusted with speculation income. So after adjusting this, what is the PGPP income, sir? 8,43,000. So here it is like 3,69,600, and here it is 8,43,000. Then they have what? IFOS incomes. Under IFOS, what they have, sir? He has paid PPF 1,20,000. Sir, PPF, if you see, PPF contribution has to be made for self only, sir. For brothers and all, if you do, it is not eligible. So it is only how much is eligible, sir? 1,20,000 is only eligible. Nothing is there. Nothing, no other incomes are there. Okay, interest and bonds, 6 lakh. Okay. So IFOS, first one is what? Interest from bonds. How much is there? Then anything else? Interest from bonds and bank deposits is having 6,74,000. Then if you add 18,86,000 gross total income, from there ATC 1,20,000. How much? 17,66,600. 17,66,600. Okay. Now tax liability under old regime, sir. It's okay. So I'm correcting from here only. Tax are how much? 3,56,179 it came. Is it correct or wrong? 2.5 lakhs 5%, 5 lakhs into 20%, balance 7,66,600 into 30% plus 4% if you do, 3,56,179. Now average tax rate in India, 3,56,179 divided by 17,66,600, it is how much? 20.16%. Whereas the foreign tax rate is how much, sir? Straight away they given 15%. If you compare, which is lower? 15%. So the relief, sir. Now what is the double tax income here? So the double tax income is interest 6,74,000. Interest 6,74,000, and this loss is eligible for set off. Since this loss is eligible for set off, adjust that 1,24,000. So what is the double tax income? 6,74,000 minus 1,20,000, 5,50,000 into 15%. How much? 82,500. If you set off that, then the final tax payable is 2,73,680. 2,73,680. Done. So come to question number 12, sir. Quickly. Sir, you should do little quick, sir. Before break, we need to complete this chapter. Question number 12. Here, both these belongs to same country. Yes, that point. I thought actually, class question I thought of this point to explain you. Thanks for pointing. See, there in that question, the loss belongs to a different country. There are like, India is there, and 2 different countries are there. Okay, so you have a loss from, let's say, country X, country Y, India are there. From country Y, you have loss. Country X, you have income, and in India also, you have income. Now, there is a chance like what? That loss could be either adjusted with India or foreign. Okay, if it is the same country loss now, then mostly you will adjust with what? Same country only. So there is no standard rule here. So what you said is correct only. So if they could, sir, the point he is asking is like, can we say like whether this loss from 1,24,000, this loss from 1,24,000, you are saying like what? It is not. Yes, adjusted here. What other assumption you can take? You think like whether this 1,24,000 can we adjust it with 6,74,000? That's what, right? See, you compare both the questions and see there. If there is no this business income, now there is other business income at least. Sir, in the question, which question that one? Question number 2 or 3. In the initial questions only it will be there, sir. Let me show you. 3 countries will be there. This one only. Question number 6, I think. See, here what we did, loss from country B 4 lakhs is there. Loss from country B 4 lakhs is there, sir. What we did this 4 lakhs, we assume this 4 lakhs has been set off from Indian income only. Understand? Now here there is only one business loss and one business income only. That has to be mandatory set off with that only. Okay, you cannot say like it was not set off there. There is a possibility to set off with both. Here there is no such kind of possibility available. You may think like, sir, I'll assume it as set off with IFOS income. But first you have to do intra, then only you should come to interhead adjustment. So that option is not there. Sir, ఎంతమందికి మీ పాయింట్ అర్థమవుతుందో లేదో? That's a valid doubt, sir. Which question we are doing? Question number 11 only, right? See, this loss from 1,24,000, what he is asking is like, this 1,24,000 loss we are setting off with what? 9 lakh 67,000. So this loss has to be set off right at any case. You don't have the option to not to set off. You have to set off. When there are two possibilities, then you can take whichever is better. You can take whichever is better. There is only one. How many possibilities? There is only one possibility to set off with this speculation income. The other possibility you may take like what? You can set off with house property. Then also double tax income will reduce. You may set off with interest from bonds and all. Then also double tax income will reduce. So in any case, you don't have other option to set off this 1,24,000. So obviously this has to be set off. After setting off, what will get the double tax income, sir? Will get double tax income as how much? 5,50,000 only. Question number 12. Quickly, sir. Question number 12. So take roughly, sir, do it quickly. So don't waste much time on reading the question once and again start solving once. It's okay. So simultaneously, he is having income under three heads: IFOS head, capital gains head, and then professional income. So okay. So the order is what? First we should go with PGBP head. So tell me, how much is the income for him under PGBP head? 5 lakh? 5,40,000. Then we should go under what? Capital gains head. So now tell me, what is the income under capital gains head? So long-term capital gain on sale of listed shares is 26 lakhs without indexation and 24 lakhs with indexation. These days indexation available or not available? Not available. And on listed shares, anytime indexation is not available. Okay, not only now. Previously also indexation is not available. But clearly they said, okay, as per the current law, what we can say, indexation not available, easily what we can take, 26 lakhs. Then they said like what? Capital gain was computed without considering the investment of rupees 10 lakhs in the capital gain bonds of REC within the prescribed time. So in the handwritten, go to capital gains chapter. Towards the end of the chapter, you'll find exemptions. So go there and refer 54 EC. Go there and refer 54 EC. So what is the page number, sir, capital gains? Towards the end of the chapter, you'll find out the exemptions. In handwritten 203, sir, I'll show even in Pulse. Don't worry, even in concept book also, it will be there. $54 EC. So now tell me whether 54 EC exemption will come here or not. In the given case, you'll get 54 EC exemption or not. You read that provision in the notes. Are you able to find that one, sir? Notes lo ledadi. Which page number? 202. Okay, don't think like I'll explain. I'm not going to explain it. You read and tell. Each and every note point again, read once again. Read it again. Sir, who are referring in Pulse page number 7.17 you can find. In 7.17 page you can find 54 EC. There, refer it. Sir, 54 EC. Okay, this is what. So tell, who can transfer? The transfer should be made by any SSE. What he should transfer? Long-term capital asset being an immovable property. It could be even a depreciable asset also, no issues. But what should be transferred? Immovable property. Then the capital gain should be invested where? NHI bonds or RECL bonds within how many days? 6 months. Then what is the exemption available? Amount invested, capital gains or 50 lakhs, whichever is lower, available as exemption. Now come back to the question, sir. Is he eligible for exemption? No, right? Why? It's not immovable property. So what is the capital gain income we have to take? 26 or 24? 24 lakh? that when you will take that 1,25,000, again, first chapter basics only you're forgetting. That's why I'm saying like first onwards revise. The exemption has to be claimed at the time of calculation of tax, not before finding out gross total income. So how much is the capital gain? 26 lakhs. Then again, IFOS. How much is IFOS income? 2 lakh 30,000. Don't tell why. So just say the answer. I know how it came. 2 lakh 30, just remain like that. So many got what? 1,97,500. Yes. 1,97,500. No. 2 lakh 30. You're sure? Vaishnavi. I can't calculate it. There are only 2 points there. Couldn't recall. Her name Bharati. Manasa, able to recall? We did already this question, this point related questions even in tax planning also. The same point came there even in tax planning also. You could recall. Maheshwari. Sir, dividend, there is in first chapter only we discussed like on dividend, you can, to earn dividend if any interest expense is earned, that can be claimed as deduction, but maximum how much? 20% of the dividend only. So 20% of the dividend now 2,87,500 into 20%, how much? 57,500. So if you subtract how much? 2,30,000. So 5,40,000, 26 lakhs, 2,30,000. There is nothing else, sir. This sum is very easy sum, but you might not remember dividend point, they're gone. You might not remember capital gain exemption point, they're also gone. Okay, so there are given only 3 simple adjustments and it's an exam question also. Okay, so total how much? 33,70,000 on that. Now compute tax. On 33,70,000 compute tax. So what is the tax liability? 3 lakh. Sir, first 33,70,000. First we should calculate tax separately on long-term capital gain. Okay, what is the long-term capital gain? 26 lakhs. First 1,25,000 exempted. Balance to be taxed at 12.5%. How much? 1,375. Balance how much is there, sir? If you subtract 26 from 7,70,000. On 7,70,000 we should apply slab rates. Slab rates now old regime, new regime, sir. Opted out of 115 BAC. Opted out means what? Old regime only. First 5 lakhs 12,500. Then on the balance 20% if you do. How much is the tax, sir? Okay, total tax is 3,75,875 plus cess 15,035. You got Indian tax payable 3,90,910. Average rate is how much, sir? 11.59%. Then, sir, did they given foreign tax rate, sir? Yes. How much is the foreign tax rate? 15%. What is the double tax income? Only the online classes from country Y is only the double tax income. 5,40,000. So 5,40,000. Which rate we should take? This Indian rate is only less. 5,40,000 into 11.59% you do. It is 62,635. Subtract it. You'll get the tax payable as 3,28,275. Rounded off to 3,28,250. Sir, 14, 15. It's okay, normal questions only. Then you can do on your own also, but come to question number 19 is a different model, which was even tested. Okay, the similar question is tested even in the December 2025 exam also. See, first come back to the material, sir, or handwritten, wherever you are following. There is something called Rule 115. Rule 115. It talks about how the currencies, the foreign currency, if you have received income, foreign income in foreign currency, by using what exchange rates it has to be converted is given in Rule 115. The taxes paid in foreign country has to be converted using what? Rule 115. First, TTBR as on the last day of preceding month in which, sir, for salary, interest, dividend, for these 3 incomes to be converted, which rate you should take? TTBR. TTBR na telegraphic transfer buying rate. Okay, so that TTBR rate has to be taken as on the last day of preceding month in which salary, interest accrued dividend na paid. Salary interest not paid, sir. In which month it is accrued? That preceding month last day you have to take. Dividend na in which month you received? That preceding month last day whatever is the TTBR rate, that rate has to be taken. So once again, sir, TTBR rate has to be taken. Which rate TTBR rate? TTBR rate for salary and interest. The accrual month, preceding month last day TTBR rate. Whereas for dividend, received month. Okay, it received in July. Preceding month means what? June. So June 30th, whatever is the TTBR rate, that has to be taken for salary, interest and dividend. Then for capital gains, TTBR rate as on the last day of preceding month. Again, in which transfer made? Same, this also like that only. Let's say transfer made in August. Which month TTBR rate we should take? July, last day. Okay. Then PGBP, house property, IFOS. For PGBP, house property, IFOS, we should take TTBR as on the last day of relevant previous year. That means nothing but on 31st March of previous year. So we have to take 31st March rate for only 3 incomes. What are those 3? House property income, PGBP income, IFOS income. These 3 we should take the TTBR rate as on the 31st March. Whereas for salary, interest, dividend. Sir, you might say, sir, interest and dividend also IFOS. No, sir, other than interest and dividend, rest all incomes it means. Okay. So salary, interest and dividend, what we should take? Preceding month last day. Even for capital gain also, transfer related preceding month last day. Sir, if any tax paid in foreign currency, that also if needs to be converted, foreign conversion of tax paid in foreign country, TTBR as on the last day of preceding month in which a tax is paid. So for majority it is like what? Preceding month last day TTBR rate only. Only for PGBP, house property, IFOS will take what? Last day of the preceding year, or the last day of the previous year. For the rest all, transaction happened in a month, then the preceding month, last day's TTBR rate only we have to take for conversion. So now question number 19, sir. Ankit, 53, is CFO of Bharat India Limited since 1st April. Okay, Ankit is the CFO of Bharat India Limited since 1st April. His income in India consists of what? Salary 25.25 lakhs before standard deduction. Sir, which regime he has opted? Assume Ankit pays a tax under section 115 BAC. So how much is the standard deduction available, sir? 75,000 if you subtract. How much here? 24.5 lakhs. Then interest in respect of self-occupied property. Sir, self-occupied property interest not allowed as deduction. 115 BAC. Interest on bank FD taxable under which head? IFOS. Then he has the following incomes. Income from business in country A. How much? 25,000. Sir, business income has to be converted using which rate? 31st March. Okay, 31st March. What is the rate, sir, here given? See, TTBR rates on various dates. February, 28th March, 31st March is how much? 72. So we need to convert it using 72. How much? 18 lakhs. Then rent from house property is how much? 4,500. Then municipal taxes are there, sir. Municipal taxes can be subtracted or not. So subtract 450. How much will come? 4050. From there again we can subtract 30% NAV. So what is the net? 4,550 into 70% you do. You'll get net. 2835 we need to convert it into Indian currency. Sir, house property, sir. Income from house property again which rate? 31st March only. So into 72. How much? 2 lakh? 120. Okay, done. Then dividend from shares held in country A, where dividend was declared in March. Dividend. Preceding month last day. So preceding month last day, na March it is received. February 28th. On February 28th, what is the, sorry, 29th, what is the rate, sir? 70. 29th is there in 2026. 28 only, right? It's okay. 28th February 2026. It's not 29th February. In 2026 we don't have 29 days, right? 28 only, no? Okay. So 28th February, how much we should take, sir? 70. So $10,000 into 70, it is how much? 7 lakhs. Then short-term capital gain on 5,000 on sale of shares of companies registered in country A, and sale proceeds were credited in the bank account outside India on when? 28th March. Sir, transfer happened in which month, sir? 28th March. So for capital gain, preceding month last day, again what? 70 only. So 5,000 into 70, how much? 3,50,000. 3,50,000. So now if you take headwise, sir, tell me quickly. First we'll start with what? Salary set. So salary set, what is the income they are having? 24,50,000, because after standard deduction it is only 24,50,000. Then house property head, sir, they have a self-occupied property. How I can say self-occupied property? Because they said like interest in respect of self-occupied property. But under new regime, default regime, you cannot avail interest on self-occupied property. So self-occupied property is nil only. Whereas they have a let-out property which is in where? Foreign country. How much is the income from that let-out property in foreign country? 2,04,120. So that itself is the house property income. Right. Then what else they have? Did they have PGBP income, sir? Yes, sir. Any Indian business income, sir? Only foreign country. Yeah. In India, no business income he is having, sir. Only in foreign country he has business income. How much? 18 lakhs. Salary is done, house property done, PGBP done. Then capital gains. Is he having any income under capital gains? Yes, he has even income under that capital gains also, sir. How much? 5,000 into 70. How much? 3,50,000. Sir, once again, this short-term capital gain is company registered in country A and sale proceeds were credited in bank account. So this is also foreign income only. The short-term capital gain, Indian income or foreign income? Foreign income only. So let me make it clear which are foreign incomes also. Salary, Indian income. Whereas house property, foreign source. PGBP, foreign income. Capital gain also foreign income. Then we'll go to what? IFOS. In IFOS, he has multiple incomes, sir. What are the multiple incomes? First, interest is there. 1,50,000. Then what else is having? Dividend 7 lakhs is there. So total how much, sir? IFOS at income 8,50,000. But total 8,50,000 is not foreign income, sir. Only 7 lakhs is the foreign income. So, okay, if you do total, how much here? 56 lakh. 120 is the total income. Okay, then tax liability. So what is the tax liability on it? 12 lakh. First 24 lakhs, 3 lakhs. Balance you apply 30%. Tax is how much? 12 lakh. Plus surcharge. Why surcharge, sir? Because total income exceeded 50 lakhs at a rate of 10%. 1,27,624. How much is the total? 13,859 plus cess at a rate of 4%. So total how much? 60,000. 014. Okay, this is the tax. Now we need to find out what average tax rate. So tell me, what is the average tax rate? 25 point. 14,60,000. 14 divided by 56,54,120. Correct only. 25.82. ఇందాక మరి వేరేది వచ్చిందన్నమ్మా. సో చెక్ అండ్ టెల్, రీచెక్ అండ్ టెల్. Okay. Why? Your calculator functioning differently, huh? 25.82%. Okay, sir, then again, here, look at this point, sir. Again, we'll overlook this point. India has DTA. India, it doesn't mean India does not have DTA. India has what? DTA with country A, and the tax paid in country A is eligible for tax credit in India. So they are referring here ordinary credit method. They're referring to what? Ordinary credit. So India has DTA with country A, and the tax paid in country A is eligible for tax credit in India. So tax paid in country A, see, 20%. So this step is only important here. See, 20% into $44,500 into 20% into 74 being the rate on. What is the tax paid in foreign country? If you see read the question, what they said? Income tax was paid by Ankit. The fiscal year, all incomes. See in here. In country A, in respect of all incomes, income tax was paid by Ankit on when? 25th May 2026. What is the rate of tax in the foreign country, sir? The rate of tax in the foreign country is how much? Rate of tax is 20%. So we want exactly how much tax paid in foreign country, because this is not unilateral relief to just apply double tax income into whichever is lower. This is what? Ordinary credit method. Ordinary credit method, we need to first figure out how much tax was paid in foreign country. So first step, how much tax paid in foreign country? Sir, we don't know. Okay, what they said, see again. Is eligible for tax credit the fiscal year. Okay, and the tax rate is 20% in country A in respect of all the incomes. Income tax paid by Ankit on 25th May. So first, what are the foreign source incomes they are having here? Business income, $25,000 is there. And then rent from house property, how much is there? $4,500 is there. Then dividend, how much is there? $10,000 is there. Capital gain, how much is there? $5,000 is there. So total how much? 29,500, 39,500 plus 5. Total how many dollars? $44,500. $44,500. Sir, we need to convert now. Sir, we are finding out the tax paid in foreign country. In foreign country only if you are paying tax. Why again you do conversions? For the sake of India, you are doing conversion. But ordinary credit method, now how it works? There is a DTA. First, we need to know how much tax has been paid in foreign country. So 25,000, 4,500, 10,000 and 5,000, 44,500. On this, what is the tax rate in foreign country? 20%. So how much? $8,900 is the tax they have paid. Could check in the answer also. How much is the tax they paid? Okay, they didn't given. $8,900 is the tax paid. But when the tax is paid? 25th May. So for tax paid, which date we have to take for conversion? Preceding month. Again, 25th May 2026 if it is paid now. Preceding month last day. Preceding month last day now what? 30th April. So on 30th April, what is the exchange rate, sir? On 30th April, what is the exchange rate? 74. So convert this 8,900 into 74. 6,58,600. So this is the tax paid in foreign country. Tax paid in foreign country. Now we want the same income, the foreign income which is included in India, and on that apply what? Average tax rate. So how much foreign income is included in India? Add this 2,04,120 plus 18 lakhs plus 3,50,000 plus 7 lakhs. This is the foreign income which is taxed in India. How much? On that apply average tax rate 25.82. $7,88,573 or 574. Out of these two, whichever is lower can be given as credit. Whichever is lower can be given as credit. 6,58,600. Then the net tax liability is what? 8,01,410. Okay. So just because we did till now unilateral relief, you cannot just follow the unilateral relief. It is what? Bilateral relief. In bilateral relief, now we need to calculate tax, and such taxes has to be compared. Whichever is lower has to be taken under bilateral relief. Okay, under bilateral relief. Whereas under unilateral relief, now you just find out what? Sorry, in unilateral relief, we don't think of foreign country much because there is no agreement there. That's why the double tax income only we apply, either average tax rate, foreign tax rate, whichever is lower. But in ordinary credit method, what we are doing? The tax paid in foreign country, convert into Indian rupees and compare it with the tax payable in India if such foreign source incomes are taxable in India. If such foreign source incomes are taxable in India, how much is taxable? Find out and apply on that average tax rate. Compare it with what? The actual tax that has to be paid in foreign country. Compare both. Whichever is lower is given as credit. Whichever is lower is given as ordinary credit. Okay, if you subtract that, you'll get what? 8,01,410. Okay, the same exact questions are almost 99%. This is an MQP question. Same question asked even in December 2025 exam question also. Okay, I know still some people might have did this conversion mistakes and made it. So we are starting with our next topic, transfer pricing. So transfer pricing, we'll get 3 7 marks questions, 7A, 7B, 8B. These 3 are like permanent slots. There is a chance where even 6B also can be from transfer pricing. So minimum of 3 7 marks questions and 2 MCQs. So minimum weightage of this chapter is like 25 marks. 25 marks. And it may go up to 33 marks also. How 33? Another 7 marks and another MCQ if it gets added, it may go up to 33 marks also. Okay. So this one chapter can decide. Most people will target again transfer pricing only, but I'll gonna say you this clearly. To get marks, this is the toughest. Okay, so this is purely about logic only. You think this chapter is easy to get marks and all, but this is the toughest chapter, sir. Okay, why? Because the logic, if you understand, the conceptually if you can do, then easy only, sir. But logic you'll get, or you'll able to understand only when you solve number of questions only. In that also, sir, again, there are like, see, 1 7 marks is from ALP methods. This is like going to be tough because they are asking it like in different methods and all. Here, second one, sir, theory, APA, secondary adjustment, this 7 marks, comparatively we can attempt. I mean, you can get this one. And thin capitalization, sir, there's only one simple concept. There only they're asking every time 7 marks question from here. So this 94, this 2 at least, you can answer. Here they are targeting so much ALP methods. But without doing this ALP methods, we cannot go into the other concepts and all. So the only thing needed is what? You need to practice these questions. Each question is like a puzzle. Okay, just because I explained once, you will not remember it for every time. Okay, again you have to solve every time, and you need to figure it out what logic has been followed on your own once again. Okay, the logic is, so logic many times can't be explained. You have to crack it on your own only sometimes. Okay, so I try to explain to the way possible or to the way it feels understandable, but understand, sir, there is no tax provisions here. Transfer pricing chapter, only to a part, the tax provisions are there. The rest all is completely about common sense and your logic only. Okay. Sir, so again, to introduce this chapter, there is a serious tax avoidance is being made by using the tax loopholes. Okay, so one such tax avoidance is made by Hindustan Unilever. See what it used to do means, sir, Unilever is a UK company, Hindlever is a Indian company, but both this Hindlever is a 100% subsidiary of what? Unilever company. It's okay, that only now formed as what? Hindustan Unilever. It's okay, these are only the companies, sir, which started, I mean, the East India Company, you know. Long back before British, there used to be East India Company. So from them only, these people are only, okay, these are like the British companies. They came to us, they take all the raw materials from India, okay, or else they have destroyed the cultures first. They introduced something called soap, tooth powder, shampoo, all these things and all. And then they started selling to us only. Raw materials they'll take from India only. They'll manufacture in UK and again they'll sell to in India only for a higher price and all. Okay, if you follow the normal traditional methods, now they over a period of years, they said like all these are like what? They are not part of civilization. As a part of civilization, you need to leave all those things and you need to come into these things and also they did, and finally they succeeded in that also. Okay, Unilever is a UK company which is having tax rate of 10%, whereas Hindlever Indian company, it is having tax rate of 30%. Now assume this Unilever is having 80% shareholding in Hindlever. Sir, back then before independence, they used to manufacture in UK only, then they used to send to India. But now post independence and after industrial revolution and all, they started their factories here only because otherwise logistics cost itself will be more. So to control all that, they have started their factories here. But the patent technology will be shared by from the UK Unilever company only. And then Here only they'll manufacture mostly. And these goods only they'll again sell to Unilever, which is there in UK. Now see, sir, this Hindliver has to pay royalty for this patent and all. Because originally the soap patent is with whom? The soap, toothpaste, these patents are with Unilever only. So Hindliver has to pay royalty. Then this Hindliver, whichever the goods it manufactured here, again those goods are sold to Unilever. Now see what happens means, Hindliver, sir, it pays royalty 1000 crores. But the actual market value for such royalty is only 500 crores. But still it is paying how much? Hindliver? 1000 crores. By paying 1000 crores, what happens, sir? Hindliver expense increase. Hindliver expense increase, sir. Here it has to pay actually how much? 500 only. But paid how much? 1000. So expense increased or not? So Hindliver expense increased. Whose profit decreased? I mean, if expense increased, now it profit also decreased. But corresponding Unilever, what happened? For Unilever, sir, it actually should get only 500 crores as revenue. But it got how much? 1000 crores. So it revenue income increased and even profit increased. Sir, why did it like that? What benefit they gonna get? Tax benefits, sir. If the profit is taxed in India, it has a 30% tax rate. Sir, they all belongs to one group only, right? So as a group, they are thinking here, where the profits are parked or where the money is there, they'll get less tax rates, or where the profits has to be transferred, so they get maximum tax benefit. If more income is in India, then they have to pay more tax. If more income is in UK, they have to pay less tax. So they are diverting profits from India to UK by saying it as royalty, by selling at a higher sales price and all. Okay. Now see what happened. Royalty paid 1000 crores, but actually how much should be paid, sir? Only 500 only. So because of this, Hindi limited profits coming down, Uni limited profits increasing. So the profit 500 crores now diverted from where to where? From India to UK. 500 crores has been diverted. The tax, there is a tax loss to India. Okay, as a group they are getting benefited. Next, let's say, sir, they have to purchase raw materials also from Unilever only. So raw material, actually they purchase for how much? 3000 crores. But those fair market value of this raw material is only how much? 2200 crores. So how much extra you paid for raw material? 800 crores. So that is also what? By way of increasing the price of raw materials, they are diverting the profits again from India to outside India, so that they can get a overall tax advantage. They will get overall tax advantage, but India is losing the tax revenue. That's the problem here. Okay, expense increased, profit decreased. Okay, same income for the foreign companies, sir. Income increased and profit also increased. Next one. They sell goods to holding company. Sir, actually they sold for how much? 5000 crores. But the fair market value is only how much? Fair market value is 6000. I mean, you need to sell at 6000, but you sold for only 5000. Again, sir, your profit you are compromising, Indian Limited. And sir, actually foreign company has to buy at 6000, but now it can get at only 5000 only. So Indian company, income reducing. It has to get 6000, but earned only 5000. Income reduced, so again profit reduced. But for foreign company, expense reduced. So automatically, when expense reduced, automatically again profit will increase. So overall, the transactions are designed in such a way, they want to divert the profit from India to some other countries where they have lesser tax rates. Okay, so this is a clear-cut tax evasion. Not evasion, sir, tax avoidance. Not evasion, tax avoidance. Okay, so this transfer pricing chapter is a SAR. SAR means specific anti-avoidance rules. There are two things, sir: specific anti-avoidance rules and general anti-avoidance rules. General anti-avoidance rules, those situations we cannot identify, or in future also there may be some minute cases which may be always arising only. So for all those general cases, there is GAR, general anti-avoidance rules. But this is a specific case. So for that, to address this specific case, they introduced a chapter called transfer pricing, specific anti-avoidance rules. As a part of SAR, there is a chapter introduced called what? Transfer pricing. So now what transfer pricing do? Transfer pricing tries to control this tax avoidance. Okay, so here there is tax avoidance. To control this tax avoidance only, transfer pricing chapter has been introduced. Understand, sir, everybody? Okay, these group companies, multinational companies, are designing their transactions in such a way that the whole profits of the group will be diverted to a country where they have lesser tax rates. So let's say there are some countries where there is zero tax rate. I mean, Dubai is a country where you need not to pay any income tax. Now what they will do, they'll arrange transactions in such a way that all the profits will go to Dubai company only. So they have some 20 companies in 20 different countries. All will have these group transactions and all. From all the group companies, they'll arrange the transactions in such a way that the whole profits will be diverted to Dubai only, so that they can enjoy the tax exemptions in Dubai. Okay, but to control such things only, Indian government has introduced transfer pricing. Understand, sir? As a group, they think what? Unilever should have more profits because the tax rate in UK is less. To avoid these practices, transfer pricing provisions are introduced. Okay, so see, associate enterprise 1 is entering into transactions with associate enterprise 2. Okay, these two are associate enterprises, nothing but group companies. Then they are called as associate enterprises. Sir, we will discuss the relationships also, in which case they are called as associate enterprises. There are total 13 relationships are there when two companies or two entities can be called as associate enterprises. So the transactions entered between them could be related to sale or purchase, related to a loan, or related to royalty or fee for technical services. Between two entities, the transaction could be related to sale, purchase, could be related to a loan, could be related to royalty or fee for technical services. And it could be an international transaction or could be a specified domestic transaction. Sir, what is specified domestic transaction? In India only, sir, two businesses are there for you. One business is covered under, let's say, ETIA, ETIAB those series. What is the benefit to those businesses? 100% profits are eligible for deduction. So you have two companies. Company 1 taxable at 30%. Company 2 can enjoy 100% tax exemption benefit. Now again, what you will do? You will arrange the transactions in such a way all the profits will be diverted to this company only, 80IA company or specified business only, which can enjoy that tax exemptions. Okay. So to control that, even domestic transactions related also transfer pricing is applicable, not only for international transactions. So between two associate enterprises, the transaction may be related to sale purchase of goods, related to a loan transaction, or related to royalty fee for technical services. It could be an international transaction or it could be a specified domestic transaction, not every domestic transaction. Then what? Transfer pricing provisions are applicable. So what happens? Instead of when transfer pricing provisions are applicable, instead of valuing the transaction at actual price, we need to take what? Arm's length price. So arm's length price is nothing but, in general terms, in a layman language, to say fair market value only. Okay, we need to take what? Fair market value only. So in fair market value, now what happens here? This 500 crores again will be added to Indian income, because they paid how much? 1000 crores. But fair market value only, if you consider how much to be paid? Only 500. But they paid extra how much? That 500 again add to your income. Okay. Here raw material purchase. Actually they should pay how much? 2200 only. But they paid how much? Excess how much paid? Again that 800 also add to the Indian entity income. Then sale of finished good. They sold for how much, sir? 5,000. But to be sold for how much? 6,000. Again this extra 1,000 also add to income only. Add to income only. So by doing this kind of adjustments only, we call it as what? Transfer pricing adjustments. So nothing but we are making sure that because of the arrangement of transactions, whatever is the profit they're going to divert, that profit again we recalculate and add back to the Indian entity income only. That's called transfer pricing adjustment. Whatever they try to divert, that amount will identify. And again add that to what? Indian entity income only, so that it gets taxed in India. So when transfer pricing provisions are applicable, we will not consider the actual values. We'll consider only what? Arm's length price. Arm's length price is nothing but like market values only. Difference will be added to taxable income. Then transfer pricing provisions are not applicable because of the adjustment. If Indian income is going to reduce, then you don't do transfer pricing adjustment. You do transfer pricing adjustment only if they are favorable to department, not to SSE. Favorable to department, now what? Tax should increase, loss should decrease. Favorable to SSE, now what? Tax should decrease, loss should increase. Okay, when the transfer pricing provisions transfer pricing provisions are going to impact, like what? They're going to reduce income or increase losses, then transfer pricing provisions are not applicable to the Indian entity. So again, throughout the transfer pricing chapter, there will be group companies or associate enterprises. Our focus is only on what? Indian entity, because Indian entity is only going to pay the tax. So our focus is on Indian entity. If the Indian entity is only our SSE, there may be a holding company in US, subsidiary company in India. SSE is whom for us? Indian entity only. So for this Indian entity, if tax is gonna reduce because of transfer pricing adjustments, we don't do transfer pricing adjustments. So because of transfer pricing adjustments, tax should increase. Okay, or income should increase. Okay, income shall not decrease, and even losses shall decrease. Losses shall be decreased. Losses shall not be increased. So here also same thing. When it reduces income or increase losses, transfer pricing is not applicable. So what is called international transaction? In a transaction where both of them are non-residents or one of them is non-resident, then we call it as international transaction. Or else transaction between an enterprise and unrelated person shall also be deemed as international transaction where there exists a prior agreement. So look at this example. There are two people, M, D. Both are in India only. Both these two are not both these two are not related. But still the transaction between these two people can be called as an international transaction. When? Because K, there is a person called K, non-resident, who already entered into agreement with M. Okay, so now what? M has to sell goods to D. Okay, now originally if there is no K, M can decide on his own price. Now what? K entered into an agreement with M, and K is saying like what? M has to sell each good at 500 only to D. So he is influencing, right? This K non-resident is influencing. Or else this K has an agreement that M has to buy units from D only at 300 rupees only. Like that, if this person is having a prior agreement or this non-resident is fixing the terms. Okay, are you able to understand, sir? This Indian enterprise D and K are like already related. But the transaction is not directly between these two. Transaction is happening between whom? M and D. But at what price M has to transact is decided by whom? K. So there is an agreement. So K directly not entering into a transaction, but he is influencing M to enter into a transaction which is favorable to the group. So then this transaction, even though it looks like a domestic transaction, still it has to be considered as what? International transaction only. Are you able to understand, sir? Okay, sir. Again, this is like what? Directly if we transact only problem, so we'll do indirectly. But that also has been addressed like what? Even if you do indirectly also, that is also still come under the transfer pricing provisions. What does it mean by indirectly? This K and D are associates. If they do directly, if they do buying and selling, then that is what? Direct. But K is not doing directly. What K is saying like, M is a supplier. So K entered into an agreement with M stating like what? You supply goods to D only at 40 rupees or at 50 rupees, like that. Then K is influencing whom? M with this prior agreement or fixing the terms. Then M and D are also associate. The transaction between them also has to be treated as what? International transaction. Transfer pricing provisions are applicable. Okay, sir. So now we're going to discuss about associate enterprises, sir. Sir, first they addressed only two relations. But those two relations, now then these companies, sir, all the tax provisions, when they were introduced, they were not this much foolproof. There were so many chances to escape in the initial years. But then this year, few companies might have escaped. The next year, they'll make some more amendments. The next year, to control that, few more amendments. So over a period of years, our tax law has been evolved into the current stage. Understand? All these didn't introduce at a one go. Okay? It's like test by test. They introduced something, it got failed. Again, to cover up that, again extra provisions, extra provisions. So first they introduced, sir, associate enterprise means they introduced only two relations. But those two relations was skipped. The company started arranging transactions in such a way they don't fit into these two relationships, but they are getting the ultimate benefits. So later on it got updated and they included how many relations, sir? 13 relations has been introduced to call them as associate enterprises. First one, any enterprise participates directly or indirectly through one or more intermediaries. So you, being an enterprise, you participate in another enterprise, in the management of the other enterprise, controlling of other enterprise, capital of the other enterprise. Nothing but here there should be directly holding and subsidiary only. A Limited has 60% in B and B has 65% in C. AB also associates, BC also associates, and even A and C are also associates. So nothing but here they are talking about control. Control can be exercised usually more than 50% of shareholding. Then if one or more persons participates directly or indirectly through one or more intermediaries in management, capital, control of two different associate enterprises, what they're going to address here is A Limited has 70% shareholding in B, 60% shareholding in C. Sir, AB are associates only, as per first point. AC are also associates, as per what? First point. Now what the second point says, now, since B and C are controlled commonly by A only, now this B and C are also has to be treated as what? Associate enterprises. If one or more persons participate directly in management, sir, in B Limited and C Limited, two different associate enterprises, but the control is exercised by only A. So in this case, AB associate, AC associate, and even BC are also associate enterprises. Understanding, sir? But these two alone are not enough. So then they have made it much more elaborative and said like what then? When one enterprise, sir, in the first two cases, they talk about 51%. But 51% is no more relevant now. So what we need to check now? If one enterprise holds more than 26% voting power in another enterprise, then both of them are called as what? Associate enterprises. One enterprise holds how much, sir? Greater than or equal to 26% voting power. So voting power comes only through equity, not through preference. So we have to check only what here? Equity. So more than or equal to 26% voting power, then both of them are associate enterprises. First one. Second one, where any person holds greater than or equal to 26% voting power in each of two different associate enterprises. See, M has 55% in D and in K 40. So M and D associate, M and K associates. And now what they are saying, like, since both are in both these entities, common entities having more than 25%, so these two are also called as what? Associate enterprises. Okay. So first we need to check is what? 26% voting power, either directly or indirectly. Okay, directly or indirectly, na? He individually holds 20%, through his wife holds another 10%. Then that comes under what? Indirect holding. Understand, sir? That person holds 20%, his wife holds another 10%. So directly 20, indirectly another 10%. So overall 30. So both these two persons are called as what again? Associate enterprises. So first point, sir, to call as associate enterprises, voting power should be how much? More than or equal to 26%. Okay. Then second one, when one enterprise like firm AOP BOI has greater than or equal to 10% interest in another enterprise like firm AOP BOI. Sir, in case of companies voting powers related, na, what they are saying, like more than or equal to 26% voting power. But when it comes to firm AOP BOI, where one enterprise holds greater than or equal to 10% profit sharing ratio in other enterprise, then also they are having what? Associate enterprises. Then also they are associate enterprises. Then one enterprise can appoint more than or equal to 50% of directors or one executive director, then also they are what? Other enterprise. Sir, understand? This first enterprise does not have 26% voting power. Sir, are able to understand? There are two people. First person didn't have 26% voting power. Still both can be called as associate enterprises one. When this first person has the power to appoint a majority of both or power to appoint one executive director, then also they both are called as what? Associate enterprises. Associate enterprises. Sir, are able to understand this one? Then when same person or persons appoint more than 50% or more than or equal to 1% of executive directors in two different enterprises. Like what? Sir, two companies are there, A Limited, B Limited. I can appoint, I don't have more than 26% shareholding in A Limited, nor even in B Limited. But I can appoint majority directors in A Limited, majority directors in B Limited also. Then me and A Limited associates, me and B Limited associates, both A and B are also associates. Okay, so next one, sir. So what are the points we have discussed? First one is 26% voting power. Second one is about what? Firm individuals, not 10% interest. Interest is nothing but profit sharing ratio. Third one, majority board, I mean more than or equal to 50% of board, board nothing but directors. Executive director more than or equal to one executive director. Then next one, when one enterprise offers loans to another enterprise, when one enterprise offers loans to another enterprise and the loan money given is more than 51% of the total assets of the other enterprise. Sir, here this other enterprise is having 500 crore assets. How much? 500 crores. Whereas the loan given is 260. How much? 260 by 500 means 52, which is more than 51%. So both these two are what? Associate enterprise. Sir, on which day asset value we have to take? On the date of loan. On the date of loan, how many assets are there? We need to check. If on the date of loan, the asset value is 500 and the loan given is 260, the loan value is more than 51% or equal to 51% of the total assets, then both of them are treated as what? Associate enterprises. Then one enterprise gives guarantee to other enterprise. One enterprise gives what? Guarantee to other enterprise, and the guarantee given is for more than 10% of the borrowings of other enterprise. So this other enterprise has 1000 crore loan, whereas the guarantee given is for 130 crores. Associate enterprises, huh? Guarantee given for how much? 130 crores. Both these two are associate enterprises or not? Should be more than 10%. 130 crores, na 13%, which is more than 10%. So these two are called what? Associate enterprises. Next, where one enterprise manufacturing or processing goods, it manufactures, but this entity is completely dependent on other enterprise for know-how, patent, trademark, license, franchise, or any other of similar nature, and the other enterprise will not provide this, then this one enterprise cannot manufacture. To manufacture this, so there is something called Apple India. Apple Products India. For this, maybe shareholding, let us assume like less than 26% also. But here the Apple phone can be manufactured only when the know-how, patent, trademark, license is transferred by the parent company. So then they are called as what? Associate enterprises, where one company can manufacture a product or article only when the other enterprise gives patent, trademark, royalty, know-how, license, franchise, or any other thing of similar nature, then they are also called as associate enterprises. So 8 points are again. First 26% voting power. Then also second point also related to what? 26% only, but you held in two different enterprises, then both those are also associate. Third one, firm AOP BOS should have 10% interest, nothing but profit sharing ratio. 3. Fourth one, you could have control majority of board. I mean more than or equal to 50% of board you can appoint, or at least one executive director. Then fifth point also 7 only, but you can do that in two different associate enterprises, then both are also called as associate enterprises. 5. Then sixth one, sir, loan. So the loan given should be how much? More than or equal to 51% of the total assets as on the date of loan. Okay, 51% of whose assets, sir? The recipient. Okay, the borrowers, not the lender's assets. The borrower's total assets we need to take. Okay, out of his total assets, if the loan given is more than 51 or equal to 51%, then they are associate enterprises only. Then guarantee, greater than or equal to 10% of the total borrowings. Then eighth one, one enterprise manufactures any or processing any good, but its whole manufacturing or processing is dependent on the franchise, the license, the trademark, patent, or know-how, or any other of similar nature to be given by other enterprise. Then one enterprise manufactures or process goods, but to manufacture that, 90% of the raw materials or consumables are supplied from other enterprise. One enterprise manufactures, but 90% or more of the raw materials are supplied by other enterprise. Then also they are called as what? Associate enterprises. Then one enterprise manufactures or process goods, but it sells goods to other enterprise or to a person specified by other enterprise, and the price and sale conditions are influenced. Okay, sir, I manufacture goods and sells, but my selling price is decided by other enterprise. Then me and that other enterprise are called as what? Associate enterprises. Sir, I manufacture, I can sell at any price I like. But if someone is influencing me to decide what should be the selling price, then that other enterprise and me are also called as what? Associate enterprises. Then individual controls one enterprise, and his individual relatives together control other enterprise. Then what? Both are called as associate enterprises. Understand, sir? I control one entity, then me also have share in other entity. Me along with my relatives can control other entity. Then both these entities are also called as what? Associate enterprises. Then HUF controls one enterprise, whereas HUF, members of HUF and relatives of the members of HUF can together control other enterprise. Then both are also called as what? Associate enterprises. 13th one, sir, there is no specific relationship. If they want anything, they can add here under 13. When enterprise 1 and enterprises 2, there exists a relationship of mutual interest as prescribed, then they are also called as associate. So 13th one is effectively not there. We have only how many? 12. Once again, sir, when individual controls one enterprise and individual and his relatives together control another enterprise, then both these enterprises are also called as associate. HUF can control one enterprise and the members of HUF and relatives of members of HUF together control other enterprise, then both are also called as associate enterprise. Next, you are a manufacturer, okay, or a producer of goods, and you sell the goods, but the selling price is decided by other enterprise, then both this enterprise and other enterprise are treated as what? Associate enterprise. You manufacture goods, and to manufacture 90% of the raw materials is supplied by other enterprise only, then they are also called as associate enterprise. Third one, you are a manufacturer of goods or producer of goods, but to manufacture the know-how, patent, trademark, license, or any other nature needed is supplied by other enterprise, then also you are called as what? Associate enterprise. Sir, manufacturing related 3 points are there. You are a manufacturer, you will get trade, know-how, trademark, license, patent, which, okay, from other enterprise only, you are completely dependent on that other trademark license, know-how, patent only to manufacture, then both those are associate enterprises. You manufacture 90% raw material supplied by other only, associate enterprises. You are a manufacturer, you're going to sell, but the sale price is fixed by other, then also these three are what? Associate enterprises. Then individual controls one enterprise, relatives control another enterprise, associate. HF controls one enterprise, members and relatives controls other enterprise, then also they are associate enterprises. These are the last 5. And if you go beyond them, sir, what? Guarantee and borrowing. Borrowings not more than or equal to 51%. Guarantee na more than or equal to 10%. 7 points, sir. 3 manufacturing. 2 is this like individual controls and relatives. HUF controls 1, relatives control 1. 5 here. 2 are what? Borrowings 1, guarantee 1, other one 7. Now the other 5 are like first 5. What are the first 5? Greater than or equal to 26%. 2 points are there. So now ALP shall be determined by using most appropriate method from the following. Most appropriate method from following. What are those? Transaction based methods, profit based methods. They are like transaction based methods and even profit based methods. What are called transaction based method? CUP, comparable uncontrolled price method. Then resale price method. Then third one, cost plus method. So we have 3 methods: CUP method, RPM resale price method, cost plus method. These are like transaction based methods. Profit based methods, profit split method, transaction net margin method, or any other method prescribed by the board. So effectively we have only 5. Profit split method and transaction net margin method. This side, CUP, resale, cost plus method. So mostly till now from these 3 methods only they are asking the questions. So okay, it doesn't mean they cannot ask in these 2, but most of the questions are we are having on these 3 methods only. We have 1 question on profit split method, I think, and 1 question on transaction net margin method only. Okay, so but on this, even in CA material also we don't have much questions. In CA final material also we don't have much questions on profit split method or transaction net margin method. We have only on these 3 methods most of the questions. Okay, so first you're going to start with CUP method. CUP is applicable when there is a comparable uncontrolled transaction. Nothing but there is an identical transaction available. For the transaction you did, there is an identical transaction available. You might have did a purchase or you might have did a sale, but for that identical transaction is available. Sir, here the logic is simple. Again, reconciliation kind of, sir, here. You'll start with identical transaction. You need to do the differences adjustment so that it will be on same terms as that of the actual transactions you have entered. Actual transactions you have entered. So let me give you certain examples, sir. You have made a purchase. Okay, you have made a purchase. For how much? You have purchased it for $5,000. This is what actual. Whereas comparable purchase, I mean identical purchase, could be only for $4,000. $4,000. Now straight away you cannot say like there is a 1,000 rupees lost to us. Yes, only, sir. Comparable transaction, the purchase can be made at what? $4,000 only. But you paid how much? 5,000. How much you paid extra? $1,000 you paid extra. Because of this, your profit increased or decreased? Expense increased. So obviously profit what? Decreased. Okay, your profit got decreased. Ultimately, why? Originally, an SSE might have arranged this kind of transaction to reduce profit only. What is tax objective? I mean, to reverse that impact is the, sir, understand, SSE objective behind doing such kind of provisions is what? To reduce profit. Whereas department objective is what? To counter those things and to increase the profit. Here, how much is the loss? 1,000 rupees expense was increased, so profit was decreased. So now, to make it correct, what we have to do? The $1,000 we need to add to the profit. If it like PGBP, we did right, the same thing kind of. Okay, but first, that is secondary, sir. First, we need to find out arm's length price. Sir, here the problem is, $5,000 might be with certain terms, whereas $4,000 comparable transaction might be with some other different terms. Now, you cannot just compare the prices alone. Whether the terms are also same or not, you need to check. Terms. Terms means one may be with discount, one may be without discount. One may be including warranty, the other may be without warranty. One may be including freight cost, while the other may be excluding freight cost. So you need to bring both of them on the same grounds, then compare. Understand, sir? You cannot compare 2 different kind of contracts here. Good might be same, but there might be 2 different situations or 2 different terms. Understand, sir? Sir, obviously, you buy a mobile without warranty, one price will be there. With warranty, other price will be there. Yes or no? If you buy 1,000 goods, one price will be there. If you buy only one good, different price will be there. Why 1,000 goods, different price? That bulk volume discount will be there. Okay. The same way, sometimes one may be cash price, the other may be credit price. So all these parameters will be there, right? So straight away you cannot say like 5,000, 4,000. This difference is because of their relationship only. We cannot say always, right? There may be some other parameters also. So first we should make sure both are on same terms. Both are on same terms, and then compare. Okay, so now actual transaction we don't gonna change. This comparable transaction only, according to what terms actual transaction is there, to make it to the same terms, comparable transaction has to be adjusted. Let's say for example, sir. Sir, actual transaction $5,000 is after $500 discount. Whereas comparable transaction is without discount. Without discount. This is actual transaction is after $500 discount, whereas comparable transaction is without discount. Now we need to bring both of them onto the same terms. Okay, now what to be done? Discount has to be provided even onto a comparable transaction. So here also you need to do what? Discount. Sir, your originally discount, what we will do? Discount we need to subtract only, right? So even on comparable transaction also you need to give discount now. What you have to do? Simply you have to subtract $500 here. Sir, everybody are able to understand? Sir, why can't we add here only $500? Okay, actual transaction you cannot change, because our aim is to not to change the actual transaction. Actual remains same only. Comparable transaction only you bring to the same terms of that of actual transaction. So actual is fixed, rigid, it will not change. Okay, the comparable transaction only you make it on the same terms or on the same grounds in which actual transaction is there. Actual transaction is with discount or without discount? With discount. Actual transaction is with discount. So comparable transaction also you want to make it as what? With discount and then compare. And then compare. Understand, sir? We cannot compare a CS student with engineering student, right? So at least first the comparison itself cannot be done. We are humans. We are not goods. Okay, but if at all done also, it can be how far it is like by a, sir, even in CA also I say like there are so many terms which we cannot compare. A student who has good schooling, good parenting, okay, might clear quicker than that of a student who came from a rural background or from a disturbed family. The chances of clearing are like obviously there is a difference will be there. So both are not on same grounds. Same here also, we cannot just compare just because the good is same. There may be the same goods, but if the conditions are different, let us make sure the conditions are also same and then compare. Are you able to understand, sir, the basic point here? Okay, so it is after discount. So with the discount we want, I mean this is like actually is with discount. Comparable also we want what? With discount. So what we should do? $500 subtract. So it became how much? $3,500. So now the comparison should be made between what? 5,000 and 3,500. Okay, now next point. This actual $5,000 is including freight. This is including freight, whereas this is like excluding freight. This $5,000 is including freight. Including freight, na, they'll deliver at your doorstep. Whereas for this comparable transaction, they will not deliver you. You only have to incur the transportation cost and all. So the freight cost is $800. Now what to do? Sir, this freight cost included here. Here also comparable transaction also what we should make? Including freight cost. To include freight cost, what we have to do? Freight is a cost. Discount is a benefit. So discount we reduce. Freight is a cost. So we have added how much? $800 then. Nothing like, okay. Then this actual $5,000 is excluding warranty. Excluding warranty. Whereas comparable transaction is including warranty. And the warranty cost is $600. Sir, actual transaction with warranty or without warranty? Without warranty. Okay, comparable transaction is what? With warranty. So now tell basic question. In general, with warranty high price or without warranty high price? High price. Okay, if at all warranty has to be removed, we have to do what? With warranty is there. We want without warranty good value. So we need to do what? Minus. So your actual transaction is already with what? Without warranty. Comparable transaction also now we need to do what? Without warranty. So warranty amount what we should do? Reduce. So how much is that? $600 if you reduce. Okay, how much you gonna get? 3,500 plus 800, 4,300, 4,300 minus 600, $3,700. So these are only the kind of adjustments we're going to see in the cup method. But every transaction, you're going to see to make the comparable transaction on the same terms with that of actual transaction, what we have to do. If that logic you are having, that sense if you are having, cup method is easy. Okay, so cup method, simple, we have a comparable transaction. But that was not on the same grounds that of the actual transaction. If it is on the same grounds, then no problem. Now what we have to do, the comparable transaction we need to adjust and make it the same comparable thing. Okay, if it is also with the same terms and conditions of that of actual transaction, then that identical transaction has become a comparable transaction. Now compare. Okay, now compare. And remember one thing, sir, we cannot invoke arm's length price or transfer pricing provisions when ultimately with these adjustments, if the profits are gonna reduce, or losses are gonna increase, then we don't go for transfer pricing adjustments. We do transfer pricing adjustment. Ultimately, with that, if the profit is going to be increased or losses are going to be decreased, then only we go for transfer pricing adjustments. Sir, how do it happens? See, you have made a purchase for $1 lakh. Okay, there is a comparable transaction. Purchase $1 lakh. This is what actual. But the comparable transaction is like $1,20,000. You purchased for 1 lakh, but outside the market value is how much? 1,20,000. Now if you adopt arm's length price, you need to pay extra how much? $20,000. I mean your expense is gonna increase. When your expense increases, profit is going to be decrease. If you invoke arm's length price, your profit is going to be decrease. So here transfer pricing applicable or not applicable? Not applicable. Why? Vaishnavi, are you able to understand? You మధ్య మధ్యలో వెళ్ళిపోతే జోన్ అవుట్ అవుతే చాప్టర్ రన్ అవుట్ అయిపోతుంది. See, actual transaction is for how much? $1 lakh. I mean, you made a purchase for how much? $1 lakh. But in an identical transaction, either you or outsiders will do it what? $1,20,000. I mean, they purchased at $1,20,000, but you purchased at only $1 lakh. Okay. Now, if you take arm's length price, you also should pay how much? $1,20,000. That means you should pay how much extra? $20,000 has to be paid extra. So when you pay $20,000 extra, your expense is becoming increase. When your expense increases, profit decreases. Transfer price again is to the object of transfer pricing. Transfer pricing has to do what? Profit has to be increased, not profit has to be decreased. So here again is to the object, so transfer pricing provisions are not applicable. So open the workbook, sir. Sir, read question number 2, sir. So half of the answer we'll get in transfer pricing, just if you understand the question properly. Sir, here first, who is the SSE? J Incorporation SSE here, CD Limited SSE here, JK and F Incorporation SSE here. CD Limited is the SSE. Okay. Now what? CD Limited or associate. CD Limited manufactures cell phones. Okay. And sells them to JK and F Incorporation, a company based Nepal. During the year, CD supplied 250,000 cell phones to J Incorporation, Korea. Sir, J Incorporation and CD Limited are associate enterprises or not? Yes, these two are associate enterprises. How many phones are supplied, sir? 250,000 mobiles has been sold. At what price, sir? At 3,000. Okay. Whereas CD Limited during the year supplied 250,000 cell phones to J Incorporation, Korea at a price of 3,000. And 35,000 units to whom? JK and F. 35,000 units at what price? 5,800. Okay. These transactions are comparable subject to the following consideration. So actual transaction is what? Actual transaction. Sir, we need to think of what transfer pricing. Na? The transaction between associate enterprise only or focus. So who are associate enterprises? CD and J Incorporation. Between these two, what is the actual transaction value? 3,000. This 5,800 is what? Comparable transaction. Now, which has to be adjusted? Comparable to be adjusted, actual to be adjusted? Comparable only to be adjusted, and we should make it like the same conditions on which actual transaction is there. Even comparable also has to be bring with the same conditions and same terms. Okay. Now see, J Incorporation with associate enterprise, it is on FOB basis, whereas to JK and F it is like CAF basis. So out of these two, sir, this is FOB basis. That means including freight, excluding freight. FOB means at the port. CAF means till India or okay till the import value. So which is including freight, which is excluding freight? This 5,800 is what? Including. Again, read the sentence and tell. You need not to convince. Which is including freight? 5,800 is including freight. Everybody clear with this? You have any second question with this? The 5,800 sold to JK and F is on CAF basis. That means including freight. Okay, whereas 3,000 is what? This 3,000 is without freight, right? So this is including freight. So we need to make this what? With freight it is. To compare, we need to make it what? Without freight. So what is the freight cost? The freight and insurance paid is 700. So from this 5,800, what 700 we need to do? Minus, because with freight it is, we want what? Without freight. Without freight now 5,800, we should subtract 700. Clear? Then next point. Sales to JK and F are under free warranty for 2 years. Where J Incorporation are without warranty. So which is with warranty? 5,800 or 3,000? 5,800 is what? With warranty. With warranty. We want what? Without warranty, because the actual transaction is without warranty, whereas comparable is with warranty. So comparable also we should make it as like what? Without warranty. How much is the warranty amount? Warranty amount is how much, sir? 500. So 500 we should do what? 500. Okay. Then next one. The J Incorporation's order was huge in volume, so a discount of 200 per unit was offered. So which is with discount? 3,000 is with discount. So, sir, with the discount now, this 3,000 can we change? Comparable transaction only, we should make it what? With the discount. Okay, so this 5,800 is without a discount, we should make with the discount. So discount has to be done what? Subtract. How much is the amount? 200 has to be subtracted. Then what? Is the comparable transaction. Is the comparable price. Simple, sir. What is the actual price? Sir, till here if you do 90% of the question is completed. Actually is how much? Comparable is how much? 4,400. That means you should actually sell at what price? 4,400. But you sold it for what? You sold it only for 3,000. How much profit decreased? 1,400 per unit profit decreased. Okay. So now to make it normal, what we have to do? This 1,400 per unit we need to add. Okay. First we need to decide whether transfer pricing provisions are to be done or not. Sir, because of now instead of actually if you take arm's length price, will our profit increase or decrease? Increase only, sir. Instead of selling price 3,000, if you take 4,400, your profit will increase. So because of this adjustment, the impact is what? Profit is gonna increase only. So we can proceed with what? Transfer pricing adjustment. So how much is the transfer pricing adjustment? 4,400 minus 3,000. How much, sir? 1,400 into how many units? 2,50,000 units. How much? 35 crores. So this 35 crores we need to add to profit. Yes or no? We need to add to profit or total income so that the transfer pricing adjustment is completed. So what? So increase in total income, how much? 35 crores. So understand, sir. It's like basically, if you understand the question, there's nothing there to do. So it's all about how calmly you understand the question, then that quickly and that easily you'll get the answers. It's okay. Question number 2 done. Sir, question number 1, I'm not doing it, sir. It's a straight theory question about associate enterprises. You already discussed it. Like even if you go through it once also, the same relationships will be there. It's okay. Question number 3, sir. Printing Limited is the SSE. So, okay, so only when you know SSE, from whose perspective you need to see, you will understand first. Okay, because transfer pricing will do it from whom? SSE perspective. Okay, so Quality Printing Limited. So Quality Printing Limited, purchasing or selling? Purchasing. So just because in the question it was mentioned as sell, you don't think like, so first you should understand the question. The foreign company is selling, Indian company is buying. So we need to think from whose perspective? Indian company perspective. So Indian company is what? Buying. At what price it is buying? $20. Whereas others are buying at what? $30. Okay, there are no other adjustments given also. Just they set the number of units only. Now, sir, you are purchasing actually at what price? $20. Whereas market value, how much is that? $30. If you buy at 30, what happens to your expense? Expense increases, profit decreases. So if you do transfer pricing adjustment, your profit is going to be decreased. So will you do this kind of adjustment or will not do now? Will not do this kind of adjustment. So how much is the effect on in profit also we'll see. Okay, so what is the difference between these two, sir? $10. So $10 into how many units, sir? 12,000 units. Into $1 is how much? 45. So total is how much? 54 lakhs. If you do this adjustment, your profit is going to reduce by 54 lakhs. Okay, so will you do this adjustment or will you not do this adjustment? We will not do this adjustment because this is not increasing our profit. This is going to decrease our profit. Sir, everybody are able to understand the logic, sir. Here, Quality Printing Limited purchased from its associate enterprise $20 per drum. Whereas from outsider, it has to pay how much? $30 per drum. So let's say if outsider price only taken, then what? This $20 price is going to increase to $30. So when it increases to $30, your expense increase, the profit is going to decrease. When profit is going to decrease, then such adjustments we won't do under transfer pricing. Okay. So this is not, we cannot apply transfer pricing provisions. Why? Ultimately, it's going to reduce the profits. To what extent? 54 lakhs. So we'll not go with the transfer pricing. So they didn't it. They calculated 54 lakhs, profit is going to be reduced. See, taxable income cannot be reduced on applying ALP. Therefore, difference on account of ALP is ignored. So the total income remained how much? 45 lakhs only. 45 lakhs only. Understood, sir? Sir, here they even asked what? Look at this perspective. Also determine income of Fox Solutions also, foreign company. Sir, that is a foreign company. Foreign company incomes are usually not taxable in India unless they are accrued from India. That's what they are going to explain. The provisions related to taxing income of Fox Solutions on applying arm's length price for transactions in essence remain, which is as follows. As per section 9. Sorry, section 9 is about deemed to be accrued in India. We want to get this, we're going to discuss this section in NR taxation chapter. Transactions not taxable in India. Transactions will not be subject to tax in India if transactions are principal to principal basis and are entered into ALP and the subsidiaries also carries on the business on its own. So here holding business is different, subsidiaries, just because there's a connection, we cannot say like the holding company profits we going to tax in India because subsidiary is separate, both are two different companies, they both operate separately, independently. So we cannot say like there's an excess between them. Transaction taxable in India if the Indian subsidiary does not carry on any business on its own. Okay, the following are the other conditions. Adopting ALP does not affect the computation of taxable income of foreign entity. Okay, we do transfer pricing adjustment only to the domestic company. Because of this, the corresponding profits of foreign entity need not to be changed because foreign entity no way consideration for us. We'll do only the Indian entity related adjustments. So let's say, sir, if Indian entity profits increase, foreign entity profits has to be decreased, right? So understand what is the original transaction they did. They diverted profits from Indian entity to foreign entity. So because of that, what happened? Indian entity profit reduced, foreign entity profit increased. Now you are reversing by way of transfer pricing adjustment. What happens? Indian entity profit increases, foreign entity profit has to be decreased. But transfer pricing provisions never said like foreign entity what we have to do. They only focused on Indian entity. Indian entity profit, whichever is decreased, you increase. Foreign entity, here transfer pricing provisions didn't mandate like that also has to be decreased. Whether you decrease or what you will do, that's your problem. Indian entity has to be first increased. Okay, so where ALP is adopted for taxing income of parent company, income of the recipient company will not be recomputed. Okay, so now, so look at this question, sir. Simple question only. Question number 4 also. Sir, who is the SSE here? Khazana Limited. Associate enterprise is what? There's a name given. Khazana Limited is what? Associate. Whereas Tech Pro Incorporation is what? Associate enterprises. Okay, these two are like what? Associate. And Khazana. Okay, if Khazana Tech Pro charges euro 1,30,000 to other entities in India. Sir, Khazana purchasing or selling? Khazana purchasing or selling? Purchasing, because see, Khazana is a company engaged in manufacturing business. Its subsidiary supplies information. Who is supplying? Subsidiary supplying. That means Khazana is what? Receiving. So Khazana Limited is buying. For what price it purchased? 1 lakh euros. Whereas the subsidiary Tech Pro charges to outsiders how much? 1,30,000. So you are buying at 1 lakh. Whereas the market value is 1,30,000. If you take 1,30,000, what happens? Profit. Expense increases, profit decreases. So when you take 1,30,000, transfer pricing provisions are not applicable because it's going to ultimately reduce your profit. Sir, able to understand, sir? Simple logic only, sir. You are buying at $1 lakh. Okay, 1 lakh euros. But if you make it 1,30,000 euros, your expense will increase, profit will reduce. So such kind of adjustments we don't gonna do. So in this case, transfer pricing adjustments are not applicable. If at all to be done, how much is the impact on profit? 1 lakh and 1,30,000. What is the difference, sir? 30,000 euros. 1 euro is how much? 50. 30,000 into 50. 15 lakhs. So the impact is what? 15 lakhs. Our profits are going to be reduced because of this adjustment. So will we reduce or will not reduce? We will not reduce this 15 lakhs. We'll say simply like transfer pricing provisions are not applicable. The total income remains 90 lakhs only. We'll not adjust anything to the 90 lakhs because this 15 lakhs will gonna reduce the 90 lakhs. So we'll not do. Second case also given. What will be the answer if Tech Pro charges 60,000 to others? Sir, you purchased at what price? Whereas others are purchasing at. So you paid extra, no less, sir? You paid more. Okay, so your expense is increased. So if you bring it to 60,000, your expense is gonna reduce. When your expense reduce, your profit is gonna increase. So how much is the difference here? 1 lakh and 60,000, 40,000 euros is the difference. So 40,000. Sir, able to understand, sir? The second alternative is what, sir? Other entities, they are selling at 60,000 euros. That means you are actually purchasing at 1 lakh euros. But outsiders are purchasing at 60,000 euros. So you are paying more. Okay, that means you are booking more expense, reducing your profit. Now transfer pricing says what? Reverse that. So reversing now what happens? You need to recognize how much is the extra expense you charged. How much is the extra expense? 40,000 euros. So 40,000 euros into 1 euro how much? 50. 40,000 into 50. 20 lakhs. So 20 lakhs, your profit has to be increased. Why? Because you already charged more expense. Because of charging more expense, already your profit got reduced. Now by adding this 20 lakhs, your profit will become what? Normal. So that's why you need to add this 20 lakhs. Okay. So 90 lakhs, if you add this 20 lakhs, how much will become 1 crore? 10 lakhs. Okay. It's basically simple problem, sir. Day before exam also. See, let's say if you need to read something like deductions. Day before exam also, again, you need to put so much of effort on it to remember each and every limit. Transfer pricing is one chapter. There are no limits. The question has to be solved only with a clean mind. So in pressure, you do mistakes here. Only when you are calm, composed, then you can try to understand the question properly and what has to be done. Okay, no much provisions, limits, conditions to be remembered. So very few limits, very few conditions you have to remember. Rest all, it's basic completely about how to look at the problem or what has to be done only. Understand, sir? Clear only here, this question. There are two cases given. You purchased actually at 1 lakh. Two alternatives are there. One, comparable at 1,30,000, comparable at 60. If you take 1,30,000, what is happening? Your expense is going to further increase, profit is going to decrease. So it is against to the principle of transfer pricing when profits are decreasing. So that route, it's not available. Second route, what is the second option, sir? 1 lakh is your actual price, whereas the market value or the arm's length price is how much? 60,000 only. So if you adopt 60,000, your expense is going to decrease, your profit is going to increase. So this way, correct route only, we can do transfer pricing. How much to be added? Now the question is, you need to add to profit. How much to be added? 40,000 is the difference. 1 euro is how much? 50. 40,000 into 50, 20 lakhs. 20 lakhs you add to the profit because that's why you are doing transfer pricing. Your profit is going to increase. So 90 lakhs add 20 lakhs. Total income is going to be 1 crore 10 lakhs. Understood, sir? Okay. Fifth we'll do afterwards then. Okay. Sixth one, sir. Question number 6. Question me. Tell. So what is the arm's length price? Actual 4,000. Comparable how much? Actual 4,000, comparable 5,800. So which has to be changed? Adjusted. Which has to be adjusted? 5,800. Okay. So not tell. Each and every adjustment tell. So this, which is after discount, which is without discount? 5,800 is without discount. So what to do here? Reduce 200 rupees discount. Okay, then. So నువ్వు 4,000 నుంచి రెడ్యూస్ చేయాలా? ఓకే. సో నువ్వు చెప్తుందంతా క్లియరే. సో కాకపోతే ఏంటంటే మధ్యలో కొన్ని ఎక్స్ప్రెషన్స్తో కమ్యూనికేట్ చేస్తున్నావు, దాన్ని కూడా వర్డ్స్తోనే కమ్యూనికేట్ చేయి. ఓకే. సో దిస్ 5,800 is what? Including warranty. We want what? But this 4,000 is what? Without warranty. So we want even the comparable transaction also without warranty. So warranty, what we have to do? Subtract. So how much? 300. Then why? Which is FOB? FOB 5,800 CF. So that means what? So 5,800 is including freight. 5,800 is including freight. Whereas 4,000 is excluding freight. So we need to bring this also without freight. So without freight now, so we need to do what? 600 subtract. So how much it is? 4,700 is the comparable transaction. What is the actual transaction? 4,000. So here Indian company selling or buying? Selling. It sold at 4,000. Whereas it should sell for how much? 4,700. So it should sell at 4,700. Whereas it sold only at 4,000. So how much income got reduced? 700 income got reduced. If you take it at 4,700, your income might have increased by 700, right? So 700 into how many units, sir? 50,000 units. Okay, so what is the total amount? 3.03. 3.5 crores. Okay, so the 3.5 crores, what we need to do, sir, now? Add. Did they given any profit? Yes, already the profit given 8 crores. To that 8 crores, this 3.5 crores has to be added. They asked like, X Limited is covered under section 10A. So that does not impact anything, sir. But one more thing. Sir, usually a unit covered under 10AA is eligible for 100% profit exemption. But because of transfer pricing, if any addition is made, such additions are not eligible for 10AA deductions. Understand, sir? What is the actual benefit to 10AA? 10AA means it's a unit started in SEZ on doing exports. Then 100% of its export profit are eligible for exemption for the first 5 years. Subsequent 5 years, 50% available. Then 11 to 15 also 50% available, but they have to transfer fixed amounts to your resource. Okay. So now think of the point, sir. Originally, whatever the profit they have declared through exports, that export profit is eligible for 10AA deduction. But due to transfer pricing adjustment, if any profit is increased, such increase of profit due to transfer pricing adjustment is not eligible for 10AA deduction. The increase of profit due to transfer pricing adjustment is not eligible for 10AA exemption. It will be there in some other question also, sir. We'll see it, okay, clearly also. In the next question, it will be there clearly. Okay, so come to question number 7, sir. Question number 7. Question not mentioned without warranty. See, here we have Dharmateja and Manideep. Both are standing in front of me. And specifically saying like Manideep is married. That means Dharmateja is what? Unmarried only, right? So if about one thing, if you are specifically stressing, and with respect to other one, if you are not saying anything, then the general assumption we take it is what? Yes, it's not, I'm also not confirming like 100% it is true in all the cases. But the general perception or the general understanding what we'll take? The other one is without warranty. Here also, one transaction they are saying like clearly it is including warranty. And obviously the other one we think it as like what? Without warranty only. Sir, first point. First they are associate enterprises or not? How 32% shareholding, more than 26% voting power. Following transactions are affected. Sir, who is SSE? Who is associate enterprise? AB Limited is SSE. Oceania Limited is associate enterprise. Now, AB Limited sold t-shirts at what price? $3. Whereas the identical t-shirts were sold to unrelated party at $4. How much is the difference? So you are selling it at a less price. So you are losing revenue. When you lose revenue, your profit will decrease. So this is gonna increase only profit. So this adjustment we can take. How much, sir? $1 here. Into how many pieces? 1 lakh. Okay. Into dollar value they given? Yes. Into 84. How much, sir? 84 lakhs we need to add because of the first adjustment. Then second one, AB Limited borrowed $2 lakhs from a foreign lender based on the guarantee of Oceania. Sir, guarantee charge is an income or expense? Guarantee charge you are paying. Expense. Someone acting as a guarantee to you. For him you are paying guarantee commission. So it's an expense to you. So okay, how much you paid as guarantee fee? 10,000. Whereas to unrelated party it is like, from unrelated party Oceania will collect only 8,000. Just because he is related party collecting how much? 10,000. So that means Ideally, you should pay only 8,000. But how much you are paying? 10,000. How much extra you paid? 2,000. So, okay, because of this extra expense, your profit decreased. Now, if you make adjustment, your profit will again jump back. So, how much? $2,000 into 84. How much? 1.68 lakhs. Again, we need to add. Then third one. AB Limited paid 15,000 to Oceania for getting various potential customer details. Okay, it sell the interested customer details. Okay, the data. For that, it paid how much? $15,000. Whereas Oceania will provide the same service to unrelated parties at 12,000. Again, it's okay, you paid 15,000, but actually 12,000 is only the arm's length expense. So you paid extra how much? 3,000. Because of it, your profit has reduced initially. Now you need to bring that back. So how much we need to add? $3,000 equals to how much? 2.52. So total to be added is how much? 84, 1.68 plus 2.52. Total how much? 88.2 is we need to add. Okay, question they given some other details. AB Limited is an SCZ and its total income before these adjustments is 1200. So to the 1200 lakhs, this 88.2 also has to be added. Okay, compute adjustment to be made to the total income calculated. State whether it can claim deduction under 10A for the income enhanced by applying transfer pricing provisions. No. AB Limited cannot claim deduction under 10A in respect of 88.2 being the amount of income by which total income is enhanced by virtue of first provision of 92C. Assume income increased by. Okay, sir. Let me show you this clearly. Sir, usually these adjustments and all, why we will do? In self-assessment only, we will do this kind of adjustments. If at self-assessment only, if you want to do this kind of adjustments, why in the first case you will arrange the transactions in such a way? If you wanted to do these adjustments on your own, then the pricing itself you will do normally. You will not first do pricing in a different way. Then afterwards for self-assessment you will not do right. So mostly transfer pricing adjustments will be carried out at what stage? AO stage only, not at the self-assessment stage. Sir, if your intention is like to pay genuinely tax, why do you arrange the transactions first in such a way? Okay, you will not even arrange the transactions in such a way also. So mostly here the default assumption is what? The transfer pricing adjustments are made only by AO. So let me show you that concept in our notes, sir. In handwritten, you'll find, even in Pulse also you'll find determination of ALP by AO. You'll find a concept called determination of ALP by AO. See, determination of income of ALP by AO, where the AO shall determine ALP based on information available with him. If he is of opinion that SSE failed to complete ALP as per appropriate method, data used for ALP is not correct or not reliable, relevant documents are not maintained, or SSE fails to furnish documents. So when can AO determine? First place, SSE didn't determine ALP. Second thing, SSE determined, but the data he used for comparable transactions and all is not correct. Third one, relevant. He said like he computed ALP, but when you asked for records, AO asked for records, no records has been maintained, or maintained but failed to furnish. Okay, on giving an OBH, then what? AO can determine ALP. When AO determines ALP, then the income of other enterprise shall not be recomputed. When they do on their own, then obviously, sir, in case without coming to assessment only they did not, then why they do adjustments and all? First itself they'll fix the price normally only. Okay, sir, price fixed without proper knowledge. Afterwards they only realized about transfer pricing. Then in such case, since they are doing voluntarily, they can adjust their income and the relevant associate enterprise income also can be adjusted. But if the adjustments are being carried by AO, when AO will do? You filed return, you paid already taxes based on self-assessment basis. Then again, AO taken it for scrutiny. In such case only, AO will do his transfer pricing adjustment, right? So if AO is doing ALP adjustments, then the other enterprise incomes will not be adjusted. They'll remain fixed like that only. Whereas to the SSE, no section 10A deduction, no chapter 6A deductions also for increased income. Not only 10A deduction, even chapter 6A deductions if any available also, not available with respect to the increased income. AO shall determine based on AO information if opinion that AO SSE fails to compute ALP, data used not correct or not reliable, relevant documents not maintained or not furnished, then on giving AOBH, AO shall determine. Okay, what? Income of other enterprise shall not be recomputed and no 10A deduction or chapter 6A deduction is not available for increased income. So whichever is available, they are not available. They cannot be available. Okay, so now coming back to the handwritten. Sir, this X Limited, we solved all these questions, right? Fox Solutions, we have solved. Jain Corporation Korea, we already solved. Then X Limited is an Indian company, this also we have solved. Then we are going into next. Sir, if more than one arm's length price available, then what to do? Because we are taking what? Comparable transactions. There might be multiple comparable transactions, right? If there are multiple comparable transactions, then what to do? Okay, then we need to check how many comparable transactions are there, whether they are less than 6 or more than 6, more than or equal to 6. Sir, if you remember in customs, when multiple identical goods are available, you will take whichever is the lowest. In deductive value method also again multiple options are there, then you take the highest aggregate, the You need to find out the value at which highest number of units has been sold. That in what? Customs. Same way here also, if there are multiple arm's length prices available, then what to be taken? Lowest one has to be taken, highest one has to be taken, or we need to take average, how it has to be taken? For that only this concept. Okay, when more than one arm's length price is available. Less than 6. It is applicable for all the methods. You do cup method, resale price method, cost plus method, profit split method, transaction net margin method, any method you do, when less than 6, this is only the approach. Okay, so what to do, sir? Take arithmetic mean of these ALPs as ALP. Arithmetic mean of what, sir? Simple average. You just take simple average. Okay, 5 ALPs are available. Total all the 5 ALPs and divided by 5, you will get the arithmetic mean. Okay, now they are giving a tolerance band also here. Tolerance band means, sir, your actual transaction value is like 160. Arm's length price, I mean you purchased at 160. But the ALP's mean, sir, you have multiple ALPs here. You took arithmetic mean, and the mean here is 155. Okay, 155. It is close only. Okay, so the arm's length price is 155. You took what? Average, and the average is how much? 155. Whereas you originally purchased for how much? 160. Now here they are giving a tolerance band also. Tolerance band means within that variance it is still okay. They are giving you a band of variance. If the difference is within that limits, it is still fine. You need not to adopt arm's length price. Let it be remained with the actual values only. Okay. So now we need to check whether it is within the range of tolerance or not. What is that range? If the person dealing is a wholesaler, the difference should be within 1%. The range is like plus or minus 1%. If he is others, mostly will get others only, sir. The difference is what? Plus or minus 3%. See, example, you have arm's length price like 228, 270, 245, 260, 252. Add all them and take average, you'll get how much? 251. Whereas the actual price is how much? 250. So now what? Actual price take 250. To the actual price, take minus 3% and plus 3%. That's called the band. Minus 3% if you take how much? 242.5. Plus 3% not 257.5. So the tolerance limit is from where to where? 242.5 to 257.5. If within this range only arm's length price is there, then no problem. Your actual transaction is correct only. Nothing corrections. Sir, able to understand, sir? Sir, sometimes you cannot do exactly at the comparable transactions. There might be some practical differences also. Because of that, 1 or 2% variance is common only. For that also, SSE need not to be penalized by invoking transfer pricing provisions and all. So they given a tolerance band or a tolerance limit to what extent? 3%. How do we should calculate the 3%? Take the actual price. For actual price, do plus 3%, do minus 3% also. Then you get the band or the limit. If within this limit only arm's length price is there, then no problem. Okay, your actual price itself is also arm's length price only. No adjustments has to be carried out. So here, 251 is the arm's length price. What is the limit here? 247.5 to 257.5 is the band. 251 within this band only, right? So within this limit only 251 is there, right? So 251 is within this limit only. So actual price 250 itself can be taken as what? Arm's length price, because that is within the tolerance band only. But let's say here if arm's length price is 260, is it within the range? Beyond the range. Since it is beyond the range, we cannot follow actual price. Now we need to take as what? 260 as only as the arm's length price and do adjustments accordingly by taking 260. If it is 251 only, then don't do because it is within the range. 255, then also don't do because it is within the limit. 256, nothing to be done. 257, nothing to be done. 258, then again do adjustment. Then downside. 245, nothing to be done. 244, nothing to be done. 43, 42, no adjustment. But 240, then again, maybe adjustment is needed. So the tolerance band is how much, sir? 3%. For traders, it is given as 1% only. On what this band has to be given? On arm's length price plus or minus 3%, actual price plus or minus 3%. On actual, you check plus or minus 3%. If the arm's length price is within that range, then your actual price is also arm's length price only, no adjustment is needed. If the arm's length price is not within that range, then you have to drop your actual price and take the original arm's length price only and recompute, add the profits and all. I mean, add the difference to the profit and all. Okay. So now continue, sir. అట్లా వచ్చినా కానీ ఇంకా అదేం లేదు. I mean, above the range, so you cannot take that one. 257.8 only you have to take. Difference you need to add. So they didn't mean points and all clear. They just given 3% only they talk. Within 3%, above 3%. Within 3% is accepted. Above 3%, again they cannot give marginal relief here. Marginally it is more than 3%, so we'll give marginal relief. All that, okay, why to complicate us? So they just simply said like 3%. Within 3%, above 3%. Above 3% means then we need to invoke transfer pricing adjustment. In the above case, ALP calculated is within plus or minus 3% variance to the actual price. Hence, actual price itself has to be considered as ALP. In the above example, if the actual price is 230, sir, 230, actual price is 230. Sir, we didn't change the ALP. ALP remained 251 only. But actual price is 230. 230 plus 3% na upper side, 236.9. Minus 3% na lower side, 223.1. So ALP is 251. Within this range, 223 to 236. ALP is how much? 251. Within this range, above this range. So ALP 251 is not within this range. So ALP 251 also only has to be considered. Okay. Now here, sir, for normal people they said like what 3% is the variance to be considered. But whereas wholesaler trading, what they said 1% only. So who are called wholesaler trading? To call them as wholesaler trading, two conditions are there. First one, they might be carrying international transaction or specified domestic transaction where their purchased cost out of the their purchased cost out of their total cost 80% or more than 80% is purchase cost only. So wholesalers know what they do generally, buy goods and they're gonna sell. They don't do much processing and all, right? So they just have some dealing expenses or some warehousing expenditure only. They don't do processing and all. So out of their total cost, if more than or equal to 80% is purchase cost only, and then their average monthly closing stock is within 10% of the sales. Okay, wholesaler now he'll not keep stock much. He'll be he'll be selling the stock also, he'll be clearing the goods also. So two conditions has to be satisfied to call him as an wholesale trader. First one, his total raw material purchase cost out of the total cost should be within, more than 80%, and his stock, average stock should be within 10% of the sales every month. If these two conditions are satisfied, he is called as wholesaler. For wholesaler will not provide 3% margin, will be give only 1%. Sir, why? Sir, wholesalers now they'll deal at lower margins. Wholesalers usually they'll do in bulk quantities with lower margins. So for them the variance cannot be 3%. Even 3% is also big for them. That's why for them only 1% variance is allowed. For normal people up to 3% variance is allowed. Understand, sir? This is when the number of ALPs available are within 6. Less than 6, not even 6 also, less than 6. Even 6 also will not come for this. The number of ALPs available are what? Less than 6. Then next option, sir. When they are greater than 6, when they are greater than or equal to 6, then we'll follow range concept. So okay, 8:12 already. So you can take break, sir. After break we'll discuss because it take another 15 minutes. Like when there are multiple ALPs available, if they are less than 6, what we have to do? Arithmetic mean will take plus or minus 3%, tolerance range is there. Then if they are equal to 6 or more than 6, then what to be done? There is rule 10CA comes into picture, sir. When the ALPs are more than or equal to 6. It applies only to cup method, resale price method, cost plus method, transaction net margin method. It is not applicable to profit split method. So for profit split method, irrespective of number of ALPs, we'll take with average only. So like this only. Okay. But whereas for cup method, resale price method, cost plus method, transaction net margin method, for these 4 methods, when the ALPs available are more than or equal to 6, we should apply rule 10CA. It suggests a range concept. What? First steps. Arrange all the ALP values available in ascending order. What is ascending order? Small to big. Okay. Then calculate 35th percentile and 65th percentile. Okay. So what is meant by calculation of 35th percentile and 65th percentile? So okay, let me take, sir, here. How many are there? Here 7 ALPs are there. Since 7 ALPs are there, we need to apply rule 10CA. ALP1 220, 225, 228, 230, 232, 234, 235. Already arranged in what? Ascending order. So now we need to calculate what? 35th percentile. 35th percentile means 7 into 35%. How much? 7 into 35%. So number of ALPs available, that number into 35%, we call it as 35th percentile. Number of ALPs, that number into 35%. How much, sir, here? 2.45. Sir, does 2.45 is a whole number? No. So whole number means what? 1, 2, 3, these are called as whole numbers. When they are in decimals, they are not called whole numbers. So 35th percentile is 2.45, not a whole number. So you round it off to next number. You take the next number, what? 3. So what is the value of 3? 228. Then they are even asking us to calculate 65th percentile. Sir, 7 into 65%. 4.55. Again, is it a whole number? No. So take to the next number. Next number means what? 5. So 5 is what? 232. So 3 here. So 228 to 232 is the range here. 35th percentile to 65th percentile. 35th percentile, if it is not a whole number, then take the next whole number available. 65th percentile also. If it is not a whole number, take the next whole number. So 35th percentile means 2.45. So take next number is how much? 228. 65th percentile is like 4.55. So take the next number. So this is the range. 3 to 5. 228 to 232 is the range. Okay. What is our actual price, sir, here? 230. Case 1, 230. Within the range or above the range? Within the range. Okay, now see. Range is what? 228 to 232. 228 to 232 is the range. Okay. Now actual price is first case how much, sir? 230 only. So 230 is between this range, 228 to 232. So actual price is within the range, 228 to 232. So actual price 230 itself is the ALP. No adjustment need to be made. Sir, there are range plus or minus 3% we are doing. Here no plus or minus 3%. 35th percentile to 65th percentile. In between that only arm's length price is there. Then actual price also can be adopted as what? Arm's length. Sorry, if the actual price is within this range, then actual price itself can be taken as what? Arm's length price. No adjustment has to be carried out. But second case, if you do, sir, case 2, how much is there? 233. Is it within the range? The range is 228 to 232. 233 is not within the range. So actual price 233 is not within the range. Then what to be done? You should calculate 50th percentile. We should calculate 50th percentile. So 7 into 50th percentile. 50%. 3.5. So take the next number. 4. What is the value, sir? 230. So see, actual price 233 is not within the range. So go for 50th percentile. What is 50th percentile? 7 into 50 percentage, which equals to 3.5. Take to next whole number, how much? 4. So value SA into 4 is how much? 230. So ALP to be taken is how much? 230. 230. So what are the steps? Arrange them in ascending order. Then 35 percentile, 65 percentile. If they are in decimals, take the next whole number and the next whole number related values you should take. 35th percentile you will get one value, 65th percentile you will get one ALP value. So if actual price is within this limit, within this range, then actual price itself ALP. If actual price is not within these limits, then what? Then actual price cannot be taken as ALP. So what is ALP then? Again you should calculate 50th percentile. So 50th percentile again in decimals, round it off to or take the next whole number, that value will be taken as the arm's length price. Arm's length price. Okay, look at the steps now. Arrange ALP values in ascending order. Calculate 35th percentile and 65th percentile. If actual price between 35th and 65th percentile, then actual price is ALP. Otherwise, 50th percentile shall be ALP. Otherwise, 50th percentile shall be ALP. While calculating percentile, if it is whole number, 3, 4, 5, then take the value of that number and next number divided by 2. If it is in fraction or decimals, then what to do? Take the next highest whole number, 2.5. 3, 3.2, 4, 4.6, 5, like that. 2.4 will take 3, 4.6 will take 5, like that. Okay, so we did part example now. Here in this example, sir, how many ALPs are there, sir? 20 ALPs are there. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. They have to be arranged in what? Ascending order. 120, 122, 124, 125, 127, 129, 130, 31, 33, 35, 36, 38, 40, 41, 43, 44, 45, 47, 49, 50. Already in ascending order. First, what we have to do? 35th percentile. 20 into 35 percentage. 7. We'll take directly 7 value. No. 7 plus 8. So 7 and 8 total what? 130 plus 131 divided by 2. Okay. Even though it is a whole number, we'll not take the value straight away. Whole number, that number and the next number values both take and divided by 2. So 7. So take 130 plus 131 divided by, you'll get how much? 130.5. Then 65th percentile. 65th means what? 20 into 65. 13. So now we can take 13 and 14 values related and divided by 2. 13 how much? 140. 14 how much? 141. So 140 plus 141 divided by 2. How much? So lower range is 130.5, upper range is 140.5. Okay. If the actual price is within this range, that itself is the arm's length price. Not within this range. Again calculate 50th percentile. What is 50th percentile? 10. 20 into 50% is not 10. So we'll take straight away 10. 10 plus 11. So 135 plus 136 divided by 2. We'll get how much? 135.5 as the ALP. Actual price not within the range, then ALP equals to 50th percentile. 50th percentile equals to 20 into 50% is 10 and next number 11. Both values divided by 2 will get 135.5. So this is what concept, sir? Range concept. Clear this one? Okay, then. Notified jurisdictional area. So notified jurisdictional areas, these countries or these territories are not having DTA with India. In DTA, actually, one is to have tax treaties. Second one is like at least exchange of information. But these are notified jurisdictional areas. Forget about tax credits and all. They are not even agreeing to exchange information also. Countries like Mauritius and all. Okay, so they will not what? Mauritius and some islands will be Caribbean islands will be there. Where all this, so most of the black money or the illegal money, they're going to invest in those Caribbean islands or in this Mauritius only, because those countries are not going to share information with any other country. So you can do your investments there. Okay, so what? Even if you are thinking like you are able to cotton, you did some kind of transaction, so, and you know that you are going to be catched, then immediately what you can do, you can just go away from the country. You already had investments in these kind of countries, and also there you can settle, and those countries are not going to share any information of you with the India. Okay. So previously, like people used to invest in Swiss bank accounts and all. Why only in Swiss account? Why not in SBI? SBI night will tell openly to one, this person has this much deposits and all. Swiss bank will not share. But these days with so much of pressure and all, Swiss bank has given at least the names. They didn't given the amounts they have, but they given the names. Indians who are having Swiss bank accounts, those name has been given. Okay, that also not made public, taken by central government. Now what central government do? If they are favorable to India, leave. Otherwise. So now notified jurisdictional areas means those countries, those territories which not even exchange informations with India are called notified jurisdictional areas. So now if any transactions are happening with a person in those country, no information will be shared. So India doesn't want to encourage those transactions. That's why what they are saying, like these two persons, so let's say Mauritius X Limited is there, India another company is there. These two are not associate enterprises. But if any transaction is happened with a person who is in those notified jurisdictional area, then those transactions are called as deemed, those two entities are called as deemed to be associate enterprises. Central government may notify any country or territory outside India to be a notified jurisdictional area. Then effect of notified jurisdictional area, what happens? All parties involved Even though they are not associate, actually, they are treated as what? Deemed to be associate enterprises. And transactions are deemed to be international transactions. All the provisions of transfer pricing shall apply, and they have to maintain documents and submit documents also as prescribed. The only negative thing is what? They don't get the plus or minus 3% tolerance range is there. That is not applicable when one of the party is in a notified jurisdictional area. Then if any payment is made to a person located in notified jurisdictional area, TDS has to be deducted. TDS has to be deducted at a rate of 30% or rate specified has to be deducted. So you are purchasing goods from a person in notified jurisdictional area. Then automatically, even though you both are not associates, it has to be assumed as deemed associate enterprises. It is an international transaction. So what transfer pricing provisions has to be invoked, even though they are not related. But since such person is in a notified jurisdictional area, this transaction also will be treated as what? Deemed associate enterprises. Transfer pricing provisions will apply. Okay, come back to the workbook, sir. Question number 5. BPL Limited SSE sold to X Limited in a notified jurisdictional area. So what? These two are deemed to be associate enterprises. Transfer pricing provisions are applicable. What is the actual transaction value here, sir? 10.5 crores. During the current year, BPL charged 11.5 crores from JD New York and 12 crores from ZZ of London for sale of identical goods. Sir, how many comparable transactions are there here? 2 transactions are there. So okay, we'll take both of them separately. So tell me, what are the 2 comparable transactions, sir? One is with what? JD and the other one is with? Okay. What is the comparable price? JD how much? ZZ? 12. Okay. Both of which are neither associate enterprises nor situated in NJA. Sales to ZD and ZZ are on CIF basis, whereas sale to X Limited was on FOB. Sir, our actual transaction is on FOB. Comparable transactions are CF. That means comparable transactions are including freight. We want what? Excluding freight. So freight cost reduce. .20, 0.20. Then India has DTA with USA and UK, fine. The SSE has a policy of providing after sales support to the tune of 14 lakhs to all the customers except X Limited, which procured locally 18 lakhs. Okay, locally value not needed, sir. But generally the SSE provide for what? To the tune of 14 lakhs to all the customers except X Limited. So actual price is without sales support, whereas the other transactions are including sales support. So comparable transactions are including sales support. So you should subtract even the after sales support cost also. After sales support cost how much? 14 lakhs. So you should subtract how much? 0.14, 0.14. After sales support. 0.14, 0.14. Subtract. Then anything else is that, sir? No. So what are these arm's length prices? 2 ALPs are there. More than 6 are within 6. Sorry, less than 6 are equal to 6. Equal or more than. Less than 6. So we'll take what? Arithmetic mean. So how much? Actually is how much? 10.5. Plus or minus 3% available. Because notified jurisdictional area na plus or minus 3% is not available. So here, sir, SSE sold goods. BPL Limited. So it sold for how much? 10.5. Ideally, it should sell for how much? 11.41. So for at how much less value it sold? 0.91 crores less value it has sold. Okay. So this value we need to add to total income to increase their profit. Increase in profit of BPL Limited. Done, sir. 7 also done. So till question number 7, all the other questions we have solved, right? Okay, 4 done, 5 done, 6 done, 7 also done. Question number 8, sir. Sir, what happened here? Xenon India Limited, an Indian company, sold goods to M Corporation, a company located in NJA for how much, sir? 9.8. Sir, since sold to notified jurisdictional area, deemed associate enterprises, international transaction, transfer pricing provisions applicable. Same year, identical goods were sold at CF basis to whom? Germany for how much? 10.7 crores. CF, sir, actual transaction is FOB, whereas comparable transaction is CF. That means comparable transaction is including freight cost. So we need to make it what? Excluding freight cost. So 18 lakhs we need to subtract. So 0.18. Then company also provides sales support worth 12 lakhs to customers excluding to M Corp. So this 10.7 is what? Including sales support. We need to make it what? Excluding sales support. So we should subtract what? 0.12. So how much? 10.4. So now the question is, as per cost plus method, they already given identical goods is 11.2 crores. But still, sir, comparable is the first method we need to take. If comparable is not available, then only we'll go to other method. So comparable is much more appropriate method to decide. So that's why this only will be adopting rather than going to cost plus method. So 10.4 is the value. 10.4 is the value. It has to be sold ideally. But it is sold for what value, sir? 9.8 crores. So you sold for a less value. Because of it, your profit decreased. Now you make transfer pricing adjustment, your profit will increase. So it can be done how much, sir? 0.6 crores is the profit to be increased. Appropriate method. Although ALP is available under cost plus method, CUP is considered most appropriate method here due to availability of comparable transaction. Plus or minus 3% is no allowed. Why? Because it is in notified jurisdictional area. So solve this question, sir. Question number 9. Question number 9. Sir, able to do? Except what? Okay, see here. Price paid. Sir, here also there's a purchase made because price paid, so it is a purchase. Related party, you paid how much? 25,000. Unrelated party, 23,500 only. Delivery term, CAF, FOB. So the related party is what? Inclusive. Including transport freight cost. So we need to do what? Excluding freight. So how much is the freight cost given? Freight and insurance. 1900. So from this 25,000, we should subtract what? 1900. This is clear, right? Because this is including freight cost. We should do what? Excluding. Because this 23,500 is what, sir? Sorry, this is related party, right? Okay, I'm doing wrongly. Okay, yes. This is unrelated party. This is what? Comparable transaction. This is the actual. Sir, actual is with the freight. Okay, whereas unrelated is what? Without freight. So unrelated, now we need to make it as what? With the freight. Because actual is with the freight. Unrelated also, comparable transaction also, we should make it as like what? With the freight. So what we have to do for 23,500, you should add this freight cost and insurance cost. How much? 1900. Done. Then credit period. Related party, 90 days credit is offered. But for unrelated party, no credit is there. So now understand. So this period also we need to make what? With credit. With credit. So credit cost also what we have to do? Add. So one is with credit, another one is what? Without credit. So related party, since our actual price is with credit, the other transaction also we need to make it as like what? With the credit, what will be the price? So we know credit price will be higher than that of cash price. So this is a credit price, this is a cash price. So this cash price also we need to make it as what? Credit price. So for that what? Credit period 90 days, interest on working capital is how much? 12% per annum. So how do they are calculating, sir? See here. What is the cost, sir, here? 23,500, right? Actual price. On that, for 3 months into 12% per annum, if you do, you'll get the credit cost relevant element also. Nothing but the price actually fixed into 90 days. 90 days into 12% divided by 365, you do also same thing, 705. So here, the interest element also or credit related also, you need to add. How much? This 23,500 is the price, right? 23,500 into 90 by 365 into 12%. How much? Same. 23,500 into 90 by 365 into 12%. 695. But there they took it as like 3 by 12. So it will come how much? 700. Okay. That actually they should do what? 90 days one only. But in question they did like 3 months. But still it's a minor thing only, not a big thing. Now, what is the other difference, sir? ITC. ITC related party not available, but unrelated party ITC is available. So unrelated party also you should do what? With ITC you should make, without ITC. So the ITC element you have to subtract. So if you subtract, how much has to be subtracted, sir? 2,000. You have to subtract. Then what is the final cost? 23,500 plus 1900 plus 700 minus 2,000. See, again here also in notes also it is given. In related party, it is with the freight and insurance. Unrelated party without freight and insurance. So this unrelated party also what we have to do? Without freight, we need to make it as like with the freight. So freight and insurance, what we have to do? Add. Then related party with the extension of credit. This is without credit. So this unrelated transaction also what we have to do? With the credit. So I mean the credit cost also we need to add. What is the cost of credit? 23,500 into 3 months into 12% per annum. Okay, we'll have to add. This is without ITC, whereas this is with ITC. So here also what we have to do? With ITC. So the ITC element we have subtracted. Then what is the total transfer pricing available? So transfer price available is how much here? 24,105. 24,105 is the arm's length price. Understand? Sir, you paid actually how much? 25,000. But how much you should have paid? 24,105. Excess how much you paid? 895 you paid extra. That you need to add it to the total income multiplying with the number of units. Now we are moving on to next method. So this question number 10, same model we already solved. You can also do it quickly only. Like 2 arm's length prices or 2 comparable prices will give. In one case, you will not do adjustment. In another case, you have to do adjustment. The same model, numbers change. We already did. So now we are moving on to next method, sir. Cost plus method. Cost plus method. In cost plus method, sir, we'll take the total direct and indirect cost and we'll add the normal gross profit margin. Normal margin, not your profit margin. In identical transactions, what is the profit margin you will take? And that profit margin you will adjust. Why profit margin has to be adjusted, sir? Sir, depending on the terms, the profit margin varies. With freight, now one profit margin, without freight, another profit margin will be there. So the profit margin has to be adjusted for those functional differences. Then you will get the ALP. So now we'll start straight away the question, sir. Then only you'll understand. So read question number. Okay, first we'll go to question number 12, sir. 12 is a little easy. SLP is a foreign company. is a foreign company. Holds how much, sir? 32% of the voting powers in ZX Limited, Mumbai, an Indian company. ZX provided banking related software to its clients. SDLLP is one of the major customers to ZX. Sir, who is the foreign company here? Is foreign company. Who is Indian company? Okay. Now ZX provides software to its client. SDLLP is one of the client. So I mean Indian SSE ZX provides what? Software service to SDLLP, right? During the previous year, ZX has billed 30,000 man hours at $36 per month. How much they billed, sir? I mean, actually they charged how much? 30,000 man hours into $36. How much? 30,000 into $36. 10 lakh. $10,80,000 is what they have billed, actual price. But they given cost. What is the cost per man hour, sir? 18. Indirect cost is how much? 12. So total $30 per man hour is the cost. Okay. But they already booked how much? 30,000 into 36. Their cost itself is how much? 30 per man hour. $30 per man hour. Okay. Now TY Incorporation Colombo. TY Incorporation Colombo is also a client to whom similar services are provided at 45% to operating cost. So in a similar transaction, how much profit they gonna earn, sir? 45% on profit, 45% on sale or cost, 45% to operating cost. This profit percentage is on cost. Okay, 45% profit to operating cost. However, in similar transaction, you have 45% margin. The same 45% you cannot apply here because the similar transaction might have different terms and conditions, whereas actual transaction might have a different terms and conditions. So now first this profit margin we gonna adjust for the functional differences. Okay, in cost plus method, we'll take the similar transaction profit margin, and that profit margin we gonna adjust for the changes or according, and we will find out the arm's length profit margin. Understand? See, SDLLP gives huge volume of business. SDLLP now whom? Your associate. Here ZX is the SSE, ZX associate is whom? SDLLP. So SDLLP gives huge volume of discount. That's why 8% of the gross operating margin is given as what? Discount. Okay. So, sir, that means in comparable transaction, no discount. But in associate case and all, we have given discount. Okay. So now, sir, here we are not adjusting the price. We are adjusting the profit margins. Be clear. Okay. Simple. 45% is the profit margin with discount or without discount. Sir, this 45 profit margin is to actual transaction or to associate transaction? Actual transaction. Sorry, both are same only, actual or associate. So what I have to say is like, in comparable transaction, we are having what? 45%, or in unrelated transaction, we are having 45% margin. In related transaction, we don't know margin. Unrelated transaction, how much we are having? 45%. Unrelated transaction with discount or without discount? Without discount. So understand, this is without a discount. We need to make it as what? With a discount. So discount element, what we have to do? Subtract. How much is the discount element? 8%. So from 45%, not directly subtract 8%, sir, because this 8% on gross profit margin. So we need to take what? 8% on 45% you need to subtract. How much? 8% on 45% you need to subtract. So understand, sir, this 45% is including discount or without discount or without a discount. So you need to do what? With a discount. So discount part also you have subtracted then. So we'll come to second point towards the end, sir. Third point. SDLLP is given a credit of 15 days to unrelated. Okay, while the unrelated party got a 45 days credit. Okay, related party is with what? 15 days. Related party is with 15 days credit. Unrelated party is with what? 45 days credit. So this 45 days credit also we need to make it as what? 15 days credit. Again, what we need to do? Subtract. The credit cost, we need to cost of credit, we need to what? Subtract. How much is the cost of credit, sir? The impact of extra credit period provided is how much? 5%. So 5% on 45%. How much? 2.25 we need to subtract. Okay, now second point, sir. SDLLP provides some technical support to ZX Limited. SDLLP provided some technical. Sir, who is the supplier actually? ZX. It has to provide, right? But it received some support from related person. Sir, understand? In this case, with SDLLP, price is not the only consideration. Why? Because SDLLP is extra providing some technical support also. So they are doing extra technical support. That's why you are charging less. Okay? Because of its specified knowledge in the banking domain. Whereas no such support is derived by the SSE. So this 45% profit margin is without any extra support. Okay? Without any extra support. Sir, here this 45 margin is without any extra support. So let me tell you much more logically. Sir, here with related party transaction, not only this amount is the benefit for you. You are having some other benefit also because they are providing you support also. So in actual case, the profit margin would be less normally also because you are getting extra benefit. Whereas here in unrelated party transaction, you are not getting any extra support. So what we have to do, this one also with the support we have to do with. Okay, this is without support, but without support, with support, sir, here you may think it wrongly and you add, but understand it clearly, sir. Here, because of support, your profit get shrinked. Support ఇవ్వడం వల్ల మనం ఏం చేస్తాం, తక్కువ అమౌంట్ ఛార్జ్ చేస్తాం. When they give a support, you'll charge less. Okay, here without support na, so you already charged more. So with the support you have to do na, you need to subtract. Sir, అర్థం చేసుకోండి సార్, లాజిక్ మళ్ళీ చెప్తున్నాను ఇక్కడ. Simple example only, sir. Sir, so I'm taking classes here. So let's say per subject charging 10,000 rupees. But one student came and said to me like, sir, I cannot pay 10,000, but I'll help you in your material work or something. So for him only 5,000 only charge. Why only 5,000 charge? Because he is providing me extra support. He is providing me extra support. Now to make, sir, because of support only, here we are charging 5,000. Without support, now how much I am charging? 10,000. So this 10,000 also, if I need to make it with support, what I have to do? From 10,000, 5,000 I have to subtract, right? Same logic here also. 45% is with support or without support? Without support. To make it as with support, you need to reduce that percentage only, because support is like a benefit here. Okay, not like an expense. Sir, expense now what we are doing straight away, without expense to be excluded, now we are subtracting. So support, that logic you're gonna confuse, sir. Clearly see, that's why I'm again explaining you the logic. With the support, actually we'll charge less in a related party transaction also. Our profit will be less. Without support, now our profit is more. So with the support, even our profit also has to be what? Reduced, sir. Naku the same again example, sir. Why I am selling it only 5,000 to a student a class? Because he's providing me some benefit, some support. Whereas to other student I am charging how much? 10,000. So now for this other student also we need a price with the support. With the support, now what we'll do? From 10,000 we're gonna subtract that 5,000 and right? Same here also. 45% is what? Without support. So with the support you have to do now what you have to do? You need to subtract the support related cost. How much is the support related cost? 10%. So 10% on 45% now how much? 4.5. Subtract all the three. How much you'll get? 34.65%. This 34.65% is on cost or profit? On cost. This 34.65% is on cost. What is the cost, sir? $30. So $30 is the cost on that. $30 into how many units are actually here? Sorry, how many man hours? 30,000 man hours. So $30 into 30,000. Total how much cost? $30 into 30,000. $9 lakh, sir. $9 lakh. Okay, each dollar how much, sir? 80. Convert into Indian rupees also. 9 lakh into 80. 7 crore 20 lakhs. Now, what is the adjusted profit margin we got? 45% is in a similar transaction. But that profit margin we have already adjusted. After adjustment, how much is the actual margin we got? 34.65. So if you apply 34.65% on 7 crore 20 lakhs. 2 crore 49 lakh? 48,000. So what is the total arm's length price? 9 crore 49 lakh 48,000. Sorry, 9 crore 69 lakh 48,000 is the arm's length price. What actually they charge? What actually they charge in 30,000 into 36, which is $10,80,000 into 80 if you do. 8 crore 64 lakhs. What they charged is only 8 crore 64 lakhs. How much to be charged is how much, sir? 9 crore 69 lakh 40,000. So you charged only 8 crore 64 lakhs, but you have to charge 9 crore 69 lakh 48,000. So how much to be added? The difference amount we need to add. Okay, so the difference amount 1 crore 5 lakh 48,000 we need to add it to the total income. So once again, sir, I'm giving you the same points. We are starting with what? Comparable profit. Something like comparable transaction only. Comparable profit we are starting in cost plus method. This is with the discount. Let's say, simple rule. Related party, unrelated party. Discount. Related party with the discount, unrelated party without a discount. What we have to do? What is the impact we have to do? Related party with discount, unrelated party without a discount. So what the discount, this unrelated transaction also we need to make it as like what? With a discount. So we need to subtract discount. Yes or no? Minus discount. Then discount only, sir. Related party without a discount, unrelated party with a discount. Then we have to do what? Unrelated party transaction is with a discount, whereas actual transaction is without a discount. So what we have to do? This also we need to make it as like without a discount. So what we have to do here? Add discount. Same way. Freight. Unrelated party is without freight. Unrelated party is like without freight, whereas related party is what? With the freight. So without freight also we need to do as what? With the freight. So freight what we have to do? Add. So freight without with. Unrelated party freight is like inclusive of freight, whereas related party is what? Without freight. So this also we need to make it as like what? Without freight. So freight what we have to do? Freight. Okay, then credit. Included, excluded. So unrelated is what? Without credit cost. Unrelated is like without credit, extension of credit cost. Whereas related is inclusive of credit cost. Now what we have to do? Add the credit cost also. Or cost of credit also. Then credit. Here excluded, here included. So unrelated party transaction credit already, credit is included. But related party transaction is what? Without credit. So that credit cost what we have to do? Subtract. Credit cost we need to subtract. Same warranty also, sir. Same warranty also, just like as freight only. So freight, warranty, both are like same adjustments only. Freight, warranty. Okay. Sales support also same only. But what we got in the recent question is like, you are getting an extra benefit. So this point, sir, which is like the second point, you should be very careful, sir, and understand the logic once again clearly. Here what? Your profit margins you are reducing here because you are getting some other benefit. Whereas in related party transaction, you don't have any extra benefit. Since you don't have extra benefit, your profit margin is high. When you have some other benefit, your profit margin obviously should be less. So to make it normal, what you are doing, that difference amount, we need to subtract. We need to subtract. So the logic to be understood for second point is like, without any extra benefit, there is no other extra benefit. Now obviously you will charge profit more. But if you have an extra benefit you are getting, non-monetary extra benefit you are getting, then obviously your profit margin is going to be reduced. So to make it normal or to make it on par with the related party transaction, this also has to be reduced. Reduce now the difference amount, what we have to do, we need to subtract. Okay, this impact of 10% sales support, we need to what? Technical support, we need to subtract. ITC, okay, sir, here also, so one student asked the ITC related discount also. Sir, here ITC, think it as like simply like GST kind of expense only. Wait, which question that one? ITC related adjustment. ITC, without ITC, with ITC. Why we have listen here. Here with ITC, without ITC, na, assume it as like you purchased with GST, without GST. First, if to get ITC, whether it is a purchase including GST, na, excluding GST. Na. So unrelated party, what? Availability of ITC is there, that means what? Including GST. Since it is including GST, the price is see this is including GST, the price has to be assumed as what? Including GST. Whereas related party no ITC, that means it is what? Excluding GST. So you have a price including GST, you want what? Excluding GST. So the GST element, what you are doing? You are simply subtracting. That's why the tax element 2000 you are subtracting here. IBM. Understand? So here in simple 25,500 is inclusive of GST. Whereas this 25,000 is what? Excluding GST. Sorry. This is excluding GST. Whereas 23,500, what they are saying like, this is including GST. So both are not comparable. This including GST value also you should make it as what? Excluding GST. So what is the GST element there? 2,000. If you subtract, it becomes how much? 21,500. Now both will become comparable. That's why the ITC element also we are subtracting. See, here you are purchasing. Here you are purchasing. To recognize as a credit, first it should be an expense also, right? ITC is a credit. But to get ITC credit, first you should have incurred a GST expense. You might have paid more GST amount, right? You'll get ITC only when you paid price inclusive of GST, right? When you made a purchase excluding GST, then there is no question of ITC also, right? I understood your way of interpretation also. Credit, it has to be something treated as discount only. But here the question is framed in such a way that they are considering it as like what? As an expense kind of only. Okay, I'm not denying or I'm not saying like your doubt is something invalid. That is a valid doubt. That's why I clearly wrote and explained even in the regular class also. Understand? Here they are thinking it as what? ITC as a credit only. You'll get credit. But first of all, once you pay more only, you'll get ITC. So once you are getting ITC now, you already paid more. Because tax element also you paid. Sir, unregistered person, registered person. From registered person, if I purchase, I have to pay more, then only I'll get ITC. Okay, so the 23,500, I'm getting ITC means what? I already paid more. Whereas from an unregistered person, if I purchase, I will not get any ITC. So I didn't paid more there. So here without GST, this one is what? With GST. So these both purchase prices we cannot compare. So to compare what? This with the GST element also we are want to make it like without ITC. So that ITC element of 2000, which is nothing but the GST element, we are subtracting. So that both are becoming like without GST. Without GST. ఇక్కడ అది మన పర్చేజా సేల్ అనే దాన్ని బట్టి ఉంటుంది. ఇక్కడ మనం పర్చేస్. ఓకే, అన్రిలేటెడ్ పార్టీ మనకి క్రెడిట్ ఇవ్వడు. అన్రిలేటెడ్ పార్టీ క్రెడిట్ ఇవ్వడు. రిలేటెడ్ పార్టీ మనకి క్రెడిట్ సరే ఇక్కడ పర్చేస్ మనకి ఇది. ఇట్స్ ఎ పర్చేస్. రిలేటెడ్ పార్టీ విల్ నాట్ గివ్ అస్ ఏ క్రెడిట్. సి విత్ ఎక్స్టెన్షన్ ఆఫ్ క్రెడిట్ రిలేటెడ్ పార్టీ. Yes or no? 90 days. Unrelated party, no credit offered. As a purchase, if you get credit, it's a benefit. It's a benefit. But you are here it is what? Without credit. You want to make it as what? With credit. So that's why what you are doing? You are adding it. అర్థమవుతుందమ్మా? మనం పర్చేస్ చేసుకునేటప్పుడు క్రెడిట్ మనకు వస్తూ ఉంటే ఎక్కువ పీరియడ్ ఉంటే మనకు బెనిఫిటే కదా. ఓకే, హియర్ వాట్? ఇన్ అన్రిలేటెడ్ ట్రాన్సాక్షన్ దర్ ఇస్ నో credit benefit. But here what? With, see, credit benefit, so forget about benefit or not. There is no benefit actually also. When he offers credit, he will charge more to compensate that. Okay, so here unrelated party charged less. Why? Because he didn't offer credit. Related party might have charged more because he has offered credit. So to make both of them comparable, here also we are adding what? Credit cost. So both became same. Cost of credit. Got the clarity right now? Okay. So IBM. So okay, you think of the questions once again, sir. Sir, in transfer pricing, your logic gets tested so many times. It's very common. If you don't get doubts in transfer pricing, then only you're having some problem. Okay, now, so it tests your logic, you test your common sense at many point of times. And that kind of questioning, if you're coming now, if someplace, if you're getting doubt now in transfer pricing, you're on the right track only, don't worry. And think of it the same way. Okay, after some time you'll get, or after multiple adjustments, or after multiple way of thinking that, you'll get some clarity, you'll understand the logic properly, then you can do the sums on your own also correctly. Okay, moderately. Not pakka, but moderately. Brain Incorporation, London has 35% equity in Salem Limited, associate enterprises. Company Salem is engaged in development of software and maintenance of customers across the globe, which includes Brain Incorporation. So Salem, Brain or associates. During the year, Salem spent how many man hours, sir? 2,000. Brain Incorporation, London has 35%. Okay. So now who is SSE? Salem is the SSE. So Salem Limited. It supplies. Salem is engaged in what? Development of software and maintenance of customers. So Salem is providing service to whom? Brain Incorporation. For providing this, Salem spent how many man hours? 2,000 hours. Okay. For developing and maintaining software, and build each hour at what? 1,000. So 2,000 into 1,000. So what is the total amount billed? 20 lakhs has been billed. The cost incurred is like what? Cost equals to 15 lakhs. Okay, done. Similar work was done for unrelated party, in which the profit has what? 50%. But here, sir, in previous question, if you see, 45% they said on operating cost. If nothing is said now, then it means it is profit on sale. So it's not, gross profit margin means usually margin on selling price, not on cost. So in the 12th question, they clearly mentioned it as on cost. That's why we took it as on cost. Here nothing is mentioned, so it has to be taken on what? Selling price. So the gross profit margin to be taken is 50%. Okay. Brain gives, sir, Brain Incorporation additionally, it gives what? Tech support also. This point is there even in the previous question also. Sir, understand, for normal outsiders, if they don't provide any tech support, you will expect how much profit margin? 50%. But this fellow is providing extra tech support. So obviously you will reduce price. When you reduce price, your profit margin also will get reduced. So that's why, to the extent of this tech support, we have to do what? Reduce. Understand, sir? Understand the point simply, sir? Sir, here, in the normal cases now, only money is the consideration. So obviously they'll have more profit margin. But here, not just the money, there is additionally tech support. Since you are getting a second consideration also, in the first thing you might compromise your profit. So to the extent of tech support, you are compromising your profit margin. So that amount we need to what? Reduce. So how much is the tech support related? Tech support to Salem, which can be valued at what, sir? 8%. So tech support equals to 8% of 50%, which equals to how much? 4% we need to subtract. Right? Then Salem gives, one difference, second one, sir. Salem Limited gives credit of 90 days, the cost of which is 3% of the normal billing rate, which is not given to other parties. Sir, understand? To Brain Incorporation, you given credit. Sir, when you offered credit, you will charge more. Your cash price will be more, credit price will be more. Credit price will be more. So to whom the credit is offered? Salem gives credit of 90 days of the normal billing rate, to which Brain Incorporation, which is not given to other parties. So it's not given to other parties. That means given to whom? Brain Incorporation. So Brain Incorporation is having more credit, 90 days credit. So for Brain Incorporation, you will charge more, charge lesser. Sir, others cash price. Whereas Brain Incorporation is what? Simple, sir. Here, Brain Incorporation has 90-day credit. Whereas for others, with credit or without credit? Without credit. So without credit, no. So this also we need to make it as what? With credit. So with credit, now whatever is the credit cost element that we need to add. That credit cost element, if you add, then you'll get. So how much is the credit cost element, sir? 3% of billing rate. So 50% into 3%, which equals to how much? 1.5%, which equals to 1.5%. So if you do, what is the total amount percentage? 47.5% is the arm's length margin. But this margin on cost or selling price? Margin on selling price. Okay. So now, how do we usually arrive selling price? Forget about this. The basic accounts formula we all learned somewhere in Inter or something. Cost plus dash equals to selling price. Cost plus equals to selling price. Yes. So here, sir, what is the cost? We already calculated cost. How much is the cost? 15 lakhs. And selling price, I am taking it as X. Selling price, I am taking it as X. So cost 15 lakhs plus profit equals to X. Agree? Cost 15 lakhs plus profit equals to X. X is what? Selling price. Sir, now we got already profit. Profit is what? 47.5% of selling price. Selling price what we have taken? X. So 15 lakhs plus 0.475X equals to X. Because this is selling price. This is profit is how much? 0.47.5% of X, nothing but 0.475X equals to 15 lakhs. Okay. Now, if you 15 lakhs equals to X minus 0.475X. So then 15 lakhs equals to how much, sir? 0.525X. Now, X equals to 15 lakhs divided by 0.525, which equals to 28 lakh 142. So this is the what? This is what? Selling price. Because X we got. This is what? Selling price. Ultimately we want what? Selling price only, sir. Okay. So actually it is almost 28 lakh 57,142. But for what value they have sold? 20 lakhs only, because they build 2,000 man hours at rupees 1,000, which is 20 lakhs only. But actually by following arm's length price profit margin, it has to be built at what? 28 lakh 57,142. So you build at a less amount, how much? 8 lakh 57,142. So that 8 lakh 57,142 we need to add what? To the total income. Understood, sir? Okay, it is there even in the handwritten also solved. See, Brain Incorporation, it was given even this cost plus profit equals to selling price. 15 lakhs plus 0.475 equals to X. 15 lakhs equal to 0.525X, and X equals to 0. So you got, okay. Sir, you can do much more quickly also. Okay, but I cannot usually process so quick. So that's why I took this X route only is better for us. Okay, even though we don't like X, but still we have to take here X. Understood, sir? Sir, here in answer they do much more simple steps, sir. Straight away they'll do. $15 lakhs divided by 100 minus 100%. Nothing but 15 lakhs divided by what they do. 47.5 is like on selling price, right? So what they do? 100 minus 47.5. How much? 0.525. 15 lakhs by 0.525 you do. Simply you will get that also. Okay, if you want proper logic and all, then this is the proper understanding. Okay. So this formula, sir, you may get confused. But this is like the standard route. Cost plus profit equals to selling price. We don't know selling price, assumed as X. Okay. So profit on selling price equals to 47.5. So we got everything. So the derivation also we got. Understood, sir, everybody? Clear now? We can proceed to next model. So where you got doubt previously? Credit period add chesedi. Okay. So simple, sir. These questions, most of the times, in classroom, since I'm explaining, you may get the logic. But this logic after 10 days, 15 days, again, you'll forget. It's okay. How it will retain so long means, when you are doing a question, you just put the logic, try to write it on the paper, then get the point. Then only when you understand selfly, you need, if you get convinced just because I'm saying, then afterwards, again, you'll get the same question once again, either in your revision or in the exam hall. So before going to exam hall only, try on your own, write the point clearly, what is the logic also. Okay, then it will be easy for you. Maximum అవసరం లేదు. So now we are moving on to the next method, resale price method. Sir, in cup method, what we'll do? Cup method, what we'll do, we'll take comparable transaction and we'll adjust the comparable transaction. In resale price method, what happens means, you import goods from your associate enterprise. That value, actually, that arm's length price we need. Okay, but what will take, those goods which you have purchased, again, you will be reselling, right? You will take the reselling price. Okay, you will take the reselling price. From there, you have to adjust the profit margin, not your profit margin. The normal, identical goods, in general, what is the profit? Your resale price only. To unrelated customer. Your resale price only you will take, but the profit margin, not your profit margin, you will subtract. The profit margin usually charged by others has to be subtracted. I mean, the comparable profit margin has to be subtracted. So you'll start with sale price. Now that's why it is called as resale price method. Okay? Whereas the previous method we are doing like what? Cost plus margin we are adding, right? So that's why it is called as cost plus method. Here we start with sale price. Sale price of whom? SSE sale price only we'll take. We'll take SSE sale price only. From there we have to subtract what? Profit margin. From there we have to subtract profit margin, not the profit margin of SSE. Profit margin in a comparable case, that profit margin will subtract and adjust for the differences. Same as like cup method only. Without freight, with freight. This also you make without freight. This also you make without discount. So those adjustments you do, then you'll get the resale, ALP under resale price method. Okay. Sir, read this question, sir. One correction in this question is like, here they'll write it as terabyte, make it is also as megabyte. Read the question and try to understand, sir. There's nothing great. I already said the points. What are the points, sir? You should start with what? Selling price of SSE. From there you should subtract what? Profit margin. Of whom? SSE's profit margin or comparable profit margin? Comparable profit margin you subtract. Then you'll get 2 or 3 points, just like as cup method, how the adjustments you do. Same here also, we need to do the adjustments. So start doing. So help me, sir, in writing the question. Sir, who is the SSE here? Who is the SSE here? Megabyte. Okay, R limited. R limited is the SSE. R limited. Okay, R limited gets goods from whom? Megabyte. So R limited and Megabyte are associate enterprises. So R limited supplies goods. Sorry, Megabyte supplies goods to R limited at what price, sir? At 7,500. But these two are associate enterprise. That is our problem. Then again, R limited sells these goods at what price? Resells at what price? 11,000. So we should start with what? 11,000. Then what is the profit margin here? 2 margins given or only 1 margin given? 1 margin only given. So comparable margin only given. So what is the profit margin? 20%. So first selling price now we need to, sir, we need to value this one. So our purchase price. So but we have is what? Selling price. So okay, we need to subtract all these extra costs and also to take it to the point of purchase. So first we should subtract profit margin. Minus 20% now how much? 2,200. Okay. Then what else is there? Okay. So there is a comparable transaction also. So in comparable, what is the case? Okay. So R limited comparable is with cold. Okay. With cold, what is the case? What are the functional differences? So okay, discount is the next difference. Okay. So we have two. Okay. One is like actual and the other one is like what? Comparable. Sorry. In actual, what is the discount given? In comparable, how much is the discount given? So what we have to do? Comparable also we should make it as like what? Sir, this is only comparable for us like. So here also we should make it like what? Sir, are you able to understand my point? Sir, here 11,000 selling price. From there you subtracted the usual profit margin of, in the industry, what is the profit margin or the general comparable profit margin subtracted. Now actually is how much? 1,500. Comparable is how much? 500. So comparable also you should make it as like what? 1,500. So how much? What do you have to do now? Extra 1,000 discount also you have to do. Subtract. Okay. Then what else is there? Freight. Freight. Okay. See. The freight and customs duty paid for imports from Cold Incorporation Poland as cost are limited. Sir, this actual is with a cost of how much? Okay, sorry, I understood. Actual is with a cost of freight of 200, whereas comparable is with a cost of how much? 1,200. Sir, discount is a benefit. Here freight is what? It's a cost related point. Okay, so comparable case, you incurred freight how much? 1,200. But in actual case, you incurred freight how much? 200 only. So comparable also you should make as if the freight is only 200. So what do you have to do now? 1,000 has to be subtracted. Sir, able to understand, sir? In actual case, you incurred only 200 freight. But in comparable case, you incurred freight of how much? 1,200. So comparable also you should make like what? As if the freight is only 200. So okay, in comparable also if the freight is only 200, then the difference what we have to do? Subtract. Okay, we have to subtract. Okay, the freight difference also subtract 1,000. So what is the total arm's length price? 6,800. Arm's length price is 6,800. What is the actual price, sir? So they should have purchased at 6,800. But they purchased at what? 7,500. So okay, they should have purchased at 6,800. But they purchased at what? 7,500. So what is the difference, sir, for each unit? 700 excess paid. So because of payment of excess, their profit have got decreased. Now with the transfer pricing adjustment, their profit will increase. So this adjustment can be done. How many units, sir? 700 into 3,000. So how many? 21 lakhs is the transfer pricing adjustment to be made. We need to add it to the total income. So understand, simple sir. First profit margin subtract, then actual 1500 discount given. In comparable only 500 discount. So comparable also how much discount we should give? 1500. So extra 1000 discount you need to give. So what you have to do? 1000 subtract. Then comparable transaction, you had a cost of 1200, but in actual you had a cost of freight cost of only 200. So you need to make even if comparable also with only 200 as the freight cost. So already 1200, right? So now what you have to do? The extra 1000 you need to subtract. If the extra 1000 if you subtract, you'll get the arm's length price as 6800. Okay, got it. Okay, sir. Question number 13 done, right? Now do question number 15, sir. Question number not 15, question number 16. Question number 16, sir. It's okay. So I don't want to waste your time. In 16 there is a mistake also. It's okay. So if you do conceptually what we did, it will be correct only. But if you follow answer, there is a mistake. It's okay. Do question number 16. Question wise correct only. In answer only they did wrongly. Arm's length price for you. 7,000. 7,000. 7,000. 7,000. How much you got? 7,000. It's okay. See, sir, again. So same way, just like as we solved the previous question. Help me. Who is the SSE, sir? Who is the SSE? Huh? Cool Air India. So who is its associate enterprise? Chill Corp. So now Chill Corp has supplied certain goods to Cool Air. So at what price it has supplied? 8,200. How many units? 4,000 units. Okay. Now, Cool Air supplies this time to resells, right? So, resells at what price? 12,000. Clear only, sir, till here? Okay. So, now, we'll start with what? The resale price. What is the resale price? 12,000. So, what is the profit margin here? 22% is given, one only given. One only given, that also how much profit margin? 25%. So, 25% means how much? 3,000. Fine. Then we have a comparable transaction also. So we have actual transaction and we have a comparable transactions. Now first tell each and every difference. First one. Discount. Actual how much is given? Actual 1800 is given. Comparable. So what we have to give? Extra 1100 discount has to be provided. So what we have to do? Discount. Subtract 1100. Clear? Then this is what discount part. The next one is what? Freight, right? Okay. Freight. Actual what is the freight paid? Actual what is the freight paid? Comparable what is the freight paid? Actual or comparable? Actual 1400 paid. Comparable? 500. So if actual is with 1400 paid, comparable also we should make it like what? With 1500 right? Sir, sorry, same with 1400 right? So what we have to do? We have to subtract freight, add freight. Sir, able to understand? So compare it with the previous question. We need to what? Sir, our actual transaction is with 1400 freight. You incur more expense. But whereas comparable transaction is only with a 700 freight. So even comparable also you should compare as if there is 1400 freight. So what do you have to do? Add. Previous logic first you understood. Discount what we added? Sir, here actual is how much? 1500. Go back to previous question also. I know here there will be confusion and all. That's why I'm taking time. I'm asking you to solve also. It's okay. So actual in previous question. First, if you have clarity over the first question, then you'll get the second question also rightly. So what is the first question, sir? Megabyte incorporation. So in Megabyte, what is the selling price we have taken? 11,000. What is the profit margin you have subtracted? 20%, which is how much? 2,200. Okay. Then what is the discount, sir? In actual transaction, how much is the discount given? 1500. Even in comparable transaction also, how much discount should be there? 1500. So extra 1000 we have subtracted. Okay. In actual transaction, what is the freight? 200. In comparable transaction, it is what? 1200. In comparable transaction, it should be 1200. So that means in comparable transaction, already more freight booked. That's why what we have to do? We have to subtract the extra freight. So extra freight 1000 we have been subtracted. So it is what? 6800. Understand, sir? Sir, how we know that extra profit? Sir, this 20% is comparable only, right? So this 20% profit, why we got? This 20% profit is because of booking 1200 as expense. If you book only 200 rupees expense, then the profit margin should be what? Much more, right? So that's why what you are doing, this freight also you are, extra difference also you are subtracting. Now in the current question, this is exactly opposite, freight point. That's why what you are doing? Adding. So there is nothing here. In actual transaction, only 200 rupees is the freight provided. But in comparable transaction, how much freight is already provided? 1200. So you should not provide 1200. Okay, to make them comparable, how much you should do? 200 only. So extra already 1000 provided. Now, so such freight, what you have to do? Subtract. Such freight you are subtracting. Understood? First question is it clear? Now second question, sir, only this point is a difference. Freight what? Here 1400 is the actual case. Whereas in comparable case, how much? 500 only. So extra freight, how much has to be taken? 900 extra freight has to be considered. So that's why 900 freight has to be what? Added. 900 freight has to be added. Okay. So this is a workbook question. In this question itself, answer framing itself, there is a mistake. Okay. So obviously you have some 1% doubt on me now. So I'll prove you. CMA final workbook. Sir, one is sure. Either first question should be correct or second question should be correct. That is for sure, right? Okay. See, this is the cool air. Cool air, chill corp, this one. So what they did, they have subtracted 900 here. Just like as what we are given in the book, they also subtracted what? 900. This is what chill corp question. It is given in what? Workbook. The next one, sir, it is a MQP, right? June 25 MQP. So it will be under 7B or 7A. See, it's okay. They kept the question as like megabyte. Instead of megabyte, terabyte of France, India are associated enterprises. R Limited imported 6,000, price 6,700. And these are sold to at cooling solutions at a price of 10,000. R Limited also has imported similar with a gross profit margin of 20%. So first from 10,000, what you have to do? 20% margin. Terabyte offered a discount of 1,000, whereas gold offered only 500. Sorry, in comparable transaction only 500 discount. Whereas in actual transaction, how much is the discount? 1,000. So here also what you have to do? The extra 500 also we have to subtract. Then the freight and custom duty for imports from gold limited is 1,200, whereas in respect of terabyte it is only 200. Same exact point which we have in the question. So now what you did see? Difference in purchase price. Here also 1,000 has been subtracted. Okay. So the same point, you could understand, right? There is mistake at one place. That mistake is only in workbook question only. So that's why what is the question is wrong? Which question is wrong, sir? In our question number 16. So in 16, correct it what? This 900 need not to be subtracted. This 900 has to be added. So if you add 900, what happens? How much, sir? Huh? 8,800. 8,800. Actual purchase price is how much? 8,200. Whereas arm's length price is how much? 8,800. Sir, you purchased for actually how much? 8,200. But as per arm's length price, you should purchase at what? 8,800. So if you take ALP, your cost will increase. No increase in total income because it reduces profit. Conclusion also, strike option. So okay, it's been a conflict even for me also. The first batch, I thought like the same explanation. But then again, when doing regular batch, Prabhakar, let me explain you the approach. Sir, his version is like, sir, so in your version 13 will be correct or 16 itself will be wrong. That is his understanding. So let me give you my explanation. Sir, we are taking, so his question, see, sir, expense already booked for 1,200 in comparable, due to which profit decreased. Yes, I'm also agreeing with this. So Prabhakar, your statement tells our expense already booked for 1,200 is comparable due to which profit is decreased. So from that you put a full stop, right? From there then, so that sentence, that part I'll not agree. See what, sir. So here freight they charged more. Because of they charged freight more, their profit is only 20%. If they have charged less freight, their profit will be much more or decreased. Sorry, I understand my point, sir. Sir, they charged 1,200 freight. With 1,200 freight only, their profit is how much? 20%. If it is only 200, now the profit percentage will increase more or decrease? Will increase. Sir, profit has to be increased. Okay. So when profit has to be increased, I also agree. But we are doing reverse way. Selling to cost we are coming, not cost to selling. When you are going from cost to selling, then the difference has to be added. But here we are coming from what? Selling to cost. Understand? Sir, if you add that one, sir, here instead of 20, you should take much more percentage. Sir, are you able to understand my logic? Actually, with the 1,200 freight, their profit is less. If the correct profit might be 23% or 24%, that means they should have subtracted how much? 23 or 24%. We, instead of calculating that extra 3 or 4%, straight away we are subtracting this 1,000. Straight away we are subtracting this 1,000. Are you able to get my point, sir? Sir, again, I'm understanding for everybody. By charging 1,200 freight in comparable case, their profit got decreased. That's why they charged only 20% profit. If it is only 200, then their profit might be much more than 20%, maybe 23 or 24%. But we subtracted only how much? 20%. The extra 3-4% we have to subtract, right? What is the equivalent of extra 3-4%? This 1,000. So that's why instead of calculating that way, we are calculating the extra 1,000 rupees also. Prabhakar, are you able to get the clarity now? So everybody, all of you, convinced? It's okay. So the problem with the transfer pricing is this kind of questioning will come even in exam also. So unless you practice each and every question just like as a Sudoku. You know Sudoku? The number boxes will try. So every question is like, every box is like a puzzle. Just because you practice the 20 puzzles, the 21st will not, you may do fast, but still there might be some questions and all will be there. So every question you need to take like afresh only. Just read the concept every time you do the question. So once you get the clarity, okay, in the sake of getting clarity, people start doing now more questions. Not required to do CA questions and all. I already went through all the CA final study material for transfer pricing, because for transfer pricing already how many 3 7 marks questions may come. So there is high weightage chapter. So I already referred to the CA final question also wherever it is needed from the CA final study material, which I thought this is not of the model which we don't cover in CMA final. So those questions I already included. You could see already question number 15 or something will be from CA final study material only. So going forward also you'll see another 3 or 4 CA final study material questions only. So you need not to again solve other materials and all also. But by solving each and every question, make sure your logic is correct. Right? Put the logic on paper and make sure that you yourself first convinced with your logic. Where all convince our first nee logic to no clarity ka convince ayunte, then you will not get confused again and again. So you'll stick to the point and you can do the sums. Okay, when you are not clear with the logic which you have did, then the same question will come again and again in the exam. Okay. Sir, and I also know I may do something wrongly. So all the transfer pricing chapter, when I am coming to class, before coming to class, I solved each and every question once again and then only I am coming to class. Okay. So because even I did multiple times, this is logic which I have to do just now. Okay. So just because I have past knowledge or I know income tax other provisions, that does not impact anything here. It's purely about how we understood the selling versus selling price cost, how it is impacting the profit and all. This is basic general understanding or common sense only. So you need to practice, and every time when you practice, you just test the logic whether your logic is correct or not. But if you do this multiple number of times here, exam day, on the exam day, early morning you sit for 1 hour and every question you could do simply also. Okay, simply whether your logic is correct, every question you can solve it in 2-3 minutes only. Because you will take the price, you will add 1 or 2 items, 2-3 minutes itself you can solve the question. The whole ALP computation, there are 15-16 sums. All those sums you can do 15 into 3 minutes, 45 minutes you can solve each and every question also on the day of exam also. So 10 o'clock your exam, right? 9 o'clock you start assume. Okay, morning 5:30, 5 o'clock you'll wake up. So there first if you start also you can cover the transfer pricing provisions. Okay, so if you practice now more, exam day you'll save much time, because here nothing to remember more. So only applying the logic. Once your logic is correct, there's no chance of doing a mistake. But other chapters and all, sir, we need to remember so many provisions. Tax rates we need to remember, conditions we need to remember, limits we need to remember. Okay, but still this is risky only. Unless you practiced 2-3 times before the exam, and day before exam also your logic which you said became old. So once again on the day of exam or day before exam you need to once again go through it. So then you can get full marks. Okay, so in a hurry mode never you can solve transfer pricing question. So that means usually you have to start these questions, not the first question also. It shouldn't be the first question also, because sometimes if it is the first question itself may go wrong, then your total confidence will fall. So that's why first better to start with a DDA question, or to start with a tax planning question, or if advanced tax question comes now, then with advanced tax question. So start with one question, then take the second question as the transfer pricing, so that you'll have time to think also 1 or 2 times, and you're not even a rush also. So in the earlier hour only you'll be completing. Okay. So the problem with transfer pricing is like you don't even realize you are doing mistake. You don't even realize you are doing mistake. So you feel like your logic. So that's why like this you write a table also. So in actual what we did, comparable what we did. Okay, what has to be done? So okay, in all the 3 methods, sir, we are following only one logic. What? We are making sure the comparable we took also see on the same grounds like actual. So this table kind of thing is common in all the 3 methods. Comparable price method, you are starting with a comparable transaction. Cost plus method, you are starting with a comparable profit margin. With that, you are doing adjustments. Third one, resale price method, you are taking a comparable resale price, subtracting the comparable profit margin. Then again, same you are making the comparable online or in line with the actual. So everywhere there is almost same kind of logic only. So for every functional adjustments, you make a adjustment table kind of. Actual what we did, comparable how much. So to make the comparable also actual, what we have to do. Okay, it makes simple our answer. Understood, sir? Sir, most of the times in the easy questions only you lose more marks. Or easy questions are which you target and go for exams only, many students losing marks. Okay, in the complicated questions which you think only you are getting at least 4 or 5 marks. Okay, so these kind of questions are the problem here is like if you do one particular mistake you may lose the total marks also. Okay, so practice 3 or 4 times the transfer pricing questions. Don't look at the answer. Just solve the question and every time write your logic clearly and solve the question so that logic remains with you. You will not get confused. Or so many times, even in your preparation also some other person will come and ask it out. Then again your logic gets tested. So every time you put it on paper and try. So okay, then your logic will have grounds. If you just keep it on your mind only and test then that will get shuffled and all again. You will be into that loop. There are high chances of, the only problem with transfer pricing is like getting confused. Okay. And we don't even know. For some student, it feels like a simple point only, why he is explaining this much also. Okay, so in a class of 50 or 100 students, for some students, they can easily catch, and why he is doing this much thing and all, what is that of? Okay, he's good at understanding the issue, so he'll do that fastly, like Maulia. Whereas some other students may take time. It's okay, the problem with logic is always the same thing, sir. Some people will understand quickly, and some people will not understand. May take time. Just because he got the logic in 1 second now, there is no certainty next time he'll get it in 1 second only. So unless you do or put it on paper, you'll not get it. Okay. 14, sir. It's a June 2025 exam question. Okay. So with the same understanding till now. So maximum resale price method. Any student who went to June 2025 exam, he know how, to the extent how you know till now. So okay. So June 2025 question is something they framed little newly. So, okay. So think of the question number 14. Don't look at the answer and figure it out how you could solve. Sir, what is the new point here? 3 profit margins are given. Then what to do? We'll take average at the margins itself. So we have discussed something like range concept. There we'll take mean of arm's length prices or mean of margins itself. Mean of arm's length prices. So average is correct only. Don't take the average of profit margins itself. Take 3 arm's length price computations you make. So like what is the resale price, sir, here? 40,000, 40,000, 40,000, 40,000. From there, in one case subtract with 15% margin, second case subtract with 23% margin, third case subtract with 19%. So you'll get the same thing. But computation wise it is, okay, computation wise we don't have, see, something we are doing now, it has to be set by the provision, right? We cannot do on it our own. So the provision says like, you can take the mean of arm's length price only. You cannot take the mean of profits. Okay, so you say, okay, if I correct your paper, I think like it is correct only now ultimately. But there is no certainty that a tax expert only will correct your paper. The paper correction will be done by a CMA. He may know tax well, he may not know tax well. Even though he know tax, he is a practicing chartered accountant. He know much about PGBP provisions, TDS provisions, deductions, but not about transfer pricing. So obviously what he will do? As per the key, whatever is there, that only he'll think. Okay, but what you did, instead of taking the average of ALPs, you are taking the average of margin itself. There is itself, you're losing the marks, right? So what the provision said means, don't take, the provision said like take the average of ALPs when they are less than 6. When they are less than 6. That's why you compute first 3 ALPs separately. What are the 3 ALPs available, sir? First one is how much? 30. Second one? 30. 30,800. 32,400. There are no other functional differences given, right? So we'll add all the 3 and divide it by 3. How much is the 32,400. So arithmetic mean is how much? 32,400. Whereas here is how much? 40,000. So what is the sir, you should have purchased at 32,400 only. How much it is? I didn't understand. What is the ALP? Okay, so then what you are saying? Okay, wait. Ashish Limited purchased at 35, correct. Okay, it actually purchased at 35. This is what sold them to distributors at 40,000 is the resale price. We want to compare it with the purchase price. So 35,000 is the purchase price, but whereas actual purchase for 35, but they should have purchased at only how much? 32,400. How much extra paid? 2,600. How many units? 2,000. So what is the total? 52 lakhs. So what we have to do this 52 lakhs? Add to total income. Got it? Okay. So now read this question also. Sir, again, this is a new question, but with the concept knowledge we have, it's enough to solve the question number 15 also. Yes, Rohit, you are correct. Solve question number 15 also. Sir, what is the resale price? It sold goods of Sun PTE for 20 crores. Sir, actual their resale price only has to be taken, not the comparable resale price. So what is the resale price? 20 crores. Okay. But profit margin, again, 2 margins given. Which margin has to be taken? 15 and 20. Which has to be taken? 20%. So minus 20%. How much? 4 crores. This is clear, right? Now, what are the other differences? After sales warranty of 6 months was provided by Sun, whereas Oceania gave sales warranty of 1 year. So, in actual transaction, what is the warranty? 6 months. In comparable, what is the warranty? 1 year, right? Actual, the warranty given is what? Sun PT is the actual associate enterprise, right? In actual transaction, warranty is for only 6 months. Whereas in comparable transaction, the warranty is given for how much? 1 year. So this 1 year also you should make it as like what? 6 months. So this 1 year also you have to make it like 6 months. So what is the impact of that? The cost of warranty may be taken as a 2% of the sale price. So 2% of the sale price means how much? 2% of the sale price. What is the sale price, sir? 20 crores. 20 crores into 2% means how much? 40 lakhs. But sir, this 2% is for the total warranty. 1 year warranty. But here the difference is only how much? 6 months. So we need to do how much? 1 by 2. Okay, 1 by 2. So how much is the, sir, comparable as warranty cost of how much? 1 year. So we should make it like what? Rohit, you are doing what? You are applying 2% on. Have you got 16 lakhs? Okay, that's your total arm's length price, huh? So, okay, so let it be. So 20 crores into 2%. Till here you understand, sir. What is the extra credit in comparable transaction is how much? 20 crores. Oh, sorry, 20 crore into 2%. So 40 lakhs into 1 by 2 we have to do, because we need not to remove the full credit impact. Only 6 months late impact we need to reduce. So 40 lakhs into 1 by 2 now minus 0.2. Minus 0. So comparable also we need to make it on par with the actual. Then your next. Sun Limited has brand value known, and the benefit of brand value is 1%. Sir, who has brand value? Sun has 1% brand value. Comparable has no brand value. So comparable also you should make like what? With the brand value. Sir, with the brand value more price, without brand value more price. With the brand value more profit margin. So to increase, sir, here comparable transaction is what? Without brand value. So we need to make it like what? With the brand value. So this difference what we have to do? Add. Are you able to understand, sir? Comparable is without brand value, whereas actual is with brand value. No, comparable also you make it like what? With brand value. So add how much? 1% of sale price. So 20 crores into 1%. How much, sir? 20 lakhs. Okay. So 0.2 you will add and 0.2 you will subtract. So total arm's length price will become how much? 16 lakhs. Sorry, 16 crores. So this actual versus comparable, you write and check, sir. It's okay. So now with this we have completed even the resale price method also, sir. None. Then we are going on to the next method, profit split method. Profit split method. Fourth method. Sir, these will be easy only, sir. Only those 3 methods are complicated. The profit split method we have 1 question. Transaction net margin method 1 question. This will not test our brain much. Cup method, cost plus method, resale price method. Those 3 only will confuse you. The next, from here onwards, the chapter will be easy only. Okay, the complicated part of the chapter is completed. With those 3 methods only, you will get multiple times this character, that character, that confusion will come. Okay, and understand, sir, again, even if you have issues also, from transfer pricing, how many questions I said? Like 3. From these methods only 1 7 marks will come. There are the other 2 7 marks which are not linked to those methods. Understand? So this 1 7 marks only you have an issue. That also 90% of the cases you may be correct only 10% chance you taking a wrong logic. And the other 2 7 marks are not related to that one. So it's completely easy only, the straightforward only. If you know the concept, you can do the question. No logic, no common sense, nothing, no baggage needed. Profit split method. Okay, profit split method applicable where the associate enterprises operate together like a joint venture. Okay, so I mean, one part will be manufactured by subsidiary, the others will be manufactured by holding company, and together they sell the product. Okay, in such cases, applicable mostly where the associate enterprises operate together like a joint venture. It is most appropriate for determining arm's length price in case of intangibles. Okay, so calculate what we have to do first. Calculate the total profit earned by the group. Then divide the profit between associates based on different parameters, whichever is relevant for that particular business model. It may be manpower, if it is more of manpower oriented. Maybe functions performed. Functions, now there could be many functions, sir. Research function, development function, manufacturing. So there could be many things. And the next one, risk taken. Okay, so any parameter which depends or which is specific to that of business can be taken. Based on that, the profit has to be apportioned between them. So this is called what? Profit split method. So we'll take cost and the profit split. Whatever is the profit share we got, that we'll add. We'll be getting the arm's length price. So there is a question on this. Question number 70. Inditech Limited is an Indian company, designs and develop a solar power drone. Solar power drone. It's Singapore subsidiary. Sir, Indian company, what does it manufacture, sir? Solar powered drone. Its Singapore subsidiary develops advanced navigation software that integrates with the drone. Sir, without a software in the drone, we cannot control the drone. It's okay, we cannot know like where the drone is moving or which direction the drone has to move. So to control all that, a navigation software has to be done. Or else, sir, these days many attacks are happening only with drones only. Ukraine did that, Russia did that. Now Iran is doing with those drone attacks only. So how the drones will operate? Mostly they set a target, prefix a target, and the drone will go to the target by fixing the navigation. Right? So most of the drones are not being operated through remote, because they have to travel kilometers, so the signal cannot be connected. So mostly the drones nowadays are like what? They'll put a target location there. Once you fix a location there, it will directly navigate to that particular location. So for this, what happening? Hardware will be manufactured by Indian company. The navigation software will be manufactured by Singapore company. So both cannot be sold separately. Without the software, the drone hardware is irrelevant. Without the drone hardware, the software is also irrelevant. So they are selling together as a joint venture only. Inditech manufactures and supplies the drone hardware. Inditech manufactures all the hardware needed, like those fans, a camera needed, all those things. And then Skytech integrates the software and the final product is sold to unrelated customer. Due to uniqueness of the technology, no direct comparables exist. So traditional methods like Kappu, TNMM are not reliably applicable. However, comparable market return for routine manufacturers without intangibles. Sir, here software intangible element is also there. But if there is no intangible element, only manufacturing considered, usually manufacturers and how much returns are 12% on manufacturing cost. So here given. Sale value is at 3,000 each drone. But manufacturing cost to both. For Inditech 400, Skytech 500. Development cost for Inditech 150, Skytech 100. Operating cost 100, Skytech 200. Total cost here 650, here 800. And the gross profit they got is how much? 1550. So this profit we need to apportion it. Okay, first. The hint given in the question, first hint is like, they have, the routine manufacturers will expect how much return? 12%. First, for them also, for both of these also, based on their manufacturing cost, will give 12% return first. So 400 into 12% means how much? 400 into 12%, 48. 48 for Inditech. 500 into 12%, 60. So first out of the profit, out of the total profit, for their manufacturing element, we already shared the profit. 48 for Inditech, Skytech for 60. Total how much, sir? 108. So out of 1550, we already apportioned how much? 108. How much is the balance to be apportioned? 14? 42. Sir, here, manufacturing cost already considered. Now out of the other two costs only, something has to be taken base, right? So which could be the most reliable thing considering their business to apportionate profit? Sir, here two other costs are there, right? Out of these two, which could be the significant one here to take as a base for apportionate or for splitting the profit between both? Sir, development cost or operating cost, which is significant? Sir, it is a normal company or something different? What the business they are doing is like a normal business or something different? Different only, right? Which involves what? Technology oriented, right? So technology oriented, now most important thing is what? Development. So which could be taken as a base? Sir, operational cost will be there for everyone. But for them, which is more significant? Okay, the driving factor for their business is the development, not just operating. So the driving factor here is what? Development. So development can be taken as a base to split the profit between both the entities. So how do I know if they ask a different question? Then again, you need to understand that, understanding the question, you need to take a call, which is significant. Understanding, sir? Okay. So now, what are the parameters, sir, for Inditech 150, Skytech 100? So that means 3:2. The ratio of apportionment of profit would be what? 3:150:100. 150:100 divided by 50. 3:2. What is the ratio? So now, apportionate this 1442 in the ratio of 3:2. 865.2 here. 576.8. So we want ALPs. Sir, what is their total cost here? 650 plus 48 plus 865.2. 48 based on manufacturing we apportion. Then 865. 1563.2. Here 860, 576. 14.8. 1563.2. The other one they didn't calculate it because they wanted only for Inditech, because Inditech is what? The Indian enterprise. So only for Inditech they have calculated. The other one they left. For Inditech how much? 1563.2. It's so simple, sir. The profit, since they given a hint like manufacturing sector usually expect 12% on their cost. So on manufacturing cost you apply 12%. So a part of the profit is already apportioned, but still there is significant profit. How that has to be apportioned? So out of the other two costs, which plays the significant role depending on the business development cost. So take that as a base and split the profit between both the entities. యాక్చువల్గా ఒక నేను కామెడీ సీన్ చూసాను. దాంట్లో వాడికి స్టోరీ ఎంత చెప్తాడు ధర్మవరపు సుబ్రహ్మణ్యం చెప్పి, సో అలాంటివి చేస్తే గూట్లే అంటారు అంటాడు. సరే అది మొత్తం వదిలేసాడు, గూట్లే అంటే ఎవరని అడుగుతాడు. ఇలాంటి పనికిమాలిన క్వశ్చన్లు అడుగుతారు చూడు. నేను విన్నానట్లే. బట్ నేను అక్కడ చెప్పింది ఓకే ఎమోషన్. నువ్వు దాన్ని నిజంగానే తీసుకొని అడవుల్లో ఎగ్జామ్స్ ఉంటుందా, కరెంట్ ఉంటుందా, ఇంటర్నెట్ ఉంటుందా అంటే నాకు మాత్రం ఏం తెలుసు చెప్పు. అండమాన్ నికోబార్లో అయితే ఉంటుంది నాకు తెలిసి. అస్సాం అంటే ఇట్స్ ఎ స్టేట్. సో దెర్ ఆర్ మెనీ towns, cities within Assam. So there might be there is a center, but we don't know. We cannot say it's like in Assam state it is. Maybe it's in capital Dispura or else like some other place, we don't know. So I used to have that also. So ప్రతిసారి ట్రిపుల్ ఎలాగ వెళ్ళాము, సిఎఫ్ఐలో ఎలాగో అటెంప్ట్ రాస్తున్నప్పుడు ఒక చోటకి వెళ్ళిపోయి రాస్తే బెటర్గా ఉంటుంది కదా అనిపించింది. అవలే. సో బికాస్ అక్కడికి వెళ్ళిన తర్వాత మనకు కావాల్సిన లాజిస్టిక్స్ అవన్నీ ఉండవు, బుక్స్ అన్ని మోసుకొని వెళ్ళాలి, స్టడీ అవర్స్ ఉండవు, హాస్టల్ ఉండకపోవచ్చు, లేదా రూమ్ దొరకపోవచ్చు. ఇవన్నీ మళ్ళీ టైం వేస్ట్ చేయాలి అని చెప్పి కన్వీనియంట్ విజయవాడ అని చెప్పి మళ్ళీ లాస్ట్కి వెళ్ళి విజయవాడలోనే ఉండొచ్చు. So then we have one more method called transaction net margin method. When transactions are more reliable at net profit level than gross margins, will go for transaction net margin method. So take cost and add the net profit earned by other players in the same industry or similar with same or similar consideration. Add that, you'll get the ALP. Okay. So we'll solve a question, sir. Question number 18. Andes Incorporation, having its business in Malaysia, has advanced a loan of 1,60,000 to Andes Limited India. Book value of total assets of Andes was 125 lakhs. Andes Limited provides software. Sir, how much is the total assets value, sir, here? 125 lakhs. How much is the loan provided? Okay, their currency is like what? MDM. It's okay, 1,60,000. What is the 1 MD equals to how much, sir? 45. So 1,60,000 into 45, you do how much? 72 divided by 125 lakhs into 100. 57 point. So which is more than or equal to 51%. So both of them are what? Associate enterprises. Andes provided software backup services to Andes Incorporation. Okay, so the Indian entity is providing what, sir? Software services. For this, Andes has spent 50,000 man hours during the financial year for the services rendered. The cost of Andes Limited is like how much? 75,000 Malaysian dollar per man hour. How many man hours spent, sir? 50,000. So what is the total cost? 50,000 into 75. It's okay. 50,000 into 75 into how much is like 1 Malaysian dollar? 45. Total how much, sir? 50,000 into 75 into 45. So the cost for them is how much? 16? 50,000. What is the selling price? Actually, they booked. Andes Limited has billed Andes Incorporation at what price? 90.75. So 90.75 now 50,000 into 90.75 into 45. 20 crore 41 lakh 87,500. So what happened? For the Indian entity, cost is this. They booked 20 lakh 41,000 87,500. So our problem is what? Whether this 20 lakh 41,000 87,500 is ALP or not, is a arm's length price or not, or we need to find out whether the selling price is correct only or something, some profit appropriations or transfers or profit adjustments has been made or not. We need to check. Okay. Now what they given? Similar business model provides software backup server to Olive Incorporation in Malaysia, Gamas Limited. Their cost and operating margins are how much, sir? Their direct and indirect cost total how much, sir? 800. What is their margin? 200. So what is their profit to cost margin? Because the comparable, we don't have sale price. So we have cost plus margin. So we are getting the operating margin on cost, not on selling price. So 200 by 800 is how much? 25% on cost or selling price? On cost. 25% on cost. Sir, what does transaction net margin method say? You take the actual cost and add net profit earned by other players in the same industry or under same or similar consideration. So what is the similar profit earned in other industries, sir? What is the profit percentage? 25%. So to our actual cost, add the comparable profit margin. So 16 lakh 87 lakh 50,000. For that, add how much? 25%. How much it equals to? 16 lakh 87,000. Sorry, 16 crore 87 lakh 50,000 plus 25%. 21 crore 9 lakh 7,000. 37,500. Sir, you should have sold ideally for what price? 21 crore 9 lakh 37,500. But for what value you sold? 20 lakh 41,000 87,500 only you sold. I mean, because of selling at a lesser value, your profit decreased. Now by doing transfer pricing adjustment, your profit will increase. So you can do the transfer pricing adjustment. How much, sir? 67 lakh 50,000. So transaction net margin method is simple. Find out our actual cost, add the comparable transaction related profit margin. That itself is the arm's length price. For the actual cost, if you take the comparable profit margin and add the comparable profit margin on cost, because you are adding it on cost, so you'll get the selling price, arm's length selling price. That compare with your actual selling price, the difference you can take it as the transfer pricing adjustment. So this we already explained, sir. Once again, determination of ALP by AO. AO shall determine ALP based on information available with him if he is of opinion that. AO shall determine ALP based on information available with him if he is of opinion that what? SSE fails to compute arm's length price as per appropriate method. Sir, cup method is there, but still he ignored cup method and went to profit split method or TNM method. Sir, out of all those, first cup method is only more reliable. So since he didn't calculate it as per most appropriate method, AO can redo. Data used is not correct. The comparable transactions or the comparable margins, functional differences, the data is not correct. Then AO can do what? Redo. Relevant documents. He did correctly only, but to verify that relevant documents are not maintained. So how do we know first he did correctly? That's why relevant documents are not maintained. That's why AO can recompute. Then AO fails to furnish documents. He said like, sir, I have documents. But when he is asking, AO is asking, he's not providing. So again, also again, AO can recompute. On giving OBH to SSE, AO shall determine ALP. ALP determined by AO. Okay. once AO determines the transfer price, sir, then for the adjustments, the income of other entity, not Indian entity, the other associate enterprises will not be recomputed. They will be like as it is only how they are before. But for the Indian entity, we need to do adjustment, but no 10A deduction will be given, or chapter 6A deductions also not available for that increased incomes. So the increased income will be taxable. But on the increased income, even though you are an exporter unit located in SEZ, still you cannot avail any 10A benefit or any other 80 chapter 6A related benefit. Okay. Then reference to TPO, transfer pricing officer. Sir, here if you see the hierarchy, sir, income tax, AC, assistant commissioner. Below AC there will be inspectors, assistant commissioner, deputy commissioner, joint commissioner, additional commissioner, commissioner. Then from commissioner above, principal commissioner, chief commissioner, principal chief commissioner. This is the hierarchy. Okay. So what is the hierarchy, sir? Assistant commissioner, deputy commissioner, joint commissioner, additional commissioner, commissioner, principal commissioner, chief commissioner, principal chief commissioner. Okay. Parallelly for these people, sir, even director generals also will be there. Instead of commissioner, director general of income tax, principal director general of income tax, chief director, director general, principal chief director general. Okay. So now AO with approval of commissioner of income tax or principal commissioner of income tax refer the case to transfer pricing officer when where SSC agrees that ALP computed by AO. Sir, AO computed an ALP, but SSC is saying like what? This ALP I will not accept. Sir, SSC is saying like what? That ALP he is not going to accept. Then, sir, you calculated. You are saying like what you are calculated is correct only, but AO is saying like no, there is a comparable transaction. You have to do like this, and he is doing some addition. That addition you are not accepting. Then the matter can be referred to whom? TPO. Now what is the TPO has to do? He calls SSC to provide evidence or computation. Okay. Where any other, sir, in the process he found out any other transaction, consider that other transaction also for adjustment, even though that was not referred. But in the process of finalizing these points which has been referred, he found out some other transaction. Even though that other transaction not referred, he can take up and do adjustment for that also. Then he'll pass an order for ALP. Once he pass an order, that order is binding on AO. AO cannot say like, no, you took some money from that SSC, that's why you are giving like this order. AO cannot say. Okay, AO has to bind to the order given by transfer TPO. Okay, in case assessment is stayed by any court, and after the stay, sir, for carrying out this assessment, in the process of assessment, the case has been transferred to TPO. Now TPO has to carry out that. But in between, the court has stayed the proceedings for some time. After removal of stay, the TPO to complete the assessment, to complete his order, the time remaining is within 60 days. Then what they are saying like, then the time limit can be extended by another 60 days. Sir, these time limits and all will get in assessment procedure chapters. Okay, there it gets again connected. Okay, now here there is an amendment, sir. ALP determined by TPO can be applied for next 2 years. Sir, every year, why the same case has to be sent to TPO? Once ALP fixed, sir, let's say for assessment year 25-26, matter went to TPO. Now TPO has fixed something as ALP. That ALP itself can be taken as or accepted as ALP by SSC also for the coming 2 assessment years, for assessment year 26-27 and even for assessment year 27-28. See, previous year 24-25, assessment year 25-26, case referred to TPO. TPO decided ALP. Now usually ALP applies, which is decided only for that previous year and assessment year only. But amendment says what? It can be applied even for assessment year 26-27 and even for assessment year 27-28. Why? To reduce the work burden on TPO. Otherwise, every year you will be referring to TPO. Again, he has to recompute. So once he do and finalize something as ALP, that can be used not only for that year, for the coming 2 years also. But SSC has the option to choose for both the years. If option has to be exercised by filing in a prescribed form with TPO. TPO confirms in writing with 1 month from end of the month in which option is exercised. Okay. So it's not like compulsorily you have to take that one. You can differ also, but you have an option to take it. Sir, why option? To avoid future litigations at least, you can accept that only as arm's length price in the next 2 years also, but that is completely optional, not mandatory. SSC has the option to choose for both the years. Option has to be exercised by filing in a prescribed form. TPO confirms it in writing within 1 month form whether such option he asked has been exercised or not. Okay. The option cannot be applied in case of such. Okay. If already any such has been initiated and all, or during the such process, the case referred to TPO, then this option is not available. Now we are moving on to APA, Advanced Pricing Agreement. So you are doing international transactions, sir. You thought whatever the pricing you did is correct only, everything. But you're not sure. If AO comes in next year and may say like, what the pricing you did is wrong, you are diverting the profits, and he may suggest some other price. Because of that, your profit will increase. You need to pay extra taxes and all. All this is a extra burden, dispute thing and all. So now now itself some clarity. What is the department opinion? What view they gonna take? Okay. So now first itself you will ask with them. Okay, these are the transactions I'm gonna do. You fix and tell me the arm's length price. Okay. Now first itself when you fix the arm's length price before entering into an agreement or in the course of the agreement process, if you go with the department and fix a price as ALP, then that is called as advance price agreement. In advance only you are agreeing for a price. Advanced pricing agreement. So you are agreeing for a price in advance. Then that's why it is called as what? Advanced pricing agreement. So CBDT with prior approval of central government enter into APA to determine ALP or to determine in manner in which it shall be determined. So what it can be done? It can determine the ALP and tell. In the APA itself, they can fix on ALP price. But there may be changes, right? Every year they may not be the same things. The raw material cost, all these things will be changing. That's why instead of fixing the price, they may tell the process of determining the ALP. That process itself also can be given. So determine the manner or directly the ALP. Okay. So now you want to apply for APA. In which form you need to apply? Form 3CEE. Form 3CE is the form to apply for APA. Fees for entering into APA. Where the total international transactions you want to enter are within 100 crores, then the fee you have to pay is like how much? 10 lakhs. 100 crores to 200 crores, then the fee you need to pay is 15 lakhs. If it is above 200 crores, then the fee to be paid is 20 lakhs. What is the fee, sir? Up to 100 crores only, 10 lakhs. 100 to 200 crores, 15 lakhs. Above 200 crores, 20 lakhs. Okay. Application can be withdrawn anytime before finalization. You want to ask for APA, but then you thought like this APA is not needed for you. You can withdraw anytime before finalization. Okay. But once you finalize, sir, this fees will not be, once it is withdrawn, this fees will not be refunded. APA entered is valid up to 5 specified years. 5 years, not for 1 year, sir, 5 years. Starting from the year in which APA entered, that's the first year, and other than that, another 4 assessment years, APA is valid. So you are entering into an advance agreement, not just for 1 year, for the coming 5 years. See, let's say in assessment year 26-27, APA entered. Assessment year 26-27 means previous year what? 25-26, year 1. Then the 5 other years, this is first one, 4 are what? 27-28, 28-29, 29-30, 30-31. For all these 4 assessment years also, APA can be applied. APA entered is binding on Commissioner of Income Tax, Principal Commissioner of Income Tax, AO, and even on SSC. So they cannot deny or reject the APA. So APA itself can be accepted as what? Arm's length price. APA applies, then 92C, determination of ALP and reference to TPO not applicable. Why? Because if APA is already finalized, why again AO have to decide? Why the case has to be again transferred to TPO? So both those two are not applicable. APA cannot be applied, same, if it is going to reduce the taxable income or increase loss. The basic transfer pricing logic. Even with APA also, by applying APA price, if your income is going to reduce or losses is going to increase, then in such case APA cannot be applied. Okay. APA is not binding. When there is a change in fact, then APA is not binding. Sir, today you applied APA with certain facts. If the same facts continues to be there, then APA is valid. If there is any change in facts, then obviously APA becomes invalid. Then next one, APA is void ab initio. What is void ab initio? From the beginning, from the starting date itself, it is void, provided if it is obtained by way of fraud. It is obtained by way of fraud. So APA, what does it mean by APA? That I know. Okay, what does it mean? Or what is the objective? The fixing the price, arm's length price in advance to avoid future litigations and difficulties. Okay, na? So that's called APA. So in which form it has to be applied? 3CE. Okay, what is the fees? And the international transaction value is up to 100 crores, 10 lakhs, 100 to 200 crores, about 200 crores, 20 lakhs. Okay. Now, APA is valid for 1 year or for multiple years, sir? How many years, sir? 5 years. Current year plus 5, including current year 5. Current year including 5 years, APA is valid. Can APO be rejected by assessing officer? APA is fixed and SSC computed as per APA. Now AO saying like, no, I'll not consider APA, I'll take some other price. Can you do that? No, sir, the APA price is fixed on or binding on Commissioner, Principal Commissioner, AO, and even on SSC. Okay, once APA is finalized, the matter cannot be again redetermined by AO or cannot be referred to TPO also. Okay. Now rollback. What is rollback? Sir, now what we said, APA, we are applying for the future years. That's called APA. When the price agreed now, in the APA, if you want to apply even in for the past years also, then that is called as rollback. If you are applying for the future years, advance pricing. When you want to apply even for a past year, then that is called as rollback. So past year, not 20 years back related also can I apply? No, there is a time limit given, sir. Rollback you can do. Recomputing total income for preceding previous years using APA is referred as rollback. Rollback can be made for how many previous years, sir? 4 preceding previous years. Forward, including current year 5. Backward, leaving current year 4 years. Understand, sir? Current year has to be counted for APA. So current year plus 4, 5 years. For rollback, ignore current year and take 4 preceding years, you can do rollback. See, APA entered in 26-27. Plus forward 4 years, 27-28, 28-29, 29-30, 30-31. Backward, how many years, sir? Rollback 4 years. So what are the 4 years? 26-27 are the current year. So backward 4, 25-26, 24-25, 23-24, and then 22-23. So these 4 preceding years rollback, this forward 5 years APA. Okay. Application for rollback has to be made through separate application. APA you do one application. If the same APA you wanted to even apply for past years also, then you need to make a separate rollback application, which is in form 3CED. Form 3CED with a fees of 5 lakhs. Sir, for APA 3CE. Okay, for rollback 3CED. Rollback option can be withdrawn while continuing APA for future years. But you cannot withdraw APA by just continuing rollback. Sir, you can ignore rollback and continue APA for future years. What you cannot do? You cannot use APA for past years rollback and cannot skip for the future years. Okay, APA originally designed for what? For the advance. For the future periods only, originally APA is designed. But then they given an extra benefit also what? You can even adjust for, you can use it for past years also. Now what you are asking? No, I'll use only for past years. For future, I'll not use this. That is not allowed. You can, past you ignore and use for future. Allowed. But you cannot say like only for the past years I'll use APA by the name of rollback and for future I'll not use, no, then that is not allowed. Okay, rollback should be applied for all the years unless they became ineligible. If such year became ineligible for applying APA or rollback, then fine. Otherwise, you cannot choose the years. Out of 4 years, first year, third year I'll apply, second year, fourth year I'll not apply. That option is not there. You have to apply rollback for all the past 4 preceding previous years, unless rollback itself becomes ineligible for those years. Okay, SSC cannot choose selectively. Then conditions for rollback. To apply rollback, on what facts APA is entered, the same fact should only be there even in the past years also, then only you can apply rollback. Returns for such preceding years shall be filed before due date. To apply APA for all those years, the rollback, the return should be filed within due date. If not filed within due date, for that year you cannot apply rollback provision. It is not a matter of appeal. For any year, already the matter was taken up to appeal. Since it is already pending with appeal, you cannot apply rollback for that year. Then effect of rollback shall not reduce income, shall not increase losses. Okay. So APA is for what? Future or past? Including current year, future. How many? Current plus 4 assessment years. Rollback. Past. Form for APA. Rollback. Fees for advance APA. Up to 100 crores, 10 lakhs, 100 to 200 crores, 15 lakhs, about 200 crores, 20 lakhs. For rollback, 5 lakhs. For rollback also a separate application has to be made. The price may be same. In APA price only you are applying even for rollback also, but for rollback again you need to do a separate application. Understand, sir? Then APA or rollback both are binding on Commissioner of Income Tax, AO as well as on SSC. Okay, then to apply rollback there are certain conditions. Return has to be filed within the due date. For all the 4 years it has to be applied, not choosy. Okay, unless such year became disqualified for rollback, it's fine. Otherwise you need to apply. Then third one, if already the matter is subject matter of an appeal or it was taken up for appeal, then you cannot apply rollback provisions for that year. Okay, the effect of rollback or APA shall not reduce your total income or shall not increase your losses. Effect of APA. Date of entering APA. Sir, by the time you enter APA, by the time itself, return of income is already filed. It may be rollback also, including rollback also. Sir, you entered APA now. Rollback you are doing now for all the past years already written file, right? Now how do you change them? Are you able to understand my question, sir? It's okay. Maybe APA entered for current year, but for current year also, they might have delayed and current year written also might have been already filed. Then what to do? Because you need to compute based on APA. But already you finalized based on some other transaction value or some other price. Then what to do? What they are saying now? Date of entering APA by the time already written of income filed. Then file modified return. What? Modified return by taking what? APA within 3 months from end of the month in which APA entered. Within how many days, sir? 3 months from end of the month in which APA entered. Not 3 months from APA date. End of the month plus 3 months. From there you need to file what? Modified return. Sir, by that time already assessment is pending. Return file assessment also taken up. Then AO has to complete the assessment as per what? APA. Okay, time limit for assessment will extend by another 1 year. Sir, by that time already assessment also completed, not only written. Return filed, assessment taken, assessment also completed. For that you want to apply APA in rollback. So then what? File modify return within 3 months from end of the month in which APA entered. AO shall reassess income and pass an order within what time, sir? Within 1 year from end of the year in which such modified return is furnished. So AO has to recompute based on what? Within 1 year from end of the year in which modified return is furnished. First modified return has to be furnished within how much time? 3 months from end of the month in which APA is entered. Since modified return filed, AO has to again assess that one. So within what time he has to complete the assessment? Within 1 year from end of the year in which modified return is furnished. Sir, here end of the month. Here again what? End of the year. Sir, we'll do question number 19, sir, and then we'll close for today. Question number 19. Sir, this question is about applying rollback. You just go through the question and tell whether for all the years we can apply rollback or not. If not, for what years we cannot apply rollback and what is the reason? For what years we can apply? For all the years we can apply, huh? Which year we cannot apply? 25, 26 we cannot apply. Why? We shall not? It's okay, sir. Not RT, RT. Limited SSE having international transactions entered into APA when 12th January 2026. So 12th January means which previous year, sir? 25, 26, assessment year 26, 27. Okay, the SSE has been doing identical transactions for the past 5 years also and intends to continue the same in future also. Applicable method for determination of the ALP is cost plus method. ALP is like how much? 540. Okay, as per APA, they determined how much, sir? Okay, APA they separate. Okay. 26, 27 is like 540. Fine. The relevant details for the earlier 5 assessment years are as follows. In each of the years, the minimum quantity trade is how much? 100 lakhs. With the above, assume that transfer pricing and other related provisions have remained unchanged for all the years. In the light of the above facts, seeks your advice. State the assessment for years for which APA can be applied starting with the first year and future. So what is the first year, sir? APA can be applied for which year until when? What is the first question, sir? State the assessment years for which APA can be applied starting with the first year and future how many years? So what are the years for which APA can be applied? So what is the first year to be applied? 26, 27, the year of application. Assessment year 26, 27, first year this is right. And then. So these are the 5 years for which APA can be applied. Okay. For how many years it can avail rollback benefit out of the given years? For all the, sir, rollback can be applied for past how many years? 4 years. So, okay, current year is what? 26, 27. Past 4 years we can apply. 1, 2, 3, 4. Okay. For how many years can avail out of the given years? Under what situation will the rollback is inapplicable? So now 21, 22, why it is not inapplicable? Now I can say easily. Why? Because it is not within 4 years. It is after 4 years. So rollback we cannot apply. So now the question is whether for all these 4 years can we apply rollback? No, no. So 25, 26 can we apply or not? Why? Sir, 25, 26 transfer pricing provisions applicable. The return of income has to be filed by maximum by when? 30th November of 2025. The return has to be filed by 30th November 2025 maximum. But they filed when? 20th 1st June 2026. So return filed within the time after the due date. So this year you cannot apply. Second year, return has to be filed by when? 30th November 2024. Filed by 23rd October only. So as per ALP, as per APA, what is the price to be taken? 550. What is the price as per assessment? 530. Okay. So because of this instead of 530, if you take 550, it is increasing only. Okay. So it gives positive impact only. So how much? 20 rupees addition only. So we can take APA here. Then third year. Why not? Return within the due date. Yes, return within the due date. Then what is the problem? Sir, if you apply APA, the income has to be reduced from 580 to 560. So negative impact. So will not apply rollback for this year. Then last fourth year. What is the due date, sir? 30th November 2022. 30th November 2022. They filed by when? 12th November, within the time only. But ALP is 495. As per assessment, 490. So 5 rupees increase has to be made. So here transfer pricing can be, rollback can be applied. So rollback can be applied only for the year 24 and 24, 25 and 22, 23. Why not for 25, 26? Return not filed within the due date. Why not for 23, 24? The impact of rollback will reduce the total income. That's why we will not apply. Then what is the duty on the part of RT as regards filing of return of income? See, for the assessment year 26, 27. Sir, when the APA has been given? 12th June 2026, right? Sir, by 12th June 2026 they got APA. Na? For current year, assessment year, sorry, for previous year, what is the current previous year? 25, 26. There is time limit for filing return till 30th November 2026. So for current year, the SSC had not even filed the return of income. Hence, the return to be filed, RD can apply the APA and compute the ALP in accordance with the same. For 22, 23 and 24, 25. Sorry, sir, this years has to be changed, sir. Not 22, 23. 23, 24 and 24, 25. For assessment year 23, 24 and 25, 26, RT has to furnish a modified return. Why, sir? Because already the return has been furnished for those months. So you have to recompute and file a modified return within 3 months from end of the month in which agreement was entered. Sir, agreement entered in which month? January. So from end of January, 3 months, February, March and April. So by 30th April of 2026, they have to file modified return for the year 23, 24 and 25, 26. Done. It's okay, na, sir? So tomorrow, by tomorrow you solve one question number 20. 21 is also APA. So tomorrow, sir, mostly he's having a doubt in question number 15. Question number 15. In question number 15, his doubt is about resale price method. In that brand value point, actually the cost is already included in the cost of Sun Limited. See, let me show you. Here what happened? What is the point they said? The Sun PTE's brand value is internationally known. And the benefit of brand value can be taken as how much? 1% of sale price. The benefit of brand value can be taken as 1% of sale price. Sir, here Earth Private Limited is SSE. Sun PTE is associate. And unrelated is like Oceania. Okay. So now from Sun PTE and here Oceania Limited. Sun PTE and even Oceania Limited. So with the Sun PTE, including brand value, right? So this including brand value, how much? 1%. Here, excluding brand value, nothing is there. Okay, sir, when you have a brand value, you will charge more. When you have a brand value, you will charge more. Yes or no, sir? Apple has brand value, so it will charge more. When it charge more, it profit margin also. Okay, Sun PTE has like more brand value, whereas Oceania Limited didn't have brand value. Then Oceania also, what we have to do? Add brand value. So here add brand value. Okay. So to the comparable transaction, what we are doing, to the extent of brand value, how much? Adjustment for benefit of brand value, we were adding 20 lakhs. Okay. Here this brand value related cost already included. So over a period of cost, because of that, Sun PTU includes brand value 1%, whereas Oceania does not have any brand value. So to include brand value, here what we have to do? Add. Same way if you think warranty. In the case of Oceania, after sales warranty was 6 months provided, whereas Oceania gave 1 year. Here warranty is of only 6 months. Here 1 year is there. So this 1 year also we should bring to what? 6 months. So we should reduce 6 months equivalent. The 6 months equivalent is how much? 20 lakhs. If you subtract, it remains normal. Got it, sir? So now we have discussed yesterday about advanced pricing also. So what is advanced pricing agreement? CBDT with prior approval of central government can enter into an APA. So APA is like to avoid disputes, to reduce litigations, APA will be entered. Once you enter into an APA, there will be an arm's length price. An arm's length price will be fixed, or the manner for computation of arm's length price will be fixed. Such price which is fixed will only be so CBDT with prior approval of central government enter into APA to determine ALP, or the manner in which ALP has to be computed. APA has to be applied in Form 3CE. The fees is like up to 100 crores, 10 lakhs, 100 crore to 200 crores, 15 lakhs. If the value of international transaction is like, if it is about 200 crores, 20 lakhs. Application can be withdrawn any time before finalization. APA entered is valid up to 5 years specified in APA. Then, sir, APA is valid for how many years? 5 years. Including current year or excluding current year? Including current year. APA is binding on CIT, PCIT, AO and SSC. Once APA is entered, then again the AO need not to redetermine the transfer price, or the AO does not require to redetermine the ALP, because already it was based on APA, and even it need not to be referred to TPO also. APA cannot be applied if it reduces taxable income or increase losses. APA is not binding when there is change in facts. So on what facts APA entered, the same fact should be continuing. If there is a change in facts, then APA is not binding. APA is void ab initio if obtained by way of fraud. Rollback provisions. Recomputing total income for preceding previous years using APA is referred as rollback. With the APA fixed, you are not only doing for this year, even for the past 4 years also, you are applying the same ALP, okay, which is determined under APA. So to applying for the past years, we call it as rollback. Maximum how many years we can apply rollback? 4 preceding years, okay. So this is the rollback. This is what APA. Application for rollback has to be made again separately. APA separately, rollback separately. Rollback in form 3CED and fees is like 5 lakhs. Rollback option can be withdrawn while continuing APA for the future years. Rollback should be applied for all the past 4 years unless they are ineligible. SSC cannot choose selectively. Conditions for rollback. Transaction is same as to APA. Returns for such preceding years filed before due date, not a subject matter of appeal. Effect of rollback shall not reduce total income or increase losses. Then effect of APA. Date of entering APA. Date of entering APA. Sir, date of entering APA by then. If return of income is already filed, by the time, sir, this is for APA and even for rollback also. By the time you got APA and you applying the APA provisions, by the time itself already return filed. If since already return filed, what to do now? Again, by applying the arm's length price determined in APA, you need to file a new return, which is called modified return, within 3 months from end of the month in which APA entered. If already assessment also completed by that, return filed, but assessment is pending. In such case, no modified return, but AO shall complete assessment as per APA. And then return of income is filed and assessment also completed. Then file modified return within 3 months from end of the month in which APA entered. Then AO has to reassess the income within 1 year from end of the year in which modified return is furnished. Okay. So now we are moving on to next concept, secondary adjustment. So what is secondary adjustment? Sir, this A and B are associate enterprises. A and B are associate enterprises. A is an Indian entity, B is in USA. Now, A has supplied to this associate enterprise at rupees 5,000 per unit. How many units? 10,000 units it has supplied at what price? Rupees 5,000 per unit to its associate enterprise, which is in USA. Now, the ALP determined is 7,500. ALP determined is 7,500. So now, what is the transfer pricing adjustment to be made? 2,500. Okay, you need to sell ideally at what price? 7,500. But for what price you sold? 5,000 only you sold instead of selling at 7,500. So how much profit decreased? 2,500 into 10,000 units. So total how much? 2 crores. 2,500 into 10,000. Paka? 2.5 crores. So now this 2.5 crores, what we need to do? We need to add to the total income. But actually, this 2.5 crores should have been received into India. If you have sold for 7,500, how much money you might have received? Extra 2.5 crores also you might have received into India in foreign currency, right? But did you receive now actually? No. What we discussed till now, even though you didn't receive, this 2.5 crores added to total income. That's what we have explained, right? Ideally, you should have sold at 7,500, but you sold at what? 5,000. Because of that, your profit was decreased or profit was understated by 2.5 crores. That's why transfer pricing provision saying like add that amount to your total income. You just adding. You didn't recover that amount to India. Okay, normally if it is sold for 7,500, then this 2.5 crores money also might have came to India in foreign currency. But actually, is it received into India in foreign currency? No. Now secondary adjustment focus on, okay, for a tax purpose you include in total income. That's fine. Okay, there is no tax loss to the country now. But there is a loss of foreign currency reserve. Ideally, there should be how much foreign currency? Extra 2.5 crores foreign currency also should be there with India. But the 2.5 crores didn't came to India. Now secondary adjustment says like this 2.5 crores also bring to India. Secondary adjustment says like what? It's not just enough if you add that to total income. You added, right? If you added means what? You agreed that that is also your income. If that is your income, you need to brought to India. So bring that income to India. For understanding, sir. If you sold for 7,500, you'll only collect 5,000. You have to collect 7,500, right? But actually, how much you collected? Only 5,000. The extra 2,500 also. Now secondary adjustment provision comes and says like collect that income also to India. Repatriate that incomes into India. Whatever is the primary adjustment done. I mean, how much ever is income you added as transfer pricing adjustment, that income you need to repatriate it into India, bring that money into India. Okay, so primary adjustment means increasing income or reducing loss due to the ALP adjustment. Example, ALP 28 lakhs, actual sale only 22 lakhs. You sold for 22, but ALP is how much? 28. How much is the difference? This difference is what? 6 lakhs. We'll add to taxable income. Now this is called what? Adding this to taxable income, primary adjustment. Now asking that 6 lakhs to repatriate into India, to bring that to India is called as what? Secondary adjustment. Okay, see again, example. ABC imported goods at 3 crores, whereas ALP is only, sorry, Indian entity is what here? ABC Limited. It purchased at what price? 3 crores. But what it should have? 1.8. It should have ideally purchased at 1.8 only, but it paid how much? So excess foreign currency it paid. So, okay, so now what we are doing, since ALP 1.8 only, whereas purchase actually made is 3 crores, the difference 1.2 crores we are adding to total income. So now what you have to do? This 1.2 crores you need to bring to India, because originally you paid 3, but you should have paid only 1.8. Excess you paid now. That excess you added to taxable income. That's fine. But that excess money you should bring it back to India also. Okay, you should bring back to India. So secondary adjustment means this excess paid has to be brought back to India within a stipulated period of time. Okay, so they'll specify certain time. Within that time, that excess money has to be, I mean, whatever you do primary adjustment, that amount has to be repatriated into India. So what happens if I don't bring back? If don't bring back, it would be treated as a deemed loan or advance to associate enterprise. So this 1.2 crores, let's say it has to be repatriated in 6 months. You didn't brought back that within 6 months. Then this 1.2 crores will be considered as you given loan to your associate enterprise. And this 1.2 crores will be counted as loan. From there on, deemed interest also will be calculated. If 1.2 is loan, on that you'll calculate notional interest, and such interest you'll add to your income. Okay, if you don't repatriate, whatever is the money you didn't repatriate, that would be assumed as you given loan to your associate enterprise. If you given loan, you'll be getting interest, right? That interest also they'll charge. Even though you don't get actually, they'll charge interest and add it to your taxable income till the time you repatriate. If it takes 10 years now, all the 10 years, this will be a deemed loan. On that interest also will be calculated. Interest will be added to the total income. No secondary adjustment is needed if primary adjustment in any previous year does not exceed 1 crore. I mean, here, what is the adjustment to be made, sir? This 6 lakh. 6 lakhs only, na? Here nothing. No secondary adjustment needed. But here if you see, 1.2, more than 1 crore, na? So only when more than 1 crore, secondary adjustment is applicable. Within 1 crore, na, even if you don't repatriate, nothing will happen. But if the transfer pricing adjustment done in the first case is more than 1 crore, then it has to be repatriated. Otherwise, secondary adjustment provision will be applicable. It will be considered as a deemed loan. Primary adjustment is made in respect of, okay, even if, sir, this provision of secondary adjustment is introduced only from 1718. That's why for 16, 17 and before years, secondary adjustment concept is not applicable. If primary adjustment is done in assessment year 15, 16, 14, 13, 14, 14, 15, including 16, 17, then secondary adjustment is not applicable. Then secondary adjustment, when it is applicable, see, when primary adjustment has been done sumoto by SSE, he has done on his own, then also applicable. When it is made by AO, then also applicable. When it is determined as per APA, then also applicable. When it is made as per safe harbor rules, there are certain safe harbor rules notified, sir. Okay, to determine how much should be the ALP. They are already considering the industries. In this industry, this much profit margin you should have minimum. If that profit margin, if you are having, then that will be considered as what? ALP only. Like that, they have introduced safe harbor rules, or as a result of agreement or assessment by mutual agreement under DTA. So because of any of these things, if primary adjustment is made, that money has to be brought back if it is more than 1 crore. Okay, so that money has to be brought back. Sumotoli by SSE himself. AO determined, APA determined, safe harbor rules determined, or because of mutual agreement under DTA. Because of any reason, if primary adjustment is made, any of these reasons, then that money has to be repatriated into India within the specified time. Otherwise, it will be considered as what? Deemed loan. Okay. Time limit for repatriation. Sir, primary adjustment because of what? Because of which of these reasons it is made, we need to check. If primary adjustment is made because of order of AO or appellate authority, you didn't did any, you normally did the case only, but AO only determined ALP and made changes. Now the primary adjustment is made because of what? Order of AO. Then repatriation has to be made within 90 days from such order. Okay. If not made, then the interest has to be calculated from date of such order. Sir, the primary adjustment is made because of what? AO's order. Then repatriation has to be made within 90 days from AO's order. If not repatriation is made within 90 days, then from the date of order, interest has to be started accruing. Then because of APA, okay, the primary adjustment is made because of what? APA. You did transaction at one price. APA suggested another arm's length price. So because of APA, you are making the primary adjustment. And such APA is before return of income only. APA got fixed before filing the return of income. So sometimes in rollback provisions and all, you already filed return. Thereafter, APA gets fixed. So, but here what? For the future years maybe. APA entered. Then only after APA only you are filing return of income. APA entered before due date. In such case, take due date of return of income. Okay. Within due date of return of income. One second, sir. Sir, in all these cases, it is from 90 days only. Here, repatriation, 90 days from, sorry, repatriation, 90 days from such order, 90 days from actual date of return of income, 90 days from end of the month in which APA entered, 90 days from the date of giving effect to agreement, and 90 days from due date of return of income. So in all the cases, it is within 90 days from those dates. Okay, even in handwritten also corrected, sir. Within 90 days. Repatriation has to be made within 90 days. Within 90 days from such order. So in all the cases, like it is within 90 days only. Understand, sir? So if it is because of AO order, within 90 days from order. If it is because of APA and APA entered before filing return of income itself, then from the return of date of actual date of return of income within 90 days. If APA entered after return of income, then from end of the month in which APA entered from there within 90 days. If because of a mutual agreement under DTA, then by the date of giving effect to agreement from there within 90 days. In any other case are nothing but the first one, sir. Here if you map these points, what, because of what reasons primary edges can be made? Sumoto nowhere covered here, but order by AO, second point. APA, these 2 points are related to APA. Mutual agreement under DTA, this one. So which are missing? This as per safe harbor rules or SSE has done on his own sumotoli, then those two are not mentioned separately. So they are covered under where? Any other case. So in any other case, it has to be filed from when? From the due date of return of income within 90 days. Any other case means nothing but SSE, sumoto, or by applying safe harbor. Sir, these dates are important, sir, because the question can be asked regarding interest calculations. Okay, so understand, secondary adjustment can be made because of primary adjustment is made sumotoli by SSE. If sumotoli made by SSE, then repatriation has to be made within 90 days from due date of return of income, not actual date of return of income, 90 days from due date of return of income. If not, from the due date of return of income, interest will be calculated. Okay, then because of what reason secondary adjustment can be done? Second one, because of AO's order. If because of AO's order, then repatriation has to be done within 90 days from order. If not, from the order date, interest will start accruing. So 2 points done. First one is what? Sumoto. So in case of sumoto, if primary adjustment is done because of sumoto, secondary adjustment also has to be made. Secondary adjustment has to be made. Within how many days repatriation has to be made? 90 days from due date. 90 days from due date. So let me write down. We have 5 issues. If it is done sumotoli, AO order, APA before return of income, APA after return of income. Okay, then mutual agreement under DTA. Safe harbor, sir. Actually, safe harbor also we will only apply sumotoli, or it covers any of these things. Safe harbor, when we only apply, then it comes under sumoto. Safe harbor are rules to determine or to help us avoiding the disputes and all. So if you apply safe harbor on your own, then it comes under what? Sumoto. If applied by AO, then it comes under AO's order. Okay, if it was considered in APA, then it comes under APA. So safe harbor, even if you don't write separately, it's fine. It gets included in any one of these points depending on the circumstances. So sumoto. Sir, if it is sumoto, then within what time the repatriation has to be done? Within 90 days from here, due date of return of income. If not, interest starts from what? Interest from same due date of return of income. Then AO's order, then order date only. From order date 90 days. Otherwise, interest also starts from what? Order date. If APA filed before return of income, then actual date of return of income. Actual date of return of income. But see here, sir, interest, there is a change. APA entered before due date of income. Repatriation has to be done within 90 days from actual date of return of income. But interest commences only from due date of return of income. Let me confirm this once again. Yes, you could see here also, sir. 90 days. If APA has been entered into before the date of filing return, the date of filing of return, you should take for repatriation. But for interest accruing, due date. For interest here, what we have to take, sir? Due date, not the actual date. Due date of return of income. Due date of return of income. APA after the filing of return of income. Then end of the month in which APA entered. End of the month in which APA entered. And interest, sir, interest from date of giving effect to APA, not from end of the month, from that date itself. From date giving effect to APA. Then if it is because of a mutual agreement under DTA, okay, then what? Date giving effect to agreement, date giving effect to agreement. Date giving effect to agreement. Here also, date giving effect to agreement. Understood, sir, here? Okay, so these are like the situations within what time repatriation has to be made. Sumotoli, SSE only did primary adjustment within 90 days from due date. Otherwise, interest accrues from due date because of AO order. Okay, 90 days from AO's order. Otherwise, interest accrues from AO order. Because of APA entered before return of income. Then repatriation within 90 days from actual date of return of income. But interest accrues from due date of return of income. APA entered after return of income. Then repatriation has to be made within 90 days from end of the month in which APA has been entered. Whereas interest accrual starts from the day from which APA comes into effect. Because of mutual agreement, then the date order has given effect within 90 days from there. Interest also starts accruing from the, if not, interest accrues from the date from which it has given effect. Sir, okay? So if repatriation is made within this time period, then no interest. If not made within this period, then interest will be continuing till the date of repatriation. Okay. So now, What is the rate of interest? You need to check whether the transaction was in which currency. Whether the transaction was made in Indian currency or foreign currency. Okay, it was denoted in dollars or rupees. If it was in foreign currency, then the interest rate is like 6 months LIBOR on 30th September plus 3%. You should take what interest rate, sir? 6 months LIBOR on 30th September of previous year plus 3%. If the transaction is denominated in Indian currency, then 1 year MCLR, marginal cost of fund lending rate of SBI, as on first day of previous year plus 3.25%. Sir, why for foreign currency 3%? Why for Indian currency 3.25%? Sir, Indian currency is little weaker compared to the foreign currency. So Indian currency will lose its value much more quicker than compared to the US or other foreign currencies. That's why in foreign country interest rates will be less. In US interest rate will be the federal bank interest rates will be 3.5 to 4% only, sir. For us it is 7 to 8% is there. So why that difference? Because in US inflation is only up to that percentage, whereas in India the inflation is much more higher. That's why high interest rates. Understand? So simply, sir, so in foreign country, foreign currency, if the currency is in foreign, if the transaction is denominated in foreign currency, what we have to take? 6 months LIBOR on 30th September plus 3%. Indian currency, SBI 1 year MCLR rate, marginal cost of fund lending rate plus 3.25%. India na SBI MCLR rate plus 3.25. Foreign currency na 6 months LIBOR on 30th September plus 3%. This is the rate of interest. So to calculate interest, we got amount. How much ever is the primary adjustment made, that is the amount on which we need to calculate interest. Rate also we have found out now. Time period we already calculated. Okay, from the due date, from the date of order and all. So to calculate interest, three things needed: principal, time, rate. Principal is the amount for which you did primary adjustment. Rate is what? This LIBOR plus 3.25% or MCLR plus 3.25%. Rate also got. Third one, time. Time we already discussed. Depending on situation to situation, the time period may change. That thing you need to calculate. Okay, sir. If you want to avoid all this, sir, you cannot even repatriate. And even you are not interested in paying this one, because if you are not even going to repatriate, every year this notional interest, on that notional interest you need to pay tax. So to avoid all this, they given one more option. What? Amount of primary adjustment. Okay, sir, again, one more point before going to that. This remittance need not to be made by the same associate enterprise. In a group, there are total 10 companies, but actually your transaction is with B, AB. Now, in the group, there are other companies also like C, D, E, F also. All these belongs to the same group. Now, instead of B, C or D repatriated. Is it a problem? No problem, sir. Anyone from the group repatriates also, it's fine. Ultimately, what we want the money to be coming to India. Okay. So, amount of primary adjustment remitted by some other concern of the same group. Such remittance shall also be deemed as repatriation by the foreign entity. Okay. Sir, if you can't do this repatriation and you don't want all this notional loan consideration and notional loan and on that, again, interest computation and all, you have one more option. If you pay additional tax, then you can be relieved from all this if you pay additional tax. What is additional tax? The additional tax rate is how much ever is the primary adjustment made. Let's say 1.2 crores. 1.2 crores you added into total income, you paid excess tax, that is already done. That is because of primary adjustment. This is because of what? Secondary adjustment. That money has to be brought back to India, right? But you cannot brought back. That's why they are asking, okay, you cannot bring back that to India, right? Pay extra tax, we'll relieve that. Okay, what is the extra tax to be paid? Additional tax 18%, surcharge 12%, cess 4%. So altogether it comes to 20.9664%. If you cannot remember, also simple. Extra tax rate 18, on that surcharge 12%, cess at a rate of 4%. Altogether it comes to effective 20.9664% only. Let's say, sir, taxable income 8 crores. On that TP adjustment is how much? 1.5. So you already added 9.5. On that normally you pay tax first. 30% tax rate, surcharge 7%, cess 4%. So on this 1.5 extra also you included here, you pay tax. This is because of what? Primary adjustment. Now what you have to do, even though you pay tax here, this 1.5 crores has to be brought back to India. If not, then additionally on this 1.5 crores you should pay 20.9664, which is another 31,44,960. Okay, normal 30% tax, surcharges, cess, that is common. Extra you need to pay another 20.9664%. Then you will be relieved from this repatriations. If not repatriation, deemed loan, from that you will be relieved. Understand, sir? Everybody? Okay, come back to the workbook, sir. 19 done. 20 we have calculated or not, sir, yesterday? 20 we did or not? So we did 19, we have to do 20, right? So quickly, sir. Page number 19.20. So what is here? Mittal & Co. Delhi is engaged in manufacture of computer hardware. It has been exporting its goods to unrelated parties till when? 31st March 2026. It is contemplating to sell only to associate enterprises exceeding 100 crores in every financial year, commencing by 25-26. As a tax manager of the company, you are requested to explain briefly with respect to APA. What is the period of its validity? Period of its validity. Once APA entered, how long it's valid? 5 years, including current previous year, total 5 previous years or 5 assessment years. When the SSE enters into an APA with department, it is valid for 5 consecutive previous years commencing from the previous year in which APA was entered. If the application is filed and APA is entered in the financial year 25-26, so the previous year is what? 25-26. So it applies even for 26-27, 27-28, 28-29, 29-30, 25-26, 26-27, 27-28, 28-29, 29-30. Okay, these are previous years. Sir, assessment years na you need to do again. Okay, it will be till 30-31. Then fees payable. Sir, up to 100 lakhs, sorry, up to 100 crores international. Okay, 10 lakhs. Above 100 lakhs to, okay, let me show you once again. See here. What is the fee? Up to 100 crores, 10 lakhs. 100 to 200 crores, 15 lakhs. Above 200 crores, 20 lakhs. Sir, here they didn't set, but they said clearly like what? Exceeding 100. Exceeding 100 night may exceed even 200 also. So exceeding, what is the fees? When the amount of international transaction undertake exceeds, the fee payable would be 10 lakhs, sir. 10 to 15, 20, right? Will exceed or will not exceed what they wrote? Then the fees is wrong, right? Let me check. Is there anything I'm missing here? Correct only, sir. This is the fee. Up to 100, 10 lakhs. 100 to 200, 15 lakhs. Above 200, 20 lakhs. Okay. So here in answer only it is mistake. How much we should make, sir, here? You should write actually the table. Up to 100 crores, 10 lakhs. 100 to 200 crores, 15 lakhs. Okay, correct it. Less than or equal to 100 crores, how much? 10 lakhs. 100 to 200 crores. About 200 crores. Okay. Then, on whom it is binding? It is binding on whose case in respect to transaction is entered, and it is even binding on PCT and even Commissioner of Income Tax and their subordinates also. Okay. However, APA is not binding if there is a change in law or facts. Determination of ALP after entering into APA. Then, once APA is entered, shall be determined in accordance with APA only. It shall override the principles of 92C, 92CA. You need not to apply all those methods and all. Whatever it has been decided in APA, that only has to be taken. So, question number 21. Quickly, sir. Start doing question number 21. Sir, 25th November 2023 means which previous year it ended, sir? 23? Previous year it is. For what? How many years we can apply rollback? Including this year, excluding this year? 22, 23, 21, 22, 20, 21, 19, 20. These are like what years we took? Previous years. Assessment years will be 23, 24, 22, 23, 21, 22, and 20, 21, because these are previous years. Okay, now see. Accordingly, there will be a change. DY wants to apply rollback for provisions of 19, 20, 20, 21, 21, 22, 22, 23. Correct only, no, sir. 19, 20, 20, 21, 21, 22, 22, 23. These four only. AO wants to apply transfer pricing from the year in which DY became the subsidiary, that from assessment year 17, 18. Is it correct? No, sir. You can apply only from assessment year. This is previous year, right? So from assessment year, previous year 19, 20 means assessment year what? Previous year 1920 means assessment year what? 2021. So in previous year wise na, from 1920 you can apply rollback. Assessment year wise na, from assessment year 2021 you can apply rollback. But what they are saying, they want to apply rollback from 1718. It is not correct. They can apply only from assessment year 2021. Previous year na 1920. Okay. Sir, he filed its return of income from assessment year 23-24 on 26th August 23. Sir, 23-24 assessment year. Return can be filed till when transfer pricing provisions are applicable. 30th November 23. So this is within due date. And assessment year 24-25. Assessment year 24-25. Sir, assessment year 24-25 is the current year in which APA entered. By when? 31st August. That also within due date. The assessments for the assessment year 2021. Okay, let me write down here, sir. Sir, tell me when APA entered. 30th. 25th November 2023. That means which previous year? 23. Assessment year. This is what? Year of APA. Yes or no? For forward, it will be counted as first year. Then backward, if you take 22-23, 2021, 1920. Assessment years like 21-22, 2021. Okay. Now what he is saying? For this 24-25, return filed on when? First here, this 24-25, 31st August 2024. Return filed on 31st August 2024. For this 23-24, when return filed? When? 26th August 2023. This also within due date. Okay. Then for 22-23, 21-22, 2021, what is saying? 2021 to 22-24. Okay, including. For all these years, even assessment also what? Completed. He said even 23-24. For all these years, assessment completed. Let us check, sir, is there any question, year-wise mistake is there or not? Whether AO is correct to apply the transfer pricing provisions from assessment year 16-17. He is not correct, sir. Why? because it can be applied only for the 4 years. This point you are able to understand, right? 4 years. Second one. In respect of assessment year 21-22, transfer pricing arrived by the board is resulting in reduction of income. Sir, when transfer pricing is resulting into reduction of income, then we cannot apply rollback for that year. So that year also we will ignore. Then what will happen to completed as well as pending assessments? If already completed, you will file a modified return within 3 months. Then that will be modified return within 3 months from when? From the end of the month in which APA entered. Then within 1 year from the year in which modified return is filed, they have to reassess them if already assessment completed. If assessment is pending, then no modified return has to be filed, but AO has to consider the APA and to complete the assessment. See, has to furnish modified return in respect of assessment year relevant to previous year to which APA applies. Furnished before entering into an APA within a period of how many months? 3 months from end of the month in which APA was entered to. The modification should arise only because of APA. In case of completed assessments, the AO would modify the total income of assessment year having regard to APA. Such order of modification has to be passed within a period of 1 year from end of the financial year in which modified return was furnished. In respect of pending assessments, the AO shall proceed to complete the assessment or reassessment in accordance with the APA, taking into consideration the terms of agreement. Okay, so quickly read this question number 22, slide theory question only. Just 2 minutes, read it and come. Question number 22, sir. It's about what? Secondary adjustment. Slide theory question. Read it quickly. Is an Indian company belonging to Bolo Group. It is engaged in sale of air conditioners throughout India. Eric USA having 28% shareholding in Fast Growth. Associates or not? Okay. That also Fast Growth also in manufacture of ACs and belongs to Bolo. During the financial year 25-26, Fast Growth purchased 20 ACs from manufactured by Eric Incorporation of USA. So Fast Growth is Indian entity. It purchased from Eric how many ACs, sir? 20,000 ACs. At what each price? 70,000. Whereas identical units manufactured by unrelated persons were purchased by it at what? 65,000. So this 65,000 is what? Comparable price. Identical goods price, no? Nothing but it is what? Comparable price. Eric given credit period of 1 month to Fast Growth, whereas unrelated gave 2 months. Sir, actual is with how many months credit? 1 month. Whereas comparable is with how many months credit? 2 months. So comparable price is how much? 65,000. So this comparable is with 2 months credit, whereas actual is with only 1 month credit. So this extra 1 month credit cost, what we have to do? Subtract. You have to subtract. So credit cost for 1 month. Okay, fine. That will subtract. Then nothing else. That is the only difference they are having. So what is the cost of capital may be taken, sir? 12%. So how much? 65,000 into 1 month into 1 by 12 into what is the percentage, sir? 12%. So it is nothing but 65,000 into 650. You need to subtract. Then you will get the comparable ALP as how much? 64,350. Whereas the actual transaction happened at what? 70,000. That means you purchased at 70,000. Ideally you should buy at what? 64,350 only. But you purchased at what? 70,000. So how much excess you paid? 5,650. How many units has been purchased? 5,650 into 20,000. 11 crore 30 lakhs. So this 11 crore 30 lakhs, what we have to do? We need to add to the total income. It is about what? Primary adjustment. Okay, done here. Then what else? Determine ALP. Okay. If primary adjustment is proposed, state the time limit for repatriation. Sir, if it is done sumotoli. Sir, if it is done sumotoli, the repatriation has to be done within 90 days from due date. 90 days from due date. So, see, as the primary adjustment exceeds 1 crore, SSC Fast Growth has to do secondary adjustment within 90 days from the due date. So, what is the due date, sir? 30th November is the due date. From there, 90 days. Okay. December, 31 days. January, 31 days. 28 days, February. So, nothing but 28th February. Consequences for non-repatriation. If the amount is non-repatriated, it will be considered as a deemed loan and it will be chargeable to a specified interest. If the amount of primary adjustment is not brought within the specified time, it shall be deemed to be an advance and liable for interest. Okay. Then what is the interest rate? Here transaction denominated in Indian currency. Since the transaction is denominated in Indian currency, we need to charge interest 1 year SBI MCLR rate plus 3.25%. From when? From the due date of filing return of income. The interest chargeable where the transaction in Indian rupees, 1 year MCLR rate as on 1st day of April plus 3.25. Foreign currency na 6 months Libar on 30th September plus 3%. Okay. If they want, what is the next option? Tax liability if such repatriation of excess fund is not opted. So they don't want to repatriate. Then what they have to pay? Additional tax. Additional tax on what? This 11.3 crores they have to pay additional tax. What? 18% tax, 12% surcharge, 4% cess. So altogether 20.9644%. Then the last one. Consequence of repatriation of money by JEET of Canada being another company belonging to the same group. Can they do? Yes. Even a company belonging to the, even some other company, some other foreign entity also can repatriate if they belongs to the same group. So this is question number 23. Then come to question number 24, sir, and do it quickly. 24. Where second point? Once are written, right? This one. Okay. 26. Year change, that is like 26. 26. 24. Sir, first they are associate enterprises or not? Paras Indian company engaged in manufacturing of mink blankets. Okay. 60 crores borrowings, 31st March. Saksham imported 5 lakh blankets from Paras for resale in Germany at what? 2000 per unit. Okay. Paras Saksham Limited Germany imported 5 lakh blankets from Paras for the resale in Germany. That means Indian entity Paras is selling 5 lakh blankets to German company Saksham. Understand, sir? Paras. Sir, here import is made by Saksham Limited of Germany imported 5 lakh blankets from Paras for sale in where? Germany. That means to Germany they are importing. Then from India, what we are doing? Exporting. So Paras Limited is selling. How much it sold? It sold at what? 2000 per unit. Okay. Whereas other dealers will sell at what? 2100 per unit. Okay. Paras received a bank guarantee for availing a cash credit limit of 9 crores for Saksham. So what are the total loans, sir? 60. Whereas the bank guarantee got is for how much? 9 crores. 9 by 60 into 100. 15%. So the guarantee provided is more than 10% of the total borrowings. So here they are what? Associate enterprises. So associate enterprise, actual transaction is for what? 2000. Whereas comparable transaction is at what? 2100. Okay. So we should take what? Comparable. The terms of the trade for other was make payment within 1 month. Whereas Saksham has the credit allowed of 3 months. Sir, actual is with what? 3 months credit. Whereas comparable is what? With 1 month credit. So comparable also what we have to do? Add extra 2 months credit also, because actual is with 3 month credit, actual with associate enterprise, comparable is with only 1 month credit. So comparable also you should make it like what? 3 months credit. So what you have to do? Extra 2 months related credit also you add. So what is the extra 2 months related credit, sir? Comparable 2100. So 2100 into 12% into 2 by 12. 2100 into 12 into 2 by 12. 40. So 42 rupees what we have to do? Add. Then you are required to determine the ALP. Yes, ALP already calculated, sir. 2142 is the ALP. Okay, what is the difference, sir? How many units has been, sir? 5 lakh units. 5 lakh units into 21. 5 lakh units of blanket into 2142. How much? 1 crore 7 lakh. Sorry, 107 crore 10 lakhs. Whereas actually they paid how much? 2000 into, actually sold for 2000 into 5 lakhs. You should have sold for 2142, but you sold only for 2000. So simply you can do this also. 142 into 5 lakhs. You will get the adjustment to be made. 142 into 5 lakhs. 7 lakh 10,000 is the primary adjustment to be made. You need to add. Okay. Then obviously secondary adjustment also they might have asked. Assuming that above adjustment have been made sumoto. Sir, sumoto na, by when repatriation? 90 days from due date. Due date of return of income. What is the time limit done? What are the implications if they were not repatriated? Consider as advance or deemed loan. Calculate interest. Here it is in foreign currency or Indian currency. Indian currency only. Again, both rates anyhow they are giving. 1 year MCLR of SBI as on 1st April of previous year plus 3.25. 6 months Libar as on 30th September of previous year plus 3%. Now question number 25, sir. Question number 25. Sir, in first case, what is the transaction price declared by TAN Limited? 3 crores. Whereas transfer price computed by AO is how much? 3.5. How much is the addition to be made? 0.5 crores is the primary adjustment to be made. Within 1 crore or above 1 crore? Within 1 crore. So secondary adjustment applicable or not applicable? Not applicable. Then second case, transfer price, actual price is how much? 5. Whereas TPO mentioned as how much? 4.5. If you take TPO order, transfer, it reduces income. So here transfer pricing itself is not applicable. Third case, sir, original transaction is how much? 10 crores. Whereas computed by TPO is how much? 12 crores. So it is like a favorable addition only. It increases profit. So 2 crores has to be made. Primary adjustment. Sir, if primary adjustment 2 crores, which is more than 1 crore, secondary adjustment also has to be done. Here, this adjustment is because of what? Order of TPO. So when it is an order of TPO, from here within 90 days repatriation has to be done. But when the repatriation is made, sir, 31st October 23 plus 90 days. 30th November 30 days. December 31 days, and 29 days like January. So by 29th January, actually repatriation has to be made. But when the repatriation is made, 31st March 2024. So not within 90 days, we need to calculate interest. Interest from when? Okay, from 1st November. November 30 days, December 31, January 31, February 28, March 31. Total how many days, sir? 150. November 30 days, December 31 days, January 31 days, February, leap year 2024. Yes, leap year. February is like 2024 is like leap year. So 29, here another 31. So total how many days? 152 days. Okay. Sir, transactions in Indian currency or foreign currency? Okay. So they given 1 year MCLR rate is how much? 7. 7 plus 3.25 percentage. So what is the interest rate? 10.25 percentage. So 2 crores into 10.25 percentage into 152 by 365. How much? See, this is the interest rate. Okay, they didn't calculate interest also. You are required to discuss tax implication in the answer of TAN regarding primary and secondary adjustment, assuming accepted all the adjustments. Either this amount has to be paid as notional interest, or else if it wants to avoid all these secondary adjustments, it can pay additional tax. How much? Additional tax rate 18%, surcharge 12%, subsidy rate of 4%. So, okay, this is also an exam question. Then, question number 26, sir. Quickly, so this is the last question from secondary adjustment. Question number 26. Itself is with the first lines only. Whether they can be called as associate enterprises or not. That part only new. 1st April, Rohit advanced a loan of 6 crores to Virat, a company resident in Dubai. As on the date of loan, advanced the book value of total assets in the books of Virat Incorporation was how much? 4 crores. In the financial year, Virat has actually revalued, okay, and increased by 2 crores. Or because of revaluation, it is 4 crores. Okay, Virat paid the entire loan along with interest on 31st August 2023. Sir, on the date of loan or in any of the loan. So look at the provision. 2 enterprises are deemed to be associate enterprises if loan advanced to the other enterprise is not less than 51% of the total assets of the other enterprise. Since Rohit is an Indian company, advanced loan amount of how much? 6 to Dubai company, which is 150%. So Rohit and Virat are deemed to be associate enterprises. So what extra points given here to confuse us whether revaluation has to be taken or not? If you don't take also, still they are associate, but the point will go wrong. You may take what? 6 by 2. Which will be 300%, which is wrong. So you don't think of revaluation and all. On the date of loan, whatever is the book value of assets, that only we have to consider. Second one, what they said, in the current year, in the middle of the year, they repaid the loan and interest. So now we have a question again, whether they are associate or not, because in the year itself, repaid. But still, even on the first day of the year, there is relationship, there is loan. So they are called as what? Associate enterprises only, even though on the closing day, they are not associates. Okay. Now, financial year, Rohit entered into an agreement to provide 20,000 medical equipments at a cost of 7,400. So Rohit entered to Virat to provide. So who is selling? Rohit selling. At what? 7,400 to Virat. Okay. So AO treats them as associate, want to recompute. Yes, they are associates only. Examine whether Rohit and whether Virat to be treated as associates. Yes, correct only. ELP. Rohit which sells the same equipment at a rate of 9,000 to Y. So comparable price is how much, sir? 9,000. Whereas actually is how much? 7,400. Sir, and at a rate of 9,500 to XLLP. So there are 2 ALP comparable transactions. One is 9,000, the other one is what? 9,500. And sir, in this case, what we have to do? Average. What is the average? 9,250 is the ALP. What are the options available in respect of such increase? How much is the increase, sir? 9,250 and 7,400. 1850 into how many units? 20,000 units, sir? Yes, 20,000 into 20,000. How much? 3.7 crores. This has to be added to the total income. Have to pay extra tax. I mean normal tax including total income. But again, this 3.7 crores has to be repatriated within 90 days. Okay, from summa from due date, AO order from AO order, like that it has to be repatriated within 90 days. Otherwise, considered as a deemed loan or advance, interest has to be calculated. Understood, sir, this one? Okay, so now come back to the note, sir. So we have something called safe harbor here. Safe harbor rules which are applicable from last December 2025 exam only. Mostly they will not ask a question from safe harbor. Even in the last December 2025 also they asked an MCQ. That also from the first lines only. Safe harbor rules. Safe harbor rules means what? The circumstances in which income tax authorities will accept the transfer price declared by the SSE. If you have computed your pricing or if you did your pricing with associate enterprising by following safe harbor, then they will not object your price and invoke or introduce something as ALP. If you follow these rules, then your pricing itself will be assumed as what? ALP. Okay, they won't invoke something else. ALP. Okay, so what? So this safe harbor is nothing but safe harbor. Sir, understand, sir? You could safely do the international transactions and all if you follow these rules. That's why it is kept as what? Safe harbor. Mean the circumstances in which income tax authorities will accept the transfer price declared by the SSE. They will not again recompute based on ALPs and all. Why safe harbor? To reduce disputes, to certain profit margins will be given here. If enterprise profit margin is maintaining the same kind of profit margins only, either not less than that profit margins. Sir, here our problem is what? Why transfer pricing? They may reduce Indian entities' profit margins and divert the profits to other countries. If Indian entities are maintaining a specified profit margins, then they can be clear that no tax avoidance is being made. Since no tax avoidance, they need not to invoke any transfer pricing provisions. See, what is that here? Type of industry. Software development services. If they do software development services, like designing, support, development, debugging, in existing technologies, not new technology, already existing technologies related only, they'll design a website, they provide support to the website, they develop, or if any issues are there, they debug. If the transactions are within 100 crores only, value of transaction, then how much margin should be there? 17. If 17% margin is there to the Indian entity, then no problem. That price is correct only, need not to invoke ALP. If the transaction is between 100 to 200 crores, then the margin to be maintained is how much? 18%. Okay. IT enabled services. IT enabled services like back office, call center, claims processing, payroll, revenue accounting, website maintenance, remote education, like what BCCA is providing, like through ClassPass and all, remote education. You can sit in a remote location and can listen to the classes. Database management. Actually, all these majorly called as BPO services, business process outsourcing. Sir, you do insurance, but all these claims processing, entering into systems, all this you will not do. You'll outsource it to some other person. So those people will be processing it. Next, payroll. You have employees, but how much salary, how much HRA, how much PF, how much PF contribution, how much TDS, all those and all you will not take. You'll give it to some other person. They will be maintaining all that. So those kind of IT related BPO has been given. If the value of international transactions is within 100 crores, 17%, 100 to 200 crores, then 18%. So software related this one. Then KPO, knowledge process outsourcing. Here business process outsourcing, here knowledge process outsourcing. Like what? Geographic info, HR services, engineering and design, animation, content development, business analytics. Sir, geographic info. Google Maps in India hire so many people, sir. They need to do just tagging. So in every, if you see, sir, Google Maps now, satellite view, if you see, if you zoom it, you can see your house. Okay, someone is, when they took the photos and someone is sitting in front of your house, now that also you can see. But if you see clearly, they have been blurred also. That vehicle numbers, their faces has been blurred. Who blurred them? People who has been hide. Every photo, they zoomed it, they look at each photo and they have to blur it. For that, this all this entry level software job is blurring that only. They do targets. Okay, so in a day you need to do this much and you need to do. Okay, the targets also. Even our people also has been taken, sir, like from a company, like, okay, so like CMA inter-qualified. As a part of industrial training, those people has been hired. They are giving 30,000 per month. But ultimately what they are doing now, this tagging thing and all, okay, so that is geographic information related. Okay, then HR services, all these recruitment process, engineering and design, animation these days, okay, content development, business analytics. So all these also, sir. See, if it is the total international transactions are within 200 crores and your employee cost is more than 60% of operating cost. Sir, out of your total cost, your employee cost is more than 60%. That means you are more service oriented, so your profit margin should be 24%. If your employee cost is within 40 to 60% of your total operating cost, then your profit margin should be 21%. If your employee cost is within 40% only, then your profit margin should be 18%. Sir, your employee cost out of total cost decide how much you are dependent on service. If you are more service oriented, more profit margin. If your employee cost out of your total operating cost is more than 60%, you should maintain how much margin? 24%. If it is like between 40 to 60% employee cost out of total operating cost, then your profit margin should be minimum 21. If it is like within 40% employee cost, then your profit margin should be 18. Then advancing intra-group loans. There were loans given. Loan to associate enterprise being non-resident. Such enterprise is not a bank or financial institution. Then depending on credit rating. Credit rating like A2, AAA, BB, B2BB, C2D, no credit rating. So 1 year MCLR rate plus these rates should be the minimum interest that should have been paid or received. If that interest is being received, then there is no problem here. That is a fair transaction only. So safe harbor rules are helping us to decide whether it is a fair transaction or not. If the associate enterprise having A credit rating, A plus, then they should have paid how much interest rate? 1 year MCLR rate plus 1.75%. If they are paying that much interest, then it is a fair transaction. Nothing to be, no transfer pricing provisions or no adjustments has to be made. If it is B category, then MCLR plus 3.25. Okay, only B2BB 4.75 to be added. C2D 6.25% to be added. And no credit rating now 4.25% has to be added. If the aggregate loans to associate enterprises is within 100 crores as on 31st March. So this applicable when the loans given are totally within how much? 100 crores. When the loans are in foreign currency and the aggregate loans are within 250 crores. Loans in which currencies are here? Foreign currency. Here what? Indian currency. Loan in INR. Sir, loan in Indian currency now will take MCLR rate. Loan in foreign currency now will take what? LIBOR rate. Okay, see, credit rating A, B, other. A na minimum reference interest rate declared for that currency. Sir, LIBOR is a common rate. So here they are going much specific and saying, depending on the currency, they will mention reference interest rate. Okay, for US, one thing will be the base rate. For UK, because US inflation, UK inflation is different. Japan inflation is much more less. In Japan, interest rate will be 1 and 2% only, sir. Because Japan, the inflation is so low, even compared to US. In Japan, actually, the interest rate will be 1%, 1.5%, 2% only. So, depending on the currency, we should take what? Minimum reference rates. Okay, for that, what we should add? Depending on the credit rating. A rating, na, add 1.5. B category, na, add 3. Other rating, na, add 4. If that much interest you are getting, it's a fair transaction. Then, intra-group loan only, loan in foreign currency only, and the amount is more than 250. Here, within 250, here more than 250. Again, minimum reference rate, A category na add 1.5, B category, okay, triple B category na add 3, okay, B and double B category na 4.5, any other na add another 6. So these are not interest rates. Reference rate plus this is called the minimum interest you should have earned. If you earned this much, no problem. If you are earning less than this, then safe harbor not applicable, transfer pricing adjustments has to be made. Then corporate guarantee. If you are given any corporate guarantee, the minimum guarantee fee you earned is how much? 1% per annum for the amount guaranteed. If you are getting guarantee commission as minimum 1%, then no problem. Then R&D. If R&D is related to software, transaction value is up to 300 crores, the margin should be 24%. If it is related to pharma also, how much? R&D related to softwares or pharma, the minimum margin should be how much? 24%. You fix the price by having margin of 24%, then it is safe harbor. No problems you will come. If the margin you are having is only 18%, the minimum margin to be maintained is how much? 24, but you are having only 18. So you are not maintaining safe harbor. AO can invoke transfer pricing adjustments, ALP calculations, everything will come. So here safe harbor is saying what? If you maintain these margins, you are safe. You will not have any arm's length, you will not have any adjustments because by AO or because of any other reasons. Okay, so you need to maintain this much margins or this much amounts as your incomes. If you are a manufacturer of auto components, you manufacture core components or non-core. What are core? For a car, what are the core components, sir? Engine, brakes, tires will come as like what? Core components. Okay, if you are manufacturing core, then for them the margin should be how much? 12%. Non-core, you are manufacturing the mirrors, seat covers, seats, they are not core. So non-core if you are manufacturing, then the margin should have how much? 8.5%. Crucial items means like what? Engine, transmission, steering, suspension, braking, batteries. These are core items. Then any other low value adding items has been provided. They are non-core, no risk services. Then intra-group services value within 10 crores, the minimum margin should be how much, sir? 5%. Markup should be 5%. Okay, for low value added items, any other thing low value added items, the margin should be how much? 5%. Sir, if you are taking from foreign country, they shouldn't have margin more than 5%. Understand? So then procedural. If you want to apply safe harbor, you should file 3CEFA with AO on or before due date. Can be filed for 1 year or for 3 years. You can say like I'll follow safe harbor like for 1 year, or else with one application only you can say like you'll follow for 3 years also. Opting for 1 year, file before due date of the assessment year. More than 1 year, file before due date of the first assessment year. Return of income has to be filed before filing 3CFA. First file return, then file 3CFA. Okay, SSE files 3CFA for safe harbor. AO has doubt whether safe harbor can be applied or not to this case. Then what he has to do, within 2 months from end of the month in which this form is filed, he can refer the case to whom? TPO. Sir, you filed return and you applied 3CFA saying like this is the safe harbor I have relied on. So you are did that also. Now AO has doubt whether that safe harbor can be applied to this particular case or not. Then what he can do, he can refer the case to TPO within 2 months from end of the month in which such form has been filed. Now TPO verifies and process an order, okay, which is binding on AO and SSE. Okay, once 3CFA is filed, verifies whether SSE is eligible or not, or transaction is an eligible transaction or not. If he has doubt, he'll refer the case to TPO within 2 months from end of the month in which 3CFA is filed. TPO verifies and process the order. Okay, SSE has objections. With the TPO order, SSE has objections. So SSE raise objections on TPO order within 15 days to whom? Commissioner of Income Tax. Okay, then Commissioner of Income Tax passes an order within 2 months from end of the month in which objection has been raised. Sir, here AO has to raise the doubt within how many months? 2 months from end of the month in which this form is filed. Then CIT, when any objections has been raised, CIT has to act within 2 months from end of the month, right? So now these people, AO, TPO, Commissioner did not act in time limit, then option is deemed to be invalid. Then tolerance 1%, 3% is not available. Sir, for range, actually we are having what? Wholesaler 1% variance is allowed. For normal people, 3% variance is allowed. With safe harbor, again, you cannot take tolerance. Okay, if you are 1%, if you are having 1% deviation from safe harbor, or 3% within 3% deviation from safe harbor also, still safe harbor is not applicable. ALP can be determined. That variance, range concept is not applicable in safe harbor. Sir, for notified jurisdictional area people also, we said what? No variances or no tolerance band is available. Even for people to whom safe harbor applicable, tolerance band is not applicable. Maintenance of books of accounts, mandatory, even if you do safe harbor. Sir, this is something like presumptive scheme for transfer pricing. In simple. Okay, if you do minimum, if you do this one, then they'll not invoke the normal prices and all. Okay, if you have maintained minimum this percentages, so this is like a presumptive for transfer pricing cases. Understand, sir? So even though you opted for this kind of presumptive, In normal presumptive, you need not to maintain books, so you need not to get them audited. But here, even though safe harbor is there, you need to maintain books, so you need to get them audited. Safe harbor not applies if associate enterprise is in notified jurisdictional area or no tax or low tax country. Penalty. Sir, penalty under 271A, 271G for non-maintenance or for non-furnishing, for non-maintenance of books of accounts or for non-furnishing the report. Then 2% of transaction value will be the penalty. Then what are the records to be maintained? Person entered into international transaction or specified domestic transaction where the aggregate value of transaction is more than 1 crore has to maintain records mandatorily. Within 1 crore has to maintain minimum records which are adequate to compute ALP. So within 1 crore also they have to maintain, but minimum is enough. AO commissioner can require any person to provide required information within 10 days from receipt of notice. However, this 10 days can be extended up to 30 days. Records has to be maintained for how many years, sir? If transfer pricing are applicable, then all the records has to be maintained for 8 years from the end of the relevant assessment year. Sir, if you remember, in starting we said like transfer pricing applicable for international transactions as well as specified domestic transactions. What are called specified domestic transactions? Transaction not an international transaction, but the aggregate value of transaction is how much? In previous year is more than or equal to 20 crores. Sir, more than 20 crores only, it is called as specified domestic transaction, and that also it should be covered here. So what? Look at this example. ABC Cements. ABC Infra is eligible for 80IA deduction. What is 80IA? 100% profit is eligible for deduction. It constructs a metro project. Now ABC Cements is a cement company. What it did? It supplied cement bag at 200 rupees only, but actual market price is how much? 400. So because of this, what happened? ABC Cement's profit is reduced because 400 rupees worth of cement bag they sold only for 200. So ABC Cement's profit reduced, whereas ABC Infra profit is increased. Why they did like that? Because here they can claim 100% exemption, right? That's why profits are diverted from this company to other company. Here also there is what? Tax avoidance. To control this tax avoidance, what they are saying like transfer pricing provisions are applicable. But this is not an international transaction. So we are calling it as what? Specified domestic transaction. What are those? If any transfer of goods and services to unit referred in 80IA, any business transacted between SSE and other persons referred in 80IA, any transaction referred in any other section under chapter 6A. Sir, you are getting chapter 6A. Under chapter 6A, it may be 80LA, 80M or any section, you are getting benefit. Okay, so I am doing what? I am entering into a transaction with you so that I will divert my profits to you. You can claim exemption. You are claiming some chapter 6A deduction. Because of that, I am transferring my profits to you so that you can claim more deduction. And both belongs to the same group only. So in such case, or one entity getting 10A exemption. So that's why what I am doing, I am transferring all my profits in the name of price adjustments or with the price changes. I am routing my profits to the entity which is claiming 10A exemption or which is getting 80AA8 and all. Or any business transaction. So I have two entities. One entity is under 115 BAB. 115 BAB, what is the tax rate? For companies, 3 are there. 115 BA, BAA, BAB. For BAB, what is the tax rate? 15% is only the tax rate. So to get that lower tax rate benefit, what I am doing, I am diverting my profits to the other entity which is under 115 BAB. So there are also specified domestic transaction. Or any business transaction between a associate enterprise under BAE. BAE is like cooperative society, which is having again 15% only. So I am transferring my profits. So directly I will not transfer profits. I will fix the prices in such a way that my profit will be diverted to the other entity. So in that case also what? Specified domestic transactions, transfer pricing is applicable. Then last, audit report. SSE who has entered into international transaction or specified domestic transaction shall file a report of CA, chartered accountant, in form 3CEB by 31st of October. So 1 month prior to that of due date only, auditor's report has to be filed under 92E. If not filed, then the penalty is how much? 1 lakh. Failure to furnish report by CA, then the penalty is 1 lakh. Failure to report a transaction. Sir, you didn't report transfer pricing correctly, then you are not reporting a transaction. So failure to report a transaction or misreporting a transaction will give you a penalty of how much? 200% of taxes. Understand? So it's okay. So next concept is about thin capitalization. 94B, it's about what? Thin capitalization. Thin capitalization means here, with respect to interest paid to associate enterprises, there are certain restrictions. Okay, this provision will talk like maximum how much interest you can pay as or how much interest you can claim as expense when it is paid to associate enterprise. See, why thin capitalization? Why transfer pricing we know. So why thin capitalization also we should understand, right? See, A incorporation is USA, B Limited in India. It has given $100 million loan to B Limited. And then B Limited India has to pay interest at a rate of 8%. That means every year it has to pay interest how much? $8 million US. Okay. Yes, B Limited can claim it as interest expense. Now what happening? A Incorporation USA will get $8 million US as interest. But A Incorporation, if it gives the same money as loan in USA, maximum it gets 4%. Now by giving it as loan, sir, actually this is not loan. It is their capital investment only. Okay, but they are, instead of giving it as capital, they are giving it as what? Loan. Okay, why giving it as loan? Sir, if it is given it as capital, on profit, first B Limited has to pay tax. then after tax, if any money is there, that will be given as dividend to A incorporation. So the same profit get taxed in B's hands as well as A incorporation hands also. That's why they are thinning, narrowing the capital part and then inserting the other amount needed in the form of loan. Sir, actually my subsidiary company in India need 100 crores capital. But what I am doing, 100 crores capital if I put, then if any profit comes also, first they have to pay tax, after only they can give me dividend. That's why to escape that, what I am saying, instead of giving everything as capital, I'll put only 10 crores as capital. The 90 crores, I know they need money. They know 100 crores, but the other 90 crores I'm not giving it as capital, I'm giving it as loan. I'm giving it as loan. Why as loan? Because on loan they have to pay interest. So interest, sir, in B Limited, interest paid is claimed as what? Expense. So that amount, it is not taxed in the hands of B Limited and it is only taxed in my hands. So simple, sir. Holding, see here subsidiary. Holding. Sir, if subsidiary has profit, on profit it has to pay tax. So if tax is subtracted, here only out of 100, how much is there? 70. Only holding get how much? 70. But instead of profit, if that is diverted as interest, subsidiary claim interest as an expense. To the extent of interest claimed by subsidiary, the profit will come down. So subsidiary will not pay any tax. So interest 100 rupees, no tax in subsidiary. Interest paid by subsidiary. So holding getting how much amounts are in this case? 100. If the same amount rooted as profit, subsidiary has to pay tax. After tax, holding will get only 70 rupees. But whereas interest root, holding getting how much money, sir? 100. So to avoid the taxability here, what they are doing, instead of giving it as capital, they started giving it as what? Loan. They started giving it as loan. And one more thing. One more thing, sir. They are diverting profits also in the name of loan, in the name of interest. Sir, actually, see, A incorporation, A Limited. It has 50 crore loan plus 50 crore share capital. Okay, sir, this A incorporation, on this 50 crore, if it is invested in USA only, it will get only 4% interest rate in USA. Okay, that means on this 4% is the interest they'll earn if they have invested in USA. But A Limited is being paid 8% interest. 8% is normal only in India. But compared to US, 8% is abnormal only, because in US the interest rates are 4%. Sir, you have this basic SFM knowledge, right? Okay, interest rate, our currency strength, inflation, all these three are connected. Okay, inflation is less, our currency will strengthen more. Okay, if inflation is high, our currency loses value more. Okay, if an inflation is high, even interest rates also will be high. So I hope you know all these three nexus. If you know all these connections, the point is what? 50 crore loan or the 50 crore money, if they have invested in US itself, US company, they'll get only 4% return. Even if the capital also, instead of investing there, they're only the capital, they'll get only 4% return. But in India, on the share capital, they are not paying any profit. Forget about that. But they are paying interest at a rate of 8%. Sir, this 8% they'll not pay in Indian currency. They'll pay it what? Foreign currency only. So A incorporation has no loss. It given $1 lakh, it will get $8,000 only. So, sir, actually why India interest rate and US interest rate is different? Because inflation. Okay, because of inflation, Indian currency will depreciate faster. I mean, Indian currency value will fall quicker because of high inflation than compared to the dollar value. That's why there is a difference in exchange, difference in interest rates here. Now what you are doing? Here A incorporation getting the interest in dollars only, $8,000. But if the same A incorporation, if it invested in US only, it will get only maximum $4,000 only. Instead of 4,000, now it is getting 8,000. Why it is getting 8,000? Nothing but this A Limited Indian entity diverting profits in the name of interest. It looks reasonable only. 8% only, now you look reasonable. Even FD also having 8% only. But understand, sir, this 8,000, it's not payable in rupees. You need to do what? With the money you are having in Indian currency, you need to buy foreign currency and to pay. So not only interest, there is exchange loss also will be there. Together it won't be more than 8%. Effectively the interest rate will go up to, because you need to pay it in dollars, not in rupees. So these associate enterprises, since normal pricing they are adjusting, ALP is coming. Here ALP interest rate is how much? 8% only, because normally in India will charge 8% is the interest rate of banks. So ALP only they are doing. But still ALP is also unreasonable, because the interest rate in India is 8%. US interest rate is only 4%, 3%. Japan now only 1.5, 2% only. That's why they are diverting the profits in the name of interest. So it can even beat arm's length price and can divert the profits to associate enterprises in the name of interest. So they thought of to control this also. So they introduced the concept called what? Thin capitalization. Okay. To control the transactions and to put a cap on interest, that concept has been introduced. Now what is the concept? See, lender, the one who is giving the loan, should be a non-resident company. The debt given or the debt taken should be whom? Either Indian company or a permanent establishment of foreign company in India. Who is the borrower, sir? Indian company or a permanent establishment of a foreign company in India. From where they have taken loan? non-resident. Okay, both these entities are what? Associate enterprises. Okay, now borrower is doing what? He is incurring any expenditure by way of interest or similar nature which is payable to associate enterprises being non-resident, and the interest amount is more than 1 crore in a previous year. Interest must be deductible while computing PGB. Three conditions has to be satisfied. First, this borrower is paying interest or of something of similar nature. Second one, this borrower is paying more than 1 crore interest. Third one, first this interest is allowable in PGBP. Sir, understand? Borrower paid actually 2 crores interest, but TDS deducted only with respect to 1.5 crores. First apply PGBP provisions. Total interest paid is how much? 2 crores. But only for 1.5 crores TDS deducted. For the other 50 lakhs, TDS has not been deducted. So as per PGBP, how much allowed? Payment to resident or non-resident here? Non-resident. So if TDS is not deducted, 100% is disallowed. So forget about the other 50 lakhs which is disallowed. How much interest we need to consider here? 1.5 only. So the interest must be first deductible in computing PGBP. How much deductible? Even though actually paid 2 crores. But 50 lakhs became disallowed because of what? Non-deduction of TDS. How much is allowable under PGBP? 1.5. That only you should count here. Understand, sir? So who has to pay interest? Borrower. To whom? Non-resident being associate enterprise. How much should have been paid? In excess of 1 crore in a previous year. Only when the interest paid is more than 1 crore in a previous year, then this concept is applicable. Third one, the interest 1 crore we need to check one. The interest must be first deductible under that PGBP. How much ever is deductible under PGBP? For that interest only we'll apply this concept. If it is already disallowed under PGBP, forget about that because that is disallowed even already under PGBP. Allowed under PGBP, and this section again disallows some interest. This section also disallows interest. But if it is already disallowed by PGBP, that disallowed only. Now whatever is allowed, take. In that interest also, this section again disallows a part. So original interest paid 2 crores in our example. TDS non-deducted for how much? 50 lakhs. That 50 lakhs is disallowed by where? PGBP provisions only. So now 50 lakhs already disallowed. So forget about that. How much interest is there now? 1.5. In that 1.5 also, this section disallows again a part. Okay. So first case is what? Who has given loan? Non-resident. To whom given? Indian company or PE of a foreign company in India. Okay, both these two entities are what? Associate enterprises. What are the conditions? This Indian entity or PE of foreign company, borrowing company is paying interest to the non-resident associate enterprise. The interest payable is how much? More than or equal to 1 crore. Interest must be deductible while computing PGBP. Now next one, sir, see. Sir, a non-resident company given debt to whom? Indian company or PE of foreign company. But the point is these two are not associate enterprises. The one who given debt is not an associate enterprises, but there is some other enterprise which guaranteed to the non-resident borrower, non-resident lender. So, sir, let's take like A, B, C. A, C are associates. A is not giving loan directly. A is acting as a guarantor for C's loan with B. Now, since A is acting as a guarantor, B foreign company is giving loan to C Indian company or associate enterprise or PE of Indian company. Understand, sir? Nothing but this lender is not giving loan normally. Just because your associate enterprise is acting as guarantor or depositing equivalent money with the foreign lender, that's why lender is giving loan. Okay, so to get this loan, who is helping? Associate enterprise is helping. To get the loan, sir, this borrower need loan. From whom? This foreign company. In generally, this foreign company is not giving any loan. But because your associate enterprise is helping, how it helps? By giving guarantee or by depositing equal money, it is giving guarantee to the non-resident company, non-resident lender. That's why this lender is giving debt to the Indian borrower. So technically, these two are not associate enterprises, but still we call them as what? Associate enterprises only. And then here also, thin capitalization is applicable. So loan need not to be given directly by associate enterprise. Some third party given loan. But because of what? Because associate enterprise is acting as a guarantor or associate enterprise is depositing money. That's why lender is giving me loan. In such case also thin capitalization is applicable. So thin capitalization applicable for the direct loans from associate enterprise or indirect loans from associate enterprise. This is an indirect loan. Instead of associate enterprise directly giving, it deposits money with some other person. That person will offer the loan to associate enterprise. Understand, sir, everybody? Here also same. Interest expenditure same as above points. Interest should be more than 1 crore. This borrower should have been incurred expenditure like interest or similar nature to non-resident. Third one, first it should have been deductible under or allowable under PGBP. Now, what is called excess interest? Here, how much is disallowed here? Sir, forget about the disallowed in PGBP. Bring which is allowed under PGBP. In our example, first paid how much? 2 crores. 50 lakhs non-TDS. So 50 lakhs already disallowed. How much interest still allowable? 1.5. That 1.5 bring here. Okay, within that 1.5 also, total interest paid or payable to associate enterprise in excess of 30% of EBI TDA or actual, whichever is lower, cannot be claimed as deduction. So nothing but in simple, sir. If you paid in excess of 30% of EBI TDA, that excess of 30% of EBI TDA will become disallowed. What is called EBI TDA? Earnings before interest, tax, depreciation and amortization. So you want earnings before interest, tax, depreciation and amortization. On that 30% calculate. If interest you allowing is within 30%, no problem. If interest allowable is in excess of 30%, then such excess of 30% will be disallowed. Okay. So then carry forward of excess interest. So look at this example. Year 0, EBI TDA 30 crores. Actual interest is how much? 10 crores. So, sir, how much is allowed? 10 crores allowed. How much is EBI TDA into 30%? 9 crores. So in excess of 9 crores, how much is there? So 1 crore is what? Disallowed. So 10 crores minus 30% of 30 crores, which equals to 1 crore. So how do we calculate excess interest? See, total interest paid or payable to associate enterprise in excess of 30%. So total 10 crores minus 30% of EBI TDA, na how much? 9 crores. So how much here? 1 crore. And actually is how much? 10 crores. Out of these two, which is lower? 1 crore. So 1 crore is what? Disallowed. 1 crore is disallowed. So see here, 10 crores minus 30% of 30 crores equals to 1 crore. Actual 10 crores. Out of these two, whichever is lower, not higher, whichever is lower, na 1 crore. So this 1 crore is what? Disallowed. Okay. So this 1 crore which is disallowed is there, na? This we call it as excess interest. And this disallowed 1 crore can be carried forwarded. So what we can do by carry forwarding? Let's say in next year, EBI TDA is 35 crores. Whereas actual interest is again 30 crores. In next year, how much interest allowed, sir? 10.35 crores into 30%. How much? But actual interest is only how much? 10 crores only, right? So you have still limit, but you don't have interest. Now what you can bring, what you can do? Last year disallowed is there, right? How much? 1 crore. That you can bring to current year and adjust. So current year, how much you can pay, sir? 35 into 30%. It is how much? 10.5. Already adjusted 10. How much is their balance? 50 lakhs. Last year disallowed is how much? 1 crore. That 1 crore bring here and adjust to the extent of 50 lakhs. So current year interest claimed is how much? 10.5. Current year 10. Last year disallowed 1 crore related 50. Total you claimed in current year is how much? 1.5. Understood, sir? So see what they are saying. Excess interest, nothing. Because 10 crore actually is within 30% of 35 crores. No disallowed interest. So carry forward interest 1 crore is eligible for set off. But how much is eligible? To what extent? 30% of EBA TDA 10.5 minus current year interest 10 crores. How much is excess surplus? 0.5. To the extent of 0.5, we can set off the carry forward interest also. So in previous year 25-26, the interest deduction is total 10.5. How? Even though actually paid 10 crores, you can claim here how much? 10.5 crores. The balance 50 lakhs. Sir, after adjusting from this 1 crore, we adjusted only how much? 50 lakhs. Balance how much is there still? 50 lakhs. That balance 50 lakhs can be carried forwarded for another 7 years. So overall, the interest disallowed can be carried forwarded for 8 years. Here, already first year done. That's why it can be carried forwarded for another 7 years. Understood, sir? Now, exceptions. When 94B is not applicable. This concept of 94B is not applicable to Indian company, PE of foreign company, which is involved in banking, insurance, NBFC. The one taking loan is a bank, NBFC, or financial company. Both banking business they are into. For them, thin capitalization is not applicable. Or it is a finance company located in IFSC. Sir, we are talking about whom? Borrower. Borrower is a banking, insurance company, NBFC. Then this concept is not applicable. Or borrower is a finance company located in IFSC. Then also not applicable. Third one, if lender is a PE of foreign bank. Lender is what? PE of foreign bank in India. So nothing but SBI is there. SBI has a permanent establishment in USA. SBI also, sir, when foreign bank can do business in India, Indian bank also can do business in foreign country, right? So when SBI has a branch in USA, then at SBI branch, what we call? PE of Indian bank in foreign country. Permanent establishment of Indian bank in foreign country. Such SBI USA is giving us loan. SBI USA is giving loan. So lender is a PE. Okay, sorry, sir, not that one. Lender is what? Sorry, wrong example, sir. Lender is what? Lender is a PE of foreign bank in India. So our lender is not outside India. Our lender is where? In India only. Sir, there is something called Dutch bank. Dutch bank, or else you can see like Swiss bank don't have branch here. Dutch bank, then JP Morgan, then what are the other foreign banks? We want multinational banks, not Indian banks. IDBI India only. IDFC also India only. Kotak also Indian bank only. Okay, Dutch bank is one thing is there. HSBC, Standard Chartered Bank, Citibank, DBS Bank, Dutch Bank, Barclays, Bank of America, JP Morgan, BNB, Bank of China, Emirates, Qatar National Bank, Doha Bank, Mashreq Bank. So all these are foreign banks which are having PEs in India, their branches in India. So you took loan from what? This foreign bank PE in India. Sir, when you are taking from bank, right, it's like a normal loan. Even though you both are associate enterprises, when you are taking from a bank, foreign bank which is having a PE in India, then thin capitalization is not applicable. First, 3 cases. First, the borrower itself is a bank, insurance company, NBFC, or a finance company located in IFSC. Then thin capitalization is not applicable. Third case, borrower normal person only, but lender is whom? Lender is a PE of foreign bank located in India. Lender is a PE of foreign bank located in India. In such case also, thin capitalization is not applicable. 3 cases. Okay. So last attempt, sir, students have studied everything. They didn't have studied properly these exceptions. The question is linked to these exceptions. Okay, the question is linked to these exceptions. So in thin capitalization, hardly 2 pages theory. Every line, every sentence is important only. Okay. Indian company or PE of foreign company involved in what? Banking, insurance and NBFC. Finance company located in IFSC and lender is a PE of foreign bank in India. So what is the total concept, sir? Borrower should be what? Indian company or PE of foreign company. Debt taken from whom? Non-resident associate enterprise or non-resident other than associate enterprise also, but associate enterprise is backing. How it's backing? Associate enterprise is acting as a guarantor. Associate enterprise which is in foreign country is acting as a guarantor, or it deposits equivalent amount with the lender. That's why lender giving you loan. In such case, thin capitalization is applicable. To apply these provisions, interest payable in a previous year should be more than 1 crore. And then first they should have claimed expense of interest or any other thing of similar nature. And that interest which is already allowed under PGBP only, here we'll consider for restrictions. How much interest is disallowed? In excess of 30% of EBITDA or actual interest, whichever is lower. In excess of 30% of EBITDA or actual interest, whichever is lower. If something is disallowed, such a disallowed interest here under 94B can be carried forward for 8 years. When it can be set off? If in the next year, the actual interest allowed is within 30% of EBITDA, then the difference between actual interest and 30% of EBITDA, to that extent, the last year's disallowed interest can be set off. Understand, sir? Okay. Which are the exceptions? Exceptions means in these cases, thin capitalization is not applicable. What are those? Indian company or PE of foreign company involved in banking, insurance and NBFC. Finance company is located in IFSC, or lender is a PE of foreign company, foreign bank in India. Okay, so come to workbook. Dear Limited, an Indian company borrowed how much, sir? 120 crores from Shine Incorporation at an interest rate of what? Sir, Shine is lender. How much given? 120 crores. Deer is what? Indian company. Okay, has to pay interest how much? 8% per annum. Okay, the said loan is repayable in 8 years. The loan was guaranteed by Tiger. Sir, Shine and Deer are not what? Associate enterprises. Not associate. But Tiger Incorporation has given what? Guarantee. And this Tiger and Deer are what? Associate enterprises. See how the namings has given. Tiger and Deer, how they can be associates in general. In general. Okay, so but here Tiger and Deer are what? Associate enterprises. Now, sir, how we can say Tiger and Deer are associate? Because Tiger has 33% shareholding. Okay, and also deposited matching amount of loan with Shine. That's why Shine has given loan to Deer. For the year end 31st March, Deer has net profit of how much, sir? 5 crores. Net profit 5 crores. Okay, after debiting interest on the above loan, 9 crores. Provision for income tax 3 crores. Depreciation 5 crores. Amortization 2 crores. Sir, we want what? EBITDA. EBITDA means what? Net profit is what? PAT. We need what? EBITDA. So what and all has to be added? First PAT to PBT. What we have to add? Tax. So 3 crores add. Then earnings before interest. Add back interest 9 crores. Then earnings before interest, tax, depreciation and amortization. Even add 5 crores depreciation and 2 crores amortization also. So to 5 crores what we have to add? Add back plus 9 crores plus 3 crores plus 5 crores plus 2 crores. So total how much, sir? EBITDA. How much? So 24 crores is the EBITDA. How much is the interest allowed, sir? 30% of 24 or actual. Actual is 9. 30% of 24 is how much? Sir, excess of 30. Okay, 9 minus 30% of 24. 9 minus 30% of 24 is how much? 7 point. 30% of 24 is 7.2. So 9 minus 7.2 is how much? 1.8 or 9. Whichever is lower is a disallowed. Sir, what is called excess interest? Excess interest is disallowed. What is called excess interest? Actual total interest minus 30% of EBITDA or actual interest, whichever is lower is called as excess interest. So here excess is how much? 9 is the total. Minus 30% of EBITDA if you do 7.2, how much here? 1.8 or actual 9, whichever is lower na 1.8. So here 1.8 crores is the excess interest to be disallowed. Okay. So now we need to recompute the profit now. We need to recompute the profit. Sir, again, what is the net EBITDA? EBITDA is how much? 24 crores. Oh, out of 24 crores now, how much interest is allowed? 7.2 allowed. 1.8 disallowed. So 7.2 allowed. So interest 7.2. Sir, then we should subtract depreciation and amortization, not a provision for tax. Why? Because we want only PBT now. On PBT we need to calculate tax. So depreciation is how much? 5 crores. Amortization is 3 crores. If you subtract, what is the profit before tax? 24 minus 7.2 minus 8. How much? Okay, 2 na? Okay, sorry, 2 only. So 14.2 if you subtract, how much? 9.8 crores is the PBT now on which tax has to be computed. See, disallowed is how much? 1.8. Since 9 crore only debited, sir, here if you see, sir, one more point here. On 120 crore if you charge 8%, how much? And 120 crores if you calculate 8%, how much? But we took how much as interest? 9 only. That means even though actual interest 9.6, we are assuming like what? Only 9 crores is allowed under PGBP. That's why we are considering only 9 crores. Look at the note, sir. So this note is not given in the material actually. We have added what? Since 9 crore only debited to P&L, How can we say 9 crore only debited to P&L? Because they said like net profit 5 crores is after debiting 9 crores. That's why since 9 crore is only debited to P&L, assumed only 9 crore allowed under PGBP, even though actual interest is 9.6 crores. So we will take only 9 crores here. How much ever is allowed under PGBP only has to be taken here, not the originally paid interest. Okay, because the other 60 anyhow is allowed. Why we need to again check here? Are you able to understand, sir? Even though they paid 9.6, 60 already disallowed. So we need not to disallow it once again. So from the 9, we need to check if anything is disallowed. Thin capitalization, question number 28, sir. No. Netra is a resident Indian company having registered office in Hyderabad. 1st April, it borrowed how much? 25 crores from Z Limited, incorporated in UK, which is the holding company. Sir, from holding company only taken loan. Associate enterprises. Interest rate is how much? 10.5. There were no other borrowings. Net profit is how much, sir? 347.5. After debiting interest on borrowed funds, depreciation is how much? 80 lakhs, add back. Provision for income tax is how much? 70 lakhs, add back. Amortization expense, 20 lakhs given na? Add back. Sir, interest, did they given anything actual? No. So what we'll do, we'll calculate the interest and we'll add back that only. If they given separately, that separately amount only we have to add back instead of actual percentage related. So how much here? 25 into 10.5. 25 crores into 10.5 percentage. Lakhs. In lakhs it is needed. 262.5. 2.62 only is right, you said. Sir, simply in crores also you tell. I can convert into lakhs. 2 point. Sir, 25 crores into 10.5%. How much? 2 crores means 200 lakhs. Plus 62 lakh 50. So total 262.5 crores. Okay, so add 262.5 also. How much is the EBI TDA? 347.5. Add 80. Add 70. Add 20. Add 262.5. 780 is what? EBI TDA. Oh, how much is allowed? Sorry, we don't want how much is allowed. We want only excess interest. Excess interest is how much? The original interest is how much, sir? 262.5 minus 30% of 780. 30% of 780 is how much? 234. So 262.5 minus 234. 28.5 or 262.5, whichever is lower. So lower is how much? 28.5. So the excess interest is how much? 28.5. How much is allowed? 234 is allowed. The excess interest is how much? 28.5. So amount of interest liable for disallowance is how much? 28.5. The next question, sir. Question number 29. Sakshita Madurai is engaged in providing what? IT-enabled services. Sir, this is a June 25 question. The following is the extract from statement of P&L for the year ended 31st March. Net profit after tax is how much? 180. So we should add back what? Depreciation 60. Interest to associate enterprise 1, 90. Associate enterprise 2, 250. Interest to others, 100. Amortization 20. Provision for taxation 80. Add back all of them. How much? 780 is what? EBI TDA. Yes or no, sir? Till this point, no doubt, right? We are adding back what? Depreciation, interest, the 3 interest, amortization, provision, everything we have added back. We got EBI TDA. Now, excess interest. But the point is, sir, this interest disallowance is applicable only for associate enterprises, others also, na? Associate. So for this, we need not to calculate any disallowance. Only with interest to AE1 and interest to AE2. How much is the interest paid to AE1? When 94B applies? More than 1 crore. So here it is within 1 crore. So in first case, we will not apply thin capitalization. So no excess interest to be calculated. Then for second case, interest to associate enterprise. So see, sir, calculation by C. Interest to associate enterprise 1 less than 100 lakhs, hence it is eligible for deduction without any restriction. Interest to associate enterprise 2 is how much? 250. So it has a restriction. So what we have to do? Maximum is how much? 30% of EBI TDA. Sorry, actual minus 30% of EBI TDA. Actual how much? 250 minus 30% of EBI TDA is how much? 230, which equals to 16. Or actually is how much? 250. Lower is disallowed. So what is the lower? 16 lakhs is disallowed. 16 lakhs is disallowed. Disallowance will arise only when the interest to AE is more than 1 crore. Hence, no adjustment is required to AE1. So now see, sir. How much is the interest allowable as deduction? With respect to associate enterprise 1, it is within 90. So no restriction, 90 lakhs allowed. With respect to AE2, actually paid 250. But 16 lakhs is excess interest not disallowed. How much is allowed? 234 allowed. Others, no restriction. How much is allowed? 100 allowed. So total interest allowed is how much? 424 lakhs. Understand, sir? The disallowed 16 lakhs is eligible for carry forward to subsequent 8 assessment years and will be allowed as deduction while computing PGBP to the extent it is allowable under 94B.